open with President Draupadi Murmu addressing a joint sitting of both the houses. Hello, good morning. You've tuned into CNBC-TV18. You're watching Power Breakfast with me, Vinny Motiwala. In terms of the markets, what we have from the US markets, a bit of a mixed session, but Asian markets, let's look at how they have opened up in the trading session today. Most of them have opened up on the green side. So whether you look at the Taiwan index, the Hang Seng, the Kospi, that's the South Korean index, all of them are managing to hold on to gains. Now, what's not holding on to gains or is muted is the ASX 200, that's the Australian index, that's down almost 0.2%. Nikkei, that's down 0.5 to 0.6%. So the Japanese index is seeing some bit of a pressure. So bit of a mixed opening is what the Asian markets have seen, but Indian markets, we're again hoping for a positive start today. Nifty implied open is indicating a 26-point uptick as of now for the Indian market. So we'll watch out for where this is headed in terms of the session now. And as of now, a bit of a positive start, a mild positive start for the Indian markets. But that's the setup in terms of the Asian markets. How is all this going to be impacting our Indian markets? What are the important cues that you should be keeping an eye out on, important stocks to watch out for in the trading session? We have a team of research joining in with us as well. But first up, I'm going to take you all through the market setup for today. What are the important cues from the domestic front that we are keeping an eye out on? Now, do not forget, yesterday, the market did see a recovery coming in. It was a bit of a volatile session that we saw, but we did see a recovery there. Nifty managed to close at the 25,150 levels. Nifty Bank, that saw an outperformance coming in as well. A lot of bank earnings that came in. So yes, we had Sensex, Nifty Bank, all of them managing to close on with some gains. But what came in from the FII front? FIIs continued to be sellers. 3,000 approximately crores of sell coming in from FIIs, while DIIs were buyers of 9,000 crores. So that trend, something has continued. Now, today, in terms of important events or cues that we're keeping an eye out on, we have the listing of Shadowfax Technologies. It was a bit of a muted, show that they got in so far. So let's wait out for the listing that will come in today as well. Maybe a muted show is what we could see, but key to watch out for in terms of listing. Now, important earnings today. We have L&T that will be reporting its numbers from the infra side. So we'll watch out for that. We have Maruti, ACC. Then we do have the defense side, some of the names like BEL, GRSE, Cochin Shipyard, those shipbuilder names. GE Vernova TND on the cap good space will be reporting numbers expected to do well versus other peers. M&M Financials, SBI Cards, TVS Motors, among some of the names that we are keeping an eye out on in terms of earnings. Also, do not forget, obviously, we'll have the India's December industrial production data that will come in on the macro front. We have the budget session that starts today in the Parliament. So key to watch out for that. Obviously, budget is on 1st of Feb this Sunday. So more updates we'll watch out for there. Yesterday, obviously, we had that conclusion of the India-EU FTA. Important update there. Key in terms of today's trading session will continue to be that as well. And obviously, there's going to be a press conference today by Commerce Minister Piyush Goyal, who will be addressing the press on this EU-India FTA as well. So key updates there is something that we'll keep an eye out on. But what is it that we're keeping an eye out on in the world of F&O? That's what we'll go across to Mangalam to get that update. Mangalam, yesterday you had highlighted in the morning itself that, maybe a volatile but range-bound session, and that's what it seemed like. Though we ended at the day's high, today what are we keeping an eye out on?
Well, today it is the start of a new series, so we call it Hello February. February in the past has, seen big moves, mostly on the downside, but when it moves up, it moves big. FY24, Feb 2024, it was a near 630-point up move that we saw. Feb 2021, it was a 1300-point up move that we saw. But by and large, we've seen about 2 to 3% sort of down moves in February. But after a big gash that we saw in January, where the Nifty lost about 763 points, the question is whether we see some positive moves in February or not. The rollovers, the Jan-Feb rollovers have been at around 71% versus an average of 72%. Mildly below. That's because some of the shorts have, ended their position and longs have carried some of their positions going forward. So that's the trend on the rollovers. FII long exposure at the start of February series is 12%. It's not terribly short, but obviously it is not, extremely long either. The start of Jan series, the FIIs were 9% long. The start of Feb series, they're 12% long. And over the last 6 or 7 series, they've been between this 8 to 20% sort of long exposure, and that seems to have become a bit of a norm. The FI net exposure is 1.75 lakh contracts on the short side. The clients, they are long. So over the last many months that the FIs are shorts, it's the clients, which are the HNIs, etc., they are long. Their net contracts a little over 1.2 lakh and long exposure at 72.5% as well. The important part, February series is laced with a lot of triggers. So if one of those plays out in favor of the bulls or more of them, then there will be a massive wave of short covering, and we can expect the big move that we saw in Feb 2021 or Feb 2024 on the way up. Why do I say that? Because you have the union budget, you have the RBI policy, remainder of the third quarter earnings, and any sort of update coming in on the trade deal between India and US. Now that India and EU are done, any update on India and US will be a very, very big positive. So 3 out of the 4 important triggers for the market, mostly likely to be positive. So that, with the FI short positioning, indicates that maybe Feb, the market could be in for a bit of a boom.
Okay, we'll keep an eye out on that. Thanks so much for that, Mangalam. But let's move on to Ria, who is here to tell us which are the important stocks that we should be keeping on our radar. Good morning, Ria.
Well, good morning. Let's start off with Marico first, which has reported its quarter 3 numbers. Quite a good set coming in here. The revenue has come in at 3,537 crores, which is above the estimates that we were working with. Domestic volume growth has also come in at 8% versus estimates of 7 to 8% growth. So good set for Marico. For Vodafone Idea, the loss has come in this time around at 5,286 crores, slightly narrowing compared to quarter 2 of this year. Revenue has been largely stable, going up just around 1%, and ARPU has come in at 186 crores versus 173 crores compared on a year-on-year basis. For Metro Brands, the net profit has seen an increase of roughly 35% on a year-on-year basis, boosted by lower tax expenses largely. And the revenue has also seen an increase of roughly 15.5% for this one. For Motilal Oswal Financial Services, the net profit has been stable at 566 odd crores this time around. Revenue has seen an increase of 6% on a year-on-year basis, largely led by the wealth and the asset management business of the company. For Vishal Megamart, for quarter 3 of this year, the revenue has seen an increase of roughly 17%. The adjusted same-store sales growth has stood at 9.6% in this quarter, and the festive season shift has led to the lower reported growth this time around for the company. Next up, Vedanta will also be in focus today. They are going to offload 6.7 crore shares in Hindustan Zinc, which will be worth roughly 4,590 crores. The floor price for this deal has been set at 685 rupees per share, and the OFS will open between the 28th to 29th of Jan.
Ria, thank you so much for the update there. We'll keep an eye out on all those stocks in the trading session. On that note, we're going to slip into a very short break. After the break, we'll get to the key developments from the White House in a special segment, Trump Watch. Stay tuned in. Welcome back to Power Breakfast on CNBC TV18. And in the US markets, what we saw was that Wall Street ended mixed on a Tuesday. The S&P 500 that touched a new intraday high, driven by the strength that we saw coming in for big tech names, while investors looked ahead for key earnings as well as the Federal Reserve's first interest rate decision of the year that is due tonight. Now, the Nasdaq also climbed almost 1%, while the Dow Jones underperformed to end 400 points lower in the red. Now, we have CNBC's Seema Modi, who's joining us to give us a wrap on what happened on Wall Street.
U.S. markets were mixed across the major indexes in Tuesday trade, with the Dow falling sharply and the S&P hitting a new all-time high. The Dow losing 409 points, the S&P 500 adding 28, and the tech-heavy Nasdaq gaining 216. While tech giants boosted the Nasdaq and the S&P, shares of major health insurers were sharply lower Tuesday. The Dow falling almost 1% Tuesday after the Trump administration proposed keeping steady the rates that Medicare pays insurers. The administration proposed an increase of 0.09%, far below the 4 to 6% increase that Wall Street anticipated. United Health and Humana falling about 20% in today's trade, while CVS Health saw its shares decline by 14%. TikTok settling with a plaintiff Tuesday and will no longer be part of a high-profile trial over social media. Snapchat's parent company reached a similar settlement last week. The trial will now continue against Meta Platforms and Alphabet's YouTube. It's the first of several legal cases against social media platforms. This case involves allegations that the way social media and streaming video apps are designed has harmed mental health of young people and left them addicted to the services. Both companies deny the allegations. That's what's happening here in the U.S. Back over to you in Mumbai.
Thank you so much for that. Now, all eyes obviously on the Federal Reserve decision that's tonight, and a CNBC survey suggests no rate cut this time around, but predicts 2 cuts this year. CNBC's Steve Leisman is joining us with the findings of the CNBC Fed survey.
Yeah, the Fed expected to keep rates unchanged today and not cut until June. Just 2 cuts priced into this year. That may reflect a better outlook for growth. Still, only modest gains are forecast by respondents for the stock market this year. With yesterday's close at 69.50, it's seeing up to 72.50, a 4% gain, and then just another, or a total of 10% by the end of 2027 to 76.53. 73% of our 36 respondents say stocks are overpriced in some way or another. Looking at the economic backdrop this year, you can see some pretty good strength from the consumers. It says 30% believe the consumer will be stronger this year, 42% about the same. That's good news because the consumer was stronger last year. But a big change in business investment, probably linked to the tax bill. 68% say stronger business investment, with 15% saying it's about the same. Another plus out there, behind the U.S., basically, majority of tariffs say the tariff impact is behind the U.S. 28% say it's ahead of it, and 14% don't know. The impact would be a 0.3 percentage point change in the consumer price index. Still, tariffs are seen having a negative economic effect. 71% say it's bad for growth. 88% say it will lower retail margins. 68% say it's bad for employment. And 80% say it means higher inflation. Uncertainty around the administration policies is the #1 risk out there. The AI bubble, Trump, the president's efforts to limit the Fed's independence, continued high inflation, and tariffs round out the list of the biggest risks to the economy. Douglas Gordon from Russell Investments sums it all up, all these tensions out there, saying there's certainly no shortage of potential exogenous risk sources to capital markets. This comes, however, against a backdrop of seemingly waning tariff impact, good enough labor data, elevated but not worrisome inflation, and perhaps most importantly, still robust earnings. So the outlook for monetary policy and the economy looks like it's going to hinge on this tension between positive aspects of the tax bill versus potential drag from tariffs, and whether there's still more in the way of tariffs to come, guys.
Okay, now here's some insights from former Fed officials Loretta Masters as well as Richard Fisher on the Federal Reserve and its upcoming decision.
Yeah, for sure, the Fed's going to stand pat. There's no rationale for doing another cut. You know, they've cut 75 basis points. They took out the insurance on the softness in the labor market. Now's a good time to watch and wait. Inflation's still elevated. And, you know, there's no urgency to do one thing or another. So standing pat now just makes a lot of sense to me.
I think they'll be non-committal. They'll leave the door open. again, we still have to. I thought Walter did a good job, Walter Isaacson, just now, in pointing out a sort of evaporating sense of confidence in the Labor Department data. See, and I think they're going to just wait and see. There's no need if the economy is doing as well as the Trump administration said it's doing, then I don't think there's any need to proceed, and particularly if inflation won't come down below 2.8 or almost under 3%. So I think they'll just hold it easy and leave the door open for something in the future.
Now, getting you the latest on Trump-related developments, President Trump believes that the dollar has not excessively weakened, and in fact, the weakness is a good thing. Trump went on to add that he would like the currency to seek its own levels, which would be a fair thing to do, but also hinted that he could manipulate the currency the way he liked it. Quoting him, "I could have it go up or down like a yo-yo," he said, and listen in to furthermore on his comments.
With the current value of the dollar, do you think it's declined too much?
No, I think it's great. I mean, the value of the dollar, look at the business we're doing. No, dollar's doing great.
You want to see it decline?
You know, it's very interesting. If you look at China and Japan, I used to fight like hell with them because they always wanted to devalue their yen. You know that? The yen and the yuan. And they'd always want to devalue it. They devalue. And I said, not fair that you devalue because it's hard to compete when they devalue. But they always fought, no, our dollar's very good.
Now, moving on, as the White House awaits a Supreme Court decision on its tariff policies, Trump at an event in Iowa signaled that he would forge ahead with a campaign of heavy import taxes regardless of the ruling. One way or another, we are going to do it, is what he said. If we have to do it a different way, he will do it. Also, at the same event, he reiterated that he will select a new Fed chair for the U.S. Central Bank very soon. And he said that once they have a great Fed chairman, which he will announce pretty soon, U.S. will see rate cuts come down, and so rates will move down further as well. Moving on, President Donald Trump warned Iraq's largest political bloc against tapping the former prime minister to return to office, saying that the U.S. would no longer help the nation if he was back in power. Lastly, we have Syrian President Assad, who spoke with U.S. President Donald Trump over the phone, according to Bloomberg. Now, what Bloomberg also said that Trump welcomed the ceasefire agreement in Syria and stated that the U.S. is ready to back reconstruction efforts there in Syria. The leaders also discussed the transition phase in Syria as well. Now, that's all we have in today's edition of Trump Watch. Up next, we're going to come back with more in terms of commodities. Stay tuned for that, but a short break right now. Welcome back to Power Breakfast on CNBC-TV18. Let's go across now to Manisha Gupta, who's here to tell us what are the key updates in the world of commodities this morning. Good morning, Manisha.
Morning, and thank you for that. Well, I'll start with gold right now because we are trading at a record highs yet again. Overnight has been a 3% gain, and after that, gold has hit a record high at around $5,180 an ounce. But we have seen a gain 20% in this year. Also in both markets. You also have crude prices, which gained 2%. It's trading at a 15-week highs. The kind of severe winter storm that we've seen in US and Canada has led the prices on the higher side. What hasn't done so well in the overnight markets has been copper. That has declined 2%, and that is because you have seen rising inventories in China, in US, and LME as well, and that is weighing onto the markets.
Okay, Manisha, thank you so much for that. Surely we'll keep an eye out on the metal space, gold, copper, all of that on our radar. But let's move on. And L&T, that's set to report its Q3 earnings today. We have Vivek joining in with us with the expectations from L&T. Good morning, Vivek.
Well, good morning. India's largest capital goods and infra company will deliver its Q3 results today. It's expected to be a steady operational quarter, but there will be a lot of questions that we will be asking the management in the media call that they will host today evening. Revenue seen higher by close to 14% on a year-on-year basis. EBITDA seen higher by a little over 17%. Margins seen expanding marginally on year-on-year as well as on a sequential basis, and profitability seen higher by 30%. Now, what does BofA Securities say in terms of the expectations? They say that order announcements in the third quarter so far, at least the ones that the company has announced to the exchanges, have been slightly soft. They're saying total disclosures are a little over 35,000 crore. They expect the ex-services order inflow higher by 11% on a year-on-year basis. Let's do a quick guidance check as far as L&T is concerned. The company had given guidance at the start of the year. So when you're looking at the top line of the revenues, they mentioned they expect to see close to 15% growth. At the end of H1, they were at 13% growth. And the management said that they are on track to meet the guidance. In terms of the core margins at the start of the year, given a guidance of close to 8.5%, 7.7% currently, they said margin expansion is still a work in progress. And as far as the order inflow guidance is concerned, they had given a 10% order inflow guidance. So at the end of H1, tracking very strong 39%. Most likely, L&T could go ahead and exceed the order inflow guidance. Two key questions that we will be asking the management. Number one, in terms of the Middle East, whether there are any order inflow worries, especially as far as the Kuwait orders are concerned. And lastly, whether any tweaking the guidance is concerned.
Okay, Vivek, thank you so much for that. Important to watch out for L&T's numbers today. But let's move on budget session. That's going to be a start today with President's address to the joint sitting of both the houses. Meanwhile, the government has listed 9 pending bills, including insolvency and bankruptcy code. The government will table the union budget on 1st of February, which is Sunday. The government convened an all-party meeting last evening to discuss ways to ensure smooth functioning of the two houses. Opposition parties questioned the government for not sharing the legislative agenda for the session. Parliamentary Affairs Minister Rijuju said that agenda would be shared later. The first phase of the budget session kicks off tomorrow. Okay. With that, we're absolutely out of time on this edition of Power Breakfast. Thank you so much for tuning in. Up next, your Bazaar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, hi. Good morning.
Hi, good morning. Yesterday it was heartening to see the markets recover from the day's low. But we've got another expiry to contend with tomorrow and so many earnings. 4 Nifty companies report their earnings today and many from the F&O, non-Nifty companies.
Well, that's right. After a while, we saw green on the screen and it was good to see, and bright green as well. After a while, we ended at the high point of the day, but obviously that was an expiry-related move. Let's hope that we're in for better times in this series.
Absolutely, Nigel. And I think, yesterday we were 4 days away. Today we are 3 days away from the union budget, right? And I want to just start with that point. I'll get to the global stuff, etc. in just a bit. But, the basic idea was that, this is a market which is heavily short and FII positioning, and Nigel will put out the data in terms of F&O positioning in just a bit. But, as when we came in yesterday, FPI shorts and index futures were at an all-time high. You were going into a big event 4 days out. So will they be covering? And I think I'm starting with something similar today. It's just that it's not 4 days, but 3 days, right? So more room for more positioning-led rally as we begin this session and over the next couple of days. I think there is room that the market is able to do it. Let's see. The budget may not offer too much, but we'll only be wiser in hindsight. Going into the budget, and everybody will say, well, it doesn't matter and this and that, but it's a big one. So you will need to be prepared for that if you're trading and if you're sort of heavily on one side of the trade. Now I'll start with the global stuff, right? Massive slump in the broader dollar. The dollar index was down 1.16% last night, and we are sub 97, 96 point something on your screen. This is big, and again, something I highlighted yesterday as well, which is, on Monday when we were not trading, the dollar had fallen sharply against majors, against Asian emerging market forex, and that kind of continued last night in the US session as well. And the reasons, of course, are a few, but basically President Trump once again saying that he's not concerned with the decline in the dollar. Actually, his exact quote is, dollar is doing great, right? And so in a way, explicitly green-lighting the decline that we've seen in the dollar. They want lower dollar, lower rates. That's well known. It was one of the first few things which we knew when President Trump and, of course, this new administration took charge. The rupee recovered yesterday as the dollar has been weak. I think, and that rupee recovery allowed equities to breathe a little bit as well. I think it's quite important. It was up 19 paise. We ended at about 91.71 against the USD. I just want to point out just one thing, right? The 10-year GSEC, and this is something which is a little perplexing, that actually yesterday closed at a new all-time high. We are at 6.71. So, is this something with regards to the budget? Is the bond market getting a sense that the government is going to expand the fiscal a little bit, do a little bit of deficit spending? Is it something else? But I think this bears watching. This is negative equity. And you don't want yields to head higher if other things start to cool off a little bit, but something we will pay attention to and talk more about. US equities hit new all-time highs, S&P 0.4% higher, NASDAQ 0.91. Anyway, they were about 1-3% away from all-time highs, even with these corrections in the recent past. Oil prices, a sharp move. 3% higher, 67.5 is where Brent oil prices are now at. Precious metals, the rally continues, and what a move, right? Silver, 8.5%. I'm looking at spot prices last night. So 8.5% and 3% on gold, respectively. So, silver ETFs, gold ETFs here in India, of course, racing ahead to try and keep pace with the move in that sense. Consumer confidence in the US that fell to the lowest since 2014. Perhaps another reason why the dollar perhaps was a little bit on the back foot last night. And of course, US is proposing holding payments to private Medicare plans at the same level it was last year. Expectation was that it'll go up 4-5%. It's actually absolutely almost no change. So there are companies here, companies like Sagility, IKS, etc., which we will need to watch out for, and we'll try and speak to some of them as we go along. Big earnings later tonight, which have the ability to move markets. Meta, Microsoft, Tesla will report. There is a Fed decision that is tonight, which we will react to tomorrow morning. But in all likelihood, the Fed is expected to hold rates and leave rates absolutely unchanged. The big headline, whenever that comes, and it's expected this week, is, the announcement of who will be the new Fed chair. I'll just tie in the levels. Nifty, if this bounces to continue, by the way, yesterday we almost got to the 21st January low, which was 24,919, and then from there we saw a very sharp bounce. And I think it's possible we head to 25,440, which is the upper end of this falling channel on the index. Hopefully that's another 250, 300 points away from here. But let's see if you're able to do it. We can maybe show you a graph as well, which kind of puts that channel pictorially much more powerful in that way. Bank Nifty saw a sharp bounce in the last 1 hour, and here the 20-day moving average is nearby now with yesterday's bounce, which is 59,516. So that's the overall picture. GIFT Nifty will give you a quick sense of how we're likely to start, and then we'll pick it up from there. 14, 15 points higher is where we're at. As I said, positioning and where we stand there. Nigel has walked across to the wall. Nigel, over to you.
Well, yesterday was a relief rally that we saw, and it was good to see. In terms of volumes, it was rather high yesterday. And if you look at the cash market flows, well, the FIs, they were net sellers, close to the tune of around 3,000 crores, while the DIs were net buyers. But, the highlight yesterday was that the gross volumes were much higher, telling you that there was an expiry-related factor that did play out. So the expiry day went to the bulls, the January series went to the bears. And in January series itself, the Nifty was down close to around 3%. But keep in mind, the Nifty Bank was the outperformer because that was as flat as can be. Which brings us to the rollover picture. Market-wide rollovers, Nifty rollovers, in line with what we've seen on an average for the last 3 series. But the Nifty Bank, the rollovers out there were relatively lower. Because for the last 3 series, it was ballpark around 75 to around 76. Now, that, in fact, has come down to around 71%. So it appears some of the shorts didn't roll over their positions. Because remember, this market is net short. If we're looking at the total open interest, the Nifty futures open interest, well, it is heavier at the start of the series. If you compare it with the previous 2 series, definitely the open interest is higher because you've got plenty of queues coming up in the February series itself. What about positioning? Similar to what we have seen in the past. The FIs, well, in percentage terms, they are net short, while the clients, they are net long on the index itself. But in absolute terms, that's what's telling you the story, because the FI net short positions is much higher in comparison to the past. And keep in mind, we had a regrouping with regard to the contract size. So the FI net short positions are aggressive at 1.7 lakh contracts short, while the clients, they remain net long as well. Going to the options data, the 25,000 call as well as put, they were fairly active. If someone is writing these strikes, well, and playing out a short straddle out there, then they're pocketing close to around 550 rupees, and they're hoping that the Nifty stays in this 1,000-point band. But otherwise, if you just look at the data points and you punch in the options data, the premium out there, for example, the 25,000 call, premium's around 400 rupees or thereabouts. So the resistance that will come in at around this 25,450 or thereabouts. While on the downside, the 24,900 mark, we've gone there a couple of times and we've bounced off that. So you'll be fancying your chances if you get a dip towards that 24,900 odd. The big cues to track in the February series, we're going to be having the Union Budget in the next few days. Earnings continue to trickle in, and big central bank meets where they talk about the RBI, FOMC, or even the ECB. So interesting times. We're a good close to the past series. February is giving some hope that maybe we could extend by a couple of 100 points on the upside even from here. And the Nifty Bank will have to play the all-important role.
Thank you very much for that. As I said, it's an action-packed day. 4 Nifty companies, L&T, Maruti, BEL, SBI Life report their numbers, and then many F&O companies like TVS Motors, SBI Cards also reporting their earnings today in the Parliament. The budget session officially kicks off. Tomorrow is the economic survey, and then, of course, followed by the budget on Sunday. And globally, eyes will be on the FOMC decision and big tech earnings like Microsoft, Meta, and Tesla. But let's also tell our viewers, okay, before let's invite Mark Franklin, Deputy Head of Multi-Asset Solutions Asia at Manulife Investments, on the show now. Thank you very much for joining in. Well, yesterday, the landmark deal between India and EU got announced. While it's been long in the making, it was also seen as a bit of a strategic hedge against the tariff policies by the US. What do you think the US reaction to the India-EU deal is going to be? So far, we haven't heard anything from Donald Trump.
I think the reaction would be quite limited, to be perfectly honest with you. It's not as if the Trump administration doesn't have other things to focus on, both from a tariff and industrial perspective, but also from a geopolitical perspective. But indeed, this is one of the implications of a more assertive, abrasive approach to trade relationships espoused by the US administration, is that other countries will seek the comfort from more entrenched bilateral agreements, which ease trade barriers that had been in place hitherto. And in fact, India and the European Union historically have been some of the strongest proponents for tariff and non-tariff barriers to restrict imports across various industries into their economies. And so at the margin, this is an easing, but wouldn't necessarily signal a broad-based rethink around trade relationships.
And Frank, it's been one of the worst starts for the Indian equity market start to the year in terms of the month of January. What is your view of the prolonged outflows that continue India's underperformance, and what are you all doing to your portfolio to hedge against this?
It's a corollary of two factors. The first factor is for foreign international investors, institutional investors. They've been quite attracted to some very powerful cyclical stories, both in the Asia region and more globally. So if you look at markets such as Korea and Taiwan, have performed very powerfully off the back of a very, very strong semiconductor, and in the case of Korea, memory chip cycle. And then more globally as well, the broader EM complex, sectors such as industrials, catalyzing investor flows in recent months. For domestic investors in India, one of the challenges for equities is the powerful rally in precious metals such as gold and silver. And there's been some signs of very strong retail demand for wealth diversification into those assets, which has come at the expense of flows into the domestic Indian equity market. From a portfolio positioning point of view, we've been quite cautiously positioned on India for a while, not out of any sense of heightened risk, more from the perspective of opportunity cost. So if we see a reversal in flows and price momentum for those other asset classes and those other regional markets, India may see a renewed bid. And indeed, the fundamentals do screen quite well for us. But at the same time, sentiment and technical factors remain very subdued. And so we need a sign of an inflection point there.
Got that. You know, Mark, morning. Do you think we see a continued large move on the dollar on the downside? Possible?
Well, we've seen quite a rapid move in the last 1 week or so, not only against the yen, but also other currencies as well. I would highlight two things. One is zoom out. What is the Trump administration trying to achieve over the next 2 to 3 years? It wants to try to rebalance global trade so that the US's current account deficit falls dramatically, and you see an industrial renaissance in the US via reshoring and more self-sufficiency across a number of verticals. For that to happen, you need a weaker dollar, because up until now, US domestic production has been uncompetitive from a pricing point of view. So a weaker dollar helps to address that. But then on a short-term perspective, we are somewhat oversold in the US dollar, and investor positioning is very skewed short as well. So it's not necessarily the case that this straight line depreciation in the US dollar necessarily continues day after day after day. You might see technical reversals. But if you then zoom out, as I said, the fundamental objectives suggest that the dollar could weaken further, but we have moved quite a pace already.
All right, let's talk about the near term then, Mark. What are you expecting from the Fed tonight, in terms of a rate decision? And the last time we chatted, you were talking about a probable hawkish cut that we saw last time around. That came about. But for this year, if I look at, the dot plot, it's suggesting around 2 25 basis point rate cuts. Do you believe that will come about?
Well, what's been quite interesting is that those rate cuts that are still priced in the market have been pushed firmly into the second half of this year. And consequently, assuming there isn't a complete curveball thrown by Chair Powell, this meeting, in theory, should have less sensitivity for rates markets, because even if they signal a pause here, even if it's perceived as a hawkish or a dovish pause, the rate pricing for the second half of the year is less affected. It was only going to be more effective if there were still rate cuts sort of hanging around in the first half of this year. Now, if you look at the data progression since the last meeting, it's clear that the jobs market continues to moderate in the US, but that moderation hasn't accelerated. But on the contrary, some economic data points have actually surprised to the upside as well, whereas inflation data has been broadly in line. So our view would be that the guidance and the interpretation of the data will be largely unchanged. The X factor could be what's been going on from a political interference perspective, and the extent to which Chair Powell uses this meeting as an opportunity to re-cement the Fed's independent stance within the policy-making establishment. But absent that, if he sticks to the script and focuses on data and their mandate, one would expect this meeting to be less of an eventful impact for markets than prior meetings.
We leave it there, Mark. Thank you very much for joining us. Good to get that perspective from you, and talk to you soon again. Appreciate it. What we're going to do is just run you through what's coming up here on the program in the next 2.5 hours. So interactions which are lined up. So 8:35, we've got the management of SBFC Finance to talk about the third quarter numbers. Stock fell sharply. Asim Sru is going to be with us. 9 o'clock, we have BNP Paribas' Kumar Rakesh to discuss the India-EU FTA impact on a variety of sectors. Sanjeev Prasad of Kotak Institutional Equities is a market master of the day. 9:30, the management of CG Power talks to us about the numbers which have come through. The management of Vishal Megamart will be speaking with us at 9:40. So that's an interesting conversation. Later on, we speak with Helios Capital's Samir Arora. He's our budget editor. Budget's 3 days out, and what is Samir got on his mind in terms of expectations? And towards the end of the program, Lata in conversation on why bond markets are sulking. I mean, that point that I made about yields rising, and this is right ahead of the budget. So Abhishek Upadhyay and Suyash Chaudhary with us in a bit.
Time to slip into a break. We've got a lot of stock-specific action to track for you today. We'll get to that in just a bit. For the time being, I'll just run you through the list. Vedanta, Marico, Metro Brands, Pikachi Food, Motilal Oswal Financial Services. They all will be reacting to positive news. So add to the list Titagarh Rail Systems and ABB India. On the flip side, Hindustan Zinc, Vodafone Idea, Vishal Megamart react to negative news. So take that break, come back. We get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call, and it's time now to talk about individual stocks. Our entire research team is standing by with CNBC TV18's list of top stocks for the day. But Nigel, the big one is you. Silver prices continue to rise, and the promoter of Hindustan Zinc is looking to do an offer for sale.
Well, you know, Rima, when we covered the Hindustan Zinc's numbers, when we spoke to the management, there was only one thing on the radar. When will the promoter take some money off the table? You know, because in the past, they've done it at around 500 rupees, and now the stock is close to around 700 rupees. So definitely that temptation was there. And that's what they've done. Late last evening, Hindustan Zinc, they came out, and there was a disclosure on the exchanges that its promoter, Vedanta Limited, that holds close to around 61.8% stake in Hindustan Zinc, they are going to be looking at selling close to around a total of around 6.7 crore shares, which is around 1.59% stake in the company. The initial offer will be for around 3.35 crore shares with an option to sell another 3.35. You know, so that's how you get the total number of around 6.7 crore shares. For non-retail, well, the issue will open today, while for retail, it'll be tomorrow. That's January 29th. The big question is, what does Vedanta Limited get? You know, at the base price, they get roughly around 4,600 crores rupees. They can use that for debt repayment, for their capex, and to pay out dividend as well. And in that, the promoter entity will gain the most because they have the highest proportion in Vedanta Limited. What is attractive in Hindustan Zinc as of now, and why do the promoters choose to do something like this? Because it's the only listed silver play here in India. Silver now contributes close to around 45% of the EBIT. Remember, a few years ago, it was around 27%. And if I go back, you know, even more, 10 years or so ago, it was only around 10-12%. Valuations are high at around 11 times EV upon EBITDA. But I'll tell you what, most brokerages are, not yet factored in silver pricing at anywhere close to around $80, $90, or even $100 an ounce. They're in that ballpark of around $60 to around $65. So Vedanta green, while Hindustan Zinc will open up in the red. Let's focus on Marico, though. That came out with a set of numbers. Manglam, over to you.
It's a good set, as the street was expecting for Marico. If you look at the revenues, 3,537 crores. The street was working with a number of 3,520 crores. EBITDA just shy of 600 crores again, similar to our poll. And margins at 16.7%, bang in line with expectations. Net profit as well, a little over 450 crores. But don't be, looking at just these numbers. If you look at it year on year, it's a very solid set. 27% revenue growth, 11% EBITDA growth. That translated into a 13% net profit growth as well. Domestic volume growth at 8%, again, at the higher end of street expectations of 7 to 8%. And more importantly, the management commentary as well. Foods, they say, will continue to compound at 25%. Digital brands will see their improvement in the operational performance. So double-digit EBITDA margin is what they are targeting for next financial year. They want to take the digital brands from close to around 1,000 crores right now to about 2,000 to 2,500 crores in the next 3 years. And they are targeting double-digit revenue growth in the medium term with operating margin, which looks like it will improve as well, as copra prices, the key raw material, is down 30% from the peak. All these factors should take Marico higher, been an outperformer in the FMCG space.
Thank you very much, Mangalam, for that. Well, let's just talk about Vodafone Idea now. Rima, take us through it.
Well, it's a mixed quarter. So on the top line, the company's revenues went up by 1.1% on a quarter-on-quarter basis. EBITDA margins expanded to 42.5%. At the bottom line, you can see the reported loss has come down. It now stands at less than 5,300 crore versus more than 5,500 crore. But that is aided by an exceptional profit. If you strip that out, the adjusted loss is higher on a sequential basis. Internals are mixed. So average revenue per user on a blended basis has gone up by 3% to 172. That is good. But the company continues to lose subscribers. The loss in subscribers in the current quarter at 3.8 million on a sequential basis is the most that we've seen in the last many quarters. So all in all, it's an okay set of, it's a mixed quarter. And on AGR, since the relief from the government came in only in January, and these are numbers till December, the company, as of now at least, has not changed any sort of, any P&L adjustments on account of AGR. So that's Vodafone Idea for you, largely mixed. But back to Mangalam, because there are a lot more consumer numbers. Metro Brands, BKG Foods and Vishal Mega Mart.
A bunch of them. Let's start with Metro Brands. A decent performance coming in, led by festive season demand, supported by the GST reduction on footwear above 2,000 rupees as well, or rather under 2,000 rupees. Margins show steady improvement. The net profit, however, looks like a big jump, a 37% jump. That's because of lower tax expense. So tax expense, same time last quarter was 65 crores, now is around 42 crores. So 15% revenue growth, 17% EBITDA growth, net profit grew by 37%. They opened 35 new stores during the quarter. E-commerce, that saw a growth of 24%, and they will launch a couple of new Fila exclusive brand outlets in this quarter. So all these factors doing well. Metro, I'm looking at it from a green side. Bikaji as well, decent performance, massive jump in EBITDA, because remember, same time last year, palm oil prices were through the roof, and now they have come off considerably from the highs, and as a result of which, on an 8% revenue growth, the company's EBITDA has jumped 72%. Margins have grown from 8% all the way up to 13%, and that's led to the net profit near doubling. Their volume growth at 8.4% as well is a positive. Vishal Mega Mart, now you would say that 17% growth is good, but remember, the company before listing was doing about 25+% growth. So the growth rate has slowed down, and the festive season shift has led to lower reported growth. Remember, first 9 months of this year, they've grown at around 20%, but the third quarter, it's 17%. EBITDA has done well, 20% growth out there. The net profit also has grown about 20%. The company said that 2.1% was the impact due to Durga Puja dates falling in the earlier quarter, and adjusted SSSG stood at near 10%. They too have added about 29 stores during this quarter, and just because the revenue growth has softened, especially as compared to the pre-IPO period, I expect some red on the stock.
Okay, well, interesting ones in Vishal Mega Mart, of course, you will see coming up in about an hour and a half or so. Mangalam, thanks very much for that. Motilal Oswal reported numbers as well. Ria has got details on this one. Ria, over to you.
Well, yes, Motilal Oswal has reported quite a good set of numbers in this quarter. The revenue has gone up by roughly 14%, and this has largely been led by the wealth and asset management business of the company. The EBITDA margin has also improved to 52.7% versus 46.3%, and this has been aided by operating leverage. The net gain on fair value change has also seen a recovery this time, but this is still much lower compared to the Q1 highs of roughly 1,068 crores. Looking at the segment-wise performance of the company as well, again, the wealth and asset management business and the home finance business has seen improved profitability this time around with better margins. Although in the capital market segment, which is institutional equities and IB, that segment has seen a decrease of roughly 18% on a sequential basis, with margin pressure also seen in this segment. But overall, good set of numbers for the company, which is why the stock is expected to open in the green today.
Thank you very much for that. Vinny is here with us to tell us more about Titagarh Rail and ABB India.
Hi, good morning. So, yes, Titagarh Rail, ABB India, both of them have partnered now. And this is mainly for 25 kilowatt driverless metro propulsion as well as tech transfer that they will be working on. The time period for this order is 3 to 4 years. And now, obviously, ABB is going to provide propulsion as well as TCMS orders for Titagarh, and this is going to be for 40 transit sets, train sets, as well as each of the 6 racks of Mumbai Metro Line 5 as well as Line 6. Do not forget, Titagarh had won orders of around 2,400 crores for Metro Line as well as around 1,500 crores to 600 crores for Metro Line 6, 5 and 6. So there's a good order win. Now, they've not mentioned the size, but still this will become a sizable order for ABB because propulsion systems account to around 35 to 40% of the cost of these entire train sets. And over and above that, there will be TCMS, which would come in for ABB as well. For Titagarh, what does this mean? Now, it will help them manufacture advanced driverless metro components locally, and obviously this will support the contract that they've received from that Mumbai Metro Line 5 and 6 as well. So positive for both these companies. We could see some green here today.
Thank you very much for that. Let's do a quick recap then. Stocks with positive news flow are Vedanta, Marico, Metro Brands, Bikaji Foods, Motilal Oswal Financial, Titagarh Rail, ABB India. Stocks with negative news flow are Hindustan Zinc, Vodafone Idea, Vishal Mega Mart. But lots happening in the world of commodities. Dollar index has slipped to a 4-year low, and that is pushing up commodities around the world, whether it's crude, gold, silver. Manisha is here for a complete roundup. Manisha.
Thank you for that. Well, absolutely. Everything seems to be running on the higher side right now. You have the gold prices trading at a record highs. We've seen $51.80 an ounce onto that one. It has been a 3% of gain in the gold prices in the overnight market. When you look at the silver prices, well, we have seen 8% of gains into this one as well. There is the debasement trade at play. But apart from that, there's a lot of retail, ETF, central bank buying, which also seems to be supporting gold and silver, both of those commodities. But not just that, as you said, it's the crude oil prices as well. We've seen 2% of gains in that. It's trading at a 15-week highs right now, especially with the very harsh winter that we're looking at in US and Canada. and the fact that the U.S. output over the weekend was lost by nearly 15% has been supportive for the crude oil prices. The only thing that is not doing so well is copper prices, down 2% overnight, and that is because you're looking at inventories gaining not just in U.S. but in LME and on Shanghai exchanges as well, and that seems to be taking some profit off on that.
Manisha, thanks very much. It's a busy time, right? And a little bit of partying in Goa, Manisha?
Oh, not at all, Prashant. One, there is no network here, and plus there is just so much work.
I know.
Voice tells us something else. I thought it's a scratchy throat because you were partying.
No, I mean, and Manisha is, of course, sending us a fair bit of stuff from the Energy Week, which is underway, and we'll play out, portions of it with top energy and oil leaders from across the world, and of course, India as well. Manisha, thank you very much, and see you back in town soon. So that's commodities in focus. We take a quick commercial break here. We've got the management of SBFC Finance joining us to talk about their third quarter results and, of course, the management rejig, which took place as well. Welcome back. Our first corporate conversation is with the management of SBFC, and the stock intraday should come up on your screen. They, of course, reported numbers, but there was also a top management rejig. So Mr. Asim Zru, founder, MD, CEO of SBFC, of course, is stepping away from his role. He's going to be taking up the role of non-executive and non-independent director and vice chairman from the 1st of April. Mahesh Dayani, will take over the role as managing director and CEO. Remember, Mr. Dhru and Mr. Dayani started SBFC together, and in that sense, Mr. Dhru steps away and Mahesh now sort of steps in. Mr. Dhru, great to have you with us here. Good morning. Thanks very much for joining us. Prashant, this side. We'll get to more reasons, etc., in a bit in terms of why the changes happen and the numbers, numbers as well. But I just wanted clarity from you. What is your you are stepping away, Mahesh is stepping up. Are you really stepping away? Is this like a exit route from SBFC? I guess that is what markets were worried about yesterday.
No, so Prashant, thank you. When you start a company, it's your baby, and there is no stepping away from parenthood. As the baby grows, there could be change in role as a parent, but there is no stepping away from the responsibilities and the love that you have for the child. So I would like to clarify that this is not an intention in any way to move away from SBFC. I'm going to be as involved as part of what I used to do. The thought process behind this is the following: that the final test of a CEO is a succession. And for me, that was easier because Mahesh and I started SBFC together from day one in terms of laying the blueprint of the company to everything that we have gone through. And to that extent, when the company has been co-built, and he's done, frankly, quite a lot of heavy lifting, while I've got unnecessary credit, for it. So the idea is that succession has always been a test in financial services, and the thought process is that I want to be associated with the company, walking with the company to ensure that the succession is smooth. Because generally, when you hand over and walk away, things tend to get wobbly. So I want to assure you that I'm as responsible to deliver on all the promises made to investors, and I will be there on the con calls, accountable and taking responsibility for what we have done.
Right.
We wanted to do this last year, but last year was a year where there were a lot of wobbliness in the environment, and the Karnataka ordinance had come in, the numbers had shaken. Now that things have calmed down, things are in control, and we have a good visibility of the quarters ahead, I thought that this is as good time as any to do this.
So you're very much going to be part of the decision-making process at SBFC. I mean, the role, as you, I think, alluded to, the role of a CEO, especially in a financial services firm, is even more important than, I guess, in other kinds of companies, non-financial companies. And the market always, of course, has the highest regard for you in terms of someone who has that credibility. But you're saying that you're going to be there very much in a decision-making, overseeing, day-to-day kind of hands-on capacity.
So see, what I've seen is that while we have done a lot of things right in terms of delivering on the numbers that we had promised, and the company's results are speaking for itself, one of the softer things is culture in the organization and how that gets built out. And as the CEO, as the MD, you are so focused on delivering the quarter that sometimes you believe and you wonder whether you are doing justice to the decade. And while the idea is that while Mahesh focuses on delivering the quarter, I help work with him, go down, travel, meet branches, build the right culture down the branches to ensure that we are able to deliver the decade as well. So from, you can continue to hold me responsible for everything that doesn't go right with SBFC. This is not walking away into the sunset. It is a different kind of a structure that we have chosen that usually, people retire and walk away. That is not the intention, and that is not, I think, the right way to do it. We are doing it a little more thoughtfully, and the numbers, hopefully, in the quarters ahead will speak for itself. But in terms of accountability, nothing changes. In terms of responsibility, I will be more responsible for the strategy and for the larger, longer term strategy of the company. And as accountable and as usual, everything that doesn't go wrong, the buck will stop here.
Hi, morning. So you will be 100% committed in terms of your time and effort to SBFC, even in the non-executive role, or will you on the side also look at something else in terms of a professional commitment?
No, so at the moment, there is no thought of doing anything different from SBFC because SBFC needs, at least I believe it does. It needs me to be fully involved, and also see the real test is a year from now to see whether the transition has been rightly affected. So the test of whatever you do comes a year later, you get the results. So I continue to be committed to building SBFC out with Mahesh, and that is how it has been from day one. We have built it together. It is just that I got more visibility in that role. But to answer your question, no, we don't intend to. I don't intend to look at anything different right now. We may, as a Claremont group, start other businesses in financial services, and to that extent, I would be involved in mentoring those as well.
Okay, hi Azim, good morning and good to see you again. Since you've clarified your stance with regard to your position in the company and that you'll be held accountable as well, let's focus on a few numbers. The AUM growth, I think, has been close to the high 20s. If you could help us out, what's the outlook on the AUM growth? And what is the gold contribution in this AUM book? Because a lot of excitement with regard to gold, and gold financiers in turn, they are viewing this as an opportunity. So give us those details.
So see, we believe that growth should be moderated based on the culture of the firm. And if you may have a Ferrari, but the roads are Indian, and if you drive beyond a particular speed, the probability of losing control increases. So after due consideration, right from the time we went IPO, we had guided that 5 to 7% quarter on quarter is what we believe, what we can digest as a growth, as a culture within the firm. And if you notice all these quarters, it has been within that guided range. So nothing changes for the next quarter. Also, we are guiding the same 5 to 7% quarter on quarter growth. And in terms of gold, for us, gold has been a good supplementary business that helps us manage the ALM as well, because we are long-term lenders on the other side. So gold, we had guided that will be below 20% of our overall AUM, and at the moment it is at 19%. So a couple of percentage points here there, but gold will remain within this range. We are not too bullish, on gold, in the long run, because the tonnage in the industry is not going up. It is just a value-driven growth. And unless your thesis is that gold will continue to keep growing, top line at this pace, it is not a very great business, we believe, to scale beyond what we are doing right now. So nothing changes in our stance. We are happy with the way gold prices have gone.
Yes.
But everything is temporary. In fact, risks are building in the system and things can move the other way. So we are actually now more focused on ensuring that our LTV is not very high. So at a total portfolio level, our LTV is about 55%. And we intend to keep it here rather than go to 75-80%, so that in case there is a price fluctuation, we are protected.
All right, Azim, you took me into another space when you spoke about that Ferrari, but need to come back down to the numbers then. The ROAs have been healthy at around 4.6%. What's the outlook? Is this sustainable out here? And also, if you could tell us out with regard to NIMs, there was a marginal dip of around 10 to 15 basis points in the past quarter. Now, we're bracing, hopeful that we get another RBI rate cut. If that's the case, how do you see your NIMs pan out?
So what we have always been very cognizant of is to ensure that our spreads remain constant, and we don't see any contraction in the spreads of the business. So if our cost of funds comes down to some extent, if you notice this quarter, our cost of funds and lending rates have moved in the same direction. So both about 20-25 basis points reduction. So we are focused on ensuring that our spreads remain constant. And in today's time and age, post ILFS, it became very clear that you cannot build a business relying on high leverage. So we have to build a business that delivers high ROA. And so far, we have ensured that even as our leverage has kept increasing slowly, although we are still very, very slightly levered at a debt equity under 2. So to that extent, we still have a long way to go. As we increase leverage, obviously the ROAs will contract a little. But nothing material and from where we are. So we intend to hopefully preserve the ROAs with a few basis point deterioration as the leverage goes up.
Well put, Asim, and we continue to, I hope we continue to have these chats regularly. Maybe one after the budget, because you've got a keen eye on sort of macros and the bigger numbers, apart from SBFC as well. So wish you all the best of luck. And, I love that line. If you might be driving a Ferrari, but you're driving it on Indian roads. So you've got to be mindful to moderate things accordingly. Thank you and appreciate it.
Thank you so much. All right.
Well, we'll take a quick commercial break here. Devin Choksi of DR Choksi FinServe with some fundamental stock conversation in just a bit. 20 minutes away from the pre-open.
Welcome back. Well, let's get in Hormuz, who joins us normally to tell us about all those stocks that moved around on large volumes, and some of them were backed by delivery. Morning, Hormuz.
Good morning, Nigel. And we've been talking about smaller private banks for quite a while now, and Karur Vysya Bank was that addition to that list in yesterday's session. Gains of almost 10% that we saw yesterday. It was the third straight day of gains for the stock. It was the biggest single day gain since February of 2021. And in these last three sessions, the volumes have been consistently on the rise for Karur Vysya Bank. What started off with around 30 lakh shares last week went up to as much as 5.5 crore shares in yesterday's trading session. Volumes were the highest since September of 2021 for Karur Vysya Bank yesterday. Those 5.5 crore shares traded compared to a 20-day average of just 36 lakh shares. And out of those 5.5 crore shares, over 1.2 crore shares were marked for delivery, the 20-day average being just over 15 lakh shares. And the stock made a record high yesterday, close to 300 rupees, has risen almost 60% in the last 12 months. Mahindra & Mahindra on the downside yesterday, among the top losers on the Nifty, as the biggest single day fall in volume since February of last year, and it has declined in 5 out of the last 6 sessions now, has Mahindra & Mahindra. In yesterday's session, over 70 lakh shares were traded, 20-day average of just 15 lakh shares. The delivery-based selling worth over 1,400 crores that took place in M&M yesterday, and out of those 72 lakh shares traded, 42 lakh shares were marked for delivery, the 20-day average being just around 9 lakh shares. And from its 52-week high, which is close to around 4,000 rupees, the stock is down almost 12% from those levels. And lastly, a stock that has been on a bit of a losing spree is Syngene. And yesterday's session also the stock fell almost 10%, in addition to the 8% fall that you saw last Friday as well. But that's not the story. The bigger story is that the stock has been down for 9 sessions in a row now. And the last instance of the stock declining 9 sessions was back in April and May of 2024. And the volumes yesterday were the biggest since April of last year. 63 lakh shares traded yesterday, the 20-day average being just around 8 lakh shares. And out of those 63 lakh shares, 16 lakh shares were marked for delivery, the 20-day average being around 3.5 lakh shares. And the stock, as a result of this fall, is down to a 5-year low now, the lowest levels since August of 2020.
Thanks very much, Hormuz, for that. So that's the picture as far as the movers from yesterday go. Devin Chokshi is with us. Devin, good morning. Good to have you with us here. Thanks for joining in. Simple question. Can we see some more this positioning, more than anything, positioning-led rally ahead of the, I dare say, big event? Because many are, when I say big event, many start by saying, well, it's not a big event. Importance of budget is falling and all of that. But it's an event, right? Nevertheless, and I mean, if the government so wishes, it can do enough in that to be meaningful for markets. So, what's your sense? More positioning-driven move possible here?
Yeah, Prashant. Good morning. Well, on expectation lines, yes, I think there should be some position taken. If at all, I think the short position should get covered. I think that is what one is expecting. Maybe some part of the yesterday's volume in the derivative market rollover, much lower, is suggesting so. Now, I think having said that, I think I would like to think how exactly the budget can pull in more amount of investors. Probably, I think the issue out here would be how we exactly attract new capital into the country. And this time around, I think more of a FDI capital vis-a-vis, I think the FPI capital as we are talking about. So that at least I think the larger part of the fall in the rupee currency, I think would probably find stability or it could to get arrested. So from that point of view, I think one is definitely keenly looking at expectations from the budget as to what are the triggers that will probably drive the inflow of currency into the country to prevent the fall in the rupee value. Otherwise, I think on the whole, corporate earnings sector definitely is becoming more and more promising for most of the investors. Currently, the environment looks, I think, quite comfortable for companies to grow in the fourth quarter as well and beyond thereafter. So I think we believe that sooner than later, if the fall in the rupee value stops, maybe you will see the market stabilizing with budget or without budget. I guess I think that is more important.
Okay, all right. Hi, Devin. Good morning. Good to see you in. Devin, I remember even on bad days, you were, reasonably positive on Vedanta. They seem to be doing the right thing yet again. Hindustan Zinc has gone through the roof, 3 lakh crore market capitalization. The promoter entity is saying, let's take 1.5% away from the market. So that's why they're going to be raising roughly around 4,500 crores. That's good news because it deleverages Vedanta's balance sheet. It also could be used for capex or even give out dividends. Your view on Vedanta from here on, and given that this OFS that Hindustan Zinc is, is going to be open today, the stock is going to pull back. Do you think it's an entry opportunity?
Yeah, Nigel, good morning. Not too sure whether I think one would call it as an entry opportunity, but yes, I think the basic momentum with the metal price rally that we have seen is continuing from Vedanta, and I think it's likely to remain so. The demerger definitely is a good trigger that we have always been talking about, and that's where probably I think 750 price was expected. We are almost in that direction, maybe. Yes, I think the deleveraging of the balance sheet is an important factor, and they are sensibly probably taking out some money from the assets like Hindustan Zinc because I think it is giving a fantastic opportunity today. In my viewpoint, I think I would probably stay invested in this particular opportunity. The merger is definitely giving much more better promise for the growth as far as I think the Vedanta is concerned. Maybe I think some units, I think after the demerger, we may not want to hold it, but otherwise, I think by and large, the white metal is something which one would like to continue holding it as far as the portfolio in Vedanta is concerned.
Yeah. No, absolutely. And I think what a move, right, in some of these precious metals, etc. So, markets, of course, have re-rated some of the underlying names as well. Not very many with exposure here, but I mean, the ones where there is exposure, things have gone well. You know, Devin, we reported yesterday that Axis Bank was up 4.5%, 5% yesterday. My colleague reported that Axis Bank may be looking to buy out the promoters of Credit Access, the MFI company. They're evaluating and they may place a bid. Just to be absolutely clear. Now, source-based information. I don't know if you have any thoughts at all, Devin, on this.
No, honestly, Prashant, I think not seen with a very great detail and how exactly the needle can be moved. I think with the MFI business, I think taken into the portfolio of Axis Bank. One will have to see, I think, what kind of integration strategy they want to evolve hereafter. If at all, I think they end up buying Credit Access. But not sure at this point of time as to how exactly it will reflect into the larger book of Axis Bank.
Okay. Got that. You know, just to go back to the commodity question, right? Another equity way to play commodities is the exchange itself, which is MCX. Do you have a view? Do you own it? Any thoughts?
Yep, I think you are right. One could possibly argue for the stock exchange business, and I think we continue to hold it. So that is the disclaimer anyway. But I think more important part here is that I think whether you would like to buy the argument that exchange business, I think becomes more favorable with the commodity business, like I think metal commodity in particular, bullion commodity. I think for which I think we want to take a complete bet on the exchange business. The answer would purely be no, because I think that could be, I think, quite a volatile kind of a situation in between. But on the whole, I think the overall approach on the commodity side of the business of MCX, that convinces me that yes, I think the volume is going to be gradually there. So, an increasing rather. So, I think we remain confident about the prospects going forward, but not just the argument because of the bullion commodity currently, which is in favor at this point of time.
Yeah, yeah. The EU-India FTA and you know the implications out of that. So I mean, yesterday, of course, the top Nifty loser was Mahindra, which was down about 4.5% by close. This morning, there are a few. I mean, there are of course implications, and this will be slowly understood. And just to make it clear, it's not happening now. The actual operationalization is only going to be in early 2027. So there is time. But analysts are also pointing out to the Alcobev sector and Alcobev space and saying, well, you know, this will meaningfully increase competitive intensity for Indian players, Indian listed players. Any thoughts on these segments, autos and Alcobev, or anything else you think needs to be pointed out?
Practically, Prashant, I think I feel it's an opportunity for auto segment. In fact, I think in the auto segment, contrary to the view that most of the global automobiles, I think, will become cheaper, I think it is unlikely to be a case. I don't think that I think they're going to be cheaper because today also, if you look at, I think, the likes of Mercedes or BMW, which are the premium category of vehicles, around 90% plus kind of components are domestically sourced and manufactured. About 10% are still imported. And I think it's not going to be substantially bringing down the price of vehicles beyond a point, even though the duty structure comes down on the 10% of the component that they are sourcing. So in my viewpoint, I think the vehicle prices are not going to come down, and neither I think the demand for the Indian vehicles. On the contrary, I feel that I think the export-oriented business, I think possibly will find better legs going forward. So let's wait and see how the details comes out. But I think per se in the auto, given the space in which Tata and Mahindra are operating or even Maruti is operating, I think they have reasonably good chance to remain at that level and maybe grow further.
Any implications, Devin, for auto ancillary companies on the back of the India-EU FTA?
I think excellent prospects emerging, Rima, out of this particular agreement that is being signed. And yes, I think as Prashant said, I think it will take time to roll out many of these initiatives. Maybe corporates, I think, will work together with the counterparts in Europe, and they will probably, I think, decide how exactly which products they want to source from India, etc. But I believe that I think the prospects are only brighter and not otherwise. We remain extremely convinced about the companies which are having the advanced infotainment systems or even the ADAS systems as a product category within their basket. I think those kind of companies reasonably hold a very good chance for, I think, some integration with some of the European majors going forward.
Okay, Devin, we'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate it very much here on CNBC TV18. We'll take a quick commercial break. We'll come back with the pre-open rates. We also have Kumar Rakesh of BNP Paribas, and we'll talk exactly about that, the India-EU FTA impact across sectors, autos in focus, and also trade. Sudarshan and Mitesh join in for some technical trading ideas. I mean, yesterday we got a bounce. Can we believe it? Can we build on it? So we'll ask them.
Welcome back. As promised, let's get our technical experts on the show. Sudarshan Sukhani as well as Mitesh Thakkar join us on the show. Good morning, gentlemen. Yesterday we had a good relief rally. It was an expiry-related factor that played out as well. But can the party continue? Can we extend ourselves on the upside? Mitesh, you go first. What would your take be?
Morning, Nigel. So, yesterday I had also suggested that people can take some long positions given the fact that 25,000, 24,950 should be a good support level. And while we have had two incursions below that on an intraday basis, we haven't had a closing below that. And I think that support level still continues to hold well. My initial belief was that we could go to about 25,400 broadly, give and take a few points as the target area. So that outlook still remains, that the bounce back could see a test of 25,400, 25,430 zones. And therefore, I think, if not immediately in the opening, if you get an intraday dip, I think that could be a short-term buying opportunity.
So ride the momentum, upward momentum till 25,400, at which level the markets may reverse and a shorting opportunity opens up. Sudarshan, hi, good morning. What is your Nifty Bank call for the day?
Yeah, good morning. See, the Nifty call was the same as Mitesh yesterday. Go and buy the Nifty and just wait patiently for the markets, because for the short term, they were giving signs that they are looking at a sort of a support level being formed. Now that eventually happened towards the end of the day because it was Nifty expiry. So during the day, things were different. But today the trade remains the same. Stay true to your long positions. If you don't have any, if you want to re-enter, buy on dips. You know, the good news came not from India, but it came from Korea. Korea eventually disregarded the news that was going to affect it and said, okay, forget about it. We'll do what we want. If that's going to happen the world, then the news will not affect the markets. The markets will go on their own and we will be much better off.
You know, Kospi is up 20% since the start of the year and continues to push fresh highs on the Korean markets today as well. We've got the Kospi gaining more than about 1%.
Korea, I remember, was the king last year.
Yeah.
70%.
And now it's already up 20% in the first month. But let's talk about stocks back home in India. Mitesh, what do you have for us?
I have 3 buys and a sell. On the buying side is Union Bank, which is after a big breakout has had a couple of days of pullback and still remains strong in a market which is, seen some stocks turn negative. So Union Bank is a buy with a stop at 172 for targets of 182. Ferris stocks had some kind of a breakout yesterday. So SAIL is a buy with a stop at 151.9 for a target of 164. And OFSs was a call yesterday as well. So if somebody has positions from there, I think a stop loss can be revised. But now, as a fresh entry also, the call can be taken with a stop below 79.50 for targets of 8100. And one sell call, that's MFSL. Keep a stop at 1605. Look for targets of around 1520.
Sudarshan, your stock calls?
Well, it's also mainly for the buy side. M&M Finance is a buy with a stop under 360. United Spirits, notwithstanding the agreement, is a buy with a stop under 1290. JSW Steel, which has been doing well, is a buy with a stop under 1200. My only short is Kalyan Jewelers, sell with a stop above 375. And I have an addition today, and that's a positional trade and investment idea. You could consider buying the PSU Bank Bs, which is essentially the PSU Bank ETF, for some months.
PSU Bank Bs. All right. Thanks a lot for that, Sudarshan. Well, Mitesh, I want to come across to you with regard to the biggest casualty yesterday, Mahindra and Mahindra. You know, it seems the street was fearing added competition because of the India-EU deal. We've seen this in the past. You know, I recall when Tesla came as well, the stock was down 4, 5, 6, 7% as well, in that period, and then it bounced back. On the charts, though, how is it looking? We'll get a fundamental view in just a bit. But on the charts, how is this one looking?
So, Nigel, I think, comparing this event with Tesla, I'm not a fundamental guy, but I still believe that, it could be slightly different. Secondly, I think, the stock has had some weekly average around this 3380 mark. It's just closed above that. But the indicators have nosedived, which means that the momentum is broken. My belief is that it should head towards 3200 as a minimum, but in a more severe scenario, 3070, 3050 could be a logical.
Thank you very much for that. Let's talk about the auto sector, mainly on account of the fall that we had in individual stocks like M&M, and even the entire auto index was down over 1%. Well, yesterday, the India and the EU have formalized a landmark free trade agreement, and this deal is likely to be signed later this year after it undergoes legal vetting and is ratified by the European Parliament. Now, for the auto sector, the cars which are made in India will get duty-free access to the EU once the deal comes into effect, and India would cut the tariffs on EU cars with a landing price in excess of 16 lakh to 10% eventually. We have with us Kumar Rakesh, India analyst, auto at BNP Paribas, now joining in. So Rakesh, for cars which are made, the EU car, the German cars, for example, tell us, how does the tariff and the pricing change for those which are completely built in EU and are just imported as is, what we call as the CBU, completely built units, and for those which are assembled in India, the CKDs, completely knocked down unit, because on that also there is going to be a marginal cut in the tariff structure. So for both these two, explain to us how much will the pricing come down by, and will it be material to cause incremental competition for the Indian auto OEMs?
Hi, good morning, and thank you for having me on the show. So for CB units, the current taxation is from 70% to 110% based on the price of the vehicle. And that is targeted to come down to 10% over a period of time of 5 to 10 years. That will entail anywhere close to about 50% reduction in those prices, but it will be in a gradual manner, possibly first coming down to 35% to 40%. That would imply CPU vehicles getting cheaper by about 20 odd percent. But we'll have to keep in mind that most of the vehicles sold in India are currently through CKD. And most of the vehicles which are available with the European OEMs are already selling in the country through the CKD route, which are relevant for the Indian market. So we think the vehicles which are currently selling through CKD are the real ones, which we should be focusing on. And there the price reduction can be potentially close to about 7 odd percent. Now, will that be entirely passed on to consumers? Will that be in one go? We doubt that because there would be significant headwind in terms of currency movement in the recent quarters we have seen. And these companies also have been struggling with profitability. So we think the real outcome of this would be that the profitability of these European automakers in India business improves, the viability and long-term visibility of their business improves. Consumers get more spread of products which are currently selling in Europe, not being sold in India because the volume was not that high. Importing through CBU was very expensive. That starts coming through to Indian consumers as well. But does that impact the existing Indian OEMs, which are the larger market share in India? We don't think so. We think eventually it just expands the market by giving more offerings to consumers, more at the premium end than on the mass segment.
So there will be a 7% reduction in most of the vehicles which are sold in India. But in your assessment, you don't think the European car makers will pass on the benefits to the Indian consumers by reducing prices. And therefore, the competition as of now will be minimal for the Indian auto companies. But what it does is that we will have more cars coming into the Indian market. So in that sense, more offerings for Indian consumers. Is that the correct assessment?
Largely, yes. Yeah. We think there would be some correction, but not the entire pass-through of 7%, we think, because many of these vehicles which we are talking about, the starting price would be about 25 lakh at showroom price. And hence, the propensity to spend is relatively higher. The price sensitivity is relatively less. And hence, reducing the price may not necessarily drive incremental demand. Rather, it makes more sense to improve the viability of the business in the country.
So, Kumar, hi, morning. Then what does it mean for all the anxiety for Indian car makers? Mahindra and Mahindra sold off, as we were pointing out earlier. So this is not that bad then, right?
It is not that bad. As in, I think in our view, it seems like an overreaction. We have seen similar overreactions in the past as well. You were referring to post the announcement of Tesla's entry into the country, post the UK-India free trade deal as well. What we see these deals essentially doing is expanding or helping in the premiumization of the auto industry in India, giving more offering to the Indian consumers at the premium segment. Most of the listed companies are operating at the price point below 30 lakh. And there we see relatively much lower disruption from these free trade agreements.
Okay. Point taken. The ancillary side, Kumar, I don't know if you have coverage, but if you have a view, is there any benefit? And these are all largely focused, not largely, but I mean, exports is a large part of it. Do you think this makes a difference?
So on the export side, the cost advantage is the real advantage that the Indian auto parts suppliers have over some of the European auto parts supplier. The tariff already was not significantly high on the auto part import into EU. So it marginally improves the profitability of these companies' potentially competitive advantage. But that competitive advantage is already there existing given the low cost of manufacturing, which is in India. Also, many of the companies in India also follow the localization route in which they have local plants catering to the OEMs in Europe. So that is also something which they have already been using. It wouldn't make a lot of sense to start shifting production from those local plants to India and underutilize their European. So that's the second part to that. The final part is even if this increases the exposure or revenue share from European market, I'm not too sure if investors would be really enthused by that, because the valuation multiple for Europe exposure is usually the lowest. The exposure to Indian market, or for that matter, the US market, is relatively gets high valuation multiple compared to the EU exposure. So whatever incremental revenue we can potentially see may get partly offset by the lower valuation multiple it will demand.
So just to paraphrase you, Kumar, no big benefit for auto anchs straight away, right? Because of this.
Yeah, on specific companies there could be, but in general, overall, we wouldn't expect dramatic increase in terms of exports.
You know, budget's 3 days away, Kumar. Any direct, indirect implications for the auto universe you track?
A lot of things have moved to GST. We would still want to see how the EV benefits are being taken into consideration. Some of the benefits are close to expiry, and if they are being rolled forward or not, if that is being held at the current level, those are some of the things that we would be focusing on. Also, the infrastructure spending, how that is being targeted for next year, especially for commercial vehicles, that would be something that we will be watching out for keenly.
Just one final question then. While you do like a lot of stocks like an Ashok Leyland, Mahindra, Maruti, Samvardhan, Madison, I can see that the upside to your target price is only in Ashok Leyland. So for instance, in M&M, though you do believe that the sell-off that we had was an overreaction, the target price for you is about 3,557. So not too much upside from where the stock currently is. So Ashok Leyland is the best bet in terms of risk-reward right now?
From cycle perspective, it seems like Ashok Leyland is, the CV industry is entering into an upcycle. We think there is a strong case for valuation as well as margin expansion, solid free cash flow generation. For rest of the portfolio of automotive industry, at least from the near term, there is a risk of commodity pressure impacting the margin expansion of these automotive companies, and that's where we are slightly more cautious. We are calculating about 100 basis point of margin headwind from commodities, the way it has inflated over the last couple of quarters. In January, there is incremental more increase in commodity prices. So all of that creates a near-term headwind. Eventually, it will get passed on to consumers. We think it can get absorbed in the system without any material impact on demand. Hence, we are not structurally concerned because of these commodity pressure. But from the near-term perspective, it can create margin pressure for the rest of the auto portfolio. For a commercial vehicle companies, it's in an upcycle, it usually is passed through. So they would be in a better position to pass on the commodity pressure to the fleet operators and other clients.
Thank you very much, Rakesh, for joining in and explaining all that. But back to Sudarshan for his 9:10 call.
JSW Steel is a buy with a stop under 1200.
JSW Steel. Mitesh, yours?
I'll go with the buy call on Union Bank.
Kata, thanks a lot, gentlemen. Well, let's focus on Hindustan Zinc as well as Vedanta Limited. That's because the promoter, Vedanta Limited, is looking to sell stake in Hindustan Zinc via the OFS route. The floor price that they've mentioned is around 685 rupees per share. The total issue size is around 6.7 crore shares. Remember, the non-retail investors, they can participate today, while retail investors, they can do the same tomorrow. What does Vedanta Limited get? Well, at the base price, they get approximately 4,600 crores. Now, that can be used for debt repayment, capex plans that they have, or even pay out a big dividend, which in that case, the promoter entity will gain as well because they get a large proportion of that dividend. What about the timing of this Hindustan Zinc OFS? Well, the market capitalization is at around 3 lakh crore. So the timing is actually very, very good. It's the only pure listed play in silver play in India, with silver contributing around 45% of the EBIT in this year. And remember, a few years ago, it was around 27%. And if you go back close to around 8 to 10 years, at that point of time, the silver contribution to the EBIT was approximately 12 to around 13%. Valuations as well, not very, very cheap, at around 11 times EV upon EBITDA. That's the forward EBITDA. But keep in mind, the current estimates that most sell-side analysts have, they are factoring in silver at around $60 to around $65 an ounce. And currently, silver prices are more than $100 an ounce. So that EBITDA estimate itself could be revised upwards, which in that case makes the valuations not very, very expensive, which currently we're talking about at around 11 times odd. The issue will get lapped up given the current scenario with regard to the spurt that we've seen in silver prices.
Interesting moves, right, Nigel? And, it's one of the outperformers, I think, towards the end of last year. And, of course, it's not had a bad run this year as well. Titagarh Rail is in focus, and so is ABB India. Vinny is here with details. Vinny, good morning.
Hi, good morning. So yes, both these stocks is something that we'll watch out for. Why? Because they have signed they've partnered to deliver some 25 kilowatt of driverless metro propulsions as well as Rex transfer. They'll be working on this together. It's a time period, execution time period is 3 to 4 years. Now, what does it mean for ABB? It seems like it's a sizable order. As of now, they've not mentioned the order size. But do not forget that Titagarh Rail had recently received a couple of orders. One was for Metro Line 5, which was around a 2,500 crore order for 132 coaches. The other one was a 1,600 approximately crore order for 108 coaches for Metro Line 6. So now this order, which ABB and Titagarh are tying up for, is also for Metro Line 5 and 6. So at least there'll be some part of this order that ABB will receive. Now ABB will be providing propulsion systems, which accounts to around 35 to 40% of the cost of an entire train set. So depending on that, there will be some sizable order win that comes in for ABB in terms of amount as well. What does it mean for Titagarh? It will help the company to actually advance its driverless metro components locally, as well as will support the 240 coaches contract, which I was talking about, for Metro Line 5 and 6, and in terms of execution, that starts improving for them as well.
Thanks very much, Vinny. For that, keep an eye on these two names, ABB and Titagarh. Just a quick wrap out of things we covered from the morning. So BKG Foods, Motilal Oswal Financial Services, I mean, that's seeing an uptick 4.5% higher. BKG is up 3. Titagarh Rail, when you just mentioned ABB India, of course, is the other one. Both are higher as well. Vodafone Idea, numbers 1%. Hindustan Zinc, Vedanta, of course, 3% at the end of the pre-open. Hindustan Zinc, I think, is down about 3. And there is Vishal Megamart, which is up about 0.4%. Marico, Metro Brands are some of the others, which are up there on your screens right now. So just getting into market open, and we'll start with the, big numbers. This is a large order, by the way, for Suzlon, which is coming through. Almost 250 megawatt wind order from ArcelorMittal. And we will try and speak with the management of Suzlon in short order. But that's a big one, no doubt. And the stock should react as we open up in a few seconds from now. But I mean, will the market see some more relief? See a little bit more in terms of a bounce, mostly positioning led? I mean, I think that's a bigger question that we have to wait and watch out for. I mean, the dollar weakening, substantially, I guess, provides a bit of space, especially on the currency side, at least in the near term. And will that allow equities to breathe a little bit as well? So about 1/3% higher on the Nifty, 25,250 is where we are at. The Nifty Bank is up about 0.5%, I think, 59,200 or so on the Nifty Bank. We've got the small cap index up 0.6. The mid cap index is up 0.5. I mean, there you go. 0.6 each on the mid cap and the small cap indices. The Nifty is up 0.5%, so this is good. And let's keep it that way, I guess, right? So 120 points on the Nifty, but it's early days. Yesterday, we started with a 70-point uptick, sold off 70, and then, of course, the market steadied, especially into close. But this is now closer to 25,300. So 24,440 is the upper end of the channel, which I was talking about in the morning. Let's see if we are able to push through to at least that level. Because, I mean, even the moving averages, etc., are above that. I mean, 200, 300 points above the 25, 440 kind of levels. 130 on the Nifty now, so ticking up and steady for now across the board. 2:1 is the advanced decline right out of the gates. We've got some, 20 odd names which are higher, maybe more, actually more. 30 odd names which are higher, the rest which are lower. Axis Bank is still the top gainer, like yesterday. ONGC, Bajaj Finance come up as well. On the other side, there's Asian Paint, Tata Consumer, Maruti, which are opening. So that's just the Nifty, but let's go wider. Rima.
Well, Asian Paints is the big drag today. It was a bit of a disappointing set of numbers yesterday. And two, the fact that the Indian currency is weak and crude prices have increased to $68 per barrel on Brent is also hurting sentiment. So Asian Paints is the big drag today. Citi has a sell call. Their target price is at 2,300. CLSA an underperform call, and their target price is even lower at 1,875, while HSBC has downgraded Asian Paints to a hold. So that's, clearly the stock of the day on the way down. Tata Consumer is also hurting today. So Tata Consumer has slipped close to about 2.5%. Auto generally is on the back foot today. So Maruti, Eicher Motors, Bajaj Auto, the auto index is weak in trade with a cut of about a third of a percentage point lower. Maruti down 2, Bajaj Auto down 1%. Remember, the auto analyst at BNP Paribas was telling us that just in the near term, the rise in commodity prices will impact the margins of auto companies, and in their estimate, it will be 100 basis points hit to some of these, companies. So maybe that's weighing on the sentiment. M&M, though, has managed to, at least is flat, right? After yesterday's big fall of nearly 5%, M&M isn't falling anymore. So Asian Paints, Tata Consumer weak, auto names on the back foot, and you've got HCL Tech under pressure. On the way back, Axis Bank continues to see buying, up 4% now to start trade. And if you add up yesterday's gains and today, Axis Bank is up nearly 8.5%. ONGC is on the rise. Some IT names like Wipro, TCS seeing buying. Trent is up over 1%. Power Grid is up nearly 1%. And we should pull up the companies where we are expecting numbers in the large cap space. Maruti is one, BEL, Tata Motors. So these are some companies where earnings are expected.
Well, that's right, Rima. Vedanta has opened a little bit higher, and we have Hindustan Zinc that's down. That's because of the OFS. Vedanta now up close to around 2%. Hindustan Zinc not down too much. There could be a fair bit of demand. Let's see whether or not it can end closer to the flat line by the end of today. Remember, there were some shorts in the system as well, so keep an eye out on that particular name. What else is moving in today's trading session? Well, after a while, we have some good earnings reactions. Let's pull up a few. Mahindra Logistics, stock up 7%. Good move is what we're seeing out there. IGI, that's the other stock that's in fact seeing a very, very good move in starting trade. Just take a look at Mahindra Logistics flying away. Beautiful move. Metro Brands, the other stock that's opened up, gap up. So after a while, we're seeing really, really good outsized reactions, particularly from the broader markets. MCX continues its winning ways. Remember, in January, the average turnover is around 10,000 crores. That compares with Q3 average of around 7,000 crores. So on the back of that, the street is quite gung-ho on that stock. What's not doing too life? I think Westlife Food, that stock in fact is seeing some selling pressure, at the start of today's trading session. That was a little bit low, and I think it's holding out there. Vishal Mega Mart is the other stock that's actually opened up in the red. Brent crude prices spiked up overnight, and because of that, Oil India and ONGC, both of them trading well in the green. Well, guys, a good start to trade. Some follow through after a good session yesterday.
Yeah, no, I mean, room for positioning-led move. I think that's been the, that's what we're kind of sort of hoping and working with. And the broad thesis, of course, has been a heavily short market ahead of a big event. Can it go into Friday like that, or will they be covering along the way? So I guess that is playing out. 160 now. So this is a good-looking screen, 25,350. So it's basically about 100 odd points away from a very, it's like a very sharply, not a gentle downward sloping channel, but a very steep fall, because the fall has been so sharp. The upper end of that channel is about 25,440, 100 points out from where we are at. That's it. Lots of other names are opening up, but why don't we bring in Sanjeev Prasad, who's with us, Managing Director and Co-Head Kotak Institutional Equities. Sanjeev, good morning. Great to have you with us here. Thanks very much for joining us. You've of course been advised. You've been advising caution for a while. In the middle, I guess a couple of months back, you turned a little bit more, should I say, sanguine. You moderated your caution, if I can put it that way, but cautious still. What's the view broadly, Sanjeev? A headline view on markets, if I can start with that.
From the last 3-4 months, we have been having slightly more neutral view on the market, from being very negative, as you know, from most of 24 and most of 25. The positive aspect is that it looks like earnings are stabilizing, and you can see that in the quarterly results this time around, we have not seen any major downgrades. And if anything, there could be some upside to earning number looking at where commodity prices are. Of course, that could mean negative for the downstream companies, but broadly speaking, looks like the earnings outlook is looking better, earnings are stabilizing, and FY 2027 should be a good year for earnings growth for the market as a whole. We're looking at about 17% growth for the Nifty 50 index based on reasonable recovery in several sectors where there was no growth this year, particularly banks, pharma, etc., which had, bank pretty much zero growth, the net profits. Pharma is a decline. So on the back of that, you should see a decent recovery. Having said that, the headwinds of high valuation remain, and that's been my primary concern with this market. Valuations have been way too high for most of the sectors and stocks, particularly in the consumption names, and that's where you have seen a decent amount of correction. So some froth has gone out of I would say, the tier 2, tier 3 names, but on a broad basis, valuation is still on the higher side. So I assume we will probably go through some more time correction. I mean, we have been in that mode for the last 18 months, come to think of it. The market has been in that narrow band for a fairly longish period of time. It could still struggle for some more time, supported by, I guess, the fact that earnings outlook is getting better. Domestic investment sentiment is still strong. But on the upper side, you have the cap of high valuation for the Indian market, relatively higher valuation compared to rest of Asia. And of course, the fact that India does not really have any great tech companies to offer at this point in time. So there is not so much interest in India, at least foreigners are concerned.
Sanjeev, the big question is, when will the FPI come back? At least you stop selling and then you maybe start buying. And it goes back to, many have said it's just simply earnings growth. And the earnings growth is not there. So is it, some are saying we need at least 15% kind of earnings growth. You said earnings outlook is improving. Will we see something similar? I mean, nominal GDP growth is going to be under 10%. For earnings, what's your expectation for earnings growth in 27?
Well, 26 was a bad year. In the sense, we had about 8% growth in earnings, and that's what we're looking at for FY 2026. FY 2025 was about 6% for the Nifty 50 index. So you have 2 years of, I would say, subpar growth. 27, as I was saying earlier, we are looking at about 70% growth for Nifty 50 index, so that looks a lot better. And based on whatever bottom-up work I've done, reasonably comfortable with the forecast with analysts my team is building in. You would probably see some downwards here. Broadly speaking, the growth is reasonably broad-based. So even if you see downwards in a few sectors, I'm hopeful you will still see about 15% kind of net profit growth. But having said that, the problem is that this is all factored in, right? When you're talking about FY 27 numbers, I mean, most people look at on a 1 year forward basis, right? And on a 1 year forward basis, the market is still about 20 odd times on a 1 year forward basis. Many of the consumption names, if you look at, are still north of 50 PA, the usual consumer staple names. The large cap tier 1 IT companies are north of 22, 23. So you don't have valuation support. That's our problem with the markets. The FPIs at this point in time, there are 3 things, which is holding them back. One is the fact that valuation in India are high on an absolute basis. Valuation in India are higher on a relative basis compared to the rest of Asia, which has performed amazingly well, as we know. And you don't see any AI-related plays in India at this point in time. And the whole excitement in the world is around AI stories, right? And look at the way the Asian markets have performed on the back of all sorts of, direct and indirect AI plays. Korean market is up 20%, calendar year days, 20 days, 20 working days probably, right? It's like crazy, absolutely.
Sanjeev, just want to go back to the note that you published earlier this week, where you say, we wonder if the recent correction in and the continued large underperformance of the Indian market versus the other markets simply reflect, 1, a temporary blip in the markets, or 2, the start of a permanent reset in multiples to their correct levels. And if the latter were to be true, we will still see a lot more in terms of a correction in multiples for several sectors and stocks. So weigh in on this. Is it going to be a permanent reset in multiples? And if that is the case, are we in for a long drawn period of subdued kind of a returns, notwithstanding the 17% earnings return expectations for next year?
Look at this on a sector by sector basis. So, look at the fact that over the last 4 or 5 years, many sectors of stocks have absolutely given no return, by the way. Many of the large cap consumer stocks are flat on a 5-year time frame. many of the IT companies are flat on a 4-year time frame. And multiples are still high, by the way, even now. So my worry over here is that over a period of time, as the analyst investor community starts understanding the business model is not as robust as what they have made out in the past, you will probably see more correction in the names over a period of time. I'm not making a case for a swift price correction, but I think over I don't know, whatever time frame you take, you will probably see derating in this, in the multiples of the stocks over a period of time. So you will have a situation where earnings probably keep on going up, but multiples keep on going down for a set of sectors and stocks, which means probably not much return in the 3 to 5 year time frame. And we've already been 5 years, by the way. We have seen no returns in many of the sectors and stocks. So I think a decent portion of the market could be in for that. Having said that, market will still perform because there are still other stocks, the valuation is reasonable and earnings are still compounding over there. So hopefully you'll still see some positive returns for the market as a whole, but I suspect many sectors of stock will not give any returns for some time. So it's a question of, ultimately, what is the right multiple for companies, or stocks. If you look at, for example, the FMCG companies, how do you justify 50p or plus minus, I would say, for stocks that are going at, maybe not even 5-10% now. Even if I take 10% growth for an extended period of time, 30-40 years, I will struggle to justify 30p, by the way. I have no DCF unless it will take a very low cost of equity. Will give you more than 30p, by the way, with this kind of earning growth. So I think there has to be reset to the multiples. I mean, only time will tell, how quickly or how, what period of time that takes place.
Sanjeev, hi, good morning. I think going by all that you've said, Sanjeev, you're sounding a little bit more optimistic every discussion we have, at least, post the time-wise, price-wise correction. So I'll take that. Let's focus on a couple of changes you'll have made to the portfolio. ITC appears you'll believe most of the bad news is in the price, as well as Max Health. If you could tell us about those two, because those two are the additions, I think. Higher weightage and an addition. Go ahead.
Yeah, so ITC obviously has seen a very big correction based on the fact that the government raised taxes on tobacco quite a lot. I mean, it will get implemented February 1st, but it's a done thing. If you take out the value of its non-tobacco businesses, roughly about 150 rupees to about 160 rupees, I think the analyst committee is probably giving higher. Let's, take some haircut over there. Then effectively you're getting the tobacco business for about, let's say, 170 rupees now. And EPS, which my analysts are forecasting for FY 2027 for the tobacco business, about 11 rupees or so. And this is after taking a big cut in numbers. So it's about 15 times, which doesn't look too bad. So my sense is once the reset happens this year, in terms of whatever damage has to happen to volumes based on whatever price increase ITC and other tobacco companies will take, you will probably get back to low single-digit kind of growth with price increases. 15p doesn't look too bad, I would say. It's obviously a cash machine. Free cash flow is very, very high, pretty much equal to the PAT over there. So 15p doesn't look too bad, I would say. So that's the reason I've added it to the model portfolio. If you look at Maxwell, the other one, obviously it's seen again a decent correction from its peak, high growth company. If you look at the EBITDA numbers, remember correctly, this is India's 116 adjustment. After that, you probably see about 65% EBITDA growth between FY 2026 and 28. It is not a cheap stock. It is trading at about 40 times FY 27 earnings. But given the quality of the company, execution, the long, growth, long runway of growth for something like healthcare service in India, and the fact this company can execute well and participate in that, I am okay with that. At least this company is growing very, very fast, by the way. So it looks okay, from a growth and fundamental perspective.
And in your model portfolio, you have also removed Embassy REIT and removed Lupin and reduced weight on Cipla. You want to take us through the rationale behind this?
I don't want to get too much into all this, but anyway, see, the fact is Embassy has performed quite well. We are probably coming to the end of the rate cutting cycle now. Maybe the RBI will cut another 25 basis point. Still a decent growth company, but it's done its bit. When we had it was about 320 rupees or so. So obviously it's done quite well in this market. So that's that as far as Embassy is concerned. Lupin has performed okay, I would say, last 6 months, 12 months, probably not much. Earning growth is looking a little bit risky over there, looking at what is happening to US generic pricing pressure. We're not seeing much of growth between 26 and 28 for Lupin. So done its bit, from a defensive perspective, it's fine. Simpler has been a bit of a disappointment. The fall in Revlimid revenues, it was anyway expected. That's happened a quarter earlier. But that's not the real issue over there. The fact is, what we were expecting was that, they will have sufficient contribution from the new molecules, which will offset the decline in Revlimid sales. But some of that, the new molecules that are respiratory portfolio, things seem to be getting a bit delayed. It does look okay, I would say. From whatever math we did for the domestic business, you can just have 900,000 rupees just for the domestic pharma business, which is a decent, high growth business that will grow about 9-10% anyway. So it doesn't look too bad at current levels, but I guess we will probably not see much of earning growth over the next couple of years, with given the decline in Revlimid revenues not being offset by sufficiently from the respiratory portfolio.
Sanjay, we'll leave the conversation here for now. Thank you very much for joining in with your perspective. Moving on then, let's invite the management of CG Power. They reported a muted set of Q3 numbers. Revenues came in line with expectations, but there was a miss on the company's profits and margins versus expectations. Margins contracted due to continued investments in their semiconductor business. Amar Kaul, MD and CEO, CG Power, is now joining in. And just to set up the interview for today, we would like to discuss on their power systems that continues to see strong growth. Will that sustain? Any slowdown in the order inflow? And when does the semiconductor business break even? What are the timelines and the profitability metrics? Thank you very much, Mr. Kaul, by joining in. Let me begin with the top line growth. Reported revenue growth of 26%. How much of that is organic? How much driven by the Axiro acquisition that you did? And in Q4, what should we expect as you end FY26?
So thanks, Seema, for having me here. So pretty happy to be here with you. Yes, you are looking at the consolidated numbers, and you must see that I read the comments on PAT missing is big because of the strategic investments into our semiconductor business, and that's going to stay there. But if you look at the standalone numbers, with a growth of 22%, we were 28% PAT, which I think is the positive leverage on what we are doing for the existing business. So new business that's added is Axiro, which did about 120 crores approximately. And so I think hopefully by this end of this quarter, it should also be able to break even and make profits as well.
Okay. And between power systems and the industrial segment, now power systems has been driving growth for you. Even in Q3, I think it was a fabulous growth of more than 40%. 9-month revenue growth has been 25%, while industrial has been lagging. Can you provide the outlook for both these two segments going into Q4 and FY27?
Sure. See, power, of course, we are riding on the wave of the way expansion is happening in the power industry in India as well as outside India as well. I think the good news is CG Power has been able to grow faster than the growth of that market. So which means we are able to take the share not only in India, but outside India as well. And I was sharing some numbers with the investors yesterday. If I look at my exports, even for the 9 months from April till December last year versus April till December this year, we are more than 50% up in terms of the bookings or the orders that we have booked for export. So which means the credibility of Make in India and the standards, the quality, the design capabilities we are having is started showing the results to us. The hard work that has been put in last couple of years is showing the results there. Coming to the industrial sector, I think the good news for us is that we are growing much better than the market. Industrial, if you go to specific to the motors business, it has shown some improvement from the negative growth. It has come to the plus side on this, but then we are growing at more than 8% to 9%, which is much faster than what the industry is growing.
Amar, good morning. We'll just come back to you in just a bit. I want to just address the breaking news which is coming in right now. What we understand is that, a charter plane, which was carrying, and these are visuals coming through right now, a charter plane which was carrying Mr. Ajit Pawar, the Deputy Chief Minister of Maharashtra, has crashed This was a charter plane going from Mumbai to Baramati. And, Mr. Pawar had programs lined up, public meetings, etc., lined up in Baramati. And, the plane has crashed. Civil Aviation Ministry sources are saying that there were 6 people on board. There are casualties likely, although we don't have official announcement yet. The visuals and the pictures, of course, look pretty bad. But this is what is coming through. Plane carrying Maharashtra Deputy Chief Minister Ajit Pawar has crashed during landing in Baramati. Actually, that's the other point. So during landing is when this plane has crashed in Baramati itself, where, as I said, there were these programs which were lined up. And as I said again, and we'll put this out, Civil Aviation Ministry sources saying there were 6 people on board this plane. And casualties likely, but we're waiting for an official announcement with regards to what has actually happened at this point in time. So just wanted to sort of, address that, and we'll try and, of course, confirm what is, the exact whereabouts status with regards to the people on board, including Mr. Pawar. So we are waiting for the details. You can see the debris of the plane crash, and I think the visuals, of course, looking pretty bad and dire. Baramati, of course, is the epicenter of the Pawar dynasty. Mr. Ajit Pawar, the Deputy Chief Minister Maharashtra, heads NCP, and of course, there are 2 NCPs now. One headed by him, the other, of course, Mr. Sharad Pawar. And of course, Mr. Ajit Pawar, one of the 3 pillars of the current Maharashtra government, which is the, the Shiv Sena, the BJP, and of course, Mr. Pawar-led NCP. Mr. Ajit Pawar-led NCP very much built on his brand, his personal brand, so this is important, of course, in that sense. To track and see what really has come through. So we'll wait for more confirmation, more details. But I thought this is obviously very important in terms of what has happened. Prayers, of course, for people who were on the plane. This is absolutely tragic. But we are trying to get an exact confirmation about what has really taken place. So the pictures are up on your screen. More on this in just a bit from now. Yeah.
Okay, all right. We'll wait for further details on that front. For the time being, let's get back to the conversation we're having with Mr. Kaul, the MD and CEO of CG Power and Industrial Systems. Mr. Kaul, I wanted to ask you about the industrial system business. Now, as you said, the growth has been, in high single digits, but margins have been a little under pressure. You've taken a price increase now on industrial motors of roughly around 17%. Do you think we get back to margins expanding from year on? And is there any other price increase that you're planning in this vertical?
Absolutely. So there's always a lag between the commodity inflation and the price increase that we do. And that's what you see here. So between April till December, we had increased about 10%, for which the realization has been pretty good. And we increased 7.5% in January itself. And there's a lag between price increase and the realization. So you'll see those coming in. So we're keeping a very good discipline on the price inflation versus the price. How do we get it over and above our operational efficiency that we are working continuously on.
So then we start seeing margin expansion from this quarter. Or quarterly, we do see that playing out, right?
Yeah, I think it'll keep improving, because I think we are done with a lot of groundwork on the operational piece, what we can improve on. It's not only pricing. Pricing is just one lever that you have. It's also I2V, we call it innovate to value, which is more of VAV program that has got become the DNA of CG Power, and also the operational efficiency to keep eliminating the waste from the system. So all these initiatives are getting very, very well as part of the foundation for us. Okay. So you'll see those good days ahead.
Okay, I want you to weigh in with regard to the transformers shortage. Could you tell us, if you have a broad number in terms of what is the situation currently? And since there are transmission lines that are getting delayed, do you think there is a fear that we could open up to China yet again, or you don't see that as a fear?
See, the way power is expanding in India as well as outside India, I don't see any concern on that, because capacity is a concern for everybody. I can talk about only CG Power, and I think the way we have been expanding capacity and the pace. Even I was meeting the ministry and a couple of senior government officials, and they were pretty, and they used the word that we are pleasantly surprised how quickly you're able to expand it. If you see, just 1 year back, we were about 20,000 MVA capacity for transformers. In December, we increased it to 45,000. And by April, I think we should be about 65,000. By July, we'll be adding another 10 to 15,000 MVA. So every quarter, we are adding to the capacity to help the country in the nation building.
Mr. Kaul, wanted to I think in the month of January, you had announced a 900 crore order for a US data center project from Tallgrass, 900 crore export order. This would mark your entry into this high margin global data center market. What kind of margins will you enjoy on this? And in your pipeline, are there more such data center orders?
So yeah, a fairly good question, Rima. This is the beginning of the hard work being done in the last 2 years that we are working on, and data center is one of the key verticals that we have been working on. And okay, this one is a big order, but then yes, there have been a couple of more orders which are not to that size. But yes, exports is also one of the key focus areas for us, and it has already started showing results to us. Margins, I'll not be, because it's confidential between the customers and us, so I'll not be able to share the margins exactly, but of course it is much better than what you would normally get. I think important for us is to keep building on our design capability, deliver the quality that is required in the global market. So the customers are trusting us, so we need to make sure that we keep that trust on.
Okay. And are there more such orders in your pipeline on the data center business that you could announce in the coming, say, 3 months? And then we'd like to ask you about the semiconductor business.
Absolutely. I think the pipeline is very strong, not only data center, but for exports, as I said, in last 9 months, our export orders have gone up by more than 50%. And the pipeline keeps increasing. So in the forthcoming months, you'll keep hearing more and more on our global expansion, because we don't stay with only India company. Indian multinational is what we have the vision for, and you'll see progress on it.
Just on semiconductor, the losses widened. When do you break even, and when will the commercial production at Sanand plant take place, and how much will that add in terms of your revenues?
So, see, it's a strategic investment, and you know it pretty well. So semiconductor chip designing and development, that takes a time. And we have the CG Power, we have taken that conscious decision. So, and we are not a company which is quarter to quarter. Of course, we will live for organic business. If you see the standalone results, it is doing fairly well. Operating leverage is pretty high. Your profitability is much higher than your top line growth. But semiconductor is a strategic investment. It's going to take some time till it starts break even. But the good news is that the progress we are making is phenomenal. The team for our semiconductor business, for CG Semi, as well as Xero, is doing fairly well in terms of the timelines. CG Semi Plant 1, which is we call it the mini plant, which is already operational and should commence the production in next 2 quarters max. So right now it is under approval and testing and validation. So in next 2 quarters, it should start production there as well. And the construction for the main plant, which will produce about 14.5 million chips a day, will be operational by December 2026. And then give it another 1 quarter or 2 for approval. So by 27, both will be fully operational.
Yeah, incentive booking is a little slow. So that's why you're sticking to that guidance, right, of December 2026?
Yeah, the plant construction for the new plant will be done by December 26. That's right.
Got it. Okay. All right, Mr. Kaul. Thanks a lot for joining in, giving us color with regard to business in both the verticals, and wish you all the best. We catch up soon.
Thank you, Nigel. Thank you.
Well, time to slip into a short break. Up next, we have the management of Vishal Mega Mart. They'll be joining in to talk about their numbers. Stay tuned.
Welcome back. The DGCA now confirming that all 6 people on board that charter plane have died, including Maharashtra Deputy Chief Minister Ajit Pawar. So absolutely shocking and tragic news coming through in terms of the Deputy Chief Minister Ajit Pawar being no more and passing away in that charter plane crash. And those are visuals, of course, coming in from Baramati. Apparently, this is the crash and the incident happened when the plane was, approaching landing, and this entire thing tragically resulting in loss of lives for all on board, including Mr. Ajit Pawar. Once again, Ajit Pawar, Deputy Chief Minister, Maharashtra, one of the oldest faces of Maharashtra politics, one of the 3 pillars of the current Maharashtra government, and hugely influential, especially in the Baramati region. Split away, of course, from his uncle Sharad Pawar. So there are 2 NCP factions now, one headed by Mr. Ajit Pawar, and the other one, of course, Sharad Pawar. Prayers and heart goes out to family and friends of those deceased. We can put out now that Mr. Ajit Pawar has indeed passed away in that plane crash, which has happened in Baramati. He was going to Baramati to address some public meetings, and this is what has transpired. Of course, we also understand that Chief Minister Devendra Fadnavis has cancelled his rally in the Konkan region, and we will, of course, be getting more information in terms of exactly what has happened, etc. But I think we can confirm. So some more information in that sense, which is coming through. The crash happened at 8:48 this morning. And the aircraft, but this is, of course, now we have confirmation, which in terms of the fact that he is indeed no more. So Mr. Pawar passing away tragically, absolutely tragic and shocking news, which is coming through at this point in time. We imagine there will be more there will be condolences pouring in. There will be, of course, I guess, other leaders of the current Maharashtra government, Mr. Pawar Senior himself. We will hear from all of them as this, of course, becomes more widely known. But the incident, of course, happening at about 8:48 this morning, and we can now confirm that Mr. Pawar is indeed no more.
Indeed, Mr. Pawar, one of the fiercest politicians here in Maharashtra, respected by all, prepared to take on both people from his team as well as the opposition. He's had that reputation, Ajit Dada, as he's called in political circles as well. No more. Very, very heartbreaking news coming in early this morning.
Nigel, this is, of course, not the time for it, but, this is also, of course, politically very significant in Maharashtra, because the NCP faction, which Mr. Ajit Pawar headed, was very much built on Mr. Ajit Pawar's sort of brand, personal brand, Dada, as you said. So now what happens there? Will MLAs with Mr. Ajit Pawar, are we looking at kind of some sort of a realignment back with the original NCP, that is with Sharad Pawar? So we'll have to kind of sort of wait and watch for all of that, and that'll that's the political side of things. But of course, this morning as we report on Mr. Pawar's passing, this is, of course, a deeply, deeply personal tragedy for, of course, his family and the wide base of support that he had in Maharashtra and, of course, in the Baramati region as well. So, absolutely sort of a tragic incident. Very, very much a Maharashtra leader, but of course, I think one of those leaders who had not influence, but of course widely known across the rest of the country in that sense, as well as someone who was a mover and shaker here in the Maharashtra politics in that sense. So that's information which we can confirm now. We of course knew that there was the plane had crashed, and we were waiting for official confirmation, but that has now come through. That Mr. Ajit Pawar has indeed passed away. I think we have Sanjeev Srivastava now joining us. He's senior journalist, someone who's tracked politics here in Maharashtra and elsewhere for a long time. Sanjeev, good to have you here. Just a quick word in on these developments, and what do you think are implications, politically speaking?
It is absolutely shocking. that Ajit Pawar is no more. When your last few minutes since I have come to know of this, it's still not fully registering that he has gone away. He was not exactly very young, but he was still what in India we can easily describe, and he could have passed away as still a youth leader and somebody who had a very bright future and had a good present. And he ultimately the mantle of NCP, a very prominent regional party of Maharashtra, which has been there for last more than 2 decades. It would have fallen on him, but now what happens next would be interesting. Ajit Pawar had a bit of a falling out with BJP during the BMC elections, and where he would go next, what will be his next move on the political chessboard, is what was being talked about in political circles. But now, whether the NCP or Ajit Pawar faction will remain this way, I really doubt. It will have to, once again, it will be Sharad Pawar's party in total, and Supriya Sule may be the next heir apparent. It's very difficult to really, I'm still coming to terms with Ajit Pawar's passing away, to be very honest, then analyze the implications.
Absolutely bolt out of the blue, right? I mean, just completely shocking that we are even sort of in a way reporting on it. But it is unfortunately confirmed now, Sanjeev. Sanjeev, do you think, I mean, again, from a political standpoint, and I know it's early, etc., but what you think this kind of, the MLAs go back to Pawar Senior?
MLAs go back to Pawar Senior, Prashant, or depending on the constituency and what are the local equations, they may also be good pick for the BJP. So the MLAs will now decide based on their individual constituencies what will best serve them. Will they be better off with Sharad Pawar or with BJP? But I still think, and this is really top of the kind of skimming at the surface only maybe, but I think bulk of them will go back to Sharad Pawar because that was their constituency, that he was their leader, and because Ajit Pawar was the kind of organizational face, right, somebody who Sharad Pawar had completely trusted and developed as a number two.
Right. Sanjeev, stay with us. We also have the former Maharashtra Chief Minister Prithviraj Chavan now joining in. Mr. Chavan, good to have you with us here, sir. It's a sad day, sad morning as we report on the fact that Mr. Ajit Pawar is no more, passed away in a plane crash in Baramati. Your first thoughts, sir?
Well, it's too shocking to describe. He was my deputy CM. First time when I became the Chief Minister of Maharashtra, he became the deputy CM of Maharashtra. And so I've worked very closely with him for 4.5 years. We had our differences, and we continued to have our political differences. But he was, without a doubt, a dynamic leader. Of course, he was surrounded by controversies, but a tall leader, a young leader of Maharashtra, in which people of Maharashtra invested in leadership, and people expected him to reach even greater heights. It's very tragic that another political leader in the series of Madhava Sindhya, Rajesh Pilot, and many others, he has also gone away. Electioneering has become such an active activity that you have to crisscross the state, and whatever means is available, one has to go. My first reaction is, of course, full details are not available. But what was this company from which this plane was chartered? I hear that this was fairly the company's track record wasn't great. It was just quickly put together company. A lot of political people had invested in it. So I think how did DGCA permit such private operators to operate is another big question, and that leads me to the thing which I've been arguing about is that we need to restructure DGCA completely. But all the same, this event will have major repercussions on Maharashtra politics. Ajit Pawar not only was a deputy CM of Maharashtra, but he was also a leader of a fairly large faction of the Nationalist Party. And the Sharad Pawar faction seems to have merged in the Ajit Pawar faction of late. If you look at the Jila Parishad elections, which are ongoing now, The Jila Parishad election themselves will be impacted because the polling is on the 5th of February. We're right in the midst of campaign, and this tragedy has hit us. It's very sad. My condolences to his wife, his family, and whatever our political differences, he was without a doubt a young, dynamic leader of Maharashtra. Maharashtra will miss him greatly.
Well put, Mr. Chavan. Just, I know this is not the. I guess it's too shocking as we hear the news. But as you said, right? I mean, what happens to the? Are we looking at a reunification of the NCP, or in terms of politically, how does this affect things, sir? In your assessment?
I think it'll be unfair to start commenting on the political outcome and all that. And let's not do it. Let's first absorb the shock. But as I said earlier, the Sharad Pawar faction has already folded into Ajit Pawar faction of late. So there is effectively only one party. It was led by Ajit Pawar. Now what happens later on, I don't know. It's too shocking to even contemplate what happens.
Got that. Mr. Chavan, absolutely well put. Thank you very much for your thoughts and thank you for joining us. Sanjeev, if you're there, thank you very much for being with us as well. This is a story which we will continue to track, report on, and get more details in terms of what really transpired with that incident which has happened this morning. So Mr. Ajit Pawar, Deputy Chief Minister Maharashtra, no more, passed away in a plane crash in Baramati earlier this morning. I mean, sometime before 9 a.m.
Longest serving Deputy Chief Minister in Maharashtra, served under 4 parties as well. 6 times I think he was the Deputy Chief Minister, and I was lucky to meet the man a few times. Extremely dynamic, witty as well. I recall a few instances when I've met him, and one of the most dynamic ministers we have had in the state. Ajit Dada, as he's fondly called by a lot of his supporters, a lot of his followers, and throughout the belt here in Maharashtra as well.
Okay, well, as I said, we'll keep coming back to this and get you more. Well, let's just turn our attention back to the budget, which is in front of us, 3 days away. Samir Arora is with us. He's founder, fund manager at Helios Capital. Samir, good morning. Good to have you with us here. Thanks for joining us. Samir, of course, is also one of the CNBC TV18 budget editors. So, you'll hear from him before the budget, on the day of the budget, and of course, some analysis post the budget on that Monday, as well, coming Monday as well. Samir, good to have you with us here. Just a quick headline kind of view on this is, as many have said, one of the budgets where there's no noise about the budget. 3 days out, absolutely quiet. Any expectations at a headline level, and then we'll get into some specifics.
No expectations. Maybe we keep hearing that they may do something on long-term capital gains for some FIIs, which may be defined as some endowments or universities or long-term, some X thing. So broadly will not matter to rest of the world, but anything that helps somebody helps everybody in that sense. But beyond that, I also have low expectations other than the normal stress. I mean, not stress that way stress, but normal stressing on capex and keeping fiscal discipline and all that, but not something in mostly market moving.
Samir, I remember when we spoke, when this LTCG thing happened, right? I think this was back in 2018. I remember you kind of started sounding very, very significantly disappointed when it had happened in terms of how this would have a impact over it was not just about then and there, but over the long run. And I think it has indeed played out in that sense, Samir. How should, if this is, I guess this is now too late to ask you what they should do, the government should do, but
I don't say what they should do because my game is to see what they will do. So what happens is if I keep thinking myself that it's so logical that long-term capital gains should be reduced, then I start believing it myself. And then I get carried away and saying that it is so obvious that this is what is required, or it is so across the world, the same thing. So mostly my thinking is they will not do it. I keep arguing on Twitter for the sake of intellectual discussion that why yesterday's discussion on your channel with Lata and all was absolutely flawed. To say that because US has this and because some other country has it, India should have.
Samir, for the purpose of, and I think I was coming to that, right? Anant Narayan has written a piece as well. He was part of that program that you're referring to. Why is that flawed? What Anant is arguing is taxation should be residence-based, like it is everywhere else in the world.
Oh, I'm not about FI thing. FI, of course, should not be here. There should be no tax in India. That is so obvious.
Then what? Then
I was talking about that debt and equity in India for Indian resident investors should be same or similar. If you want to say it that the equity guys are okay at 12.5, and over time you'll bring debt guys down to 20 and 15 or whatever, not to make it look that one set of people is arguing, if they are, that the equity tax rate for Indian investors should be increased to what they are paying on debt. Because I'm saying that is wrong, because the debt guys, when they are earning that interest and on that they are paying tax, somebody else is offsetting that interest from his income and is paying less tax. It's not the same in equities, where if I buy somebody's stock at 100 and it goes to 200 and I sell it, the guy who sold it to me at 100 can keep saying, oh my God, I made an opportunity loss. But he does not go and take a tax credit for it. And therefore, one side pays and the other side does not get an offset. But when you are doing basically interest, tax on interest, one guy is paying, is earning the interest and is paying tax. But on the other hand, the guy who paid that interest is reducing his tax. So therefore, effectively interest is a zero-sum game. And therefore, one guy wins and one guy loses. Whereas in capital markets or in equity, particularly cash equity markets, there's no offset. So if you broadly look at it, the equity guys might be paying more tax than what it visibly looks when compared to debt. And secondly, we can't conveniently leave out STT from all calculations and say because the US and all don't have. So if we broadly, I don't know exactly what is the ratio, but if STT collections are, let us say, I have no idea, equal to capital gains tax, then broadly we should look at it that the capital gains tax in India is not 12.5, but in aggregate 25%, if it is double. I mean, if it is equal, because STT doesn't come into any of these discussions. But if you're saying for FIIs, I've been saying from day one that there should be no tax in India, just like Indians are not paying any tax on all the investments that they are making days in US and everywhere else. And they are being taxed in their home country, which is India.
Yeah, but if you bring,
but I don't expect any of this. I don't expect.
You're saying no real, tangible, high conviction expectations from the budget. Let me put it that way. I'm paraphrasing you.
I'm saying I can dream in my mind and hope in my mind that they do some of this.
Yeah.
But we are not acting on that and not believing also, because these things. The fact is, practically the rates were just increased last year. So it is not easy for anybody to change them back. Maybe you can do 2.5%, 5%, even that will be helpful. So basically the thumb rule is, if you reduce, say, from 12.5 to 7.5, and you can say it's temporary for 5 years, market will go up 4-5%, because you are basically adjusting for the lower tax, and so the post-tax returns will go up, and that'll get you'll get 4-5% pop, and that will change sentiment. It'll show that the market, government and the system accepts these things, even if they are for 5-year period or something. And you can change the sentiment. Otherwise, sentiment will need to be changed with A, passage of time, B, this EU deal, then US deal, then general things as they improve and earnings improve. So that'll take 6-9 months. That's how you can do one or the other.
Yeah, okay. That clarifies things. I can go on about that debt and equity versus debt, but I think that Lata already debated that yesterday.
Our thing is, we normally go from one end to the other in terms of celebration. So just to tell you, at the end of 2007, we thought we were getting so much FII flows that we stopped FII flows, if you remember.
Yes.
And we used to have capacity. Now we are feeling that there is so much equity flows. Actually, it is not so much equity flows. It is required because it's replacing FDI also a little bit. And anyway, who in the world feels bad that there is equity flows, and then they will suddenly say the valuations are high? Which valuation is high in the sense? Of course, they may be higher, but they were like this premium to other markets. The absolute P's in the 18 to 22 range have been there forever. So just because the market fell, we are trying to justify that this must be because of high valuation, but it didn't fall in 23 and 24 and whatever 21 and last year and 7, and they were the same valuations. So I don't believe this. That's why I recommend everybody to read the halo effect. That if the price is down, you make some logic for why that price is down. If the price of a stock is up and is up 20% per annum for 5 years, can anybody say that this is bad management? No, it is the best management. They have great plans. That is why so it's everything is
Samir, one argument against long-term for FPIs, right? Because the problem is rupee. I mean, it's not a BOP problem. It's basically the portfolio flows which is hurting, FI sales which are hurting, and that's showing up in the currency, etc. So you need dollars in that sense. Would it be a hard sell if they made taxation residence-based? I mean, I'm not saying it'll happen, but you think it'll be tough to say?
Because
but I'm saying people will say, well, you know, it's unfair. You're giving FIs for easy exit. Local investors are being taxed.
They are not giving any extra benefit to FPI, because when the Indian guys, and now, you know, you see everywhere that because of Gift City and all, that Indians are investing in US mostly, let's say, and everywhere else, they are not paying any tax there. That tax is being collected by Indian government. So effectively the US government is leaving that tax and saying, no, you can pay it in your own country. So it is not this thing, but I'm saying it becomes difficult once you have set it. Therefore, I've been saying reduce it for everybody. Don't do it only for FIs. Just reduce for everybody to 7.5 or ideally to 0. And you change STT a little bit, because on the other hand, separately, we keep saying, although we own all these exchange stocks, that, you know, the volumes are too high, speculation is too high. Okay, change one, but of course, on Twitter, I'll be attacked by all these traders, but broadly adjust if you so want, or let it be for 5-7 years and then decide after that. Because we need something instantly. By the way, separately, because now we have to do a lot of calls with our customers, our investors, because of currency fall and all. It is a bit embarrassing the way the currency is falling every day, when, you know, the dollar has depreciated by some 2.5% in this month, and against that the FIs have lost 2% on that. So it's a 4-5% difference in basically 2 weeks. So all these things have to be handled. If tax is there, you're paying tax on INR returns, and then the euro investor has lost 20% in 1 year on just the currency. That is why best is, since everything can't be controlled, at least tax can be equalized. I think anyway it's too late. It must have been printed by now, the budget, so let's not.
Samir, I had more questions, but we've been squeezed in because of that unfortunate news which has come through. But really appreciate you coming on. Thank you for joining us, and we'll see you on the day of the budget, in terms of what really comes up. But as Samir said, no real tangible expectations in this one. A lot can be done, should be done, but of course, don't keep hopes too high, as he put it. We'll take a break. On the other side, we have the management of Vishal Megama join us on the third quarter numbers. Coming back quickly.
Welcome back. Vishal Megamart reported a steady set of Q3 numbers. The stock is down nearly 4-5% in trade as the revenue growth at 17% is lower than the revenue run rate the company has enjoyed in the past. And even the reported same-store sales growth at 6.1% was impacted on account of the advancing of the Durga Puja to Q2. Adjusted same-store sales growth was at 9.6%. Guninder Kapoor, MD and CEO of Vishal Megamart, is now joining in. Thank you very much for joining in, and thank you for waiting by patiently. Now, historically, and when we spoke to you during the IPO, you used to grow at 24-25%. 9-month revenue growth is 20%. What is the sustainable growth path?
Firstly, thank you very much for having me on your show, and good morning to everyone. I must point out that at the time of IPO, we had guided for a growth of about 20%, an EBITDA growth of about 25%, and a PAT growth of about 30%. So those were the broad numbers. And if you look at a performance for the first 9 months of the year, it's 10% same-store sales growth, actually 10.3%. To be precise, the EBITDA growth is 24.4%, and the PAT growth is 30%. So it's exactly as per what we had broadly guided at the time of IPO. And each of the quarters have been quite consistent with that guidance. What you're referring to is indeed correct. The festive season this year is split between Q2 and Q3 because Durga Puja fell in Q2, and therefore to that extent we got extra revenue in Q2. So in Q2 we achieved a same-store sales growth of 12.8%. Consequently, the EBITDA growth was also 30% as against 25%, which is what we had said. And our PAT growth was 46.5% in Q2. So if you look at our YTD numbers where everything becomes equal, we are exactly as per what we had guided, which is 10.3% same-store sales growth, 20% overall revenue growth, 24.4% EBITDA growth, and 30% PAT growth.
Okay. And that is the long-standing guidance even as we look into FY27, because there appears to be increased competition from the likes of Zudio, Meesho, etc. So given the way the competitive landscape is emerging, you're confident about this 10% SSG growth, 20% top line, 25% EBITDA, and 30% growth sustaining at least for FY27?
We feel pretty good about that, but I must quickly clarify that that guidance is for the full year. As you know, we have seasonality in this business, depending on when the festivals fall in which particular quarter, and also because of the onset of winters and summers and so on. And therefore, I must quickly clarify that the guidance is for the full year. It is not for each of the quarters which constitute the year. Again, depending on the seasonality, some quarters would be higher, and there would be some other quarters which will be consequently lower. But the full year guidance, yes, that's a guidance.
Okay. And how is the competitive landscape on account of, say, Zudio, Meesho, etc.?
Well, the competitive landscape has been quite intense over the last 2-3 years. In addition to the couple of players that you've mentioned, we have other very large competitors too. And then we have quite a few regional competitors who compete with us in various parts of the country. And finally, you have competition from the digital commerce, quick commerce, etc. But I would submit that the competitive landscape has not changed that dramatically over the last 12 months. It just continues to be there. And there are various periods or various quarters when some folks are expanding, and there are certain other periods when some folks in the market are not expanding or restructuring their businesses. So that, of course, changes from quarter to quarter. But otherwise, I would submit that the comparative landscape over the last 1 year has been quite the same.
One word answer, Kedara. Block coming anytime soon in the next 6 months, say?
I don't know. As you know, I'm not the investor there. So, yeah, I wouldn't know.
All right, a short conversation, but thank you very much, Mr. Kapoor, for joining in. Great chatting with you. Get into a break. On the other side, Lata is waiting by to speak with experts on why bond markets are sulking so much ahead of the budget.
Fly Emirates, fly better.
Welcome to our budget countdown. India's bond yields have been steadily rising. In January, they have surged to 6.7% this week, despite last Friday, the Reserve Bank announcing over 2 trillion rupees of liquidity infusion through open market purchases of bonds, through 90-day repos, that is long repos, and through a dollar-rupee buy-sell swap. The yield surge, the rise in the 10-year yield, may be due to high. A CNBC-TV18 poll shows the government may borrow 11.5 to 11.7 trillion rupees in FY27, that is issue new bonds, to meet its expected deficit of 16.8 trillion rupees. So the gross borrowing, including states borrowing, including money to be borrowed to redeem old bonds, together could be about 29 trillion rupees of fresh central government and state government bonds. Now, is this the market's worry? To analyze the fears and the numbers of the budget, I'm joined by Suyash Chaudhary. He's the CIO debt at Bandhan AMC, and Abhishek Upadhyay, the senior economist at ISEC PD. Gentlemen, thank you very much for your time. Suyash, first, why is the market so worried in spite of the liquidity? It is 2 trillion announced on Friday, but if you took the OMOs from December onwards, it is about 3 lakh crore only OMOs. And then you take the swaps, another like $25 billion. This is a lot of money the RBI seems ready to give. Why is the market sulking?
So, Lada, I would submit, in fact, the market is not sulking. It's remarkably well behaved. Let me just put some numbers in context. Since September, October of last year, the short end of the non-SLR curve, let's say the 1 year equivalent of the bank deposit rate, is up roughly 50 basis points. The 5-year interest rate swap is also roughly up 50 basis points, but the 10-year government bond yield is pretty much in a 20 basis point range. And a large part of this probably has to do with the very large scale OMOs RBI has conducted. By our calculations over the last 13 months, RBI has taken out effectively 75% of the net central government bond supply, so basically 75% of what the government supplied on a net basis, RBI has taken out via OMOs, and which is probably one of the big reasons why the government bond curve, in fact, is very well behaved. I would argue probably the underlying macro dynamic is shifting slightly. You are seeing, outside of agricultural commodities, a significant reflation in global commodities. And this is no longer, only limited to precious metals. If you see industrial metals since October, they are up 25%, maybe 30% in INR terms. You are seeing developed market yields beginning to rise again. And generally, people are feeling good or better about the global economy, and that's reflecting in global yields as well. So I don't think we are doing anything exceptional with respect to India bonds. In fact, I would submit that and admittedly, drivers of the sovereign curve will be different than drivers of the non-SLR or the interest rate swap curve. But still, we are remarkably well behaved. And in fact, there is room for bond yields to rise, reflecting probably the shift in macro dynamic that we are undergoing.
Okay. Well, actually, the question you get from viewers is that Reserve Bank has done 5 rate cuts and, the market is back to where it was after the first rate cut. But anyway, I'll, time permitting, come back to it. We have to get to the budget. Abhishek Upadhyay, I think you are expecting a net borrowing of 11.2 trillion rupees and a gross of about 16.5. I'm getting a slightly higher number in the poll I did. But if you can walk us through the numbers, this 16 trillion would be a gross amount of borrowing from the government?
Well, Lata, so a few things to look for from the budget. One, of course, this is the first year government is shifting to a medium-term debt to GDP roadmap. We have to see what that means for the process of fiscal consolidation. Last few years, we have had clarity that fiscal deficit is going to come down steadily to sub 4.5% levels. It is not clear whether government will share a similar glide path now, whether fiscal profile will behave in a more zigzag way, depending on spending commitments. So we are working with a fiscal deficit deficit projection of 4.2% of GDP, which is just about 20 basis points of consolidation. Assuming some of that deficit will be funded by, again, another year of good small savings collections, because we expect bank deposit rates to stay low. We don't expect RBI to be tightening policy anytime soon. So small savings collections should be high. And we also think some short-term borrowing the government may resort to manage the sentiment in the bond market. So given that, we estimate a net borrowing number which is very close to what we are getting for the current fiscal year, which is something like 11.6 trillion. It could be slightly lower than that. In terms of gross borrowing, there is that uncertainty about whether RBI has a lot of government bonds maturing on its balance sheet next year. We estimate close to 90,000 crores. Whether they are going to swap that out with the government or not, I agree it is perhaps too close to the budget now, but such switching has happened at around these times in the past. We can't rule that out. So if RBI does manage to switch out its maturing securities, then gross borrowing number could fall to below 16 trillion. Otherwise, the number could be around 16.7 trillion.
Okay. Yeah, I take your point that we are now switching to this debt to GDP, debt to overall outstanding debt of the government as a percentage of GDP. That is what we are going to monitor, and we are hoping to bring it down from 56% currently to about 50% in 5 years. So will the government be okay about the fiscal deficit being higher? Suyash, which number in the budget is that? If it is 4.2, will the bond market be happy, the fiscal deficit, or if they see the overall market borrowing number to be something, what will you watch out for? And how will markets react to each number?
So yes, Lata, 4.2 would be good for the bond market. If we can keep, the gross supply number in the vicinity of 16 lakh crores, that will be good. But look, I mean, you answered that at the beginning of this conversation. Despite RBI taking out a huge chunk of bond supply in a short span of time, bond yields are really not moving much. And we do think it reflects, shifts in the underlying macro dynamic globally. And I think we need to respect that as well. And I don't think transmission at the 10-year point matters as much. So even if we were still concerned about transmission, it's really the front-end rates that matter for transmission. In fact, I would go a step further and say that, we should no longer worry about transmission. It's, the economy is doing fine. Credit growth is fine. In fact, currency in circulation has picked up substantially, which shows a robust underlying economy. And the global setup on yields is changing. So all said, we do expect bond yields to remain in a bit of a range for now.
What's the range?
Again,
I mean, I'm asking 10-year because that's what everyone tracks. But do you see it go to 6.75, 6.8?
I would say broadly, 655 to 685 would be a good range to work with. I mean, that's just a number I'm throwing directionally. Like I said, there is room for yields to actually rise, reflecting what's going on in the rest of the world. And that's absolutely fine. I don't think, anything is broken really. I think markets are reasonably orderly and they should price in evolving risk from the rest of the world, including from what looks like a rising commodity cycle again.
No, I take your point. Market's not broken at all. It is just that a bunch of steps came on Friday. And what did you get on Tuesday? You saw the yields only go up. That kind of surprised the market. But it's not. 6.7 is hardly broken. Abhishek, what would your range be? And which is the number or numbers that may spark reactions?
Well, at this stage of a policy cycle, it is really difficult to pin down yields, right? So what we have seen is there is reasonable conviction. Rate cut cycle is done with now. OS market is in fact pricing start of rate hike cycle end of this calendar year. Growth has held up much better than would have been expected. So that is partly a result of all the policies and measures taken by RBI and government, which are working now to ensure growth is on a reasonably good footing now. And finally, there is limited scope for fiscal deficit to come down. That big process of fiscal consolidation is also now over. So in this backdrop, you would broadly assume limited downside to bond yields from current levels. So if you're looking at 10-year, very, very broadly, you would think, 6.5 to 7% kind of level. There is tendency for yields to overshoot at this stage of cycle. Now, we are not in a similar situation as mid-2022 when 10-year yields went to 760 kind of levels. That time, RBI was hiking rates. Still, there is no visibility about rate hikes. So I would think there should be some cap to yields, perhaps 7% or so. But yeah, happy to give a broader range rather than a very narrow range now, given various factors impacting bond market now, which you are sort of pointed.
So what's your range? 6.6 to 6.8 or even 7? I thought I heard you say 7.
6.5 to 7% broad range, but 660 to 690 is what I would think broadly a trading range from market standpoint.
Okay, well, that would effectively wipe out all the rate cuts that came our way. But yes, as you say, the cutting cycle is over and now the market is looking at a growing economy, which is what the higher yields are reflecting. Unfortunately, out of time, but I will touch base with both of you after the budget and hopefully before the policy to know how the Reserve Bank may react. Thank you very much for joining us. Have to wrap up on Bazaar. Chartbusters coming up.
You're watching us here on Chartbusters. It's been a decent start to the February series with the Nifty holding with a gain of almost 70-odd points. The Nifty Bank doing a shade better, continuing its outperformance from yesterday afternoon, and the mid-caps as well doing well. It's a whole host of earnings-related moves that we're seeing, be it something like an Asian Paints or Tata Consumer on the Nifty or in the broader markets as well. Big moves that we can see across a lot of names, the likes of Vishal Mega Mart, there's Mahindra Logistics, along with all the other names that we're seeing, International Gemological Institutes, etc. as well. I'm Mangalam Malu, with me, Nigel D'Souza. Hi, Nigel. Good morning.
Hi, Mangalam. But I think we've got quite a few managements on the show, so let's get straight. I think it's time for a snack.
It's time for a snack, and a salty one. We have Bikaji, Rishabh Jain, who's the CFO of Bikaji Foods International, joins us after their numbers, where it's been an over 70% rise that we saw in the EBITDA, understandably on account of favourable gross margins and favourable raw material environment. And the net profit also doubled year on year. Rishabh, congratulations on this set of numbers that you have. 8.5% revenue growth, volume growth in your third quarter, with the EBITDA expanding along with the net profit growing. What's your outlook on the remainder of this year? And more importantly, the outlook for FY27. Post-GST transition has happened. Volume, revenue, margins and net profit target for the next financial year.
Yeah, so thank you very much. So overall outlook remained very positive. So after post GST, what we're seeing that overall in traditional snacks, our overall revenue has grown close to 11%. But our main business, which is snacking business, grown at 14% plus in quarter 3. And that's what we are very hopeful and seeing good result. In quarter 4 also, we see the same level of growth what we see in our ethnic snacks business and traditional snacks business. From margin perspective, of course, quarter 3 of last year was very tough when edible oil price has gone up very high. But yeah, overall in last 2-3 quarters, our team has done a good job in managing edible prices, be it rising prices or managing or building efficiency in the company. So what we see in the next 2 to 4 quarters, we want to be at the same raw GM level and EBITDA level, what we're doing right now, and focusing more on growth and driving business.
And what kind of growth are you focusing on? Mid-teen sort of growth with high single digit or closer to low double digit sort of volume should continue with your margins at current levels?
So currently we're close to 50-52% utilization. So what we see that at least we should grow at 14 to 16% value growth with 10-11% volume growth. That's a target what we have taken for at least next 4 to 6 quarters.
Okay, hi Rishabh, good morning and good to see you. Could you tell us what is the target revenue share you're looking at from your core as well as your focus markets? If you could split it up for us.
Yeah, so core market, of course, where we are having leadership position in all 3 markets. So core market, what we want to be grow at 12 to 14% growth in core market versus focus should grow at least 18 to 20% growth. That's what we are taking as a target.
Okay, all right, got that. Also, exports is a relatively smaller part of your business, but from the time you'll have listed, you'll have hiked it marginally, 3 to 4%, 4 to 5, now it's at around 5.5%. Do you see a big tailwind out here? And ultimately, where do you see this contribution go to?
So export market, we have done reasonably some work in export, be it acquiring one plant in Indore to grow a frozen segment, and that has worked us very well. And we see for export market to grow at 35% growth for next 2-3 years. That's a target what we see in an export market because it's very small in our overall kitty, and the opportunity is very big. We are very small compared to a competitor. We see it's a great opportunity for us to grow.
You see this as a great opportunity for you to grow. What about your total distribution reach? It's about 3.34 lakh outlets. You had a target of about 3.5 lakh outlets by the end of this year.
Right.
Right. Where does that go next year? And what's the expected growth that you are, expecting on the distribution side?
So from distribution lens, this year we're taking target, we'll add 5,000 outlets, and there's 6,000 outlets which are left, and we are on track to complete in this. So for the next 2 years also, we want to add 50,000 outlets every year, and that's a target what we're taking, to add 50,000 outlets every year on year.
And what's the update on your performance coming in from some of the acquisitions that you had earlier made? I remember there was Bhujia Lalji, which you were targeting almost 3 digits in terms of revenue. There was this bakery business that you made an investment into. You wanted to scale that. As compared to what your targets were, where are those numbers right now on an absolute basis? And what's your growth here?
So we acquired the hazelnut. We invested in the hazelnut factory. That's a bakery and premium sweets business and doing very well. So last year when we acquired, the top line was close to 50 crore rupees. This year they will be doing 100 crore rupees. On the track of doing close to 250 crore in next 2 years. So they are doing a good business. and in premium sweets, bakery, and coffee segment. And they have opened 16, 17 outlets. Currently they have 16 outlets, and they want to open more 10, 12 outlets in next 15 months. So that's the target and on track.
All right, we take that point, Rishabh. Thank you so much for joining in. Quick snack and a crunchy one. You've given us a lot of numbers and a lot to munch over as we speak in the next quarter as well. That's the management of Bikaji Foods. What we'll do is take a short break, and as we do that, the countdown for Budget 2026 is underway. The most influential voices decode, analyze, and speak about the impact of these policy decisions from the Finance Minister. It's a power-packed lineup that we bring you throughout January, the day of the budget, and the week after the budget as well. Market veteran Ramesh Damani, Helios Capital Sameer Arora for all things market. JP Morgan Sajid Chinoy joins in to discuss the macro signals. We also get you insightful analysis from industry veterans, and Dinesh Karambar along with Ashok Wadhwa join in for the tax rhetoric.
You want to talk business? Meet me in the Onboard Lounge.
Welcome back. The market is extending its gains, now closer to that 25,300 mark, and it's led by a lot of these old economy stocks. You have ONGC, which is up 6%. Sharp spike in Brent is what we saw overnight, $68 per barrel. So all these upstream oil companies, ONGC, Oil India, doing extremely well. Coal India, Hindalco, BEL. So among the top Nifty gainers, the five of them, all of them belong to the traditional economies. So we have Coal India, Hindalco, ONGC, BEL, and PPCL as the gainers. Axis Bank as well, weighing in with a gain of almost 1.3%. But speaking about some new companies, the new listing today was that of Shadowfax Technologies. Abhishek Bansal joins in. It was a softish listing in this market. Obviously, the issue was subscribed about 3 times as well, led largely by QIBs and a bunch of retail investors. A momentous occasion, as you can see on your screen, the visuals, the founders ringing the bell out there, listing at 112 rupees versus the issue price of a little over 120 rupees itself. Abhishek, thank you so much for joining in. Irrespective of the way the market is poised right now, it is an important day in the life of your company, and more importantly, it's the start of a journey where you will have to speak to investors on a regular basis, and it's a milestone, not a destination, as we say in the listed universe. Thank you for joining in, and congratulations on achieving this milestone. Now, speaking about milestones, the last time you joined us, you did say that, this 30-35% sort of revenue growth is likely to sustain. The first half of this year, you've done 68% because of increased aggression towards growth. And typically, the second half of this year, or any year, you do about 60% of revenues. So if I back calculate that, given your first half numbers, you are pretty much on track to that 4,000, 4,500 crores this year. Is that a milestone that the analysts should work with, at least for FY26?
Thank you for having me here. It's my pleasure to speak to everyone. Well, again, as you would understand, it's tough to give a forward-looking guidance.
Now you're listed. You don't need to worry.
Publicly disclose our numbers. Yeah. No. I mean, we have had a phenomenal season. We look forward to delivering an exciting year of growth. And we believe that the growth that we have seen this year will continue happening over the next few years. With the capital markets behind us, we are going to rapidly invest into automation, building state-of-the-art technology, and more importantly, trust between our customers, our sellers, and ensuring that every household in this country is being serviced by Shadowfax.
Okay, all right. But Abhishek, first of all, good morning. Congratulations on the listing. And I love the visuals that come in during these listing celebrations, right? Because you'll take all the kids from the family, all of them get to ring the bell. Lovely sights out there. But now a lot of responsibility on you guys. So give us a few more details. Street is pricing in 145 crores of EBITDA this year. Is it possible?
Again, tough to give you a number like this.
No, Abhishek, now you can give. The regulator's on board. You're already listed. It's okay.
No. I think we'll wait for the
okay,
official communication.
Let's try it this way. You don't give us numbers. Just tell us whether our thinking is on the right track or not. Basis what you've done in the first half versus what you usually do in the second half. 4,000 crore revenue, is that on the right track on our thought process? And, as what Nigel asked, about 140, 145 crores in terms of EBITDA, because that's what the street is pricing in when they assign a multiple to you. So we just want to know whether the street's thinking is in the right direction or not. Is the thinking in the right direction?
Yeah. No, you're thinking in the right direction. That's the number we are aspiring for. And again, given how second half of the year generally looks like, we have grown very, very aggressively at 65% in the first half. Second half being the festive season, we expect some good results to come in. Our first results will probably be out in another 2.5 weeks from now. So looking forward to that.
So ballpark then, margins will be in the mid-single digits, right?
Yeah. Margins will gradually improve. We operated at about 2% EBITDA last year. This year, we have operated in the first half at about 2.9% EBITDA. We are going to see gradual increase in margins every quarter.
Now you're talking, Abhishek. We like it. So what is the longer-term horizon in terms of margins? Where is it headed? High single digit, not in the near term, in a longer term.
See, a business like ours, if you look at some of the global economies, some of the Western countries, you will see typically express parcel companies operate at a early pre-teen sort of an EBITDA number. I think that's a sort of a number we'll probably look to aim towards over the next, or in a steady state sort of a view.
In the next 5 years?
Hopefully, yes.
Hopefully, yes. All right. Next 5 years, pre-teen sort of margins, that's the global aspiration or the global benchmark, and that's your aspiration. But that also means that you'll have to do a lot more of your value-added services. Currently, it's about 40-45% of sales. Where do you expect that mix to go? And also quick commerce, which is about 20% of your business. Where do you expect that to go?
I think value-added services are a very, very important part of our business. It is something which our customers love, which create a big differentiation for us thanks to the tech agility and some of the rollouts that we have been doing. We expect value-added services to remain a similar sort of a market share for us as part of the overall portfolio. Quick commerce, again, it's growing at a rapid pace. It's probably one of the fastest growing verticals for us as well as for the industry. We are going to see accelerated growth for us. Today, quick commerce is at about 20% of our business. It'll marginally grow by about, in terms of the split, maybe about close to 30 to 40% over the next 4 to 5 years.
And is quick commerce more margin accretive for you?
No, it is. I mean, we are probably the single largest players in quick commerce in the country today. We power every quick commerce company, be it horizontal quick commerce, vertical quick commerce. And if you look at quick commerce as a business, it's a platform play. It's a very, very high return on capital invested business for us. Completely a platform play where we're working with every player who's delivering to our home in minutes today.
Abhishek, one final question from my end before we let you go. Their top client accounts for around 50% of business. Is there, a focus on, de-risking from this top client?
Absolutely. That's probably one of the biggest focus for any organization, and especially in a market structure where we are today. In our structure, given, the top customer in a quick commerce vertical, or be it in a e-commerce vertical for the industry, they'll account for a lion's market share, and that certainly reflects in the market share for a logistics company like us as well. But as I've said before, I think one of the biggest targets for us, now we have built out the network, we have got the anchor customers, we have got profitability. The idea is to democratize this service and take it to every seller, every D2C brand in this country. One of the biggest areas we are going to invest in is ensuring that every small seller, every small D2C brand starts using Shadowfax, and over the next 4 to 5 years, we become the de facto of doing logistics in this country.
Right. A lot of the logistics players, a large logistic player in the country, be it a traditional one or the new age ones, everyone aspires to deliver everywhere in the country. So it is heating up when it comes to competition as well. But like you said, execution and value-added services that you give will be differentiators for players. You've gained market share. Let's see whether you sustain it out there or not in the eyes of intense competition. Just a final question before we let you go, Abhishek. You've also earmarked 200 crore for acquisition. Have you, enlisted any sort of potential asset that you want? What are your acquisition timelines here? Can we hear anything very soon?
So again, we are pretty exploratory in terms of acquisition, nothing that I can disclose right now. Our whole idea from an M&A standpoint is to acquire interesting categories. Last year, we made a small acquisition in this company called Critical Log, which was doing high value, time-sensitive sort of deliveries. We love that asset. We saw at a great value add to our existing customers. We love doing value-added services, and anything and everything which we can sell to our customers, which can be differentiated from the market, where we can charge a premium, is something that we'll be interested in. But nothing in the next couple of quarters which I can disclose right now.
Yeah, but you said that you are eyeing some value-added spaces. Is there any place where you see a gap in your portfolio which you think is very interesting, very small in the market right now, but you expect it's going to be big? And I'm not asking for specific companies, names or anything, just capabilities. If you could give us a sense on the direction that you're looking at.
I think one of the biggest capabilities now we are getting into is white goods and delivering some of the larger items. That's one portfolio which is missing for us. It is going to be a big driver of market share growth, revenue growth for us in the coming years, and that is something that we are investing in right now.
All right, Abhishek, thank you so much for joining in. Subdued listing today, but good future is what you are promising the street, and the street will take note of that. Good luck to you, your family, and congratulations once again. We'll speak after your quarterly numbers are reported. Take a short break, come back, getting more on the markets and a lot of stock-specific action. Stay with us.
Welcome back. You're tuned in to Chartbusters. You're on CNBC-TV18. Well, let's focus to our special segment where we get you a few ideas for profit from Money Control Pro. Khushbu Rai Gupta of moneycontrol.com joins us to talk about a stock that she's tracking closely. Khushbu, take it away.
In today's idea for profit, we have Mahindra Finance. Mahindra is a market leader in tractor and utility vehicle segment with a deep penetration in the rural market. The company is driving its transformation agenda by adding new verticals and embracing technology to complement and strengthen its core business. It has put up a roadmap aiming to improve asset under management, cost ratios, and stabilize asset quality and net interest margin in order to achieve higher return on asset. The company is changing its customer mix by increasing the non-vehicle share and going digital. On the earnings front, strong signs of recovery has been witnessed in the tractor and SME segments, which could lead to robust disbursement growth. As the inventory level rise, we see an uptick in advances to be driven by both new verticals and used vehicles. Overall, Mahindra Finance is a long-term growth story and the current valuation also looks very reasonable. The stock should be accumulated with a long-term view.
All right, a big move is what we're seeing in the broader markets right now. 350 points for the mid-cap index, 2,000 stocks advancing, and some of those gainers are only extending their gains. The likes of CG Power, which is up 7% right now, and also seeing some traction on a lot of these metal names. We'll wrap up on this edition of Chartbusters on that note, but you don't go anywhere. The team of Trading Out comes up next.
Cool. You can see footage on your screen. The President of India, Draupadi Murmu, arriving for her joint address to the Parliament. And this comes at the start of the budget session, just 3 days before Finance Minister Nirmala Sitharaman will present her union budget on Sunday this time around. And before that, as the session is about to begin, President Draupadi Murmu will be addressing both the Houses of Parliament in her address at the start of this budget session. Of course, we'll have the economic survey that will be presented tomorrow and then followed by the budget on Sunday.
Right, it's an important week for the economy, the markets, policy making. And you know where to watch it, CNBC TV18. And that's exactly what you're doing right now. You're watching us live from the CNBC TV18 Motilal Oswal studio. This is Trading Hour. I'm Manglam Malu, with me Hormaz Fatakia. And as always, Ritu Singh joins us as well. It's been a good start to the February series. The Nifty is up 120 points. The mid-cap index doing a lot better, with 2,100 stocks advancing for about 800 stocks which are declining. Important levels conquered on the Nifty Bank as well, above the 50 and the 20-day moving average. And more importantly, it's all about earnings. A lot of stocks moving in big directions on either side. So the top Nifty loser right now, Tata Consumer, Asian Paints, both of them down about 5%. Post what was a resilient set, but the broader markets, there are some serious fireworks in terms of earnings. Mahindra Logistics up 12%. Big surge is what we've seen in Metro Brands, International Gemological Institute. So very, very stock specific. Ritu?
Yes, and very stock specific, and it'll continue to be that, especially in the run-up to the budget as well. Whether that is infrastructure, consumer, all of those stocks are going to be in focus. But earnings, as for now, dominates. The markets, broader markets, seem to be back in the game, if we can say so. I mean, the Nifty, like you said, trading up about 115 points as we speak. The Sensex also up about 380 points. Brent, by the way, it's inched up to $68 per barrel overnight. And that is good news for some of the oil companies. So those are in focus as well today. We'll keep an eye out on that. The Nifty Bank, that led the recovery in Tuesday's trading session, again up 1.8% as we speak. So looks good as we start this show. Let's toss it across to Hormaz for more stock-specific action and some of the names that are buzzing in trade today.
It's been up-down all morning, but more up than down, and the bulls will take that, especially considering the way the Nifty Bank is moving. You spoke about oil, and that could well turn out to be the proverbial joker in the pack as we go forward if these oil prices keep rising. And that has had a benefit on both ONGC and Oil India. You look at the prices here, 6% higher for ONGC, the fifth straight day of gains. Oil India is up 7% as well. You take a look at the volumes here. ONGC is at almost 3 crore shares that have been traded, almost 8 to 9x of its 20-day average. Oil India too has had over 1 crore shares that have already been traded in the first 2 hours of the trading session. The 20-day average being just around 11 lakh shares. So strong moves on both ONGC and Oil India. Earnings, as Manglam was highlighting, stocks moving on either direction. 2 names where the street has been left a little disappointed. One being Asian Paints. The stock was down yesterday after the results were out. It's extending those losses today, 5% lower. Vishal Mega Mart too, 4% lower on the stock, and both of them are declining on strong volumes. 15 lakh shares have already been traded on Asian Paints. The 20-day average is just 2.5 lakh shares. Vishal Mega Mart has had over 1 crore shares that have been traded, the 20-day average being less than 20 lakh shares. So strong volumes on both Asian Paints and Vishal Mega Mart. But on the flip side, the stocks that are being in the news, one positive earnings reaction has been on Motilal Oswal. That stock is up 10% now as we speak. MCX continuing to make new record highs every single day, now nearing the mark of 2600. And Vedanta, of course, the OFS that it announced for its subsidiary Hindustan Zinc, and that too is at a new high now, nearing the mark of 750. You take a look at the volumes here. Both Motilal Oswal has had over 20 lakh shares traded. MCX and Vedanta too, both of them trading at volumes that are significantly higher than their 20-day average, Manglam.
All right, take that point, Hormaz. Thanks a lot for that. Those are a bunch of buzzing stocks, but none more than Tata Consumer, the top Nifty loser right now. Confounding, because the results were fairly resilient. In fact, there was margin expansion, as the management had earlier pointed out as well. Maybe there is something that the street is nitpicking, perhaps the international coffee prices and maybe the outlook out there, the demand, etc. So who better than the Managing Director and CEO Tata Consumer Products, Sunil D'Souza, joining us here on the numbers as well. Sunil, thank you so much for joining in. And that exactly is the first question, because we'll obviously speak about demand, business, and how margins are likely to pan out. But is there something that the street has missed this time? Or are they worried about something? a big gash on a Nifty stock after what is a resilient performance is quite unusual. Have you done any fact finding here?
So Mangalam, thanks for having me. Our job as management is to deliver numbers, and it's for the street to decide what the share price should be, right? And I do think we've delivered a decent set of numbers. We've crossed the 5,000 crore mark for the first time in a quarter. 5,112 for the quarter, up 15%. EBITDA was up 26. Group net profit was up 36. So financial numbers look good. It was a volume driven top line. Tea up 3, salt up 14, Sampan up 45, ready to drink up 26. Growth businesses grew 29%, contributing to 30% of our business, in line with what we had guided for. International grew strongly, bit soft on the bottom line, driven by US coffee prices. But you know what? We've taken our latest price increase in January. That covers for most of the coffee pricing, and therefore from here EBITDA margin should look better. Strategically, I think we're in a good place. Innovation up to 4.8 against our target of 5. Quickcom grew 100% for us.
Right.
Ecom plus Quickcom is 18%. So all in all, a good set of numbers. I wouldn't comment on the share prices per se.
All right. Okay, so let's try and figure out what the street could perhaps be a little worried about. And if you can address those concerns as well. One, on margins for the international business came down from about 14% to about 12%. You had earlier said that the exit quarter consolidated margins would be upwards of 15%. Are you on track for that? Secondly, Capital Foods and Organic India still haven't hit the 500 crore per quarter sort of run rate. It's still about 350, 354 crores. Do you think, that is likely in the fourth quarter?
Yeah, so Mangalam, we've guided for exit to close to 15% EBITDA margin, and we remain on track for that. 14.2 this quarter, which is up 60 bips versus last quarter, and 120 bips versus last year. Actually, if I add the negative of the US coffee alone, I'm at a 15% already this quarter. So having taken the price increases in the US, we remain confident of getting close to that number by the end of this quarter. That's number one. Number two, for Organic India and Capital Foods, overall margins remain very strong, 48% or thereabouts. Capital Foods domestic has improved sequentially month on month. The little bit of pressure was because 20% of the business comes from exports, and the US tariffs have impacted us a bit because retailers have downstock. But that said, we've taken the price increases, remain confident of driving it. Organic India grew 26% this quarter, so there's no reason to worry. On top of that, actually speaking, we've made rapid changes in our go-to-market systems in India to make sure we provide additional focus. Just to put it in perspective, when we started off, we had separate sales people by category with common distributors. But over a period of time, we've realized we needed to separate distributors as well. So right now, we've gone with 3 different models, where salt was overwhelming. It's a salt separate distributor. Everything else is a separate distributor. Where tea and salt was overwhelming. For example, in Calcutta, 91% of the business came from tea and salt. Only 9% was growth. We created a separate growth distributor. And in other geographies, we've created a separate salesperson who goes to smaller outlets and a focused high caliber salesman who goes to the larger outlets. So with that and portfolio expansion and continuing to put A&P, we remain confident of driving these numbers up.
Mr. D'Souza, this distribution efficiency drive that you've undertaken, if you could give us a little more clarity, I mean, all these changes that you're talking about, where will the gains start to show up first, and how quickly will they start to show up, whether that is, faster revenue growth, margin improvement, where do you first expect to see these gains?
So these gains will primarily come in the top line, and they will come simply because of focus. When we became a multi-category business, so to speak, right? Just from a tea and a salt, we went into Sampan, we went into ready to drink, we went to Capital Foods, Organic India, Soulful. To give focus at the front end, we started to have separate salesmen. Just to make it simple, it's a tea and coffee, salt and Sampan, and Capital Foods and Soulful. But what we've seen is where, like I gave you the Calcutta example, where tea and salt is overwhelming, the focus of all the salesmen, the supervisory force, everyone is to make their numbers. It's easy to do the bigger categories, right? So therefore, we've separated it out, right from salesman to distributor to supervisory, both the territory sales executive and area manager. So there is separate focus. We think we'll get distribution expansion and we will get SKU expansion in the stores that were present to drive top line. The pilots that we ran for about 3 months bear this. In some of the cities, we got nearly a 60% uplift in SKUs. In most cities, we got a 20 to 25% increase in top line. So we remain confident of driving top line. The margins are in a pretty comfortable place.
Mr. D'Souza, the two numbers that stood out for me in the quarter, as I look at the numbers, one was the growth in Sampann, as you highlighted, and the other one being the growth in Narishko. Both of them were comfortably above what the street was anticipating, but at 45% and at 26% for Sampann and for Narishko, do you believe this is a sustainable rate of growth? And if not, what is a normal sustainable rate of growth that you are envisaging for both of these businesses?
So both these businesses form part of our growth portfolio, and we've always guided for a 30% growth. And I wouldn't change the number there. Yes, we do try to hit sixes instead of fours from time to time. And I think this quarter we've done that. Ready to drink is broadly in line with the 30% guidance. It's 27 volume actually. And we're in a good spot. We've very, very clearly decided to focus on 3 pillars, a full stack of water, right from Tata Copper up to Himalayan, and with a lot of value-added waters, you'll see a lot of launches coming in. Clear portfolio on affordable hydration with the cups portfolio and tea, coffee. We've got kombucha, ready to drink, coffee. Now we've launched a 50 rupees coffee, etc. On Sampann, I think there are 2 categories which have really driven the numbers. The growth has been broad-based, including our core of pulses, poha, makhana, all that. But also our new launches of cold pressed oils and dry fruits. I think they have been exceptional. Dry fruits, actually, I'm close to a 300 crore annual run rate now. Similarly with the cold pressed oils. And these are products launched in the last 18 months. This whole hypothesis of entering categories which are low trust, providing high quality products with a Tata brand name, differentiated, I think has worked to our advantage.
All right, just a quick one before we let you go. Sunil, 20,000 crore this year is a foregone conclusion with 15% exit margins, almost 1,000 crores on Narishko as well. Next year, the revenue, margin and Narishko growth target. 3 words.
So, Mangalam, nothing changes. Double-digit top-line growth, EBITDA margin expansion. We will exit close to a 15% this year. In the medium term, we're targeting to be around 17 in the next 2 to 3 years. So directionally, it will move in that. And Narishko, 30% growth, I think is a given.
Take that point. Thank you so much for joining in. And like you said, it's the street's job to value the business. Yours is to deliver the numbers. Wish you good luck for the 4th quarter. Take a short break, come back. We get joined by the management of IGI to discuss their results as well. Let's talk buzzing. After a very good performance, Ishwar Iyer, who's the CFO, joins us in our studio.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back, and earnings reactions all over the street today. Positive ones, negative ones, but focusing on the positives, IGI is one such name. Gains of up to 9% that you've seen in today's trading session. It was a strong quarter that the company reported as well. Now, to discuss the quarter gone by and the road ahead as well, now being joined by Ishwar Iyer, the CFO of the company. Ishwar, good morning. Thank you for joining in.
It's been a pleasure. Thank you for having me here.
What defined this quarter? You mentioned that there has been a comeback of the natural diamonds as well. Do you believe that it is here to stay, or the focus, as has been over the lab-grown ones, that is continuing to be the focal point?
Yeah, I think over the last 4 or 5 quarters, I think strategically the company has been finding ways and means to penetrate the natural diamond segment as well. Of course, we've been in this business for 50 years, and as independent certifiers, I think we have a good standing. The endeavor of the organization, therefore, has been, while LG has enabled us to scale up, how do we therefore penetrate the ND market has been one of the important strategic levers that the organization has been working on. So over the last, I think, 12-15 months, we're making significant progress in that direction in terms of improving our penetration, improving our reach, and therefore engaging with the retailers far more than what we used to do earlier.
It's beginning to show as well on your numbers. You know, certification revenue growth this time, 45% was led by natural diamond and 35% by LGD. Importantly, your average realized price was higher, so natural diamond obviously has higher realizations, and this has happened for 2 quarters in a row. So if you can give us a sense on whether you've gained market share, the market has grown, and what have you done differently to make this inroad into the natural diamond market, which has a bigger leader? What does your number stand at right now?
Yeah, I think over the last, as I just mentioned, 3-4 quarters, we're building far more capability within the organization in terms of providing ND the direction that it requires. So I think we've been able to therefore get in people with stature, etc., to provide impetus to this business. So from that standpoint, I think we are gaining share. Our engagement
right now?
See, in India, I think we should be around the 40-50% range.
And how much have you gained so far?
It's very difficult to quantify that. But what the way we try to assess it is in terms of, do we get new customers coming in? Is there a scale up of the existing customers? I think those are trends that we know, because gauging customer share in this industry is pretty difficult. So from that context, yeah.
Has that happened? New customers?
Of course, that's the reason. When you say, for this quarter again, 40-45%.
Neither of us wear any of the diamonds, get them certified, but perhaps our co-anchor from Bangalore may be interested in a few. Ritu, you have a question?
Yes, Mangalam, I'm quite interested because, I see, Mr. Iyer, you started grading lab-grown jewelry as well, not just loose stones. Is that going to be the next big growth engine, and how do the margins compare? I mean, does the bling start to fade when it comes to jewelry or loose stone? I mean, just give us a sense of how big a part of the business will it be?
Yeah, I think over the last few quarters, we've been noticing significant investments that has gone into the lab-grown segment. We have a lot more players coming in. There's a lot of private equity investments coming into the segment. And, we've talked about this in the last 3-4 quarters whenever we met up in the studio here. I think that is probably a new growth driver for this industry, because the lab-grown, the initial consumer foray into lab-grown was in the US. But with the Indian consumers coming into the faith, this could be the massive leap for the industry as well. From that context, I think, yes, it continues to play a very significant part of our portfolio. Yes, the realizations on jewelry obviously is lower versus loose stones. But regardless of that, I think we'll continue to focus on this emerging segment in India as well.
Well, speaking of that emerging segment, quickly, Mr. Iyer, lab-grown diamonds are just getting cheaper and cheaper for now. That's the trend we've been seeing. But, does the need for certification, you think, will actually come down when it comes to lab-grown diamonds? And, will trust start to matter more? So, over a longer term, how do you see this story playing out?
Yeah, very relevant question. I think a couple of points here. I think over the last 4-5 quarters, there's been a significant stability as far as the lab-grown diamond pricing has been at the wholesale. Along with that, I think the need for certification today, at least from a certification from an independent third-party assessor, is far more relevant than what it was in the past, because we have natural diamond on the upper side and then lab-grown diamonds in the middle and then glass at the bottom end. So unless the consumer gets to know what he's buying, and there are value differentials across these 3 segments, Therefore, the need for certification, therefore, I think is going to be far more relevant as we get into the future.
The need for certification, no doubt about that. The need for third-party independent certification, no doubt about that as well. But from just a consumer standpoint, oftentimes, the brand that they buy it from often becomes the certificate of quality itself. And I say this specifically for a company like Tanishq or the Tatas, right? When they started their carat meter, we didn't even have the BIS. And now the BIS machines are modeled on what their own testing machines are. So in a way, it's the government paying nod to the quality and purity of the brand like Titan. And now they've started Beyond, which has lab-grown diamonds as well. So that is one. And the second part is they've also started to install carat meters or measurement diamond purity machines in their own stores. So with brands coming up with something like this, do you think you will still need a third-party independent?
See, the independence is finally what determines the price. So obviously you need can I call for lack of a better word, a segregation of duty here in terms of you can't self-certify what you're selling.
Yeah, but
so from that context,
the kind of trust that they've built, they
of course there is no disputing that. Tata's is number one as far as the Indian continent goes. But of course, for other brands, unless you're able to scale up with the trust element like the Tatas have, it becomes very difficult for them to then self-certify and sell that. But from a consumer standpoint, I think we still will need to look for an independent certifier to finally, measure the quality of the final produce that they're buying.
Talking about the trend, but it all boils down to three numbers. What is the kind of number of reports that you're targeting next year? What is the kind of realization that you're targeting next year? And eventually, what does that mean for your revenue margins and PAT?
Yeah, see, from an industry standpoint, I think we delivered, at least IGI delivered close to 21% volume growth this year on the back with a 18% revenue growth. But we are seeing significant tailwinds in the industry. There is a lot of capacity that is getting added from the lab grower standpoint. There is, as I mentioned, a lot of investment coming into the lab-grown jewelry segment. And of course, our endeavor to accelerate our share and penetration in the natural diamond segment. So I think the tailwinds remain strong, and we are confident of probably repeating this performance into 26.
Repeating, not bettering.
Let's hope for the best, yes.
Realizations?
See, India has pulled back on the realizations over the last 12 months because we were trailing because we took a price correction 24 April, May because the lab-grown pricing had corrected at that point in time. Post that has been pretty stable, and thanks to the performance on the natural diamond segment, at least in Q4 and Q3, that's enabled us to pull back and get back to just above what we ended last year. So that's a significant achievement for the organization as well.
1,000 rupees coming next year.
Sorry, sir?
1,000 rupees coming next year.
Let's hope for the best, but it's too early days for us in terms of providing a forward-looking guidance. But yes, we'll come back in due course.
All right, Ishwar, pleasure having you today. Thank you so much for spending time and joining us today. Wish you good luck for the rest of the year as well. And the management of IGI there on their results, the stock 9% higher at 317. Take a short break. Just as we do that, here's a quick heads up as India gears up for Budget 2026. The big question around growth priorities, reforms and the road ahead takes center stage. Budget Vision 2026, what India wants, brings together top corporate leaders, economists and policy thinkers to share their views on what they expect in the upcoming budget announcement. You can watch Budget Vision 2026 on the 30th of January, 10 a.m. in New Delhi. Welcome back. Now, the fourth edition of India's flagship energy conference, the India Energy Week, is underway in Goa. And from the sidelines, Manisha Gupta caught up with S&P Global Energy's president, Dave Ernsberger, on his outlook for energy prices in the backdrop of geopolitics and trade concerns. Listen in.
Joining us here at India Energy Week is Dave Ernsberger. He's president, S&P Global Energy. Dave, thank you so much for joining in. First of all, your sense on all the geopolitics, trade tariffs, and its impact on prices and demand that you would have seen.
Well, this week here in India is actually an exciting week in the global markets because it's the first week after Davos where a lot of the geopolitical narrative for 2026 was teed up and actually advanced a little bit. And what we know coming out of Davos and what we're talking about here in India Energy Week is how is this uncertainty around geopolitics playing out in the price of commodities, particularly oil and gas at the end of the day, and what does that mean for demand? And the verdict so far is that the oil and gas markets are not discombobulated, they're not broken, they're flexing to this new situation that we have. And it's been very exciting to see here in India the way that any source of incremental demand in the market is playing its part in moving that conversation forward. So. Volatile environment, but the markets are coping well, and India is a big part of that.
How would you also look at India energy security, because that seems to be the conversation around?
Well, the most interesting thing to me here this week is seeing the queue of sellers lining up at the door of India's buying community. And that's great news for Indian energy security. We heard from the Canadian energy minister this morning here in Goa. I've talked with some folks who were representing Venezuelan sales in India who are here also looking to do partnerships in India. So the opportunity to diversify suppliers to India has never been greater than it is this year.
How are you looking at the global markets? Do you think they will settle down anytime soon? And where would you look at the crude prices from here?
Well, certainly the energy markets are fairly settled. We see certain pockets of price movement. U.S. natural gas prices are getting a lot of attention this week. That's a very localized phenomenon. The price of gas in India is actually relatively competitive compared to what it has been over the past few years, and so is the price of crude oil. Generally speaking, in the global market, we're expecting to see oil prices averaging at about $59 to $60 a barrel over the course of this year as a whole. I know they're higher than that now, but for the year as a whole, we see them settling back a little bit. And in the next 2 or 3 years, we see prices averaging around $62 a barrel. So, markets are moving a little bit in the here and now, but they're actually very settled and tilting towards being a little bit oversupplied for the next couple of years, which, again, if you're a buyer, is great news.
All right, from crude, let's shift focus to the bond markets. This is our segment Bond Street, where we bring you the latest on the developments on that front. The bond yields, they are trading higher today. The 10-year government bond yield, in fact, now is at 6.7% compared to about similar levels where it closed at yesterday. And this is the highest level that we've seen on the 10-year benchmark since March of 2025. So that's an 11-month high that we're talking about at the moment. That is when it had last touched this kind of a level. Now, the main reason why yields are not really coming down is because of the heavy bond supply that is expected in the coming months. Now, when the government borrows, typically it does by issuing bonds, and if investors feel there's too much supply coming in the market, not enough demand, the prices tend to fall, and because of the inverse relationship, the yields move up, and that is why, expectations of a large government borrowing immediately start to put pressure on yields even before the actual bonds are issued. Now, markets are squarely focused on the upcoming budget, where estimates suggest there will be a much higher central government gross borrowing, as per various estimates, anywhere between 6.2 to 16.5 lakh crore rupees. That's compared to about 14.7 lakh crores for FY26. Now, so far in the current fiscal, about 12.8 lakh crores has already been raised, and that means the market is still preparing for a large remaining supply. Now, that is as far as the central government is concerned. The states are also coming and tapping the market heavily. The total state borrowings for FY26 was pegged at 11.83 lakh crores, and a record 5 lakh crores is still expected to come in the current quarter alone. So the large supply of bonds coming to the market with both the center and the states coming at the same time is putting a lot of pressure on yields. Now, RBI is doing its part. It's announced multiple liquidity injection measures to support the market, including that 1 lakh crore rupee of bond purchases through the OMO, which it announced on Friday, and it has now even advanced it to tomorrow as early as that. It also did a $10 billion forex swap for 3-year tenor, which will be done later in Feb, a 25,000 crore 90-day, a longer day VRR. In fact, this year, RBI has announced a record high 6.6 lakh crore OMO. And even with the CRR injection, the swaps and the currency leakage, if you factor all of that in, the total liquidity injection in this fiscal year by RBI has been at record high 5.5 lakh crores so far. So no half measures from RBI, but despite all of this, the yields are refusing to budge, because the supply is very large, and therefore liquidity support is working more as just a cushion rather than a full solution. Now, take a look at yesterday's state bond auction, which RBI disclosed. 15 states have raised about 38,300 crore rupees, with cut-off yields ranging between 7.15 and 7.64%. The amount is actually lower than what was scheduled and lower than what the market was expecting, partly because Maharashtra did not accept bids in one of the bond reissues. But, the bottom line really is that bond yields are rising not so much because of the liquidity factors in play, but because the market is now preparing to absorb a very large volume of government borrowing. And until there is more clarity on these borrowing numbers and the supply calendar, yields are unlikely to come down from these kind of levels.
Right, that is the focus on bond yields there. Ritu, thank you for summarizing that for us. Just before we take the break, pull up Car Trade Technologies. Numbers were out just a few minutes ago, and the stock has taken a bit of a nosedive as we speak. 9% lower now on the stock for Car Trade. Remember, the big underperformer that Car Trade was, it moved up from levels of less than around 300 rupees up to 3,200 rupees, and from there it has now come off to levels of 2,300 as we speak. So 9% lower on Car Trade Technologies. Mind you, the numbers look okay at the sight of it. Margins have expanded, EBITDA growth of 56%, revenue growth of 19% as well. We'll get you more details as the day goes by. For now, Car Trade Tech 9% lower. Take a short break. Get you more on the markets on the other side. Stay tuned.
Well, while we're talking about results and corporate earnings, etc., there is an important underlying trend that we're also tracking right now, and that is in our special fundraise segment. Sridhar Sankaraman, who's the Managing Director of Multiple Alternate Asset Management, joins us now. Sridhar, thank you for joining in. You know, there's this trend of a lot of PE-backed companies hitting the streets, etc. There is this underlying macro trend of discretionary demand picking up. in manners which aren't captured by some of these traditional incumbent players as well. But at the same time, a lot of PE money is going into iconic family brands, which have been run fairly well, but now maybe because of multiple reasons, they are looking at either value unlocking or new arenas for growth for them, and the PE runs that company. One of them has been VIP. I've got to ask you, the big deal of last year was multiples going ahead and buying a company as legacy-like as VIP. While the brand is a legacy brand, the industry right now is scattered with a lot of these new age brands coming in, etc. Does it still hold the relevance, and what is multiple strategy of turning VIP around from here?
Thanks, Mangalam, for having me. Thanks, Hormuz. A quick stat, Mangalam. The last 5 years, about 40 families have actually sold their businesses to private equity, and 10 of them are in the consumer space. So this is not, but I still believe we are only at the tip of the iceberg. I would not be surprised if this number is 400 in the next, sort of in 5 to 10 years. It's because the next generation is telling their parents that, listen, we'd like to do something of our own. And parents are a lot more, sort of receptive to the fact that I leave cash in the hands of the next gen rather than pushing them to run a business that they may not be interested in. And here is where private equity funds like us want to use this opportunity to buy some of these legacy businesses. Some of them could also be undermanaged and see how do we unlock the full value, right? I mean, out of these 40, 10 of them are in the consumer space, VIP being one of them, Eureka Forbes is the other. You saw Dairy Day, Vinny Cosmetics, Fog. I mean, so many examples are really coming through, right? VLCC, and so on and so forth. So this is a very important part of the strategy for us as multiples, and we are really doubling down on this. We think there is a lot of money to be put out in this space. In the West, shareholders and management have always been different. But in India, you always had the owners also, sort of running the businesses. This is the change that's happening, and we think private equity is a very good transition for these families. And multiples being local, Mangal, for us, our ability to understand families, the nuances, the relationships between them, and be sensitive to that has, I think that's what has allowed us to play in this space. We did 2 deals in this space last year. One was VIP, as you said. The other is Qburst, which is a tech services company based out of Kerala. So we bought out that as well. And we are really looking at this as a large opportunity.
But while you speak about these things, oftentimes what happens is between the PE coming and the family deciding whether they want to sell it to the PE or not, there is a lot of critical time lost. And by critical time being lost, critical brand salience is also lost. So you named a bunch of these companies, barring Eureka Forbes, which also is currently an uphill battle. None of these investments have actually turned the fortunes around of a company which was once legacy. What's different this time for VIP, or what do you feel would be different?
Well, I would say this is a very recent strategy for a lot of funds. So it's been the last 3-4 years is where you saw the action. And JB Chem, in terms of the pharma company, has been a great example. It was listed, and it was taken over by a private equity fund, and it was a great outcome. So there will be a lot of examples. I think I would say picture abhi baki hai on this. Okay. But Mangalam, very quickly on VIP itself, right? We think that the core DNA of the company is brands, and they have 5 brands whose top of mind recall is very high. At the bottom of the pyramid, there is Aristocrat and Alpha. At the middle of the pyramid, that is clearly Skybags, which is youth, VIP, which is much more classic, and then at the top you had Carlton, and then there's a handbag brand called Caprese. So top of mind is high, market share is low. So the more difficult problem is solved of saying that there is brand awareness. We are just focused on picking the low-hanging fruits, and we are just surprised with the number of low-hanging fruits we have to pick. There was no CEO in the company. The CFO had become the CEO. So that's the first fix that we did. There was no CMO in the company, so we brought in somebody, CMO. The head of HR was pretty much also the sales head. So, these are all really the low-hanging fruits from a leadership perspective, right? And we think that a private equity fund will bring in the strategic agility to extract the full value of these brands. In some
across to Ritu, who might be a potential customer of the Caprese bags. Ritu, take it away.
Well, not so much the Caprese bags at all, actually. But, Sridhar, just to get back to VIP, because you're talking about the kind of churn at the leadership, and you've brought in people, since your acquisition, the MD has exited, promoters have partially sold down, competition is quite intense as well. So one, how are you ensuring execution doesn't slip during what seems to be this transition phase? And secondly, Dilip Piramal still holds about 20%. Should the market expect further stake sale? And does full control really matter for you to unlock value as far as VIP is concerned?
So I will answer the second question first, Ritu. So we, along with Mr. Piramal, have the entire. So we have the full board control as well as the management control, and we have from a sort of stake perspective and from an ownership perspective, it is very, very clear that it is with multiples, and the consortium of multiples that is really in charge of the company. On the first question, see, there are categories where there is higher barrier to scale. You can build a brand quickly on Instagram, but it's equally difficult for you to build a brand that reaches a scale. The entire luggage industry is in that category. 70% of that market is still offline. So here you have in VIP, 25% of your business is online, 20% is MT, 20% is GT, you have CSD, you have B2B. It's a very, very diversified channels in which this entire product gets sold. You just can't be an online only player and hope to get scale, which is why my earlier point on saying one of the few categories with higher barrier to scale. Number two is there is something that's happening in this business, right? All of us, when we were growing up, we had one TV in our homes, and it was called broadcast. That's changed to unicast, where all of us are watching stuff on the phones. Similarly, in luggage, all of us had 2 bags in our homes, and whoever would just travel to carry those 2 bags. But now your bag is different, your wife's bag is different, your kid's bag is different. So there is this whole personalization that's happening, which is why one of the few consumer categories which is having a double-digit volume growth. One of the very few consumer
categories. And in that,
categories.
unfortunately, VIP didn't participate. And that's the question,
which is what
right?
we are hoping to change.
Right. The other part in that itself is, you said low-hanging fruits in terms of management, etc., was taken care of. Now, there were also low-hanging fruits of a lot of unsold inventory, which was there, a lot of, perhaps fractured dealer relationships and places where others had also gotten some space.
Yeah.
How far along are you in fixing that? And secondly, Mr. Piramal still holds 20% stake. You hold 32% stake. While you have full control of everything else, were Mr. Piramal to be very happy with the performance that you've done and the stock rises, want to sell more, would you buy more?
I would really cross the bridge when it comes to Mangalam. Okay. And I would just say that on the low-hanging fruits, right? There are a couple of other very interesting facets, right? Our fill rates have been very low. So while there's demand, we have not been able to service it. There's a lot of inventory on one hand, but as the fill rates are very low. So even the entire product channel mix has been broken, which is again what is something that we are fixing. The demand forecasting process was completely broken. So a lot of sort of basic stuff is what is being fixed in the company as we speak, and I'm hoping that I'll let the results do the talking. But I would just say that things are going per plan.
Sridhar, you mentioned that there is a lot of money to be put out in this space when it comes to private equity. What beyond VIP are you looking at right now in terms of areas, as well as if you can list out some companies as well that's on your radar?
Yeah, so maybe not so much the companies, but the areas. Harmas, there are 3 sectors which we are very bullish about, right? Apart from travel, which is the first sector that we spoke about. The second one is jewelry. The movement to fine jewelry is real, right? Jewelry for party wear is different than office wear, then different than casual wear, and so on, right? And that's one category which again we are seeing double-digit volume growth. The another space is building materials, selective part of building materials, right? While new homes are being built with increasing affluence, there's a lot of refurbishment which is now happening. And
what parts in specific?
So building materials, we are seeing good amount of parts in FMEG segment, which is a lot more on the consumable side. Also, what is interesting is while you might you track listed space a lot, there is a silent shift that's happening from a lot of brands and consumers. Maybe I'll take examples of 3 sectors where loyalty is low: BPC, food services, and maybe apparel. Apparel, ABFRL and Arvind Fashions put together, the last 2 years would have added maybe 300 crores of revenue. But you have 4 new brands which have added 2,000 crores of revenue on the outside: Soul Store, Rare Rabbit, Snitch. Think about another company called Style Union, right? Similarly, on BPC side, while FMCG companies are finding it difficult to grow, Nykaa is growing at 18%, right? Food companies are struggling to show more than 2 to 3% SSSG, whereas you have Zomato growing at 18%, right? So there is a switch that's happening both on the channel side as well as the brand side, and especially in categories which are very flirtatious. Right. So we've been mindful of that, and our big learning has been a consumer company in this day and age needs to learn to disrupt itself. Otherwise, it will get disrupted by somebody else sooner than later.
I'll take that point, and I'll also leave you with a promise to join us once again, and we discuss this itself at large and beyond VIP is what we will talk. Thank you so much. Always a pleasure, Sridhar. You know, we keep calling you very often. You come not very often, but this time you have to promise us, join a lot more than what you're doing already.
Done deal. Cheers.
Okay.
Thank
Done deal.
you.
That's on national TV. What we'll do is take a short break, come back, focus on the markets, speak a lot more about individual stocks. We also have result reactions waiting by for you.
Fly Emirates, fly better.
Welcome back. RPG Life Sciences, that's one stock in focus. It slipped more than 8% in trade following what was a weaker set of numbers in the third quarter. Profit falling more than 36%, margins contracting as well. Ashok Nair, the managing director of RPG Life Sciences, is with us now to decode these numbers. Ashok, welcome. Thanks for your time here. You know, it was a bit of a subdued quarter because of international formulations and the API business, but domestic market is still seeing some traction. Start by telling us what was the volume and value growth that you saw in the quarter and how you expect to close the fiscal year.
Good morning. Thank you for having me here. The domestic, in fact, has grown almost 1.5 times than the market. We've grown at 12.5% for the YTD growth, and the quarter has been 10.6. Volume has been 5.3 as compared to 2% of the market. So the domestic is still looking very robust. In fact, all of our specialties portfolios, our immunosuppressants have grown by 12%, MABs have grown by 17%. Last time we spoke about Naproxen on the path of becoming 100 crores. We are continuing to clock at 15.6% growth. So the price growth has been 2.3 because 35% of our products are under DPCO. But going forward, that is something where the balance 65 products we will look into taking the full price increase. So domestic has done well. Yes, as you said, API, we had a challenge. I'm sure last time I'd mentioned that we had a fire incident and the restoration, in fact, has been complete now. But we are taking some time to validate each and every product which is getting remanufactured there. But by Q4, we are in full position to get back to what we were doing. And the January month for API is looking good. So API should strike back. International formulations, we are good, but international formulations got to do with one or two markets where some of our key customers were taken by private equity funds, and they're just looking into having a leaner inventories. So others overall, this is just a quarter of phenomena.
You know, which is what the street is actually a little worried about. And thanks for clarifying that, Mr. Nair, because when we started the year, you said that you are targeting 10 to 13% growth in this financial year. The 10 to 13% range has come for parts of your business, but not the entire business, and you explained why. So just wanted to know what the revised guidance stands for the year, and at the same time, if you could give us a target for the next year. Naproxen, a 100 crore drug in 2 years. What's the next milestone here? And you also said that you're looking at organic opportunities in the API space. First quarter FY27, can we hear something?
So you must have seen that we already formed our subsidiary in the name of RPG Active Pharma. So the due diligence is going on. We surely would like to see the first quarter of FY27. We should be in a place to have some asset coming into our portfolio. So that's something which is seriously work has been happening. There should be some positive development on that.
On the revised guidance for this year and the targets for next year?
So that is something, let me wait and watch for this quarter, how the API bounces back for us. And I'm sure at least we'll come back to what we were doing in our earlier times.
You know, Mr. Nair, international formulations business grew around 7% in the first half. It's 6.1% in the first 9 months. Was there some slowdown that you witnessed during this quarter? And if so, do you believe that the situation returns back to normal as we go into the fourth quarter and into FY27 as well?
Yeah. So what had happened exactly is one of our clients was taken over by a private equity fund. So they are relooking into their inventories. They are making it leaner. But then that is something which we are not lost out. They are one of our key customers. And the quarter four is something which we should be able to get back to the products.
Mr. Nair, currently you don't have any exposure to the US market, a pretty large market. Any plans of going there? And also a word on your capex for the year. 140 crore or so is what you had guided us. If you could give us a sense of, where this would be deployed in building some of the smaller brands.
Yeah. So as far as US is concerned, no, we are not there currently. And it's not that we are not US approval plans. It is our product pipeline is not very strong for us to enter into the US. And the investments are very high unless we just have 1 or 2 products there. So that is something which we are working on. And maybe when we are looking for our acquisitions, we will be looking into the plans which are US approved. So we can have an easier way to get into that place. The second, as far as the capex, you're right. We've been infusing almost around 140 crores every year, 40 to 45 crores. That will continue to happen. And that is more to do with our plant upgradations to expand our plants and increase the capacity.
Does Neprosin turn 200 crores and 500 crores?
So Neprosin is something which we are all very, very young. We should be, for sure, by FY27, we should cross this thing. What we are looking at it is, I do not know whether I mentioned you, we just got approval from Canada for our Naproxen as an OTC. Walmart will be our first client. So considering all this to put together, we should see that at least in the next 3 years, we achieve 200 crores globally.
Next 3 years, 200 crores globally. And any other OTC that you're targeting?
No, currently it's only Naproxen.
Take that point. Thank you so much for joining in and giving us your outlook for the near future. Obviously, you will wait and watch on the API business to revise your guidance. But for now, you do believe that going forward, maybe FY27, you will get back to the old growth path of 10 to 13%. With that, we'll take a short break. And as we do that, a quick sneak peek into the stocks that we will address on Your Stocks today at 2 p.m. Don't forget to catch both fundamental and technical experts, their views on the stocks that are flashing for you on the screen. I can see MRF, Godrej Agrovet, SBI, Hitachi, a bunch of them, all of them on our radar. Your queries answered at 2 p.m. today.
Welcome back. Let's get you a quick check on all the macro signals for the day before we wrap. The markets as we speak are up about 142 points on the Nifty, 450 points on the Sensex. The markets continuing to extend gains on the back of that optimism from the EU trade deal and other positive earnings weighing in. Apart from that, take a quick look at the rupee. It is actually improved today to 91.72 kind of a levels. It's up 0.24%. So there's a bit of an improvement we've seen. Keep in mind that's because the dollar has been weaker, not that the other factors have changed much. So that's one thing to keep an eye out on. Brent crude prices, as we've been telling you, they've risen up. There's some supply concerns because of the storm in the US, and overnight we've seen a bit of a gain there, 68.04 on a barrel. That's where the Brent is at, and the 10-year bond yields, as we've been telling you, inched up, now trading at 6.705. That's a 11-month high. No relief on the bonds despite the measures from RBI as far as liquidity is concerned because of oversupply concerns. On that note, we're going to wrap up this edition of Trading Hour from Mangalam, Hormaz and me. It's a goodbye. Thanks for watching, but stay tuned. Halftime report will take all the action forward.
Stocks leap up after a tech rally pushes S&P 500 to a record high. Energy, metals, utilities and capital goods are big gainers, while consumer sectors, FMCG, consumer durables and autos drag.
Vedanta Limited floats an offer for sale to divest up to 1.59% of its 61.8% stake in Hindustan Zinc for over rupees 4,500 crores. The offer follows a sharp run-up in the stock of the silver producer on the surge in the white metal prices.
Consumer stocks take a beating with Asian Paints leading the decline after a rain-marred quarter. Tata Consumer too dips despite a strong show, as do Marico and Godrej Consumer.
Crude oil surges at 2% overnight to a 15-week high following a severe winter storm in the US and Canada. The lower output and rising tension in the Middle East keep oil on the boil.
Maharashtra Deputy Chief Minister Ajit Pawar dies after his plane crashes in Baramati earlier today. A total of 5 people were said to be on board Pawar's private jet, including 3 passengers, 1 pilot and a crew member.
Hello, good afternoon. You've tuned into Halftime Report. We're coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Ekta Batra as well. Good afternoon, Ekta. And it's a good afternoon that's coming for the markets as well. Today, again, we're managing to see that the Nifty is managing to hold on to gains of 0.6% as of now. 25,300 levels. Almost near the day's highest point, what the Nifty is managing to trade at. The broader end of the market, that's doing well, outperforming the benchmark indices, whether you look at the mid-cap or the small-cap, managing to hold on to strong gains. Mid-cap up almost 1%, small-cap is up more than 1% as well. So good gains coming in from the broader end of the markets. Energy, metals clearly shining in today's trading session. A lot of individual movers on the back of their earnings as well. Ekta.
Hi, Vinny. Yes, absolutely. You know, we have ONGC as well as Oil India, which are trading with good gains in today's trading session, as crude is trading at 4-month highs. We have a lot of results today as well. L&T, Maruti, ACC, SBI Life. So a lot to reckon with in today's trading session. But on the show today, we'll get you an exclusive conversation with Habilkar Rakiwala of Wockhardt on the latest developments with their antibiotic drug. In our What's Trending segment, we'll bring you conversations with the management of Marico and Asian Paints on their Q3 numbers. We'll also bring you excerpts of from the India Energy Week 2026.
Okay, Asian Paints, let's bring the first management on board. They reported their Q3 numbers. Unseasonal rain, shorter festive season impacted the performance. The company believes competitive intensity will remain high in the industry. In fact, my colleague Mangalam actually caught up with the management of Asian Paints and began by asking about the demand outlook. Listen in.
I think what we saw was a little bit muted demand in October because the festival window, as you said, has been pretty short in terms of only the first 15 days and a prolonged monsoon. We saw definitely a strong pickup in November and December, and the December exit rates have been much higher from a quarter average in terms of what we are seeing. So I think from that point of view, it's a good indication in terms of both volume and value in terms of doing well across businesses.
All right. So, you know, when I look at your third quarter volumes, closer to 8%, but the value growth is a lot lower. You had earlier indicated that, you know, the value volume difference would be between this 500 to 600 basis points mark. It's been a little more than that. What explains this?
See, actually, if you look at from a point of view of overall coatings, we have grown at about 4.4% in value if you take the industrial sales. And the volume is about 8.3%. Overall, when we look at all the sales put together from a point of view of coatings. So we would say that it is still within that bracket in terms of what we spoke. And if you take all the businesses, as I said, industrial sales and everything, I think 4.4 is possibly a reasonable kind of value growth in the current set of demand conditions in terms of what we've been able to launch.
Right. And what do we, make of the margins? Because your range has been 18 to 20%. This time around, you've done 20%. Gross margins have been better than what the street expected. In fact, the higher end of the range as well. So do you expect your margins to be around this 20% mark, or do you think you will plow back some of these to, drive growth once again, and then the margins come back to about that 18%?
So overall, we have done a very, very strong work with respect to our cost structures, looking at a lot of cost efficiencies in the system, working on material formulations, cost efficiencies, which have kind of been driven very, very strongly, which has kind of given us an upping from a point of view of margins. We've also looked at pushing some of the premium products where possibly the margins are much higher to that extent. And that is something which has given us possibly a little bit of elevation, which is coming with this overall margins. The deflation of about 1.1% has also helped us in this process. As we go forward, I think one thing which we are committed in the industry going forward, that as a leader, we would like to kind of see that how can we really increase the demand? How can we really invest more in the brand, put more money in the innovation, and look at bringing more technologies into the system? So we would say that we will continue investing heavily into the industry as we kind of go ahead. And we would kind of like to maintain this band of 18 to 20% PBDIT margins.
What about, something that was very interesting in your conference call where you said that maybe structurally the demand for painting or the frequency of painting is coming down. And that was very interesting because, the big thesis was that we paint a lot less than our global peers. What explains that, and what should we make of overall demand then, given this trend that you're seeing?
So I think as we look at possibly over the years, the painting cycle used to be something like 8 years or so. Now it has kind of really come to about 5 years. I think it's kind of now flattened out in terms of as a painting cycle as we see it. More importantly, what's happening is, given the kind of consumption which we are seeing at a consumer level, this is still a discretionary spend which can be deferred at any point of time. And given the fact that today there are other areas of demand which are coming up, people are spending and really using the discretion very, very carefully. Especially, I may see that from a point of view of occasion-led painting is something which we are definitely seeing a structural shift, where it was supposed to be very, very high. Now it seems to be shifting to that extent. But all the more, I think there are more homes, and I think we would kind of see that possibly the painting cycles, while they remain the same, I think we have more and more numbers coming up, given the overall kind of population growth and homes growth which we are seeing in India.
So does that mean double-digit volume growth is sustainable fourth quarter onwards itself?
Yes, I think so, because I think we did about 10% growth in last quarter, about 8% now. I think we should kind of remain in the similar band in terms of going forward. That's something which we are looking forward to.
8 to 10% or 10% plus?
Yeah, in the band of about 8 to 10%, yes.
All right, in the band of 8 to 10% volume growth, value growth would be about 5 to 6% or 4 to 5%?
Yeah, the gap, I think, which we have been saying about 5%, I think 5 to 6% kind of a band will remain.
All right, so 5 to 6% revenue growth, 8 to 10% volume growth, and EBITDA at around 18 to 20%. What about competition? Do you think the worst of disruption is behind us, and going forward it's going to be steady state for everyone?
I don't think so we will reach a steady state. I think there is a lot of activity which is happening. The competitive intensity will continue. We also have now, a consolidation happening in the paint. And to that extent, I think overall, the area of competitive intensity will continue. We will have to be really up on our toes in terms of really the kind of work which we are doing in the market, whether it is innovation, whether it is in terms of newer initiatives, whether it is from a point of view of things which possibly the market has never seen. And that is something which we are looking forward to in terms of bringing a lot of changes as we kind of go ahead.
Right. So when you say that it is going to stay, in what manner will it stay? Will it be in the manner of pricing disruption? Will it be in the manner of distributor discipline? It will be in, some lures that are given to the consumer. Will it be at the cost of margins for everyone? Can you define competitive intensity when you say that it's going to sustain?
See, traditionally, what we have seen is that the distribution structures have reached a particular maturity. People only look at spreading the distribution structure and having more and more retailers in their game. That possibly would continue. I think more intensity will be in from a point of view of pricing, in terms of how people look at really pricing, how people look at intermediaries in the market to that extent, how people look at the B2B market from a point of view of reaching out directly and so on and so forth. So I think a lot of intensity would kind of coming from the areas of pricing, discounts, and people trying to reach various segments very differently.
Okay, so that's the management of Asian Paints. That stock is under pressure, down around 4% The management commentaries seem to have possibly spooked the markets a little bit, and a little bit of an underwhelming quarter, though the management is indicating that they will maintain margins between that 18 to 20% band going forward. We'll take a break, but a quick heads up as India gears up for the budget 2026. The big questions around growth priorities, reforms, and the road ahead take center stage. Budget Vision 2026, what India wants, brings together top corporate leaders, economists and policy thinkers to share their views on what they expect in the upcoming budget announcement. Watch Budget Vision 2026 on 30th January, 10 a.m. in New Delhi. Welcome back. Well, for the markets, it's holding up quite well. We have the mid-cap index, which is up around 1% at this point in time. So definitely the broader markets are faring better in today's trading session. We have the advanced decline ratio, which is positive as well. So around 2,800 stocks advancing to around 1,300 stocks declining at this point in time. But let's continue with our What's Trending segment. And now we're focusing on Marico, which reported what was a good set of Q3 numbers. The profit has risen around 13%, while the other hand margin has contracted. Our colleague Mangalam did speak to the management and started by asking on their near-term volume target. Listen in.
As far as obviously the copra prices have corrected, and we need to ensure that we take some pricing action maybe as we move towards the next quarter. I think the hyperinflation obviously had an impact on parachute volumes because of the absolute pricing. Also, we had taken some MLH correction, which led to a 2-3% volume drop. So I think volumes going forward is going to stabilize. We'll continue to aspire for delivering a high single-digit volume growth as a base case and try to improve upon it. And obviously, as the copra prices come down, margins will continue to improve in the subsequent quarters.
All right. How much will the margins improve because of just raw materials, and how much will it improve because of the mix? Because we've seen value-added do well as well, and alongside that, you are seeing some recovery in the operational performance of your digital-first and premium brands too.
So I'll give you a longer-term perspective. Obviously, the value-added hair oil growth, which we are confident about delivering now consistent double-digit growth, is leading to a mix improvement. As far as the digital business is concerned, we expect digital business to grow 2.5x of the run rate and moving into a 10% plus EBITDA. I believe that at least in the immediate term, next year, I think mid-teen kind of a growth in bottom line is a base case. And we'll aspire to try to do more, which will translate into at least a 150 to 200 bips margin expansion.
All right, 150 to 200 bips margin expansion. Now, you know, it was very interesting when just a day before your results board meeting, you announced the purchase of 4700 BC. And it's a business that does an annual run rate of what, about 140 crores on the top line. What can you scale it to? Are you looking to, you know, include it in the Marico overall distribution system? Because that's not something that you've been doing with a lot of the acquisitions that you've made so far. You allow them to run their own course. What's the scalability, margin synergy, and opportunity out here?
Firstly, I think it's we are very excited about this acquisition because if you really look at it, we have been focusing in the food business with wellness and health. This is a better for you gourmet snacks, and therefore it opens the TAM significantly. And I think we are seeing a very great tailwind of people wanting to do in-home consumption of snacking as trends like OTT, people, you know, having a lot of in-house consumption of snacks, as I talked about. Now, if you look at this brand, obviously there was some part of the business, which is a very small part, which was being sold in PVR cinemas, which will continue to have that arrangement. There's some business which is sold in some of the international airlines, which I believe is a very, very good market because it drives trials and saliency for the brand. And there was an online sale. Now, obviously, as we move into the Marico system, it gets access to definitely to the entire modern trade, which will be a driver, and premium food outlets. We see significant synergies in cost and other operating model between, you know, some of the other fruit brands like True Elements and this, and therefore, while there will be an accelerated pathway for both True Elements and 470 BC to break even, we also will generate enough, you know, cash from this savings to drive investment for accelerated growth in these brands.
All right, so multiple of the current number we can expect shortly itself, right? Given the sort of distribution unlock that happens.
I think we aspire to move it to 500 crores in next 3 years.
All right, 500 crores in the next 3 years. What about the other acquisitions that you were eyeing? It's widely reported that you are in talks with a plant protein maker as well. Anything that we can hear in the very near future? Can you tell us whether talks are at an advanced stage or there are no talks either?
We can't comment on speculative reporting. I think we continue to look at acquisitions in the digital businesses to plug some of our gaps in our portfolio. So we can't comment on anything specific which is speculative.
What about competition in the hair oil space itself? Because it's now an increasingly mature market, and you know, one of your peers, Bajaj Consumer, reported industry-leading performance, obviously on a very favorable base. How's competitive intensity been, and how do you plan to, you know, keep your edge ahead in a post-GST world?
I think two things. One, I believe there is enough opportunity and headroom for growth in the value-added hair oil space, which includes premiumization, the vectors of problem solving like hair fall. It is good that, you know, there are multiple players wanting to invest behind growing this category. This category has enough opportunity for growth. The GST rationalization has helped in affordability in pricing, which drives some of the unbranded or moves volumes from unbranded or smaller brands to larger brands. And therefore, we are extremely confident. If you look at our, even on a 2-year CAGR, we had X of Shanti Amla, which is a bottom of pyramid where we are not investing and defocused a bit. We have a double-digit growth in volumes. And therefore, we are extremely confident of value-added hair oils driving double-digit value growth over the next couple of quarters and even the next 2 to 3 years. And it's good that actually there is competition investment, because what had happened in the past 2 years till we repivoted to this strategy some couple of quarters ago was that too much investment was happening below the line and too much of irrational competitive activity was happening. So we welcome this, you know, the fact that, you know, multiple companies investing behind growing the category.
All right, just a final question before we let you go. Saugata, you've been on this diversification journey from Marico, and as we look at it right now, about 25% comes in from foods, digital first, and premium personal care. Around 20% plus comes in from international. So nearly half of your portfolio has diversified away from the oil business. And in that as well, the oil business, you have rigids, which are a lot lower than, say, food or value-added hair oil. How much more diversification is on the cards from here on? And what's your overall aspiration, say, over the next 3 to 5 years?
So we have, there are 3 vectors of diversification. One which you alluded to in India, where we are driving foods, digital, and as well as premium personal care. It is extremely critical that this continues to grow while also becomes profitable. I think we are keeping a sharp eye on the profitability. There is also 2 other diversification which is happening within international business. We are reducing single country risk. At the same time, a portfolio, we are now available offering shampoos in multiple markets. We are there in baby, we are there in skincare, and therefore there's another level of diversification that is happening. We believe that there are very few global Indian brands, and Parachute Advanced has a huge opportunity to become a global Indian brand. It's available today in 48 countries, and we want to push that envelope as a brand which drives, care and nourishment.
Okay, that is the management of Marico on their Q3 numbers and the expectations going forward for their businesses as well. But on that note, we're going to slip into a very short break. The countdown for Budget 2026 is underway. The most influential voices decode and analyze the impact and policy decisions from Finance Minister. We bring you a power-packed lineup throughout January and on the day of the budget. We have market veteran Ramesh Damani as well as Helios Capital Samir Arora for all things market, followed by JP Morgan Sajid Chenoy to discuss the macro signals. We also get you insightful analysis from industry veterans and Dinesh Kanabar as well as Ashok Wadhwa for the tax rhetoric.
Fly Emirates, fly better.
Welcome back to Halftime Report on CNBC-TV18. As of now, the Nifty is at 25,280 levels. When we started the show, it was just around 25,300 levels, now slightly below that. So we'll watch out for that. Nonetheless, managing to hold on to gain, slight bit of a fall from when we started the show. But which are the stocks that are moving around in today's trading session? Let's go across to Vivek to give us the list of the buzzing stocks. Good afternoon, Vivek.
Well, good afternoon. It's a very positive day that we're seeing, especially as far as the broader end of the markets are concerned. Advance decline ratio skewed in favor of the advances after quite a few trading sessions. So in terms of individual stocks and sectors, the ones that we're tracking, look at the oil and gas space, sharp up move as far as oil prices are concerned. That's given some positive sentiment for most of the oil, especially as far as the exploration companies are concerned. So Oil India, ONGC doing very well. But not only that, quite a few downstream companies too today are doing quite well. OMC as well as IOCL as well as BPCL doing quite well in the session. Motilal Oswal, the other stock on the radar, one of the top gainers on the NSE 500 index, up almost 9% on good volumes today. CG Power numbers came very close to 330 yesterday, but after that, the management held a conference call post-market as yesterday. Good commentary coming there, high by almost 8%, one of the top gainers on the F&O space. Have a look at most of the defense names today. Ahead of the budget, most of these names are seeing significant buying. Look at BML, Bharat Dynamics, Garden Reach. Most of these names up anywhere between 3 to 8%. And the entire metal pack, this particular pack continues to move higher. Names like Nalco, Hindalco, NMDC, even a Vedanta doing very well in the session, all up anywhere between 3 to 6%. On the other hand, quite a few laggards as well. Car Trade Tech, posted its numbers, Q3 numbers just a while ago. Slightly muted said, that particular stock down 7% on high volumes. Most of the consumption names after disappointing results, disappointing commentary, talking about elevated competitive intensity, most of the names under pressure. HUL, Asian Paints down almost 5%. And Tata Consumer Products, despite a beat on its results, down over 5% today. Manappuram, this particular stock in focus, the company's MFI subsidiary posted a loss down over a percent and a half. Radico Khaitan, after a while today, one of the top laggards on the NSE 500 index. And most of the auto names today, quite a few negative news flow that the street is digesting. Number one, the EU FTA. Along with that, today, some news flow regarding higher tariffs as far as South African market is concerned. Most of the stocks down anywhere between 1% to 4% today.
Okay, all right. Thanks very much for that, Vivek. So a lot of stocks which are buzzing around in today's trading session. Just watch out for CSB Bank, which is holding up quite well ahead of its numbers. So that stock is up around 5% CSB Bank is in focus. Also, we have a couple of other stocks such as Schneider Electric, which is seeing a good gain, up around 8% on good volumes as well as in terms of price action on that particular counter. We'll take a short break, but up next, we'll bring you excerpts from the India Energy Week 2026. Stay tuned for that conversation. Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, it's a buzzing market. Just want to point out a couple of stocks such as Motilal Oswal, which is doing well post its numbers. So that stock is up around 9.5% at this point in time or thereabout. 9% at this point, so 798 odd rupees is where it's trading at. Remember that it's reported a 6% growth in terms of revenue, which is led by segments such as wealth management. So good going for that one. Remember that there have been a couple of stocks which have come out from the capital market space which have caught interest. For example, Angel One, where the revenue was up around 11 odd percent. Grow, where they did report a deal in their segment as well. ICICI Prudential, AMC, a couple of these stocks which were in focus on account of a good amount of numbers which they reported. But let's shift focus now to the commodity space. The quickest way to meet the rising electricity demand is through natural gas, says Tim Hodgson, who is the Canadian Minister of Energy and Natural Resources. From the ongoing India Energy Week, our colleague Manisha Gupta did catch up with the minister and began by asking about the rising electricity demand. Listen in.
In the world we're in today, where we are seeing the demand for electricity go up dramatically, we're all thinking, how are we going to meet that demand? That demand can come from renewables, but renewables are not baseload power. They need to be supplemented. To the extent that we can supplement them with grid storage and affordable ammonia and get to baseload renewables, that's wonderful. That's still out there a little bit. In the interim, the fastest way to get there is natural gas. So we in Canada are focused on abated natural gas. We can look at how we produce that natural gas with low methane emissions. We can look at pre-combustion sequestration. We can look at post-combustion sequestration and drive the carbon footprint of that down. So the quickest way is natural gas for baseload power. The next quickest way is nuclear. And we're in Canada building for the world's first commercial small modular reactors. We're also looking at large nuclear. I know India is looking at large nuclear. Yes. You're going to need uranium to fuel those reactors, and Canada would be a wonderful source of supply for that.
And that exactly is my next question. How do you see Canada and India being partners when it comes to rare earth, when it comes to critical minerals, and of course, oil and gas?
Yeah. So today we were meeting with many of India's leading energy companies. And what I heard from each of them is they're interested in diversifying their sourcing of LNG. They're interested in diversifying their sourcing of LPG. They're interested in diversifying and adding to their critical minerals stockpiles. They're obviously interested in more sources of uranium, given the big nuclear build, and they're interested in more conventional oil. We can work together to do all of those things.
How would you look at the Western world right now? So whether it's about, especially with the U.S. tariffs on so many of them, I understand there are conversations and negotiations happening. As the energy minister, what is your top priority right now for Canada?
So our top priority is to expand our international trade. Our Prime Minister has said he wants us to double our international trade by 2030. To do that, we need to sell more of what we have, which is some of the world's best natural resources. That's what we're going to do. We are looking for like-minded partners who believe in free trade. What we will tell all of our trading partners is we will not use energy for coercion. We will not use tariffs for leverage. We believe in multilateralism. We believe in free trade.
When it comes to India, what kind of conversations are ongoing? Because there have been talks which haven't gone through for a lot of time right now.
Yeah. So I think our Prime Minister has spent quite a bit of time with your Prime Minister at the G7 meeting in Canada earlier this summer, on the sidelines of several other meetings. They've developed a good rapport. I think they both see a good path forward that's a win for India, a win for Canada. And I, for one, couldn't be more excited about being in this new beginning and finding a way to work together for the long-term benefit of both our countries.
And more from the India Energy Week, Amrita Sen of Energy Aspect says that they don't expect a big pullback in crude prices this year. She spoke with Manisha Gupta. Listen into that conversation. And Manisha began by asking her about the geopolitical concerns and crude availability. Listen in.
Yes, I think it couldn't have been at a better or worse time, depending on how you want to think about it. Geopolitics, 100%, like that's kind of been the biggest driver, even starting the year. We've had Venezuela, Iran, but I think Russia is really the kind of main focus. And like you said, the first question, really, how much availability there will be coming into this year. Everybody, including our numbers, they are showing these big bills. And yet, what you've seen is a market prices have been kind of edging higher. The backwardation of the crude curve, you know, basically the front month versus second month, that's really steep. And that is telling you something isn't quite adding up, right? So I've been doing some of the numbers. I've been in Asia for a good, like this is my third week, seeing a lot of our clients here. And I think one of the things that's becoming very evident, unsold Russian oil on water is on our numbers. We've got a very, very detailed tanker tracking team, 140 million barrels. And I think that is the big discrepancy between, yes, it looks oversupplied, but that 140 million barrels is not available to the market. Even in India, talking to the refiners here, it does look like they've been asked to reduce purchases with the US-India trade talks kind of going ahead. And so that's where the tariff bit comes in as well. So I do think that's the big unknown in the market, is that will those sanctions get lifted? Then the oil is available and it's bearish. Our base case is that, you know, we are very far away from peace. If that's the case, then prices can actually remain supported and even edge a little bit higher.
Most of the people believe that going forward, the first half could see the prices lower, but the second half could see it higher. What do you see playing out between these two halves?
In theory, that is the case, right? Even our price forecast, in fact, was the lowest in Q1 because this was supposed to be the biggest oversupplied market. But now with the Russian unsold, there was a big outage in Kazakhstan as well, the CPC. I'm not 100% sure we will see that big a pullback in Q1. I think in Q2, maybe because you've got a lot of refineries that go for maintenance, some kind of, and before summer demand picks up, you can probably get a pullback. Second half, the reason we also think prices will be higher is because with lower prices, you should get production respond. US supplies should respond. But again, let's be very clear. Prices need to go down first before it can go up. Right now, it's still moving higher, right? And that's why I think I'm very cautious of saying first half lower, second half higher. Also, you know, we haven't mentioned there's a massive winter storm in the US, and our upstream team have calculated we're going to be losing 9 million barrels of crude oil production. All of these just continue to tighten up the market.
And what about natural gas? Because that has been gaining only on the back of this winter storm.
Yes, $7 per MMBTU in the US alone. And of course, you know, the saying has always been when the US sneezes, the rest of the world catches a cold. And now very much so for gas markets. You know, gas markets are going through a complete revolution, becoming more like oil, because in the past they were very siloed, right? US has its own market, Europe had its own market, and Asia and Europe interacted a little bit via exports. Now we've got 3 BCFD of new LNG projects starting up in the US this year, 1.5 BCFD next year. It's becoming a global market. So if the US can't export, suddenly global prices also shoot up. We are seeing some significant production losses across the board, really, as a result.
And what's your sense on India buying right now? Because with India not being able to buy that cheaper crude from Russia, problems also with Iran, how are you looking at India's import mix?
Import mix-wise, look, India has not bought from Iran since sanctions happened. Russia has obviously been 2 million barrels per day-ish, 1.8 to 2. That's the big shock to the system, right? You're now about 1 million-ish, and we think it's going to go below 1 million. Naira will, of course, continue to buy. Reliance is buying a little bit, but the state-owned companies will have to reduce quite a lot. And that, of course, I mean, if Urals is now being offered at -14, there's a margin impact, right? But the good news is Venezuela, there should be, like companies like Reliance are applying for a license. They should be able to get that very heavy, cheap oil into the market. Some of the trading houses are also offering Venezuelan oil into India. Indian complex refiners would love that. So there's a little bit, even though the volumes are not as big, a little bit of an offset. And look, OPEC have increased production. In the grand scheme of things, prices are not that high, right? So it's still a good, very, very good time overall for refining margins. Yes, if we are talking about $85 crude, that would be a very different thing.
Okay, all right. So that's the word coming in on the commodity space. Well, back to the markets now. It's holding quite well currently for the markets. We have the broader markets which are faring better. Like we mentioned, the mid-cap index is up around 0.9%. The Nifty currently at 25,266. We'll take a short break. But up next, we'll get an exclusive conversation with Habil Karakiwala of Wockhardt on the latest developments with their antibiotic drug, which has reached the endpoint of a phase 3 trial. Stay tuned. Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, let's talk about one particular company now. Wockhardt's antibiotic for FISQ or WCK4282, that's basically the molecule name, has successfully met the primary endpoint in phase 3 clinical trials. It will be used for patients with complicated urinary tract infections. And we now have with us Habil Kharakiwala, who's the founder chairman at Wockhardt Group, to just make us understand what this means and how relevant this particular development is. Mr. Kharakiwala, thank you very much for taking the time out. Well, this particular antibiotic, which is WCK4282, it's met the primary endpoint in your phase 3 clinical trial. Just explain to us what that particularly means.
Very good afternoon to all of you. This is the fifth molecule from our drug discovery program of antibiotic, where we have completed clinical trials. And this was compared with the gold standard today, which is meropenem, which is used. And it was equally effective compared to meropenem. The biggest advantage of 4282 or Faviscure is that it does not add to multi-drug resistance. Whereas today, multi-drug resistance menace is mainly because of meropenem, and extensive use of meropenem has led to multi-drug resistance. So one of the major advantages of our drug is that it will prevent spread of multi-drug resistance, and it will be used as a initiation of a treatment. So we have a product like Faviscure, which will initiate a treatment in critical cases, whereas we have Zenith, which will be dealt where all other drugs fail.
Okay, just wanted to understand what are the next steps now post this phase 3?
We have completed phase 3. We will be filing to DCGI in a month or two, actually, because that is the time it takes to complete the filing and records and everything. And then we hope that we receive approval soon, because government has come with a new guideline to clear drug in 45 days, and one has to really see what really happened.
Right. Hi, sir. Good afternoon. So you have applied only on the Indian drug regulator front, right? Or will you be applying somewhere globally as well? Or is that, how does the process go from here now for that?
This is a drug which we have focused really from an Indian perspective. So we thought all our drugs we first introduced in India. Zenith is the only drug we are doing on a global basis. And that we have already applied to US and European authorities, and thereafter to other authorities, basically.
Okay, so you'll be only, you'll be looking to launch this particular WCK4282 in the Indian market first.
That is correct to begin with, and subsequently we will also apply to all the emerging markets.
Okay, but you know, if I remember correctly, Mr. Kharakiwala, you've said for Zenith, you've received a lot of delays in the Indian regulatory process. For example, you've said that, you know, you probably don't even think your file was reviewed very easily, or there were delays in terms of review. Do you think that you're probably going to face the same kind of issues with WCK4282?
I hope not.
I mean, where is the process? Have you spoken to the regulators?
So see, the question is, once we make an application, then only we will have some idea, okay, what is the regulator view. And government has come out, as you know, with a new guideline, where they are really focusing on faster approval of all drugs. So we hope and we expect that our future application will go on relatively on a faster track. And we hope to receive approval in due course of time after that.
What is the potential of this drug?
Today, you know, meropenem and similar drug which are used, they cover roughly 28 lakhs patients in India. So from that perspective, Faviscure will act as a more preferred choice against meropenem, because it prevents development of other multi-drug resistance. And from all point of view, if we want to control multi-drug resistance, we have to go with this safer product, which are equally or slightly better effective than the existing therapy.
Sir, so what is the potential number over there for the Indian market? And also you said later on you would go to the emerging markets. If you could give us any indication there as well, what would be the size of this market?
It's the potential of this market would be of the order of something like about 1,000 crores, more than 1,000 crores in India potentially.
Okay.
And we hope to get a significant market share over a period of time.
Okay. All right. Well, Mr. Karakiwala, I just also wanted to get a quick update with regards to Zenec. You know, the last time you had spoken, there was the accelerated approval in Europe. You're still pending that approval in the US. Any updates that you can share with us from our last conversation?
The only update available is, as far as the US FDA is concerned, they have visited all the manufacturing sites, which is okay by them. They've more or less cleared it with minor observation here and there, which is in a matter of 1 week or 2 weeks, it will get cleared. They also completely review our clinical data. They were there in Switzerland for about a week or so. And it is still going on. As once it gets over in the next few days, we believe that it will be relatively smoother sailing now onwards for the way to approve the product as far as the US is concerned. We have no news as far as the EU registration is concerned.
Okay, so when can we expect that US approval then?
As we mentioned earlier, it should be sometime in the middle of the current calendar year.
Okay, all right. Mr. Karakiwala, always a pleasure speaking with you. Thanks very much for joining in and speaking with us and giving us an update on WCK4282, which is their latest antibiotic. They are looking to target that for the Indian market. They've completed phase 3 trials at this point in time. We'll take a short break. We'll get you a lot more on the markets once we're back. Stay tuned.
Welcome back to Halftime Report on CNBC TV18. As of now, the markets have come off from when we started the show, right? 25,300 above that, what the Nifty was trading at 12 p.m. And now look at it, it's at 25,260. So 50, 60 odd points. It's come off from when we started the show. And specifically in the last 1 hour, what we've seen not doing well, NTPC, BEL, that's seen a bit of a fall as well of almost 1% from the time we started the show. But that's all the time we have on this edition of Halftime Report. Thank you so much for tuning in. Up next, your business lunch.
Cool.
Stocks leap up after a tech rally pushes S&P 500 to a record high. Energy, metals, utilities and capital goods are big gainers, while consumers, FMCG, consumer durables and auto sectors are the big drags.
Vedanta Limited floats an offer for sale to invest up to 1.59% of its 61.8% stake in Hindustan Zinc for over 4,500 crore rupees. The offer follows a sharp run-up in the stock of the silver producer on the surge in the white metals price.
Consumer stocks have taken a bit of a beating today, with Asian Paints leading the losses after a rain-marred quarter. Tata Consumer also declines despite a strong showing, as do Marico and Godrej Consumer.
Crude oil surges 2% overnight to a 15-week high following a severe winter storm in the US and Canada. The lower output and rising tensions in the Middle East keep oil on the boil.
And Maharashtra Deputy Chief Minister Ajit Pawar dies after his plane crashes in Baramati earlier today. A total of 5 people were said to be on board Pawar's private jet, including 3 passengers, 1 pilot and a crew member. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormaz. Hi, guys. You know, the markets have started the Feb series on a positive note, right? And we're seeing that mid-cap index outperforming today.
Indeed. And that's been the story of the last couple of sessions, particularly the last hour of trade yesterday and a better part of today's session as well. The index still managing to hold on to that 25,250 mark, which has been a bit of a resistance zone for the Nifty. And it's been up, down all day. More up than down, but now we are entering into the business end of the trading session. The last couple of hours, it is an extremely earnings heavy day. You can see numbers from Arvind Fashion at the bottom of your screen, but there are 4 Nifty companies reporting results today: Maruti, L&T, SBI Life and BEL, and most of those, at least Maruti's results, could be expected any time from now. The stock trading at the lows of the day as SBI Life, and of course, there are a lot of other broader market names as well. So today and tomorrow are the 2 busiest days in terms of earnings, at least for this quarter as of now, before we head into the all-important budget session. So markets still holding on to gains, but slightly off the highs of the day.
Absolutely. And as you pointed out, earnings and the budget will be the key things to watch out for this week, right? But let's take a look at the sectors that are doing well today. We've got ONGC and Oil India, which are higher due to that rally in oil prices overnight. Brent is near that $68 a barrel mark and is at 15-week highs. The oil and gas index in general doing well. GAIL, IOC, all of them higher in trade. The other sector that continues to shine is those metal stocks, which are cashing in on the up move in precious metal prices. Hindustan Copper, Vedanta and Nalco, all of them soaring in trade. Hindustan Copper 12% higher, as you can see. But on this downside, we've got that FMCG pack, which is leading the losses. Asian Paints is down nearly 4% and is seeing deeper cuts after its Q3 numbers, while Tata Consumer is also following despite a resilient Q3, right? Other FMCG names, HUL, Britannia, all of those stocks are lower in trade today. But, you know, as we pointed out, the budget session of the parliament began today with President Draupadi Murmu addressing a joint sitting of the Lok Sabha and Rajya Sabha. The budget session will be held in 2 phases, with the first phase to conclude on February 13th. The second phase of the budget will commence on March 9th and will conclude on April 2nd. The first phase of the budget includes the tabling of the economic survey, which is scheduled to be released tomorrow by the Finance Ministry, followed by the union budget on February 1st.
The biggest trigger of this week, this series, and possibly might set course for the rest of the year as well. And for more on this year's budget, we were joined by Samir Arora, the founder and fund manager of Helios Capital. Listen into what he had to say.
No expectations. Maybe we keep hearing that they may do something on long-term capital gains for some FIIs, which may be defined as some endowments or universities or long-term, some X thing. So what happens is, if I keep thinking myself that it's so logical that long-term capital gains should be reduced, then I start believing it myself. So mostly my thinking is they will not do it. Debt and equity in India for Indian resident investors should be same or similar. That is wrong, because the debt guys, when they are earning that interest and on that they are paying tax, somebody else is offsetting that interest from his income and is paying less tax. It for everybody. Don't do it only for FIs. Just reduce for everybody to 7.5 or ideally to 0. and you change STT a little bit, because on the other hand, separately, we keep saying, although we own all these exchange stocks, that, the volumes are too high, speculation is too high. Just if you so want, or let it be for 5-7 years at.
A lot of stocks are buzzing on the back of their third quarter numbers. Ria joins us now with all of those details. Ria?
Well, yes, let's start off with Motilal Oswal Financial Services first. This one has been gaining in trade today after its Q3 numbers. Net profit has been stable at 566 crores. Revenue has seen an increase of roughly 6% on a year-on-year basis, largely led by its wealth and asset management business. For Vishal Megamart, this stock is down roughly 5% today. The revenue has seen an increase of roughly 17% on a year-on-year basis, but the adjusted same-store sales growth is muted at 9.6%, and the festive season shift has led to a lower reported growth this time around for the company. Vedanta is up around 4.5% after the company has announced that it is going to offload 6.7 crore shares in Hindustan Zinc worth roughly 4,590 crores, and the floor price has been set at 685 per share for this deal. The OFS will be open between the 28th and 29th of Jan for this one. Titagarh Rail Systems is also moving in trade, up roughly 4%. In fact, ABB India is also up 6% on the back of this announcement. They have signed an agreement to deliver propulsion for a 25 kilovolt metro. And the last stock is RVNL. That is also up roughly 4% after winning an order worth roughly 242 crores from South Central Railway.
Doing well for itself is RVNL. Ria, thank you for that update. The big listing of the day today was Shadowfax Technologies. It was a subdued debut for the stock and still continues to remain so, listed at a 9% discount at 112.60 compared to an issue price of 124, still remains at those levels. We spoke to the management of the company after its listing, listening to what they had to say on their road ahead.
We look forward to delivering an exciting year of growth, and we believe that the growth that we have seen this year will continue happening over the next few years. With the capital markets behind us, we are going to rapidly invest into automation, building state-of-the-art technology, and more importantly, trust between our customers, our sellers, and ensuring that every household in this country is being serviced by Shadowfax. Given how second half of the year generally looks like, we have grown very, very aggressively at 65% in the first half. Second half being the festive season, we expect some good results to come in. Margins will gradually improve. We operated at about 2% EBITDA last year. This year, we have operated in the first half at about 2.9% EBITDA. We are going to see gradual increase in margins every quarter.
So that was the big listing of the day. But sources say that the Ministry of Electronics and Information Technology has completed work on drafting of the India Semiconductor Mission 2.0. Ashmit Kumar joins us now with all of those details. Ashmit?
Well, this is a big policy push that the semiconductor ecosystem has been looking forward to. Bear in mind that India Semiconductor Mission Phase 1 was sanctioned in 2021. That had an outlay of 76,000 crore rupees. And since then, as many as 10 projects have been approved. Ones by Tata, the likes of Micron have been approved. And importantly, these projects have been set up across the whole ecosystem. So that's fabs, display fabs, the OSATs, ATMPs, all of them have been set up. 10 projects have been set up. Now, importantly, what we're given to understand is that MeitY, Ministry of Electronics and IT, has completed drafting the structure of what ISM 2.0 may look like. We're given to understand that the outlay may be even larger than the 76,000 crore rupees that we saw for Phase 1. The scope of ISM 2.0 will be much wider. It will look at designing. Designing will be a key component. Designing and manufacturing, both here, as far as India is concerned. And we're given to understand that MeitY will shortly begin interministerial consultations, especially getting a nod from the Finance Ministry. And finally, the Cabinet. The nod is expected. The MeitY is targeting to secure a Cabinet nod by the end of March. So clearly, all eyes now on MeitY as far as the semiconductor ecosystem is concerned.
Ashmit, thank you for that update there. Before we head into a short break, here's a quick heads up. But before that, numbers of TVS Motors flashing on your screens. Profit of around 940 crore rupees. compared to an estimate of 980 crore. We'll get you more details on this in just a bit. But the stock as of now is looking to recover from the lows of the day. Get you more on the other side of this break. But as India gears up for Budget 2026, the big questions around growth, priorities, reforms and the road ahead take center stage. Budget Vision 2026, what India wants, brings together the top corporate leaders, economists and policy thinkers to share their views on what they expect in the upcoming budget announcement. Watch Budget Vision 2026 on the 30th of January, starting 10 a.m. onwards in New Delhi. Welcome back. You're still with us on Business Lunch. Tragedy struck Maharashtra's politics earlier today as it lost veteran leader and Deputy Chief Minister Ajit Pawar in a plane crash. Pawar's private aircraft crashed while attempting to land near Baramati in Pune district. Pawar was travelling to Baramati to attend a series of public meetings ahead of local body polls on February 5th. The plane, a Learjet 45 aircraft, took off from Mumbai at around 8:10 a.m., but it disappeared from radar shortly before 8:45 a.m. and crash landed at approximately 8:48 a.m. near runway 11 at Baramati Airport. 4 others in the aircraft also perished in the crash. Following the crash, the NCP leader's family, which includes Patriarch Sharad Pawar, wife Sunetra and cousin Supriya Sule, are on their way to Baramati. And CNBC TV18's Santhya Gora now joins us from the Santa Cruz Airport in Mumbai, from where leaders are departing for Baramati. Santhya, over to you.
Ajit Pawar, fondly called Dada, has left a void not just in the lives of his friends and family, but also within his party and Maharashtra's politics. He started his political career in 1980s. Initially, he worked under the shadow of his uncle Sharad Pawar, but soon rose through NCP's ranks and file. He started his career with sugar mills and other cooperative structures and will always be remembered for reforming Maharashtra's cooperative structure. Ajit Pawar was known for having a deep understanding of administrative work and how a government functions. He will also be remembered for his reforms in Maharashtra's irrigation sector. He's sworn as Maharashtra's Deputy Chief Minister on 6 occasions, but the dream of becoming the Chief Minister of the state never materialized. Right now, we are outside Mumbai's airport for private planes, and friends and family members, relatives and other party leaders and other politicians have started departing for Baramati from Mumbai. Ajit Pawar's death has unsettled Maharashtra's political landscape. And in the wake of this unfortunate tragedy, the future and political relevance of parties like NCP, SP and NCP AP and political leaders like Supriya Sule, Rohit Pawar, Praful Patel, Sunil Tatkare and even Eknath Shinde will be rewritten now.
Absolutely. Thank you for those details, Santya. But a whole host of political leaders paid rich tributes to the Deputy Chief Minister. Take a look.
महाराष्ट्रातले एक लोकनेते होते आणि महाराष्ट्राच्या कानाकोपऱ्याची माहिती असलेला, महाराष्ट्राच्या प्रश्नांची जाण असलेला अशा प्रकारचा हा नेता होता की ज्यांच्याबद्दल जनसामान्यांमध्ये प्रचंड मोठी आस्था होती.
अतिशय मनाने ते निर्मळ होते, याचा अनुभव मी स्वतः घेतलेला आहे. त्यांच्यासोबत मी मंत्रिमंडळात देखील काम केलं. मी मुख्यमंत्री असताना त्यांनी उपमुख्यमंत्री म्हणून देखील काम केलं. आणि जेव्हा मुख्यमंत्री मी असताना मुख्यमंत्री माझी लाडकी बहीण योजना किंबहुना इतरही योजना जेव्हा आम्ही सुरू केल्या तेव्हा आर्थिक जे काही घडी आहे किंवा आर्थिक तरतूद जी आहे ती अतिशय उत्तमपणे त्यांनी त्यावेळेस केली.
अजित पवार का ये एक्सीडेंट में निधन होना ये बहुत ही दुखद और दुर्भाग्यपूर्ण है. पिछले 40 साल से महाराष्ट्र के राजनीति में मेरे बहुत घनिष्ठ मित्र रहे, उनके मेरे पारिवारिक संबंध रहे. बहुत कर्मठ, अच्छा प्रशासक और विकास की दृष्टि रखने वाले ऐसे वो नेता थे. उनके जाने से बहुत बड़ा नुकसान हुआ है.
अजित दादा पवार यांच्याशिवाय महाराष्ट्राचं राजकारण, समाजकारण हे बेचव आणि आळणी होईल. त्यांचं व्यक्तिमत्व गेल्या अनेक वर्षापासून आपण पाहतो. दिलखुलास, रोखठोक, कार्यकर्त्यांना हवासा वाटणारा नेता. त्यांच्या जाण्यानं महाराष्ट्रावर दुःखाचा डोंगर कोसळलेला आहे.
Fly Emirates, fly better.
Welcome back. Since we were on a busy earnings day, pull up a couple of names just before we move on. TVS Motors is one of them. Numbers were ahead of expectations. Margins expanded despite the one-time impact of the labor costs. Margins have expanded by 120 basis points, higher than expectations as well. Revenue growth of 37% from last year as well. The revenues were also above expectations, as was the company's EBITDA. So 3% higher on TVS Motors as we speak. A strong quarter coming in from the company, aided by almost a 30% volume growth that the company had seen during this period. And also pull up Craftsman Automation. That company also reported numbers just a few minutes earlier. That stock is also reacting to its results, 3.5% higher now on Craftsman Automation. On to a CNBC TV18 exclusive. The EU Trade Commissioner Marico Titan has said that the trade agreement will enable EU tariffs on Indian car makers to come down from 10% to 0 over a transition period. Speaking to Parikshit, Sefcovic also said that the quota for Indian automotive industry will be 2.5 times more than the EU quota, and that the agreement will have a review clause to adjust quotas as per the market dynamics.
We've been looking for the mutual win-win, and in the end we decided that we have to respect the size of our market. So European market right now is 2.5 times bigger than the Indian one. And we also understand that India wants to develop its own manufacturing capacity. So we've been really playing with the numbers, with the projections, and in the end we ended up with a quota for European car makers for exports, then additional quota for completely knocked down cars. This is very trade language, the CKD cars, plus the parts. And the quota for Indian size would be corresponding to our markets 2.5 times bigger. And I see it as an opening because we know that the dynamism of Indian market is such that we agreed to future-proof our agreement, and therefore we will have a review clause which can also adjust these quotas according to our both agreements in close link with how the markets on both sides would develop.
Right. So currently, tariffs on imported cars, fully built imported cars, are in the range of 70% and 100% in India. How does the tariff on cars exported from Europe into India come down? What will be the level to which it will come down immediately? Yeah.
Once the agreement is in place, so it will drop down from, I think, the 110% right now to 35%, and then gradually in the transition period it should go down to 10%. We agreed to have a little bit different timeline for combustion engines and battery electric vehicles, because we know that it takes longer to get these cars online and to simply make them important part of our mutual trade. We also are reducing from current level to 8.25% the tariff line for the CKD cars. There, I think it's again very important because it would allow the European car manufacturing to kind of strengthen the production line, manufacturing capacities, assembly lines here in India, and we have parts in the deal which will be fully liberalized. So I hope that this would create enough of the space to really start an open new chapter in a manufacturing, in car production, and I think that this is the good news again for both India and European Union, that we can work in such an important part of the industry.
All eyes are on the Federal Reserve decision tonight, and a CNBC survey suggests no rate cut this time around, but predicts 2 cuts this year. CNBC's Steve Leisman is here with the findings of the CNBC Fed survey.
Despite the expected arrival of a new Fed chair appointed by President Trump in coming months, respondents to the CNBC Fed survey see only modest changes to the funds rate over the next 2 years. Only 2 rate cuts are expected this year and none in 2027, bringing the funds rate down to 3.13% for 2026 and staying there through 2027. Part of that is improvement in the economy, with the probability of recession falling to 23% from 30% in the prior survey. 31%, however, do think the Fed ought to be cutting at this meeting, even while most think it won't happen. An improved growth outlook could explain why only limited rate cuts are forecast this year and next. GDP seen coming in at 2.4% this year, which is above potential. The CPI forecast actually declined to 2.7%, down by a tick from September, and the unemployment rate 4.5%. It would only rise a tenth from where it is right now. Kathy Bostiancic, chief U.S. economist with Nationwide, writing in, we anticipate continued solid and more consistent economic growth in 2026, underpinned by fiscal stimulus and easier monetary policy. The rate outlook shows fairly even distribution among hawks and doves, with a plurality in the center forecasting 50 basis points in cuts, 9 seeing fewer and 10 seeing more than 2. And while BlackRock's Rick Reeder leads in prediction markets, that's not the case in the CNBC Fed survey. Warsh leads with 50%, expecting him to be named as chair, Reeder at 14%, Hassett, the NEC director, at 11%, and Fed Governor Chris Waller at 11%. But asked who the next Fed chair should be, Waller once again topping the list with 44%, Warsh at 25%, Hassett at 14%, and Reeder at 6%. It remains worth watching when both the market and the survey show the Fed holding around 3%, even though President Trump will have his man at the helm of the Fed.
All eyes tonight will be on Jerome Powell and company. And as we wrap up on this edition of Business Lunch, here's a quick sneak peek into the stocks that we'll be addressing on your stocks. Don't forget to catch fundamental and technical experts give their views on all of these names flashing on your screens, including MRF, SBI Cards reporting results, the new listing Bharat Coking Coal, and a lot of other names. Do send in your queries to cnbc-tv18.yourstocks@nw18.com. From Arundhati and me, thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Putra. With me as always is Vivek Iyer. In the green, but we have come off from the highs of the day. On the Nifty, it's a 130 point off number from the highs of the day, below the 25,300 mark. The mid-caps, though, they are outperforming today.
Good afternoon, Sonal, and some green on the screen after a while. So starting off the February series on a positive note. A lot lined up on the show. A couple of important corporate conversations as well. So let's start off with the top headlines. Stocks leap up after a tech rally pushes S&P 500 to a record high. Energy, metals, utilities and capital goods are the big gainers, while consumer sectors, FMCG, consumer durables and auto drag.
TVS Motor shares spike following its Q3 results. The company's revenue and margin come in above street estimates. Profit for the company surges nearly 60% on a YOY basis.
CG Power shares surged over 8% after a decline in the previous session following the Q3 results. The management tells CNBC-TV18 that their export orders are up 50% on a year-on-year basis for the 9 months ending FY26 for power systems, and that they are seeing good demand for power systems in the global market.
ABB India higher in trade after the company signs agreement with Titagarh Rail to develop propulsion systems and enable technology transfer to 25 kV driverless metro projects in India.
Shares of logistics service provider Shadowfax Technologies made a weak debut as its shares listed at a discount of 9% to the issue price of Rs 124. The management tells CNBC-TV18 that their EBITDA margin will gradually improve going forward. Welcome to Midcap Radar. Well, earnings season is upon us. Thick and fast earnings are being seen on the screen. A couple of minutes ago, you saw the numbers or the results of TVS Motors that just flashed, and it's a strong top-down beat as far as TVS Motors is concerned. The EBITDA margin, something that used to be a bit of a drag for the company, has improved significantly and has beat street estimates. That particular stock higher by almost 3.5%. On the other hand, Car Trade Tech, the classifieds provider as far as the auto space is concerned, also reported its results a couple of hours ago. That particular stock saw a steep decline as far as the post-results reaction was concerned. The other stock on the radar was Craftsman Automation that came out with its results. Year-on-year basis, you did see a certain improvement come about. That particular stock too now higher by over 3%. But this is our special segment, Midcap Movers. Sonal has hopped across to the wall and she takes us to the mid-caps that are moving around in the session.
Well, yes, mid-caps are outperforming after a while. So let's take a look at some of the big movers in the broader markets. Sterlite Technologies, it's a big surge on that one, locked in upper circuit, up 20% as we speak. Mahindra Logistics is the other one, seeing gains of around 14%. We do have Hindustan Copper. The copper rally continues, and with that, Hindustan Copper has surged up 12% as we speak. Tejas Networks is the other one, 12.5%. Aventel is the other one, which is up around 11.5%. And these stocks are adding to the gains by the hour. So some interesting names on the list. Let's move on to the next slide where we'll see other big movers. Lloyds Enterprises, MCX, HCC. That stock is up 7% as well. MRPL, good refining margins is something which is keeping this sector afloat. We do have Jindal Worldwide, a textile player, which is also higher. The textile space in general is higher because of the EU-India FTA as well. Let's move on now and talk about some of the losers in trade. Actually, that number is lesser today. We do have Shadowfax Technologies, spoke about the listing. It's been muted. That stock is down 10.5%. Vishal Megamart, after the numbers that the company reported, down 5.5%. RPG Life Sciences is the other loser in trade today. So that stock is down around 8.5%. And we spoke to the managements as well, where they are talking about a possible recovery. Granules India down 3%, reported numbers of the weekend. We have BLS International Services as well, which is not doing so well. And Marico Titan, something around the alcohol industry as well when it comes to the EU-India FTA, where alcohol could become cheaper on imports. So let's see what the impact overall here is.
Well, that's right, Radhika Khaitan sulking a little bit in the session today. One particular sector that you just alluded to was the capital goods space, and after a while, seeing a little bit of screen, ABB India, a large Arduin coming in over there, so that particular stock doing quite well. CG Power post its results. Siemens India as well as Cummins, both of these names after a while today are making headlines for the right reasons. Both of these stocks too doing quite well in the session. But before we head into that small break, a quick heads up as India gears up for Budget 2026. The big questions around growth priorities, reforms, and the road ahead take center stage. Budget Vision 2026. What India Wants brings together top corporate leaders, economists and policy thinkers to share their views on what they expect in the upcoming budget announcement. Watch Budget Vision 2026 on 30th January, 10 a.m. in New Delhi.
Welcome back. You're still tuned into Mid-Cap Radar. Let's talk to a management now. Dodla Dairy is the management joining us today. The company's EBITDA margin declined YOY while the revenue surged 14%. Dodla Sunil Reddy, the managing director of the company, is joining in now to understand the quarter gone by and most importantly, the outlook going forward. Mr. Reddy, good afternoon. Thank you so much for joining in. Well, I wanted to understand the outlook on margins from here on. There's been a decline on a YOY basis, and there was also a spike, an unusual spike in procurement prices in the flush season, despite the flush season. Do you think the guidance that you had given of 8 to 10%, there could be some downward risk to that?
Thank you very much for having me on the show. Regarding our procurement prices, it was unusual that the flush season, which normally is a period of surplus for the dairy industry, this year was lacking, and there was not the surplus was not available in the system, as most of the country was also running through a shortage, and that is the reason procurement prices didn't come off, and they've actually gone and become as expensive as what the normal summer prices would be. But I think we've already factored in the summer prices, and we have not yet taken a price hike, not in the current period. I think as we go forward, depending on how the summer pans out, it'll either be a price increase that will have to come into the offing, and the margin should remain in that 8%, 9% ranges.
Okay, so are you still seeing the shortage that you spoke about that happened in Q3? Is that shortage still continuing?
Yes, it's still continuing because of either bitter winters across the country. That shortage is still continuing.
Okay, Mr. Reddy, we get that completely. So the earlier EBITDA margin guidance was in the range of 8 to 10%. So you're now reducing the upper end of the band to 8 to 9%. Is that correct? And also, have you revised your revenue guidance or for FY26? We understand that the earlier guidance was in the range of 12 to 13%.
So basically that 1 or 2% when the consolidated will be very difficult to crack as an exact number. And also we have done an acquisition in OSAM, and an Africa business is doing well. So I think our revenue guidance would still be in the range of the 14-15% kind of a range that we will be looking at. And the EBITDA margin, although right now it's showing 7.5%, we can still look at it going to that 8 to 9% of the EBITDA margin.
When are you planning to take a price hike, Mr. Reddy? Will it be in Q4, or do you push it to the summer season that would start somewhere in Q1 of FY27?
It all depends on the weather. I think if February and if the El Nino predictions that are coming to be true and the summers start to move in earlier, we might have maybe a 10-15 day difference between the fourth quarter or the beginning of the first quarter.
Okay, so sometime between the end of Q4 and the beginning of Q1 FY27. We get that. You spoke about the acquisition, you spoke about the inorganic growth that has come in through OSAM business. So now give us a target for that particular business. How has the current performance been? And we also understand that it operates at a slightly lower margin compared to your original business. So going forward, what will be the blended margin trajectory?
I think currently this is the first quarter where we have taken OSAM as a whole quarter, which has given us a revenue of close to 80 crores. And also the margin is a little lower because we're still correcting it in that 1% range of the margin. But we are confident that this will give us around the 300 crore or in the short term to 500 and 600 crores in the little longer term in terms of revenue. And the margin also, we're anticipating that we can comfortably push it up to the 5-6% of EBITDA margins to start with in the short term of a year.
Okay, so that is about the OSAM business. Revenues of around 300 crore rupees in the short term to 500 crore rupees in the longer term. What about value-added products? You spoke about how procurement prices were unusually high. That would have impacted margins across the board. So how much contribution came in from value-added products? And do you plan to expand that further in terms of contribution?
Thank you. Yes, the value-added products, in fact, has grown for us from 23% 9 months last year to 25% this year, in spite of having a summer which was non-existent and most of our summer products like buttermilk, lassi and ice cream not doing well. This is on the back of paneer picking up for us and other products also moving up. The reason why the overall value add shows a decline from the 32% was because our bulk trade of butter and powder almost became non-existent. Like, for example, in the current quarter, it was 0 to compare to 70 crores in the last quarter, last year, the same quarter. But I think the value added as such has done well from 23 to 25%. Also, OSAM Dairy that we have acquired when we look at the consolidation is at a lower value added around 13%, which we also think that we will be able to move that up to around the 15-20%. So in the days to come, we will still see a further improvement in our value added product range.
Understood that. A further improvement in the value-added product range. Give us a sense of your market share among the private players. What is the overall pie of the market that you enjoy? And has that improved, especially post the acquisition? We understand earlier it was in the range of 6 to 6.5%.
For OSAM, it will still be in the same range because it's still too early for us to make a major call. We're still in the process of correcting. It's hardly been 4 or 5 months that we have acquired. Right. I think that is where it will still continue to be as a market share of the...
I wanted to understand your animal feed business or orga feed, which is still a small percentage of the overall business. But, you know, there's been so much happening globally, and animal feed comes to mind when we talk about that. Right now, how much is it as a percentage of revenue? How do you plan to expand it? And do you have export exposure here?
There's no export exposure for cattle feed. It's entirely a captive business to our own farmers that we are doing. Okay. I think it will be in the range of 150 to 160 crores for the financial year that we are looking at, and a profit margin of around 10% of EBITDA that we can comfortably look at. And that is where it will be. And that would be almost at the range of, let's say, 50% of capacity utilization that we will be. And I think in the year and a half, we can look at getting our capacity utilizations up to that 80-90% mark so that it can further go up to the 400 crores kind of a revenue in the medium term.
Understood that. And in terms of expansion, you know, we understand that you were looking at expanding capacity as far as Maharashtra is concerned. Total capex lined up. Where does Maharashtra currently stand at? And especially give us timelines for the orga feed business.
So the orga feed business, as I said, the existing capacity that we have, which we're roughly now using around 50-55%, will maybe in a year and a half come to full capacity utilization. And coming to Maharashtra, out of the 280 crores that we have earmarked as capital, we have spent 60 crores. And the remaining 220 crores will be spent in the year to come. we are looking at it in the beginning of the financial year 27 that we will be able to commence production and add around at least a 3.5 lakh liter or kind of an operation as an additional operation there.
Okay, take that point. Mr. Reddy, thank you so much for joining in and giving us perspective on what happened in quarter 3 and most importantly, the outlook on the business going forward. That's the word coming in from Dodla Dairy. They maintain their guidance on margins and revenue growth of 14 to 15% and spoke about some of their acquired businesses and the animal feed business as well. With that, we'll slip into a short break. But before we do that, here's a quick sneak peek into the stocks that we will address on your stocks today. Do not forget to catch fundamental and technical experts give their views on these at 2 p.m. today only on CNBC-TV18. Welcome back. You're still tuned in to Mid-Cap Radar. A lot of stocks in the broader markets which are buzzing in trade. Let's get in Vinny, who'll talk about ABB and Titagarh. Both these stocks on the back of a partnership. Vinny, tell us more.
Yes, so both these stocks today are on focus on the back of this partnership. Now, Titagarh and ABB have partnered on a 25 kilowatt of driverless metro propulsion and tech transfer. So what is ABB going to be doing in this? This is a time period of order is 3 to 4 years execution. Now, ABB is going to be providing propulsion as well as TCMS order for Titagarh for 40 train sets, each of 6 racks for Mumbai Metro Line 5 and 6. Do not forget, Titagarh had received a couple of orders for Metro Line 5 and Metro Line 6 as well. So aggregating to around 4,000 crores in total that received orders for train sets, coaches as well. So that is why, now this comes in as a positive for ABB as well as Titagarh, because Titagarh also, this will help them in terms of the manufacturing of these advanced driverless metro components that will come, and execution starts improving as well for them over here. Do not forget, for ABB, this will be a sizable order, though the order size is not mentioned in this, but given that these order wins that Titagarh had were significant size and propulsion systems account to around 35 to 40% of the overall cost, so it will be a significant order for ABB.
Well, thank you so much, Vinny, for joining us and taking us through the details as far as ABB India and Titagarh Rail Systems is concerned. Well, as you just saw on the bottom of the screen, the results of CSB Bank just came out. That stock down almost 7% post the results. A slight deterioration as far as the asset quality on a sequential basis is dragging the stocks lower. But TVS Motors came out with a stellar set of numbers. Rima joins in with more details.
Thanks so much for that. Indeed, it's a beat on the company's top line. Revenues went up 37% on a year-on-year basis. This was driven by a volume growth of 27% and realizations to increase by 8% on a year-on-year basis. We also saw a richer product mix in the domestic market, driven by a higher mix of premium two-wheelers, EVs and three-wheelers segments. Margins too came in strong at a multi-quarter high at 13.1%. Again, a better mix and a rupee depreciation helping here. So EBITDA margins at 13.1%, expanding by 120 basis points on a year-on-year basis. Profit surge 52% year-on-year. Slightly lower than the CNBC-TV18 poll, but here there was a labour code impact of 41 crore rupee. There is a conference call scheduled at 3:30 p.m, so we will watch out for the further outlook on domestic export volumes, update on the ABS implementation. And we've seen an increase in raw materials. Companies managed to do well on the margin front, but are they looking at any sort of a price action or a price increase? Stock has also been an outperformer. In the last 1 year, TVS Motors is up 56%. In the last 2 years, 88%. Last 3 years, 250% increase. And in the last 5 years, it's been a rally of nearly 590% for TVS Motors. Back to you.
Okay, all right. So that is about TVS Motors, the stock surging on the back of good numbers. By the way, before we talk about Motilal Oswal, just take a look at the markets. We've come off sharply from the highs of the day. The Nifty is just up 20 points as we speak. When we started the show, it was up around 80 points. So watch out for the moves on the Nifty. The Sensex too briefly slipped into the red, and the mid caps, they are outperforming, yes, but that index too has come off sharply from the highs of the day. So yes, there is some selling pressure which has come by from the highs. Let's talk about Motilal Oswal Financial Services. That stock is doing well in trade after reporting the Q3 numbers. Ria is joining us with more. Ria.
Well, yes, Motilal Oswal has reported quite a good set of numbers in this quarter, which is why the stock is also surging in today's session. This time around, the revenue has gone up by roughly 14%, and this has largely been led by the wealth and asset management business of the company. The EBITDA margins have also improved to 52.7% from 46.3%, aided by operating leverage. And the net gain on fair value change has also seen a recovery this time, although it is still much lower compared to the Q1 highs of 1,068 odd crores. Looking at the segment-wise performance of the company as well, the wealth and asset management business as well as the home finance segment have seen improved profitability along with better margins. And looking at the capital market segment of the company, which includes institutional equities as well as IB, that segment is down roughly 18% sequentially, with margin pressure in that coming in on that segment. But overall, good set seen by the company this time around.
Well, thank you so much, Ria, for joining in and giving us all the key highlights as far as the results of Motilal Oswal is concerned. A sharp recovery, up almost 8%. But later on today, capital goods big boy, one of the top movers as far as the entire index is concerned, is L&T, and it will be reporting its results post-market hours today. It's expected to be a steady operational quarter for the company, with a sequential improvement seen as far as its core EBITDA margin trajectory is concerned. So revenue seen higher by close to 14%. EBITDA, the CNBC-TV18 poll expects to be higher by close to 17%. Margins are seen up 28 basis points on a sequential basis as well as on a year-on-year basis, and profitability seen higher by close to 30%. Now, BofA Securities says that as far as Q3 is concerned, the order inflow announcements that the company has declared to the exchanges has been quite soft or quite muted. Total disclosures has been slightly in excess of 35,200 crores. Now, talking about the guidance, and that will be the key to watch out for as far as L&T is concerned. At the end of H1, the revenue, remember the company had targeted a 15% growth for FY26. It stood at 13% growth, and the company had said that it is on track to meet the guidance. They, however, expected H2 to have stronger execution. As far as core margins are concerned, the company at the start of the year targeted a core margin range to be around 8.5%. At the end of H1, it stood at 7.7%, and the management did indicate that margin improvement is still a work in progress, and that will be something that the street will watch out for as well. As far as order inflow guidance is concerned, a 10% higher order inflow on a very high base of FY25 was what was expected. H1, the company's order inflow stood very strong at 39%, and the company did say that it is well positioned to exceed the order inflow guidance. So the key thing to watch out for L&T, number one, a couple of order cancellations as far as the Middle East is concerned, and number two, Project Lakshya 2.0, something that the street will look forward to.
Okay, that is a big number to watch out for in today's trading session, and Maruti is the other stock that will be in focus on the back of numbers. But for the markets, we have come off from the highs of the day. Nifty Energy Index is doing well. ONGC is the top gainer. We also have Oil India, which is doing well in trade. Crude oil prices at a 4-month high, which will aid their realizations. But do remember, there is a fear of oversupply in the crude market, 1.5 million barrels per day this year. So that is something that could keep crude prices in check. So those are some numbers we'll be tracking for you. But with that, we have run out of time on this edition of Midcap Radar. Stay tuned. Your stocks when we return.
Hello, good afternoon. You're tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much, as always, for tuning in. Now, today, in terms of the markets have come off significantly from the day's highest point. If you look at the Nifty as of now, at the top of the screens, it's just holding on to 56-point uptick. That's 0.2% uptick for the Nifty, 25,230 levels. At one point of time, it was about 25,300, but then after 12 o'clock, if you look at it, seems like it's given up those gains. And right now, in the last few minutes, seems like it's trying to make a comeback, but let's watch out for that. As of now, 25,200 is what the Nifty is holding on to. Broader end of the market, nonetheless, is managing to hold on to better gains versus the benchmark indices. Overall, today, it's been performing well versus the benchmark indices. So let's watch out for that. Like I'm saying, in the last few minutes, again, we've seen that spike up coming in the market. Just a slight bit of a recovery. So let's keep an eye out on that as well. IT not managing to do well, FMCG not managing to do well today, but what's doing well? The energy, Nifty Energy, that's the top sectoral gainer, as well as the Nifty Metals, that's also managing to hold on to good gains. But that's the market setup for you all today. Let's actually bring on board our experts who are here to solve all your stock-related queries. We have Asta Jain, Research Analyst at Hem Securities, as well as Saumil Mehta, Head of Alternate Research Capital Market Strategy at Mirae Asset Sharekhan, to answer all those doubts that you all have been sending us. Asta as well as Saumil, good afternoon. Thank you so much for joining us on the show as always. Let's get started with the stock-related queries. And the first query for today is coming from Rajiv Sharma, who's writing to us from Patna. He's holding 20 shares of MRF, and this is at a price of 20,000 rupees. He's asking if he should buy more shares at the current level. MRF, what's your view on this one, Asta? Surely one he's been holding in for a while, but MRF, should he buy now as well?
Hi, good afternoon to everyone. Now, talking about MRF, first of all, I would like to throw light on the result date. I think the results will be coming on 6th of February. So better to wait till that time. This is what I believe. Now, if I talk about the fundamental seems to be okay, because the results which they have posted in the last quarter was a kind of an average result, because what we have seen is that there was a top line growth of around 7%. That is a not very strong one. And so in the Q2 of FY26, they have witnessed the top line growth of around 7%. And in fact, what I believe that MRF is such a stock which one should really wait on if anyone wants to make a fresh entry. So my idea here is just to wait till 6th Feb. Let's see how the results come out, because in the second quarter, there was some impact of the monsoon, which we have witnessed on the sales of that company. And hence, we have seen some sort of exports issues also. So my idea here is just to wait. And if anyone has that stock in the portfolio, then one should remain invested for the price target of around 1,51,000 or so. So idea here is just to wait before making fresh entry.
Okay, wait before you make fresh entry right now. That's the word coming in from us. Now, the fundamentals. Saumil, on the technicals, MRF, what should the viewer do? Wait out for levels, and what is the level then they should look to enter at?
Good afternoon to everyone. View is negative in the medium term and in the short term as well. But in the long term, definitely positive. However, as Asta said, in the very short term, there could be a slight more of a selling pressure here. 1,32,000 would be the next support, and after that the next support is around 1,26,000. So these are the two levels I'll watch out for. Revisit around 1,32,000 and 1,26,000. 1,26,000 probably would be a screaming buy on this stock, but revisit at those levels. View would be positive in the long term, but not in the short term and medium term.
Short and medium term, not a positive view. Long term, positive view there. Saumil has mentioned some levels also. You can revisit and look at MRF at that level. Next query for today. Ashok is writing to us from New Delhi. He's holding 1,999 shares of Jio Financial Services, and a price is 332 rupees per share. Wants to know whether he can hold this for the next 6 months. So more of a short-term query there. Asta, Jio Financial Services, what's your view?
So yes, what we have seen in their number was that there was some improvement in their core earnings, and that was mainly due to the stronger lending and the fee income which this company has generated in their and has shown in their numbers. But idea here is valuations are very high, and we are seeing that in such kind of a market, when markets are not in a very good mood, the high valuation stocks always get beating up. So I think here also this is the problem with the counter, that their valuations are high, and hence we are not able to see a good rise. Despite posting a decent set of numbers, idea here is to stay invested in this counter for the price target of 305, but it will take some time because in the short run, I believe some more pressure can be witnessed in the counter.
Okay. Somil, what's your view for Jio Financial Services? Their buy price is 332, right? So they're making a loss, and they want to know only for a 6-month time period, is it going to reach that level there?
I don't think so at this point of time. My view is negative on Jio Financials. Overall, in the weekly, monthly charts, all low top, low bottom formation, and my next target on the downside is 240. So yes, weak in the short term, medium term, but in the long term, if you are able to hold on for a little more, like for probably a couple of years, I think this stock will do really well. My targets are well above 350, 360 levels, but at this point of time, in the short term, in the medium term, I'm not very positive, and downside targets would be 240 to 30 levels.
Okay. Not in the short and medium term. Long term is where one could look at holding the stock on for. Hope that solves your query there. Next query then, we have Balakrishna, who's writing to us from Karnataka. He's holding 1,000 shares of Bharat Coking Coal. Price is 45 rupees per share. And then he wants to know if he can hold this for 1 more year. Also wants to know on Aarti Industries and Shilpa Medicare, is it good to invest in these stocks for a time period of 2 years as well? Asa, your view. Bharat Coking Coal, obviously, it's a recent listing there.
Yes, it's a recent listing, and the issue price was 23 at the higher end because the price band was 21 to 23. But what I believe that here the investor has taken the shares at a highest price, because 45 was the highest price which this stock has touched in the recent past. So I think there only, he has make an entry on, and that is why he's facing some sort of losses. Right now, fundamental seems to be okay, but when the issue came, the price was only 23. So it was at a price to earning multiple of around 8.6. So from there, we have seen a good jump in the PE ratio as well, because right now it is quoting 37. So my idea here is to stay invested in this counter, but I think it will take some time to reach those price high of 45 again, or it will take some time to break even in this stock. So idea is, if the view is long term, then remain invested, because in the short term, I believe that this stock has seen a huge jump from its issue price. So it might take some more time to reach till the level of 45, where the cost price is. Now, talking about Aarti Industries, I believe the results have not been announced yet. So wait for the results, because these markets are not so good. And here, I believe that after results, if anyone make any sort of decision, then it is a better choice. So right now, just wait for the numbers to come. My idea here is maybe 6th February is the date, if I'm not wrong with my memory, when the Aarti Industries will be declaring its numbers. So I think just wait for those till that time, and then make any decision for this counter.
Okay. Somil, I will ask you on the two stocks, that is Aarti Industries, Shilpa Medicare, current levels for a time period of 2 years. Is it good to enter this one?
Aarti Industries, yes. I think if you are talking about a little medium to long term, the stock is looking positive here. Ending diagonal pattern has been formed, and I'll be expecting this ending diagonal to break on the upside. Now, in the next 6 months to 1 year time frame, I'll be expecting the stock to go above 400, 420 levels. That would be my target for Aarti Industries. So positive here in the medium term outlook. For Shilpa Medicare, this one, I'm not very positive on this stock. Low top, low bottom formation on all the time frames. quarterly, monthly, weekly charts. Daily sharp sell-offs here. So I'll be expecting this trend to continue on the downside. Next target on the downside would be 250, and if it does not sustain at 250, then the next target would be 210. So negative on Shilpa.
Okay, negative on Shilpa Medicare there. Okay, we have BEL that's reported their numbers right now as well. So when I'm looking at it, it seems like it's better than what we were expecting at CNBC-TV18. Revenues at 7,122 crores, EBITDA at 2,117 crores. Good jump in terms of revenues as well as the EBITDA performance that we've seen coming in. Margins also at 29.7% versus what we were expecting was at 28.1%. So strong beat seems like, at least versus what the poll that we're seeing. And net profits have seen a jump of around 21% on a year-on-year basis. Labour code impact also we had at the flash at the bottom of the screen. It was around 16 crores that one saw coming in right now, the new labour code impact. So watch out for that one. Revenues managed to see a growth of 24%, EBITDA up 28% as well. That is BEL for you all. And we saw the stock spike up as the numbers were announced as well. So keep an eye out on that. Let's move on then to the next query then for today. We have S. Jayakumar, who's writing to us from Tamil Nadu. He's holding 100 shares of Hitachi Energy. This is at a price of 16,900 rupees per share. Long-term investor wants to know if he should continue to hold or sell at the current levels. He's making some bit of a profit on this one. Astha, your view.
So first of all, just want to make one correction. Aarti Industries will going to announce the numbers on 2nd February. I was wrong with that part, so I'm really apologize. And now talking about Hitachi Energy, first of all, Hitachi Energy is looking very, very strong because this company manufactures the value or the product across the power grid's value chain. So I think what is major attraction about this company is its strong order book. They have got very strong order book. Their execution capacity is very, very high and operational efficiency is also very strong. So I believe that Hitachi Energy is such a company where one should remain invested in, and price target which I would like to give to this counter is around 19,500. So to approximately 2,000 rupees up from the current level. Remain invested in this counter for the price target of 19,500.
Okay, we'll keep an eye on those levels there. Samil, your view for the long term for Hitachi Energy?
Long term, definitely positive. In the very short term, we've seen a little bit of correction, but I think this is a buying opportunity. I'm positive on this stock. 16,000 levels would be a very crucial level to watch out for as a support on the downside. But on the upside, I think the next target would be around 19,900 and then 22,800. So these are my two targets in the medium to long term outlook. Yes, positive in the long term.
Positive in the long term for Hitachi Energy. So continue to hold the stock. Let's move on and actually slip into a very short break. And viewers, here's a note for you all. The countdown for Budget 2026 is underway. The most influential voices decode and analyze the impact and policy decisions from the Finance Minister. We bring you a power pack lineup throughout January and on the day of budget itself. Market veteran Ramesh Damani and Helios Capital Samir Arora for all things market, followed by JP Morgan's Rajat Chinoy to discuss macro signals. We also get you insightful analysis from industry veterans and Dinesh Kanabar as well as Ashok Wadhwa for the tax rhetoric. welcome back to your stocks on CNBC TV18. And we still have with us Asta Jain of M Securities as well as Somil Mehta of Mera Asset Sharekhan to answer all those queries. But before we go to them, we have Maruti Suzuki that has reported their numbers. Revenue seems to be largely in line with what we were expecting. EBITDA has come in at around 5,572 crores versus a 6,000 expectations. A slight miss there. Margins, a bit of a miss versus just 60 basis point miss versus what we were expecting. 11.2% is what the EBITDA margin has come in at versus expectation of an 11.8%. We have net profits, 3,794 crores. That's come in slightly below what we were expecting. So slight miss, I feel, is what is coming from the numbers overall is what we're seeing right now versus the poll at CNBC TV18. The stock also has seen a fall coming in right now as well. Asta, let me ask you on Maruti Suzuki as well. What's your view coming in right now? Doesn't seem to be that great. At least the street is not happy with the numbers.
After that GST rollout, I believe that definitely Street was expecting a good set of a number. At least they should perform on the expected line. So here the numbers are coming below the expectation. I think that not be a good case for the Maruti, and we may see some sort of a pressure in the stock prices. But these are prima facie number, so I really need to check the numbers in detail. But prima facie, it seems not to be so good number, and we can see some sort of pressure in these stock prices.
Absolutely. We will surely wait out for more details also as of now in terms of numbers. Revenue growth has come in at 28.7%, and we were expecting a growth of 32% on a year-on-year basis there. So yes, that's something that we'll be keeping an eye out on. And like I said, margins also seem like a bit of a miss versus what we're expecting, 11.2% versus 11.8%. Volumes were up by around 18%. So we will watch out for more internals and more details. Last year, the margins were at 13%. We have Naveen Kulkarni, Chief Investment Officer at Axis Securities, joining us on the phone line to talk to us about Maruti numbers. Naveen, good afternoon. What is the first look of the numbers for you? Seems like a bit of a miss that's coming in here this time.
Yeah, I guess so, because based on what you read out, the margins seem to be a miss in this quarter. Difficult to say why they would have missed. Of course, Q3 again depends on how the festival quarter has panned out, but volumes were pretty strong, so we are expecting a good set of numbers in terms of the overall margins. But I think there is a miss there. Both, I think revenue there is a slight miss as well as in the margins.
There seems like some bit of a miss there. Obviously, because one was expecting actually margins to improve, I'm also going to wait out maybe in terms of a release that we have. But overall, realizations, they were up 12%. What is it that one should expect now from Maruti? Seems like the stock has seen slight bit of a recovery from the day's low right now from where it hit after the numbers were reported. But any thoughts on that as well?
Yeah, so the volume numbers for Maruti are quite strong, and the segments that they are operating in, I guess there is the competitive activity, especially in the lower end of the segment, is quite low right now. And structurally, also from discretionary consumption point of view, auto sector continues to look good. So Maruti, in all likelihood, over the next 12 months, should be able to maintain its market share and probably also gain a little bit of market share. So structurally, it looks good, considering the new launches and everything. This quarter miss, again, we need to study a bit more. I have to listen to the conference call to understand what exactly has happened.
And also any sort of a worry that comes in, given that, these commodity prices, they have seen a bit of a rise. So higher commodity prices, is that something, a concern that we're keeping an eye out on for the next quarters as well?
So commodity prices could be a slight concern, but again, the biggest commodity is steel, right? So that is still okay. If that rallies up very sharply, then there could be a challenge. But we'll have to see how commodity prices will have an impact. Maruti still has a decent amount of pricing power to pass that on. Also, the whole structure of auto industry has changed. There is more value addition which happens. So from that perspective, also, it's slightly easier for companies to pass on commodity prices also. So I won't be very concerned about commodity prices, but yeah, if there is a sharp rally, then it will become a concern.
Okay. And any thoughts? The stock has recovered. I would like the director and producers to pull up this chart and refresh it, because look at the stock now. It's just down 1%. At one point of time, we had seen a very sharp decline coming in for Maruti Suzuki. So yes, that recovery has surely come in terms of the numbers. So maybe we'll wait out for these details. Naveen, just a word overall then in the auto pack. Would you prefer four-wheelers, two-wheelers right now? And obviously, we're just ahead of the budget as well. So what are we waiting for now here?
Yeah, so again, Autopack continues to look interesting. Maruti, of course, has done pretty well in the last 1 year. It should continue to do well considering the volume numbers have been pretty strong. The recovery in the stock price could be some bit of short covering also that could be happening. But I think we'll await more details. If there is no significant cut in earnings estimates for next 1 year, I think Maruti should still continue to do well.
But would you maintain your earnings estimates given that right now the numbers, it was a slight bit of a miss? What is your thought there?
It's difficult to say right now, but I think the volume trajectory looks fine. So I don't see a huge cut in earnings, maybe a couple of percentage points based on what has happened in this quarter is a possibility.
Okay, you're not expecting a huge cut in terms of earnings there. Maybe a couple of basis points is what we'll watch out for. Maybe more details, we'll wait out for in the con call or updates coming in from the management as well. Naveen, thank you so much for joining us and explaining us the numbers or decoding the numbers of Maruti Suzuki with us as of now. Thanks so much for that. But Maruti Suzuki, surely the stock has recovered and moved slight bit on that green side. You can see it flip-flopping between the red and the green as of now. That's Maruti Suzuki for y'all. We'll wait out for the details from the press release or the management commentary as well. But yes, not much in terms of numbers exciting, but wait out for more details there. But that is about Maruti Suzuki. Somil, if Somil is there with us, anything in terms of levels that we're keeping an eye out on for Maruti Suzuki?
Maruti has been sliding down for a little while now, but has taken support at 200 daily exponential moving average, which is around 14,500, 14,700. So that will become a very crucial level now. Anything below that, I think the next level will be 14,000, probably below that as well. But at this point of time, in the medium term, in the long term, I'm very bullish on Maruti. So I'll be looking to buy on declines.
Okay. That's the view coming in there on the technical front for Maruti Suzuki as well. As well as Somil, thank you so much for joining us on the show and helping answer all those viewer-related queries as always. Viewers, we do have some bit of Maruti Suzuki's press release that has come in as well. And in terms of the highlights the management has said that owing to the GST reforms, they're saying there's a sharp recovery in the Indian car market, primarily led by small car segment. And they said that they've received and achieved the highest ever quarterly domestic sales of 5,64,669 units. So yes, that's just an update there. We'll wait out for more details in terms of anything more coming in from Maruti Suzuki. As of now, the stock is flip-flopping between the red and the green, but after that sharp fall, which we saw when the numbers were just reported, the stock has seen a recovery there. But with that, we are absolutely out of time on this edition of Your Stocks. Thank you so much for tuning in. Remember, you can always message us, WhatsApp us your queries, or email us your queries, and that will be flashing at the top of your screens, the email ID as well as the number as well. So do send us your queries. Don't go anywhere. Last round of trade is still left, and for that, your closing bell up next.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Whether you look at the Taiwan index, the Hang Seng, the Kospi, that's the South Korean index, all of them are managing to hold on to gains.
On Monday, when we were not trading, the dollar had fallen sharply against majors, against Asian emerging market forex, and that kind of continued last night in the US session as well. So about 1/3% higher on the Nifty, 25,250 is where we are at. The Nifty Bank is up about 0.5%, I think, 59,200.
Looks like the earnings outlook is looking better. Earnings are stabilizing, and FY 2027 should be a good year for earnings growth for the market as a whole. We are looking at about 15% growth for the Nifty 50.
So Mr. Ajit Pawar, Deputy Chief Minister Maharashtra, no more, passed away in a plane crash in Baramati earlier this morning. I mean, sometime before 9 a.m.
No expectations. Maybe we keep hearing that they may do something on long-term capital gains for some FIIs.
President of India, Draupadi Murmu, arriving for her joint address to the Parliament, and this comes at the start of the budget session, just 3 days before Finance Minister Nirmala Sitharaman will present her union budget on Sunday.
Whether that is infrastructure, consumer, all of those stocks are going to be in focus. But earnings, as for now, dominates. The markets, broader markets, seem to be back in the game.
Sterlite Technologies, it's a big surge on that one, locked in upper circuit, up 20% as we speak. Mahindra Logistics is the other one, seeing gains of around 14%. We do have Hindustan Copper. The copper rally continues.
Okay, well, that is the day so far. And oh boy, I mean, the volatility on the index is just quite amazing and really quite something to behold. I mean, you know, you literally there was 25 points on the index about, 15-20 minutes back. Then there was 150 odd points. Now there is 50 points. So the ticker tape is changing very, very fast. This is Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant, Nigel and Reema with me. Guys, hi. Afternoon.
Hi, afternoon. So the intraday high on the Nifty was closer to 25,400, 25,372 on an intraday basis. And that was a level, both Mitesh and Sudarshan had pointed out, from which the markets could reverse. And we've seen profit booking take place. The high was hit somewhere around 11 o'clock. Still holding up in the green. Mid-cap performance is a lot more heartening. Yes. So adding on weight from yesterday's rally, and the advanced decline ratio stands at 3:1.
Well, that's the big takeaway for me, that at least the breadth of the market has improved. We have got slammed back, and today, after a while, you have the mid-caps actually that are outperforming what the frontline index is doing. Both the small cap and the mid-caps, they're doing better than what the Nifty as well as the Nifty Bank. So that's why portfolio is feeling good. Some of these stocks have fallen a great deal, but currently they're pulling back equally as swift. We have ACC's numbers that are at the bottom of your screen. It's ACC's consolidated numbers. Remember now, it's going to be merged with Ambuja Cements, and it trades at a big discount, because always there was that fear that it's going to get folded up into Ambuja Cements. I think the numbers, on the top line as well as the bottom line, more or less in line. The EBITDA number, well, it appears it's a bit of a miss. It was expected to be soft, but the margin is even softer than expected. So keep in mind, but for ACC, the problem is there's a lot of intercompany sales. So that's why now analysts look at Ambuja Cements on a consolidated basis, because it's very difficult to analyze, the reported numbers from ACC and the other subsidiaries. The stock has been a big underperformer, and it continues to remain, sub that 1,700 odd mark, which is actually much lower than replacement cost on an EV per EBITDA. It's the cheapest stock. But as I said, parentage is with Ambuja Cement. So if you want to play Adani Cement, you rather look at Ambuja Cements. That's the way the street looks at it.
Broader markets, of course, Nigel, is the story. But I just noted down, what we've done on the Nifty, right? If you can, the intraday basically will tell you the story. So we opened at 25,370, and that was the high approximately. A point here or there. That is the opening high. Then we fell 140 points. By 10:15, we were at 25,230. Then, in the next hour, we jumped back 130 points again to 25,350. So that was 11:30. 150 we fell to 25,190, that is 150 point down. And now we are essentially about 60 points up from that low level. So 140 down, 120 up, 150 down, and now about a 60-odd point bump up. So, I mean, you know, it's like a very, because positioning is on the long side so light and markets so heavily short, I think it's being, you know, the index is bobbing around like a, you know, like a ball which is being thrown around. So 60, 67, 70-odd points is what you have. But the heartening fact, I think, as Rima and Nigel both said, market breadth is positive. Almost 3:1. So 3 up for every 1 down. And it's a really wide swath of stocks which are doing very well. How should you position yourself is the question. Mitesh Thakkar is with us with that answer for you. Mitesh, good afternoon. Good to have you here. Your thoughts in terms of index trades, and then we'll get to stocks.
Good afternoon, Prashant. So yeah, actually, we did get a bounce back as I was talking yesterday, and I said getting past 25,400 could be a challenge. And I think we got a high around 25,370, 75 zones. I think overall the market, remains oversold, but weak. So it could be some kind of a choppy move between 25,000 broadly and 25,400, and a break on either side would suggest further movement in that direction. But the overall bias for me as of now is on the negative side. So I am looking at more of shorting positions as we get close to about 25,400. On the stock side, I have one buy and one sell. Bharti Airtel is breaking down, so sell there with a stop about 1961 for targets of around 1900. And HAL is buy with a stop below 4509 for targets of 4625.
Okay, defense is clearly the sector of the day. We should pull up the India defense sector. And Bharti is down nearly 8% since the start of the year. It's been a rank outperformer for the last 5 years, but seeing some profit booking at higher levels. And with today's fall, it's dipped below the 200-day moving average. Bharti Airtel 1.5% down since the start of the year, 8% lower. But let's quickly touch upon the numbers that came in from the auto pack. So starting with TVS Motors, which was a strong set of numbers. The company's revenues went up 37%. This was driven by a volume growth of 27% and a realization increase of 8%. Margins came in at a multi-quarter high of 13.1%, aided by a better mix. There were more premium two-wheelers, three-wheelers, exports in terms of the mix, and plus the rupee depreciation. So 13.1% margins versus 11.9% on a year-on-year basis, ahead of expectations. Profits went up 52%, lower than estimates, but impacted by the labor code, which hurt the bottom line by 41 crore rupees. There's a conference call at 3:30 where the street will watch out for the outlook on volumes, domestic and exports, any update on ABS implementation, and the price action following an increase that we've seen in raw materials. The other one is Maruti Suzuki. And before we get to the numbers, pull up the intraday chart. Maruti Suzuki post the numbers fell 4.5% and now has managed to recover. It's still settling, finding its feet. Stock now is down 2.5% off the lows when it was down 4.5%, 5%. But it's once again, slipping off. Numbers look fine. The company's revenues went up 29% on a year-on-year basis. This was again driven by a combination of volumes increase of 18% and a realization jump of 9%. But realizations are actually lower on a quarter-on-quarter basis. The stock initially fell because of a margin miss. The EBITDA margins for Maruti were lower than estimates at 11.2%. It missed consensus expectations and declined 80 basis points on a year-on-year basis. But this was on account of a higher one-off expense which dragged the margins, on account of gratuity long-term compensation. If you strip that off, ex of one-offs, margin performance is better. And that is the reason why even the profits came in lower than consensus expectations. So that is Maruti. But earlier in the morning, there was also some news on Maruti where I think Bloomberg had reported that South Africa is considering imposing tariffs of up to 50% from vehicles from India and China because it wants to protect its domestic industry from a flood of imports. This is what Bloomberg had reported. And for Maruti, while exports are not very large, South Africa is one of the top export markets. So that's the reason why since morning, the stock has been subdued, but now is trying to find its feet on the back of the numbers. So Maruti down 2%, TVS Motors up. Mitesh, you want to comment on the technicals of any auto stock which stands out? Yesterday, we had M&M, which was down nearly 5%, and today big moves seen in both these names.
So, for me, I think M&M is a stock which is showing signs of weakness. While the stock has managed to bounce back from lower levels, I think, yesterday or day before yesterday, the closing was around 35.50, and yesterday we got a closing of about 33.90. And today we are just kind of holding around those levels. There's a weekly average, which comes in around the levels of 33.88. Once we start closing below that, I think the stock should complete a breakdown, and I would look at a target of 3,200 to begin with, and in a slightly negative case scenario, even 3,070. So the overall setup is negative. On the upside, I think, it will be very difficult for the stock to get past anywhere close to about 3,500, 3,510 levels. So I think, if the stock comes to 3470, 80, again, I would be on the shorting side. Similarly, for Maruti also, it's recovered from the intraday lows, but the weekly charts are slightly negative, which means that this pullback will most likely fail to get beyond 15,250, 300 zones. And I think there's still a chance of the stock heading towards 14,200 to about 14,100. So negative view there as well.
Okay, all right. Got that, Mitesh. I think we have Mayuresh Joshi who joins us on the show. Hi, Mayuresh. Good afternoon. Good to see you in. Maruti is the stock that we're talking about. Initially, it did see a sharp downtick. It was down close to 4% actually, and then it recovered into the green. Your take on the numbers and the view on the stock?
Afternoon, Nigel. No, I think numbers specifically on the operating front, a tad bit of a miss. Now, is that because of the commodity costs remaining a tad bit higher? And if that is the case, I think as we head into Q4, because base metal prices have gone through the roof over the past few weeks, whether it's copper, aluminium, to a certain extent, steel as well. I think that can probably have some element of an implied impact as far as input costs are concerned. When it comes to the overall volume growth, I think the expectation largely getting built in is with the structural GST changes and the product category that Maruti services, right from an entry level to the hybrids. I think they've got a good mix as far as both value and volume in terms of engine capacity is concerned. No two ways in terms of the dealer and distribution network. However, what kind of an impact does higher input costs have in terms of elevated prices going ahead, not just for Maruti, for the industry as a whole, and how much of an impact will it have on margins going forward? It's something to be seen. The second aspect, obviously, the one-off in terms of the wages and the revision of the wage bill has an impact, but that should largely be missing from Q4. However, I think with the EU deal, I think there is some element of circumspect going around in terms of how cars might get flooded. But again, Maruti is in a sweet spot as far as those markets are also concerned, because even the extremely high premium cars or variants are not a very significant proportion in terms of causing a dent. And how much does it actually have an impact is something to be seen. So I think a tad bit below, as I said, on the EBITDA front, but I think commentary on all these aspects will be closely watched out for me.
Yeah, no, absolutely. Just pull up these stocks, right? We'll talk about BEL numbers which came. So actually, why don't we address the numbers first, and then we'll have a slightly bigger discussion on defense. But Ria, tell us the numbers. I mean, numbers look good. They were a beat, at least on an EBITDA level.
Well, yes, a very strong set reported for BEL, and it's a beat across the board for the company this time around. The revenue has gone up by roughly 24% versus the estimates of 17% growth that we were working with, and this is led by healthy execution of a very strong order book of roughly 73,000 crores for the company. EBITDA and net profit have also seen increases of 28% and 21% respectively, well above the estimates of 14% and 12% growth that we were working with. EBITDA margins have also expanded by roughly 100 basis points on a year-on-year basis, and the Street was actually expecting the margins to contract by 64 basis points this time around. And the better profitability in this quarter has been led by lower other expenses as well as lower employee costs for the company. Material costs to sales are roughly at 54% in this quarter versus 52% that we saw in Q3 of last year. Order inflows, if you look at those for 9 months of FY26, they stand at roughly 17,500 crores, which means the company has already achieved roughly 65% of their regular OI guidance of 27,000 crores for FY26, and order book, as I mentioned, also stands strong at 73,000 crores. Now, going forward today, we have the earnings call at 4 p.m. So we will be watching out for updates on orders for subsystems for large projects like the 97 LCA Mark 1A aircraft, Uttam radars, export orders, QRSAM, as well as the Akash NG missile systems. And apart from this, we will also be watching out for management commentary on the order pipeline as well as execution improvement.
No, absolutely. Thanks very much for that, Ria. Appreciate it. Stocks up 8%. And I think half of those gains, maybe a little more, has come after the numbers came through, just a little before 2:30. But it's not just BEL, right? I mean, if you can pull data patterns up, let's just look at the stock. It's up 13%. There is BEML, which is up 9%. Solar Industries is up 8.5%. Mazgaon Dock, if you can quickly pull these up. There you go. That's BEML. Solar Industries, we should put up. Mazgaon Dock, we should look at. Midhani is up 7%. MTAR Tech is up 6%. Bharat Dynamics is up 6%. Cochin Shipyard is up 6%. HAL is up 5.5%. Zentech is up 6%. Garden Reach is up 5%. Paras Defense is up 5%. Astra Microwave is up 4%. And by the way, these are all part of the Nifty Defense Index. All these names. And of course, the index itself is up 6%. For the week, and we've just traded 2 days. Monday was a holiday. I mean, the Nifty Defense Index is up 8%. Of course, I mean, it's coming off beaten down levels. But Mayuresh, is this the, in a way, the clearest set of expectations one can have? I mean, one doesn't know about anything else, but at least with everything which is happening in the world, I mean, I think the bet is that the government will spend, substantially, at least budget a substantially, higher amount of money to be spent on defense. And I mean, if you believe that, what's the best way to get exposure here?
Prashant. No, I think no two ways about it. I think the expectation is that in terms of a budgetary allocation for the sector as a whole, I think it should be a bump up from last year's budget as well. And that probably seems to be the need of the hour, looking at how geopolitics is probably shaping up. And therefore, I think with an increased allocation expected to take shape and place, the kind of orders that can come through over the next few quarters can be quite significant. It's not that these companies are sitting on meager order books. Order books are already very sufficient enough for a whole host of defense players. I think the revenue visibility of the book to bill is sufficiently covering for the next 4 or 5 years, to say the least. But I think the orders in terms of both execution and the niche capabilities that are expected to come through, specifically in terms of the dynamics and then the dynamics of warfare that is changing, I think the margins should be relatively better, and the timelines in terms of executing these orders will be very well defined. Therefore, I think better margin orders, better execution will probably mean a working capital cycle should be better off for a majority of these players. Obviously, in a quarter or two, you're probably going to get those one-offs happening for a whole host of these defense companies. But I think the sector is buzzing, and you're absolutely right on expectations of higher allocations translating into higher orders with better margins, expected to create stronger earnings visibility going ahead.
While the overall capex expenditure in the budget is going to go up 10, 11%, for defense in particular, the expectation is 20 to 25%. So Jeffries goes on to say it could be as high as 25%. So I'm just reading the note. We expect the defense capex to rise to 1% of GDP by FY31. As of now, it's 0.5%, similar to levels 4-5 years post the Kargil war. India's defense spends are lower compared globally and thus have headroom to rise. And across the board, the expectation is the defense capex will be meaningfully hiked in the upcoming budget. But just a quick word on CSB Bank, Catholic Syrian Bank, if you could get that up. You remember they came out with a pre-quarterly update and the stock got very excited with the gold loan portfolio. The gold loan portfolio went up by, I think, 40, 45, 50% roughly in the pre-quarterly update. Now we've got the actual numbers and there is a meaningful increase in the company's NPAs, and that may have disappointed the street. So gross NPAs now stand at 1.96 versus 1.81. Net NPAs stand at 0.67 versus 0.52. So asset quality has deteriorated in the internals that we have of the numbers. We still don't have the NIMs, but that stock is reversing. Post the quarterly update, it had spiked, and today you are seeing a decline of 15%. Mayuresh, CSB Bank?
Hi, Rima. Afternoon. I think solid set it was expected to be, but what probably happened in terms of the delivery that they gave a quarterly update and what actually came through, I think the street probably is a little bit disillusioned by the whole impact. However, I think going forward, I think within the mid-cap private sector banks per se, I think the large part of expectation is going to be deposit accretion. I was hearing the Karur Vyasya management where Mangalam had conducted an interview yesterday after the results were out. the management is very confident, and therefore part of this private sector banking space, specifically the mid-sized ones, I think the deterioration is largely behind us. Asset quality pressures are looking far more stable as we speak, specifically on the net NPA front. And therefore, I think deposit accretion is going to be a key factor for the industry as a whole, and specifically for mid-sized private banks, because if they have to maintain their run rate and maintain the run rate in proportion of the larger ones, I think their expectations of deposit base actually improving with interest rates actually normalizing and falling as we speak are expected to be a little bit of a tricky situation. Therefore, I think one really needs to be a little bit choosy within this space. I think a few of the banks within the private sector space, the mid-cap private sector space, have delivered a good set of numbers, as I said. Karur, DCB Bank has a decent set of numbers. So in my opinion, I think anybody holding these should continue.
Okay, Mayuresh, we leave the conversation here for now. Thank you very much for joining in. On the other side, Jitendra Shriram of Baroda BNP Paribas Mutual Fund will be joining in. Stay tuned.
Jitendra Shriram is with us of Baroda BNP Paribas Mutual Fund. Jitendra, good afternoon. Good to have you with us here. Markets back up 110 points, so which means we're at 25,284. Essentially, that is another 120 odd point jump from where we were at 150. So lots of 150 point moves today from the open. Jitendra, we were just talking about defense, and I just wanted your thoughts there. You know, it's the cleanest kind of expression, right? Of if I can call it that. One doesn't know what will happen anywhere else, but defense spending perhaps goes up with everything which is happening in the world. What's your sense?
I guess so. So if I were to look at the budget which is due over the weekend, I would probably suspect that given the major item heads of central government spending, which includes railroads, roads and defense, etc. If I had to bet on one sector that might actually see a big flip up, I think it would be defense, given that, world over, you're seeing a much bigger push on defense spending. So this is something that, as a pure catch-up or, going by what your border countries are doing, we may also need to step up that. So that is something which probably makes a lot of sense.
How are you all positioned with respect to defense in your portfolio, Sriram?
So clearly there are certain names that we have directly on defense, which report into the Ministry of Defense, all the names, some of which have been flashing here. But also I would say there are also a lot of proxy play available. Like, you have certain automakers, certain auto ancillaries also who do a little bit of work for defense, which is also some of the proxy exposures that we have in our portfolios.
All right. Hi, Jitendra. Good afternoon. Good to see you, Ben. But what would your positioning be right now? Because, yes, we're seeing a bit of a spurt owing to positioning. The FIs are short. The RSI was moving towards oversold levels. The PCR as well was down. But still, there is that bit of disappointment with regard to earnings, not yet picking up to steam, though it's hopeful that it will pick up. The FI sellers selling does continue. And one wonders whether the retail will have that patience. So at current reckoning, how would you position yourself? Would you deploy money? Would you still hold on to some ammunition?
So if I were to look at broad earnings color till the last weekend, whatever has come out, about 140 odd companies that reported, I would say the numbers were hovering around the mid-single digit. But having said that, some part of it was this exceptional cost item because of these new labor code provisions. So to an extent, if I were to back of the envelope make an adjustment, I would suspect that we are trending somewhere close to our real GDP growth, somewhere in the high single digit kind of a mark in terms of earnings. Now, clearly one sector that has been on a tear for the last 3 or 4 months has been the metal space. And I think the contra positioning of it, that the user industries are seeing a little bit of disappointments, whether it be auto sector, whether it be consumer electricals, whether it be, even some parts of capital goods, especially the industrial segments. We are seeing a little bit of margin pullback there, which is coming through. So I would say that is an area where we would have taken some money off the table. Metals is clearly an area. And if I were to broaden the spectrum, I would say more of dollar sensitives is an area where we have added on to, whether it is tech, whether it is metals, etc., which are proxy play on the rupee dollar benefits starting to kick in. That's an area we have added on to.
No, got that. Just maybe look at a few other things, right, which are moving around sharply. There is defense, of course, we've discussed. Tejas Network, occasionally it gives these, the trend has been, it's just been a secular fall, but once in a while it just makes a sharp 10-15% kind of a move higher, and then that's it, fizzles out. We've seen many, this many times. The last big kind of move on the way up in what has been a declining, one-way declining trend has been, was late 2025, November 2025, when we saw a 15% move. Stock was at about 400. And then, of course, the recent low is closer to 300. But it's got very large volumes at this point in time. What else? There is Electra Green Tech, which is coming up with a very sharp 10% move. ABB is moving up about 7% at this point. MCX is another one, right? I guess that's another proxy for all the activity in gold and silver. So MCX is up another 7%. So it's basically at a new all-time high. So stock exchanges, of course, have not had it all good, but commodities, absolutely kind of different picture. I just hope, and I'm not sort of preempting anything, but there was some chatter about, because that segment has done so well, maybe the government looking to maybe get some more revenue out of that transaction tax there, the CTT. But as I said, it's not expectations, but there was some chatter some time back. We'll have to see. But that, for something like M6, which has done so well, that will be significant. That's what's going on. CG Power, of course, we've been highlighting on the back of numbers. We've had the management with us earlier. We've got something like a Red Tape, which is up 14%. Sirma, which is up 10%. Actually, so many of these sort of single stocks which are jumping up on large volumes as well. And that's the reason why market breadth overall has been very, very solid in that sense. Something like a CG, Jitendra, CG Power, the transformer space. Any thoughts at all? Anything you like? Stocks have corrected quite a bit.
No, absolutely. So whether when we look at this entire electrical piece, I would say that we have seen meaningful corrections come through there. And to my mind, at least a large part of their backlogs should be, obviously there is a little bit of an impact which comes because, things like transformers, etc., are copper users. So to an extent, when you have a situation where just quarter on quarter, that is the third quarter, October to December quarter over the July to September quarter, you had a 15% dollar increase in copper prices. You're obviously going to see a little bit of pain point on the copper side. I presume a lot of these people would be hedging, whether on exchanges or otherwise with their sellers. So to an extent, I suspect that part of it will be mitigated. I think in some of these cases also we are seeing some large lumpy orders come through, which are either on the export side or also on the domestic side. So it's an area we are structurally positive on because we are seeing a lot of shortages for medium and high tension transformers, both in Europe and the US. So to an extent, I think the business dynamic is still fairly optimistic. Although you may see a little bit of margin pullback in the near term just because of the sharp spurt in metal prices.
What's the sector that you're most bullish on, where the risk reward is attractive?
If I were to take a step back and see, even there are certain, if I to just draw the color from September 24 till date, there are at least 300 stocks odd in the small cap space which have really crumbled. They're down like 45-50% and so on. So I would say there is a definitely, when fear is very high, the fear gauge is prompting amber. There is definitely a case for looking at some of these bottom-up ideas because I'm sure that you will find a little bit of value picking now emerging. The valuation froth has drained off, so that is something that could definitely sound quite interesting. Other than that, I would say that, the entire power ecosystem is something we are very bullish on, whether it be the utility space or whether it be power equipment, both on the generation and transmitters. That's something we continue to stay very positive on.
Okay, all right, Jitendra, we'll leave it there. Thank you very much for joining us. Good speaking with you. Appreciate it very much here on CNBC TV 18. 150 points on the Nifty, 25,322 is where we are at. I mean, actually, the other space, actually, we've talked about all this stuff individually, but the PSU space, right? 1.5% on the Nifty PSU index. Actually, we should look at the CPSE index maybe because 5%, yeah, that really shows it. A lot of the defense names are also part of the CPSE index. And of course, banks are doing well. Oil, you got ONGC, Oil India. So really, that is, along with the defense index, the CPSE index, perhaps doing the best. It's also perhaps many of these are exposed to what the government may do in the budget. I mean, these are areas where the government has influence with regards to policy changes and so on and so forth. We were joined by Samir Arora talking about the budget, founder and fund manager at Helios Capital. And the conversation largely revolved around his sort of expectations. He's keeping, of course, expectations low, but especially with regards to equity taxation, these are some of his thoughts. Listen in.
No expectations. Maybe we keep hearing that they may do something on long-term capital gains for some FIIs, which may be defined as some endowments or universities or long-term, some X thing. So what happens is if I keep thinking myself that it's so logical that long-term capital gains should be reduced, then I start believing it myself. So mostly my thinking is they will not do it. Debt and equity in India for Indian resident investors should be same or similar. That is wrong because the debt guys, when they are earning that interest and on that they are paying tax, somebody else is offsetting that interest from his income and is paying less tax. Still for everybody. Don't do it only for FIs. Just reduce for everybody to 7.5 or ideally to 0. And you change STT a little bit. Because on the other hand, separately, we keep saying, although we own all these exchange stocks, that, the volumes are too high, speculation is too high. Just if you so want, or let it be for 5-7 years and then decide after that.
Okay, Nigel is standing by now. There is Samir on the budget, but positioning before the budget and how that is changing. That's the other big thing, because I mean the market's been swinging around like this because of the fact that it's been one way positioned. Nigel, take it away.
Well, that's
Our
right.
numbers changing.
Just look at the options data actually, Prashant. We're talking about the markets being up close to around 100 points. On the call buying, actually not making any money because the IVs actually are come down. And that's why the 25,300 call, the premium actually is down by close to around 5% the last time I checked, at around 240 rupees odd. Normally when the premium's so high as well, you'll get a sense that there is writing at those levels. So there is some kind of writing. We should get that strike up for you in the screen. On the downside as well, the 25,300 put, well, out that the premium has lost close to around 25% in today's trading session. So there is writing being seen at around the 25,300 mark, both on the call as well as on the put side. The important marks to look at, on the downside, you're looking at the 200 DMA, which comes in at around the 25,154. That's very, very important in terms of a first reference zone. The support comes in at around 24,900. However, in terms of resistance, 25,400, 25,450, that's the crucial resistance zone that we're seeing. And today we almost got to around the 25,400 mark. Individual stocks that you're looking at, Asian Paints, that's the one that's seeing fresh shorting today in an otherwise strong market that ended under pressure yesterday, and today as well was under pressure, clearly telling you the markets don't like it. Many analysts thought the street was pretty much okay, but there are shorts getting built into the system. And oil is making a bit of a comeback because of that disruption that we are seeing in, in the United States. So you have Oil India as well as ONGC, fresh buying being seen on both those two counters, and that's why those stocks are holding strong. What's seeing some unwinding of positions? Well, Syngene, there is some unwinding that we're seeing on that particular counter. So net-net, the bulls will believe, well, they have a couple of 100 points left on the upside in this run itself. Let's see whether or not we can get to around the 25,450, 25,500. Then the bulls will like to make a bit of a dash to higher levels. Reference point on the downside, 24,900. Back to you.
Very interesting, Nigel. Thanks very much for that. So that's the F&O, information that you need to know if you are trading, because positioning is really, the head at this point in time, driving markets from one end to the other, and we've seen all these wild swings. Some news coming in from the HAL CMD saying, and this is coming through right now, to deliver 10 helicopters to Pawan Hans in F527. That is the coming financial year. There is a bit about capacity at Pawan Hans, at HAL as well, targeting about 1/4 of our turnover should come from civil aviation in the next 10 years. And oh wow, that's quite something. Considering to make civil aircraft at Nashik or Kanpur unit. So all interesting comments from the HAL CMD. We take a break. We are back. We'll get you a check on what's happening in dealing rooms with Nimesh on D Street Chatter. Stay tuned.
Fly Emirates, fly better.
Welcome back. You're tuned into Closing Bell. A good follow-through session is what we are seeing. By the way, you have SBI Life that comes out with its set of numbers. The APA number appeared a little bit better than what Yash's poll threw out. And the value of new business as well, very measly better. But those numbers will go down as in line or a wee bit better than what the street was working with. Yash will be dissecting those numbers and join in. For the time being, hopping across to Nimesh. D-Street chatters with us. Nimesh, I think thumping the table and all, I don't know, but at least they're not crying now. They must be smiling.
Oh, absolutely. There is a bit of a smile back, Nigel. And this is exactly what we discussed yesterday as well, that the market was so extremely oversold that a technical pullback was on the cards, and that's played out yesterday as well as in today's market. So again, Nifty is back to day's high. Having said that, now watch out for the resistance level of 25,450 on the upside. That was a big support. Now it's turning out to a big resistance on the upside. So that's something to watch out for. Even from a flow perspective, the selling intensity has lowered a slight bit in today's market. I had suggested yesterday as well that for the last many days, a Middle East sovereign fund was a big seller. That selling seems to be largely over. Today there was a small basket which I think has got absorbed in today's first half. So it looks like that selling is largely over from that sovereign fund. Even the mid-cap index has rallied pretty solid in today's market. The index is up 1%. A lot of individual names have bounced back from extremely oversold levels, so a bit of relief rally there as well. I guess a bit of pre-budget rally is now playing out in a lot of the defense names, power names, as well as the PSU stock. So maybe that momentum will continue until the budget. But at least from extremely oversold levels, there is a good technical pullback which has played out in today's market across Nifty as well as in the broader markets.
Indeed. What about stocks, Nimesh? I know most of the news flow is surrounding earnings, but what else have you picked up?
Well, a lot of names which are pulling back from the recent lows. So the first name is Delivery. Recent low of 370, 380, and now you've seen a bit of a pullback in that stock as well. I guess some bit of buying is back, and specifically one large domestic mutual fund has been accumulating at this level. So maybe a bit of buying support and Delivery. So a bit of recovery there. A couple of the other two names where specifically one particular mutual fund has been an active buyer. That is Landmark Cars as well as Syngene. Syngene is still down from post the earnings. It was down almost 10% yesterday. Even today is down. But at lower levels, there is a bit of buying happening. And some domestic mutual funds are active as well in Syngene is from a flow perspective. So that's a couple of names. The third name is L&T. Even that has recovered from the intraday lows today, largely because, as I said, a large sovereign fund was a seller. And part of that basket was L&T as well. Looks like that selling is largely over in L&T. So a bit of recovery in that name intraday. And the last one is Paytm. Even that's buzzing in trade today. The earnings are tomorrow, so a bit of a pre-earnings rally as well. But for Paytm, my sense is the city is anticipating some corporate development as well post-earnings. So watch out for any news if there is any post the earnings in Paytm.
Okay. All right. Thanks a lot for that, Nimesh. By the way, another stock that's come out with its set of numbers, I think, is Accutas. I think this is the erstwhile Amy Organics. Just pull up the intraday chart. It's a massive move that we're seeing on that particular name. I think there's Accutas Chemicals. Let's get it up for you on the screen. I think they're revising their revenue growth guidance from around 25% to around 30%. So explains why that's another stock from the broader markets that's suddenly seen a big spurt up. Now up 7% as we speak, holding really strong last 1 month as well as doing well. And last 7 days, as the chart is telling you, the stock is up close to around 15%. But there is a revision in the guidance, and that's why that stock is bursting away. Let's go back to Mitesh Thakkar from Bonanza Portfolio. Mitesh, you've got a couple of trading ideas for us. Help us.
Yeah. So, one is, IOC is stock with this move towards the on-year day's high. That's a BTS the stock at about 161. And a target around 165 for tomorrow is quite likely. And the other one, which is reversing from extremely oversold levels, would be Keynes Technologies. Keep us target about 34.65 and target 35.50, 35.45 would be low for tomorrow.
IOC, and the other one is Keynes Technology. On oil marketing companies, the fear is in the budget that excise duty will be hiked. So most of these oil marketing companies are making handsome marketing margins on the back of the decline in crude prices because retail pump prices have not changed. So maybe the government could look at increasing the excise duty to shore up its own revenues. So, it could affect the marketing margins of oil marketing companies negatively. But PSU is clearly the sector of the day, and not just the defense names. Oil India, ONGC, 9.5%, 7% respectively. Look at GAIL in the oil and gas pack. Outside of that, an EIL is up 5.5%. RCF is a gain of 3.5%. A Concor is up 2.5%. So across the board, PSUs are on fire. In fact, let's talk about Oil India and ONGC. Because they're gaining in trade on the back of the rise in crude prices and the sharp rupee depreciation. Sonal is here to give us some numbers and analysis. Sonal?
Well, crude oil prices are at a 4-month high, and we are seeing a positive rub-off on oil producers like ONGC and Oil India. There are actually twin factors working for these stocks. The first one, of course, is crude oil price hike, which has come by, and that is after months of it being quite range-bound. Every $1 per barrel increase in crude oil prices increases EPS for these stocks by 1.5 to 2%. And the other factor is that sharp rupee depreciation that we've been talking about. So every 1 rupee depreciation also improves their EPS by 1 to 2%. So these are the twin factors which are working for ONGC and Oil India. But it is important to note that in calendar year 2026, the oil market is expected to be oversupplied by 1.5 million barrels per day. And that is something which could keep crude oil prices in check. The other factor is that oil demand growth may fall by 20% short of the past decade's average in the next 2 calendar years. So we need to watch out for that barring any geopolitical uncertainty that comes by, there could be some pressure on crude oil prices, or at least they could remain range bound. Motilal Oswal in a recent note did indicate that Brent below $65 per barrel could mean that there could be earnings cut in the second half, and they flagged the risk of a sharp uptick in exploratory cost write-offs over the coming quarters for ONGC especially. This could weigh on earnings in second half of FY26, so these risks should also be kept in mind when we look at these two stocks. In terms of valuations, reasonable. ONGC is cheaper than Oil India, 0.8 times price to book, 7.8 times, 7.3 times in terms of FY27 PE, and Oil India at 18 times in terms of PE. But yes, these stocks are on our radar today.
Thank you very much for that. Dipan Mehta is now joining in for the last leg of the show. 15 minutes to go to wrap up what's been a good trading session. The rebound from yesterday continues, particularly the mid-cap index, which is now approaching a 1,000-point rally. Dipan, hi. Thanks for joining in. Anything in the defense pack that caught your fancy? Is running up too much ahead of expectations, or do you think we'll hear enough in the budget to justify the up move today?
Yeah, good afternoon, and thank you for having me on your show. I think, this defense story has been run over so many times. And sure, I think there'll be higher allocations. We want to get more spending done in defense. It's all about being Atmanirbhar when it comes to defense spending. And what we are seeing over here is pure and simple pre-budget buying taking place on the expectation that the allocation will get increased and the order flow at these companies will go up. But I think the preference, in my opinion, has to be with the shipyards, especially Mazagon Dock, where the order book position is looking a bit thin at this point of time. But massive orders are on advanced stage of negotiation. Valuations also are reasonable. So I would prefer to play Mazagon Dock as a defense play rather than some of the other defense companies where already, we have the kind of order book position and the order flow in place. So there's a surprise factor when it comes to Mazagon Dock because you can expect huge orders coming through in the next few months or so.
Dipan, stay on. The one sector which is dragging today is FMCG, and we had a chat with the management of Tata Consumer Products. Listen into what they had to say because stock is under pressure.
Guided for exit to close to 15% EBITDA margin, and we remain on track for that. 14.2 this quarter, which is up 60 bips versus last quarter, and 120 bips versus last year. Actually, if I add the negative of the US coffee alone, I'm at a 15% already this quarter. So having taken the price increases in the US, we remain confident of getting close to that number by the end of this quarter.
Asian Paints was a bit of a disappointing set of numbers. There were some brokerage downgrades also that came through. Listen in to what the management had to say about the outlook and the rise that we've seen in crude prices and how it impacts business for them.
One thing which we are committed in the industry going forward, that as a leader, we would like to kind of see that how can we really increase the demand? How can we really invest more in the brand, put more money in the innovation, and look at bringing more technologies into the system? So we would say that we will continue investing heavily into the industry as we kind of go ahead. And we would kind of like to maintain this band of 18 to 20% PBDIT margins.
Dipan, sharp fall in Asian Paints over the last 2 days, yesterday and today. And this is pretty much reversing all the optimism that we had post the Q2 numbers when the company had reported the double-digit volume growth. Your analysis on Asian Paints Tata Consumer?
I think first of all, they're extremely expensive. In Tata Consumer also, I was just checking 80 times trailing 12 month. Asian Paint still goes around 60 times trailing 12 month. For companies where the underlying growth now has gone down to high single digit and there's increased competitive intensity as well. So when you have a result in front of you, you do analyze what the valuation is. It's kind of a reality check as well. So keeping that in mind, I'm not surprised with the kind of move which we have seen over here. No doubt, I think they are great long-term stories and the fantastic companies have been great value creators in the past, but a good company necessarily will not be a good investment. And I'm not certain that Asian Paints or Tata Consumer are good investments at this point of time. One may remain invested because your price point may be very low, but to expect them to significantly outperform and create wealth from these levels, I'm not so sure.
Any stock that you've been buying recently?
No, Rima, nothing right now. Just waiting for the earnings season to get over. And there are many bets we had made in the prior earnings season, companies like Zaggle Prepaid and Sky Gold and BLS International and a few other stocks as well. But, we are waiting for the numbers over there. But by and large, I think it's just a wait and watch for us. And typically new ideas will emerge post this particular earnings season as well.
And post this earnings season, have you made any bets?
No, not yet. I think we're just waiting and watching. But I'm particularly impressed with the numbers that come through from a lot of these solar equipment companies. The valuations are extremely attractive. There is, of course, fear that the order book position may not grow as much as it has and overcapacity coming into play. But I think that still there is chance for all these solar equipment companies to even deliver good returns from these levels. If the company which comes to mind, we can discuss with usual disclosure that we are invested or looking to invest is Fujiyama. It's a recent listing. It's a major player in the rooftop solar energy business, going in for further backward integration. And rooftop solar is very different from a lot of the other solar equipment OEM manufacturers, more of a consumer business. And we feel that that company has got very good growth prospects, a lot of government encouragement also for rooftop installations. And as far as that particular segment is concerned, we've hardly scratched the surface.
Fujiyama, the rooftop solar, I think it's the Surya Ghar, right? Is that the allocation under which the government is incentivizing?
There are lots of incentives at state level also, maybe you know more than me. All I know is that it's a focus area for the government and it's got a great value proposition for the households who do put the solar panels on top. There's great scope for even commercial, to put in commercial premises as well. And it's not an easy business. It's not like setting up a solar equipment manufacturing company and then you do B2B. This is a B2C business. It requires extensive marketing, distribution, after-sales service. And when you compare Fujiyama's valuation, P multiple, price to book to some of the other appliance companies, could be Havells India or could be Bajaj Electric or any of the other large, even air conditioning companies, it is trading at a discount. But I know it's a new listing. We don't have adequate history, not completely sure of their kind of corporate governance standards as well. But I think it's worth taking a chance on a company like this. Again, a disclosure that we are positive on the company in the segment. Therefore, our views could be biased. Of course, other big players, two big players in this thing are Tata Power and Vari Energy. Both these companies also, I think, are of interest to us.
Okay, all right. Dipen, stay with us. Let's go across to Vinny, who's joining in to help us analyze CG Power. That one, Vinny, is powering ahead. And today, the lone image of red on the screen could be Vinny because the screen is green.
Absolutely.
Vinny, tell us more.
Absolutely, Nigel. The screen is green for CG Power today. Yesterday, they reported the numbers. It was not a great set of numbers, muted numbers that came in from the company, revenue in line, but profits and margins were a miss. But let's talk about the brokerages. Now, the brokerage notes that came in this morning, UBS, they maintained their buy call, target price of 820 rupees per share. Nomura also maintained the buy call, target price of 820 rupees, though Nomura had cut the EPS target for CG Power by 7 to 9%. But they're positive on the overall growth outlook for the sector going forward and CG Power for also going forward as well. JP Morgan also, they maintain their overweight call, but they cut the target price to 698 rupees per share. They said that the demand, export, that's turning out well, especially on the international front, and entering into new markets is something that could maybe lead the growth for the company. US data center order, that was a big one for the company, and that is what they were positive on as well. Now, apart from that, we spoke to the management. We did have some commentary that came in here. The semiconductor business, which reported a loss even this time, they're making a lot of investments on this one, but they said that, in the near term, investments will continue, but they expect to achieve break-even very soon. Xero, which the company has acquired recently. So there the revenue started seeing an improvement. 120 crores is what the revenue contribution was this time. And they said that this company will achieve break-even by the end of Q4 FY26. Industrial segment, which was a bit muted and only a 9% growth, they said that they expect margins now to start seeing an improvement from here on for industrial segments, given that they've taken price increases, a lot of other factors that are working for them, and they're working towards reducing costs there. So industrial segment, that is going to start seeing an improvement in terms of margins. And other than that, export orders, that has seen a sharp jump up. Export orders do have slight bit better margins versus normal other orders. So that is something where they're focusing on, and that could be a driver for the company going forward as well.
Indeed, very bullish on exports. I think they said in the first 9 months of this year, exports went up 50%. Get into a break. Vinny, thank you very much for that. We'll come back with more.
Welcome back. Well, the markets are holding with solid gains today. Actually, a few of these stocks that have got bombed out, they have bounced back. Deepan, I'm going to name a few of these stocks. I don't know whether you like any of them. Tejas Networks, Tata Group company, the stock had become a third from the top. Tilaknagar Industries, the street was very, very excited with regard to that deal that they announced with Imperial Blue. That stock, in fact, has bounced up. And also, you have a couple of these other names like ONGC and Oil India. They haven't participated on the upside because of, feeble Brent crude pricing. But now there is some hope that, in fact, Brent crude actually has bottomed out. What's your view on any of these names? Bombed out names, but bouncing back today.
Tejas Network, I just can't look at so much of volatility in the earnings, and that's what keeps me away from it. You could have a blowout quarter, and then next 3-4 quarters go into loss making, and then also if you compare with its peak profits, it's not that attractive. So Tejas Network, you may trade in it. News may come. If you expect a good quarter, you may buy based on trading opportunity. But Tilaknagar is an interesting stock. It's a kind of a high risk, high return stock. There are integration issues. And if Imperial Blue really they're able to extract the maximum out of it in terms of growth, revenue, profitability, then the entire complexion of the company will change and it will go to the next level from being a marginal player to being quite an important player in the alcobev industry. But also they have this entire litigation. I think Mansion House is the brand which is under some sort of litigation, and the outcome over there also is important. But it's a company we are tracking closely. Valuations are reasonable, very aggressive management, great track record, and if they're able to make this Imperial Blue a success, then I think you could have great returns for the next few quarters.
All right, just keep an eye on a few other stocks, Rima, from the broader markets. Kilburn Engineering, we had the management on Chartbusters a couple of weeks ago, and they were sounding very optimistic. The stock, got absolutely hammered. It went down one way, I think, from close to 600 rupees to 450 rupees. Today, they have announced a small order of around 60 crores, but on not very large volumes, actually. The volumes are just around 2 lakh shares. That stock is suddenly spurted up. Kilburn Engineering, that's the stock that I'm talking about, suddenly moved to the high point of the day. So keep an eye on that one as well.
Well, post-market hours, L&T will be reporting their numbers. There is a media briefing at 6 o'clock. Numbers typically come out between 4:30, and globally, we've got Meta, Microsoft, and Tesla reporting numbers. So NASDAQ, which was high yesterday, watch out for the follow-on action. But just counting down to today's trading session, Dipan, do stay on. The Nifty ends with closer to a gain of about 0.7%, a gain of 170 points. So adding on to the rally, yesterday the low on the Nifty was closer to 24,900, 24,932. So from that level, we've added on more than 400 points on the Nifty. The Sensex also sees follow-on buying, gaining nearly 500 points. Mid-cap index was the big star. Mid-cap index up 1,000 points, 1 3/4 of a percentage point. On the way up, defense, oil and gas names all higher. It gets captured in the Nifty CPSE index, which was up 5.2%, and BEL numbers were also very strong, ahead of expectations. That got the stock excited. Eternal bounces back after the recent sell-off. So a 5% move on that. On the way down, it was Tata Consumer, Asian Paints, so FMCG was a drag. And Maruti numbers looked fine, but the stock ended with a cut of 2.5%.
Okay, all right. The real story actually was in the broader markets today. Plenty of stocks that did do well in today's trading session. Net, the bulls will be happy. Not just the expiry factor that played out yesterday. They have started off the February series on the front foot, though you'll have to say that we are bouncing back from extremely oversold levels. The crucial mark that you'll be tracking now is going to be that 25,500 odd, the crucial resistance mark. Well, we'll wrap up on closing bell, but you stay with us. Markets Forward comes up next.
1%.
Dalal Street starts the February series on a positive note. Gains for the second straight session. The Nifty ends above 25,300, led higher by metals and oil and gas stocks. The mid-cap index outperforms, gaining 1.5%.
Maruti Suzuki reports a steady third quarter with revenue up nearly 30%. Profit rises 4% despite a 600 crore rupee hit due to the new labour code. TVS Motors delivers a strong Q3, reports double-digit revenue growth led by strong volumes. Margins hit a multi-quarter high of 13.1%.
Shares of CSB Bank see their biggest single-day drop since listing after their third quarter earnings missed expectations. Asset quality worsens, provisions rise, credit costs were also elevated.
Bharat Electronics hits record high after delivering an all-round beat in the December quarter. Revenue rises 29%, order book swells to 73,000 crore rupees.
You're watching Markets Forward right here on CNBC TV18, your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Hormuz Fatakia, with me Ekta Batra. Ekta, second straight session. The Nifty is now up 300 points in 2 sessions.
Hi, Hormuz. Yes, absolutely. Maybe some amount of optimism ahead of the budget, which is probably seeping in at this point in time. Just look at the way the defense index did in today's trading session. But separately, we did have the broader markets, which favored a lot more today. So we had the mid-cap index, which gained around 1.6%, and the advanced decline ratio, which went home in positive terrain. So that's what took place in terms of the markets, a quick snapshot there. But let's tell you what we have lined up for you in the next 30 odd minutes on Markets Forward. We'll start with the top movers and shakers of the day with Vivek. Earnings drive strong moves on Dalal Street today. Auto stocks steal the spotlight while we break down why consumer names came under pressure. Last but not least, we delve into the key market events to watch out for in tomorrow's trading session. But on to our first segment of the day. Vivek joins in now from the wall with the top movers and shakers for today. Vivek, over to you.
Well, thank you so much for that. We started off the February series on a very positive, optimistic note. Advanced decline ratio very strong. Broader end of the markets doing very well in the session. And ahead of the budget, one particular sector that stood out today, like you mentioned, was the entire defense pack, aided by a very strong showing by Bharat Electronics. Most of the defense stocks did very well. BML, Bharat Dynamics, Garden Reach, HAL, all of these stocks up anywhere between 5 to 10%. The other set of stocks that did quite well were the oil companies, aided by higher oil prices. The upstream companies did very well. So Oil India up almost 9%, ONGC up 8%. But surprisingly, even most of the downstream names today managed to move higher, up anywhere between 1% to 3%. In fact, most of the PSU names today were quite strong. The capital goods pack, significant underperformers till today. Today saw quite a bit of a recovery, aided by some positive news flow on ABB and a strong management commentary from CG Power. Most of the names rebounded. Hitachi Energy, BEL, Solar Industries up almost 9% in the session today. Metals continued their move higher, clearly an outperforming sector as far as 2026 is concerned. Nalco, Vedanta, Hindalco up anywhere between 3 to 6%. And MCX, numbers came day first day, very strong set of numbers, beat street expectations. And along with the fact that January has seen much higher trading volumes, MCX, one of the top F&O gainers for the day. On the other hand, quite a few laggards as well. Like you mentioned, CSB Bank, asset quality deterioration as far as the sequential basis is concerned. Surprising given the fact that private bank so far has seen very strong asset quality. That stock ended lower by over 15% on very high volumes. The consumption pack today saw significant selling pressure. Muted commentary coming in from majority of the names, HUL, Asian Paints, all of them down significantly lower. And Marico Titan, the top NSE 500 laggard for the day, down over 6%. Some worries of heightened competition due to the India-EU FTA trade agreement.
The spirits are down today for Marico Titan. Vivek, thank you for that update there. To take the conversation forward, joining us now, Mayuresh Joshi of MarketSmith India and Shrikant Chauhan of Kotak Securities, in what has turned out to be an absolutely crazy afternoon of earnings. Gentlemen, good afternoon. Thank you for joining in. Shrikant, to you first. 300 points in 2 sessions now for the Nifty. For a change, it's on the upside. Now, do you believe that this move has legs to extend further back to 25,500 or even beyond? And your call on the index now.
Yeah, absolutely. Many chances that the market can hit the levels of 25,500. The way the market has held the level of 24,900, and it is consolidating very close to the 200-day simple moving average. So whenever we see such type of activity, most of the time market tries to hit the major resistance level, which is around 25,500. Also, if we consider option statistics, then based on that also there is good amount of call writing has happened at 25,500. So maybe in next 1 or 2 days, we are going to see the levels of 25,500. But in case market manages to cross this 25,500 by tomorrow itself in the morning, then in next 2 days, we may even see the market crossing the level of 25,700, where the market is having next leg of resistance. So broadly, I am of the view that the market has made a classic bottoming formation in last 4-5 days. And before the budget or maybe on the day of budget, we may even see the levels of 25,700 or 26,000.
Okay. Well, Mayuresh, what's your sense? We've gained a significant amount in the past 2 trading sessions for the Nifty. The broader markets have caught up as well. What do you think is the rest of the week is going to look like?
I think the expectation largely is being built on optimism that the budgets will have a significant amount of positive connotations attached to it when it comes to both the fiscal balances, fiscal and the current account balance, the market borrowing program, and the expectations in terms of capital outlay. And therefore, I think markets are a tad bit more optimistic in terms of budgetary announcements. Obviously, I think the EU deal has added a lot of optimism to the markets as well, which will offset some of the pain of the US tariffs imposed specifically on a lot of key export-oriented sectors. Along with that, I think earnings have been a mixed bag so far, but a large part of the expectations moving ahead in Q4 and for the next financial year, the base case seems to be a 12 to 14% earnings growth, which is quite reasonable and quite good in the global context, which probably might get marred both in terms of tariff impositions across a lot of geographies, as well as some element of inflationary pressure that can play out. So I think optimistic on the markets. As we look at it in markets with India, I think we're trying to get into a rally attempt, which means I think there are a lot of sectors and stocks which are forming decent and reasonable paces, which can probably provide a fillip and fodder for the next bull run that is expected to come.
Well, some optimism rising ahead of the budget on a Sunday, but beginning the earnings action for the day, Maruti reported a steady quarter for the December period. TVS Motors, though, rallied because numbers were a beat, aided by strong volume growth. Rima is here to decode the numbers for both of these stocks.
Thanks so much for that. So let me start with TVS Motors, where the numbers were ahead of street expectations. The company's top line went up by 37%. This was driven by a volume jump of 27% and an increase in the company's realization to the extent of 8%. Margins came in at a multi-quarter high of 13.1% on the back of a better mix and rupee appreciation, and margins were up 120 basis points on a year-on-year basis. Bottom line got impacted on account of the labor code, so expenses went up by 41 crore, but even outside of that, profits were up 52%. Now, Maruti also reported an operationally pretty strong numbers and largely in line with expectations. So top line growth went up 29%, again, mostly driven by volume growth, about 18%. The balance was a realization increase. The stock initially reacted negatively to the margin miss. So EBITDA margins for Maruti declined by 80 basis points on a year-on-year, 180 basis points on a year-on-year basis, and it came in lower than expectations. But this was an account of a one-off because of gratuity long-term compensation. So if you strip that out, adjusted margins were in line with expectations. But the reason why the stock could be under pressure is because there was this article in Bloomberg which spoke about how South Africa is looking to impose higher tariffs on imports of cars from India as well as China to protect its own domestic industry. Now, for Maruti, exports are not very large, but in the export business for Maruti, South Africa is one of the key markets. So maybe that overhang was there on the stock price all day today. But operationally, adjusted numbers look fine for Maruti, and TVS, of course, was a beat.
Adjusted numbers look fine. Rima, thank you for that update there. 2.5% lower still on Maruti, but TVS Motors, though, outperformed, ending 5% higher, closing in back towards those record high levels. But the one that did not have a very good afternoon was CSB Bank, and everything that could have possibly gone wrong for the bank went wrong in this earnings report. The asset quality deteriorated on a sequential basis, and that is also because most of the other private lenders have reported an improvement in their asset quality. The gross NPA was almost at 2%, net NPAs at 2/3% as well, deteriorating from the September period. Provisions went up, and as a result, the profitability was impacted. Profits were flat despite other income going up 25%. Core income was the only highlight, though, 20% higher on the NII front. But take a look at this. Credit costs were higher and significantly higher than last year. NIMs were lower than last year. The CD ratio was higher than last year. So all of it has seen a bit of a deterioration compared to the same quarter last year. The return ratios also disappointing. The ROAs were lower. They were lower by 30 bips. ROEs were lower by almost 200 bips. So that is also having an impact, and everything. At one point, the stock was down almost 18%. And then it was one of the biggest single day fall that the stock has seen since its listing. So from the 52-week high, which is close to 580, the stock is down almost 30% from those levels. But Mayuresh, word on CSB Bank. An outlier, if you can call it that. Most of the other private lenders have done fairly well on the asset quality front. This one has taken a beating because of this.
Afternoon, Hormazo, absolutely. In fact, the update was a tad bit better for CSB Bank, and what they actually delivered was exactly the opposite. And therefore, I think you're absolutely right. I think in the context of mid-cap private sector banks, actually reporting decent set of number on all parameters. Asset quality, specifically gross NPAs, have seen a downward trajectory for most mid-sized private sector banks. Also, the PSU banks that have probably reported. NIMs have probably shown signs of stability. In fact, a lot of managements are hinting towards better NIMs and stable NIMs going ahead. The credit deposit ratios, specifically, I think deposit accretion has been reasonable, but that is one key area to probably track going forward as well. The CASA deterioration largely for most bank behind. And therefore, on all parameters or most of these parameters, I think it fell well short. And therefore, the reaction that you probably saw on the stock itself. I think a couple of mid-cap private sector banks which reported very good set of numbers, in my opinion, so far have been Karur Vysya Bank and TCB Bank always.
Okay, all right. Thanks very much for that, Mayuresh. That's on the banking stocks. But we did have defense, which was in focus ahead of the budget. Shares of Bharat Electronics hit a record high after delivering what was an all-round beat in the December quarter. Ria joins in with an analysis of the quarter gone by. Ria, over to you.
Well, yes, very strong set for BEL this quarter. It was a beat across the board for the company. The stock closed over 9% higher today. In fact, it also hit an upper circuit of 10% at one point in the session. Now, looking at the numbers of the company, revenue went up by roughly 24% on a year-on-year basis versus the estimates of 17% that we were working with. And this was led by healthy execution of a large order book of roughly 73,000 crores for the company. EBITDA and net profit also increased by 28% and 21% respectively versus estimates of just 14% and 12% growth on a year-on-year basis. Even the EBITDA margins have expanded by over 100 basis points on a year-on-year basis compared to the street estimates of a 64 basis point contraction. And this better profitability this time around has been led by lower other expenses as well as lower employee costs. Material cost to sales, looking at that at 54% in this quarter versus just about 52% in Q3 of last year. Order inflows, if you look at that metric, for 9 months of FY26, order inflows are roughly at 17,500 crores, which means the company has already achieved roughly 65% of its regular OI guidance of rupees 27,000 crores for FY26. And order book, as I mentioned, stands strong at roughly 73,000 crores for the company. Going forward at 4 p.m., we will have the earnings call wherein we will be watching out for updates on orders for subsystems for the 97 LCA Mark 1 aircraft, Uttam radars, export orders, QR-SAM, as well as Akash NG missile systems. And apart from this, we will also be watching out for management commentary on order execution as well as the order pipeline.
Okay. All right, Ria, thanks very much for that. Let's in fact toss this across to Mayuresh. Mayuresh, BEL, record high for that stock. But there's overall optimism on the defense space ahead of the budget. What's your expectation? Would you be a buyer of these stocks at these levels?
So again, I think the large construct is the defense allocation in this budget will be significantly higher compared to last year. And in fact, significantly higher compared to other the capital allocation to other sectors as well. Obviously, I think the backdrop is what is happening in terms of geopolitics and on our own borders as well. Having said that, I think the kind of order book for BEL, for HAL, for shipping company like Mazagon, Cochin are at an all-time high levels. I think the revenue visibility along with the book-to-bill ratios are significantly higher. And therefore, I think with more allocations happening in the budget this year, the expectations of more orders coming their way can be a significant driver going forward. Again, a large part of expectations of these orders being margin accretive, largely being better margin orders with better execution in terms of timelines, will mean better working capital on the P&L, and that will probably lead to better element of growth as far as overall numbers are concerned. Obviously, for defense companies, there is going to be a quarter or two where structurally, I think there is some element of slowdown that is witnessed. But over a longer period of time, I think the kind of dynamics that are changing and the export opportunity also, which is presenting itself, gives them a good chance to probably ensure that the earnings growth and EPS ratings, as we see it in markets of India, grow at a decent pace. So, good story, structural story, yes, as far as defense is concerned. But I think the stocks have run up a tad bit too much. I think they're trading way above pivot levels as we see it. And therefore, corrections is the way that I would look, either for BEL or HAL, as we see. Valuations a tad bit more expensive also, as we speak.
Indeed, and a little too much is what Mayuresh believes. A lot of these defense names will, of course, be reacting to their results tomorrow. We'll keep an eye out on these names as well. But on to the consumer corner then. Consumer stocks today took a bit of a beating, with Asian Paints leading the decline after a rain-marred quarter. Tata Consumer also fell despite a strong show. Marico, Godrej Consumer, all of them underperformed in today's session. Listening to some of the managements that we spoke to earlier in the day.
We have grown at about 4.4% in value if you take the industrial sales. And the volume is about 8.3%. We will continue investing heavily into the industry as we kind of go ahead. And we would kind of like to maintain this band of 18 to 20% PBDIT margins. The painting cycle used to be something like 8 years or so. Now it has kind of really come to about 5 years. I think it's kind of now flattened out in terms of as a painting cycle as we see it. More importantly, what's happening is, given the kind of consumption which we are seeing at a consumer level, this is still a discretionary spend which can be deferred at any point of time.
And in other geographies, we've created a separate salesperson who goes to smaller outlets and a focused high caliber salesman who goes to the larger outlets. So with that and portfolio expansion and continuing to put A&P, we remain confident of driving these numbers up. Nothing changes. Double-digit top-line growth, EBITDA margin expansion. We will exit close to a 15% this year. In the medium term, we're targeting to be around 17 in the next 2 to 3 years.
I think the hyperinflation obviously had an impact on parachute volumes because of the absolute pricing. Also, we had taken some MLH correction, which led to a 2-3% volume drop. So I think volumes going forward is going to stabilize. We will continue to aspire for delivering a high single-digit volume growth as a base case and try to improve upon it. And obviously, as the copra prices come down, margins will continue to improve in the subsequent quarters.
And if you look at a performance for the first 9 months of the year, it's 10% same-store sales growth, actually 10.3% to be precise. The EBITDA growth is 24.4% and the PAT growth is 30%. So it's exactly as per what we had broadly guided at the time of IPO. And each of the quarters have been quite consistent with that guidance. The festive season this year is split between Q2 and Q3.
The underperforming consumer-oriented stocks in today's session. Shrikant, just going a detour back to the defense names, all of them, BEL was at a record high today. Most of them saw very strong traction. Anything that looks attractive to you on the charts?
Yeah, Ormas. I think, see, like most of these stocks have broken their important resistance level in today's date, especially Bharat Electronics, which was consolidating below the levels of 420 for almost 6-7 months, has broken this level. And now, based on its technical formation, the next level to watch out for would be 500. The other stock which we like is Bharat Dynamics. And there also, we have seen relative outperformance as compared to other stocks. So there also we are expecting stock to move towards the levels of maybe 1650, 1670. And Hindustan Aeronautics, after very long time, the stock has crossed its important resistance level at 4600, and it has completed its entire corrective pattern of last almost 1.5 year. So broadly, I am of the view that defense sector should do really well in next coming few days.
Okay, all right, Mayuresh as well as Shrikant, thanks very much for joining in and taking us through your view in terms of stocks as well as the markets. We're going to take a short break, but we'll get you all of the top corporate voices along with key market events to watch out for just in a short bit. Stay tuned. Welcome back. Well, let's get in some corporate voices now. Shadowfax Technology is listed at what was a 9% discount to its issue price. Founder and CEO Abhishek Bansal said margins will improve gradually and the second of this year will see aggressive growth. He also added that white goods will be a big growth driver going forward.
And Wockhart's management in an exclusive chat with CNBC-TV18 said that its key antibiotic candidate WCK4282 will be launched in India and emerging markets once it gets the approvals. The potential market size in India alone is estimated at over 1,000 crore rupees. The company also expects an approval for its novel antibiotic Zynic by mid of 2026.
In the US, that is. But before we wrap up, let's bring you some key market events to watch out for. Upasana Bhatt is standing by to tell us what to watch for.
Well, first up, let us look at the key important results that we'll be closely tracking for tomorrow. Companies like Adani Power, Tata Motors, Dabur, Blue Star, Apar Industries, ITC, KPIT Tech, Paytm, Voltas, Dixon Tech, Colgate, GE Shipping, all these counters will be reporting their Q3 FY26 numbers tomorrow. Now, some of the key stock in focus on the back of corporate action. Cupid will be in focus as the board will consider bonus issue of shares tomorrow. Now, let us look at some of the domestic economic cues. Now, economic survey for 2026-2027 is to be tabled in the parliament tomorrow, and also RBI will be conducting OMO auctions, that is tomorrow on 29th of Jan and even on 5th of February. Now coming to the global economic cues, US trade balance data for the month of November will be out. FOMC decision will be out tonight, so we'll be keeping a track of that as well. And in terms of global earnings, results of IBM, Meta, Microsoft, Tesla, all these counters we'll be watching out for. So all in all, looks like a power-packed day tomorrow.
Boy, what a lineup that is. Upasana ran out of breath in trying to tell you the number of earnings that's in store tomorrow. But we won't run out of breath in trying to bring those to you. But for now, Ekta and I take your leave on this edition of Markets Forward. Thank you so much for tuning in. News and updates continue on the other side, so stay tuned.
पिछले एक दशक में 25 करोड़ देशवासी गरीबी को हराकर गरीबी से बाहर निकल के
Well, the budget session of Parliament is kicked off with the President's address. We are just 3 days away from Finance Minister Nirmala Sitharaman's 9th consecutive budget history in the making. From revamped income tax slabs to a brand new labour code, the government has unleashed a slew of reforms in the last year. So what can we expect from Budget 2026? Staying the course on fiscal discipline, sustained infrastructure spending and boosting domestic manufacturing are the key market expectations. Almost all brokerages expect the government to peg nominal GDP growth near double digits. Only Jefferies is expecting nominal GDP growth to be below 10%. Brokerages also expect the government to stay the course on fiscal consolidation. A majority predict a fiscal deficit projection of either 4.2 or 4.3% for FY27. They also expect the government's capital expenditure to rise from just over 11 lakh crore rupees last year to more than 12 lakh crore rupees in this budget. Well, those are some of the expectations that the market is building in. To discuss what we should look forward to from Union Budget 2026 and what the Indian industry is hoping for, we're joined by the top brass at FICCI, Anant Goenka, the president of FICCI, Puneet Dalmia, the vice president of FICCI, and Rashesh Shah, the former president of FICCI. Gentlemen, appreciate you joining us here on the program. Anant, let me start by asking you, last year, the direction of the budget was very clear. It was more focused on spurring consumption, giving tax benefits to the consumer. Do you believe that we're likely to see a continuation of that or a reversal back to more capex?
Yes, from FICCI's side, we had a pre-budget survey, and the three asks that are coming out from industry is: one is continued focus on manufacturing, focus on exports, and a continued thrust towards growth with the various FTAs and opportunities that are getting signed, and a thrust on infrastructure spend. So these are the three larger expectations that came out of our pre-budget survey. There is overall fair amount of optimism with growth expected to be between 7 and 8%, and the fiscal glide path also to be maintained at the targeted 4.4%.
Let me pick up on those themes that you spoke of that the FICCI survey brought up, and let me go across to Puneet Dalmia. Puneet, in specific next steps now, we've also seen a flurry of activity from the government ahead of the budget, many measures being taken, including, for instance, the notification of the labour code, which was actually brought in many years ago, the operationalization of that innovation fund as well, which was again a budget announcement 2 budgets ago. Puneet, from an export perspective, while we've seen these deals being inked, none of them are yet operational. They'll only be operationalized in 2027. That's the EU deal, and hopefully the UK deal will be operationalized in this year. What would you expect on the export side from the budget to provide some more sort of momentum to Indian exports?
I think, the fact that the EU deal has been announced recently is a, very massive opportunity for India. It is unlike other deals, and it's unprecedented in terms of scale. So, India has just 3% market share in the EU imports. And I think it's a $6.6 trillion opportunity with, where across labor-intensive sectors, also India has phenomenal, possibilities. So apart from scale and growth, it also gives India diversification. I was talking to many of my friends who are already diversifying markets. And, this is a, unprecedented opportunity. Yes, it will take some time to play out. But I think, businesses are built for the long term. And
yes.
I think people will make very serious investments in the supply chain. And finally, I think this is a sustainable deal because it's based on shared values of, democracy, rule of law, and civilizational states. So I think I'm very excited about the fact that, this is an opportunity which offers scale, growth, diversification, as well as shared values. So it's sustainable in the long term.
Yes, those are, of course... Yeah, those are important factors as far as the India-EU deal is concerned, Puneet. But, coming back to the near term, the specific ask that FICCI has made of the government, what would you like to see this budget deliver on?
Look, I think, budget is a statement of intent. Budget is a statement of where the government wants to focus. I don't think, we can expect anything in the immediate quarters, like what will happen in Q1 or Q2. I think government has already done a lot to spur consumption domestically. I think government has reduced GST. We have also reduced income tax for under 10 lakhs slab. So I think domestic market is good, and a lot of export rupee is falling, which is making India's exports more competitive. So I personally think that the macro opportunities are, getting created. But, just in terms of specifics, I think if government just continues its momentum to implement these trade deals sooner and ensures that the India remains cost competitive, I think it will hold us in good stead over the long term. There'll be some hiccups along the way, which all of us as entrepreneurs have to deal with.
Rashesh, let me bring you in. The ask, of course, of the capital markets is a change in taxation. Whether or not it will happen is a different story at all. Are you going into this budget expecting anything on that front?
No, I think overall, I think the capital markets are in a good place. Of course, FIs have been selling. There has been pressure on the rupee and all that. But overall, I think last year was a difficult year. But every year cannot be a great year for capital markets. So I think a lot of the investors are absorbing it. I do feel that government needs to, by commentary and by action in the budget, need to bring the animal spirits back. I think the India-EU deal is a great, it has improved sentiment a lot. And along with that, I think in the budget, if the government continues to push, I for one feel allowing the fiscal deficit to slip a little bit by government spending more on infrastructure may not be a bad thing, because that will give it a fillip. And with inflation being low, we can take the risk. Yeah. Of course, the rupee may fall, but I think we can allow that because that will improve our exports. But we do need to get the animal spirits going, and the government spending is a key catalyst for that.
Yes, government spending has been a key catalyst for many budgets now. But, Anand, going back to this animal spirits business, I mean, we've been waiting for the animal spirits to be unleashed for the last several years now. And the government keeps saying that, look, we've done our part. We've cut GST. We've cut income tax. What about you guys? What are you going to do?
Seeing a big shift, I'd say that post GST 2.0 from October, November, we are seeing growth levels in many industries, double digits, strong double digits, 20% plus rates, levels of growth. And as a result of that, utilization of capacities is certainly going up. And I'm seeing a shift clearly towards much higher private capex. So I do believe that that will continue. A few areas that FICCI has suggested to the government that we can do more on. One is continue the momentum on the electronics space by setting up a mega electronics park along the lines of what's happened in China, where the entire value chain is closely knit together. Second is with various wars being led happening in the last year, can we increase spend on defense manufacturing, especially on the technology and research side? So an increased spend in defense. And the third is critical minerals tailings program. Again, critical minerals are very important. We are not naturally very rich on that. So on the tailings, is there some recovery that can be done? And can we have a specific program around that to make sure there's higher recovery?
Well, important points, each one of those. An electronic hub, an electronic park may perhaps be an idea that the government will toy with. We don't know. This has been the big success story. The Apple story has been the big success story for the Indian export sector. But Anant, you talked about defense, and I was having a conversation with the defense secretary, and he was of the opinion and of the view this is going to be, by the way, the first budget post-Operation Sindoor. So a higher defense allocation is expected. You've seen defense stocks rallying ahead of the budget on the back of that expectation. Critical minerals, but one more aspect, and I want to get both Puneet and you to comment on that if you'd like. The nuclear sector, the last budget, the last session, the government passed the Shanti bill. Both the renewable energy minister as well as Mr. Vaishnav have been talking about, micro reactors, small modular reactors. Do you expect measures to push this sector in this budget? A PLI scheme is being spoken of as well. Anant, I'll start with you.
Right. I think it's very timely, particularly with the growth in data centers coming in and suddenly India possibly being short of power just because of the amount of shift towards AI. So this is a great momentum that has been started towards opening up and looking at partnerships on the nuclear side. I think it's still very early in terms of the research technology that is there to really make it live. So whether it will come in this budget or we wait for technology to strengthen, and maybe in about a year's time we'll see more incentives and goals towards making nuclear happen. I think that is still to be decided.
Yes, that perhaps could be a start, could be made in this budget. We will have to wait to see. But Puneet, any out-of-the-box ideas that FICCI has suggested to the government that you would like to see the government take forward? You know, we saw that jobs focus with the internship schemes and so on and so forth. We had seen the Research and Development Fund in the previous budgets. Any out-of-the-box idea that FICCI has put on the table?
Shireen, I think, there is a lot of the, breakthrough ideas that the government has announced has to find its way on the ground. So like, I think you just spoke about this R&D budget. I think ANRF has been formed now, and even RDIF, has been formed. And I think it's been headed by a, very strong private sector person. So I think just to ensure that India plays the innovation game globally, a lot of more work needs to be done into how this capital will be allocated, who will be the secondary level fund. So I think just executing on some of the ideas to increase India's R&D spend, which can be linked to national priorities and where we can get solutions which really have tangible impact on the ground, is very important. And I personally think that just some of the things which we have already started, doing more of this faster will yield a lot of results. And I think, one of that is also, just ease of doing business, decriminalization of various codes. It will just unleash animal spirits much more. So I think some of the things just need to be executed deeper and faster, in my view. And I think that will really get India even more momentum, than what it already has.
Rashesh, coming back to you, we've seen the government move away from setting high disinvestment targets, which were then not being achieved. Do you expect anything on that front, any change perhaps, bolder statement perhaps on disinvestment, asset monetization, anything you believe that we could perhaps hear on IDBI Bank, for instance, and even bank consolidation in general, because the finance minister has spoken about it publicly in a conversation with me where she said it's work in progress. Do you believe the budget could perhaps take things forward?
Yeah, I would expect, I think IDBI is on the cards and there has been quite a bit of conversation on that. So something on that lines along with the consolidation and driving efficiency in the PSU banks, maybe also something on LIC, some disinvestment in LIC would also be on the card. So I think headlines would be around that. But as I said earlier, I think what government, earlier you said government has been spending for last few years and the private capex has not come, which is true. But if you look at the drive for fiscal consolidation has also impacted overall growth, especially when the private sector capex has been slow. Exports may face some headwinds in the coming quarters because of US. So I think it's very important right now that government allows the fiscal consolidation to be on pause for some time, start spending money. It might drive yields up a little bit. It might drive rupee down a little bit. But I think it's a worth risk taking because inflation is low and people need some catalyst. And the catalyst will have to be the government because I don't think the private sector is not aggressively investing because the demand has been muted. If you look at capacity utilizations, they are still not inching up. So I think that is going to be very important.
Well, so far, we've seen the government being steadfast in maintaining its fiscal deficit glide path and its fiscal deficit targets. Don't know whether we're going to see any departure from that. By the way, gentlemen, there's also going to be another important event to watch out for, which will be the release of the 16th Finance Commission report, which will coincide with the presentation of the budget. What will the tax devolution to states be? That's also going to be a key factor to watch out for. What happens to centrally sponsored schemes? All of that will also have to be factored in as we look at the impact of the budget. Gentlemen, before I let you go, a quick budget poll. Anant, I'll start with you. How long do you think the speech is likely to be? Over an hour? An hour? You're on mute, Anant.
No, I think it'll be over an hour.
Over an hour. Puneet, a little bit more
Over an hour.
specific.
Over an hour.
Over an hour. Okay,
Yeah,
Rashesh.
I think it should be more than an hour. The commentary is going to be very important. So I do hope that she elaborates on quite a few things.
Well, over an hour, that is the FICCI consensus on how long the finance minister's speech is likely to be. By the way, it was a very short speech the previous year, not the last budget, but the budget before that was a very short speech. But of course, over an hour is what FICCI is voting with. Remember, 11 a.m. is when Finance Minister Nirmala Sitharaman will rise to present her 9th consecutive budget, creating history in independent India. Gentlemen, we will tune back in on Budget Day, which is a Sunday, so it's going to be a working Sunday for all of us. But look forward to more conversations then as we decode the fine print of Budget 2026. Many thanks for joining us here this evening. We will head into a break, but when we return, an exclusive interview with Sudarshan Venu of TVS Motor on the India-EU free trade deal. That and more when we get back.
Joining us right now is the chairman of TVS Motor Company, Sudarshan Venu. Sudarshan, thank you so much for joining us. The India-EU FTA talks have been concluded. It will come into effect sometime in 2027. Give us a sense of how does this help global automobile majors like yours, and how does this reduce tariffs on automobiles, on two-wheelers being exported from India to Europe?
Really, it's a pleasure to be with you, Parikshit, on this wonderful occasion of the signing of the India-EU FTA. India, as you know, is the fastest growing large economy in the world, and it's such an exciting place to be in. With the Prime Minister's vision for Viksit Bharat and the efforts taken by the government, we now have access to a lot more countries, to UK, to Middle East, to Australia, to Switzerland, and now to the whole EU trading bloc, which is one of the largest trading blocs in the world, if not the largest. And I think this will only further enhance the strength of our exports and add to more jobs and more growth in the Indian economy. This will benefit many sectors, including ours. I think Europe is a large market mainly for bigger CC vehicles, and Indian companies have been producing bigger CC vehicles, what we do with BMW, Bajaj, of course, with KTM, Hero's working with Harley, and also you see now more exports of two-wheelers into the European market. And of course, with Norton starting production in the next months, really, or weeks, this will help all of us to leverage India as a manufacturing base for the European market as well.
How does the tariffs on two-wheelers being exported from India to Europe go down, and vice versa?
I think the bigger opportunities for Indian two-wheelers going into Europe and also for the broader auto component sector, as far as the reduction on the European tariff for the European two-wheelers coming into India, that clarity is a little awaited in terms of the reduction. In terms of Indian two-wheelers going into Europe, of course, like in the case of UK, it was 5%, which now goes to 0. So the bigger opportunity is for Indian two-wheelers going into Europe. I think in addition also, this is more beneficial broadly for the larger industry in terms of auto components, automobiles, and commercial vehicles. So far, the Indian two-wheeler market has been more focused on exports to Africa, Latin America, and now in addition to the larger displacement vehicles where India has already been exporting to Europe. So it is more a question of those duties coming down and also the significant 30+% duties of European vehicles into India coming down, which hopefully will expand the customer base for high-end two-wheelers.
Right. And of course, the CKD tariffs have also come down from 16% to about 8.25% on cars. This is what Maros Sefcovic had told us, Sudarshan. So the CKDs on two-wheelers are also on similar lines?
I think two-wheeler exact details are awaited, Parikshit, but really what we're looking at more is, I think, the expansion of the premium industry and the customer base, because these foreign European two-wheelers are coming into India. But you must also keep in mind that many European brands are also already producing a line of two-wheelers in India. So hopefully this will lead to more of their global production shifting to Indian base, and also for many of the companies in the supply chain becoming part of the global big motorcycle supply chain of the European companies.
Right. One question before I ask you about your results and we end this. How do you see India becoming, or Europe becoming, a big market for two-wheeler manufacturers in India once this FTA comes into effect?
I think this opens up a broad array of opportunities for various sectors. Two-wheelers is only one of them. So far, two-wheeler exports have been more in Asia, Latin America, Africa, and this opens up Europe further. We already partnered with BMW where the one-cylinder and in future the two cylinders will go into Europe. The Norton two-cylinder is being produced in India, which will also go into Europe. And this gives a further fillip to that opportunity and also for the auto components and entire sector as well.
Right. My final question on TVS results. The company has reported a 48.6% jump in consolidated net profit to 841 crore for the third quarter of the financial year. And the profit stood at 566 crore. How do you see the results, the major growth drivers, and how do you see the next few months?
Firstly, I think the Indian economy has done very well, supported by government measures of reducing GST and also reducing income tax on the middle class, which was done in the last budget. This has resulted in the two-wheeler industry having its fastest growth in the last 8 or 9 years. at over 20% in the last quarter. And I think this industry growth is giving a momentum to all of us. And of course, TVS products have been well received in the industry. So that helps us continue to grow. Secondly, I think some of the African markets are also doing well. And therefore, we are seeing growth on the international markets. Lastly, I think India is such a great place to be in with economic growth and a young consumer base that our financial services business continues to grow as well on the lending.
All right. Thank you very much, Sudarshan Venu, for joining us on this big day that the India-EU FTA has been concluded. We will, of course, wait for the ratification to see how it helps the auto industry. But thanks once again.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money, your weekly personal finance date with me, Surabhi Upadhyay. Well, the budget is upon us. And like every year, the market and investors are wondering if the finance minister can come up with some sort of a magic formula that charges up sentiment and gives the bulls a new lease of life. Now, last year, we've already seen lots of major changes, actually, a big overhaul of the capital gains regime, for instance. We've also seen significant income tax cuts, especially, of course, in the new default income tax regime. So should we really expect any major changes in personal taxation at all? And how can this budget perhaps impact we, the common people of India, when it comes to our wealth creation journey? Well, joining me to answer those questions are Rahul Jain of Nuvama and Amarpal Chadha of EY. Gentlemen, thank you so much for joining in. At the outset, I want to start by putting in a caveat. No, we didn't plan this. All of us are in black and white. This is not a hint or a sign, and it was not planned. But I don't know. Gentlemen, so is it going to be, I don't know, black letter day? I hope not for the market and for investors.
Black is lucky for me, Survi, for...
Oh, black is lucky for Rahul. Amarpal, what do you think? Black budget, blue budget, red budget, green budget? What will it be?
I think the coincidences are always good. So let's hope the same thing happens on the budget day.
True. Well said. So, gentlemen, the whole idea is to kind of, rewind, take a step back, rewind and prepare our viewers for what to expect on Feb 1 and if that really changes our life in terms of our investment journey and our tax planning journey. So, Amarpal, let's start right there. Like I said, and memory is still very fresh, right? Last year was a huge budget from the tax perspective. We saw so many changes in capital gains, so many changes in personal income tax. So just recap some of the big ones for us and tell us how are these changes progressing along? I mean, have they been well digested by taxpayers?
And as you rightly said, Surabhi, I think it was a very big year last time for the budget, especially for personal tax, and people were actually also not expecting something this big to come. To assume that the tax slabs will change in a manner that up to 12 lakh, there will be no tax and there will be a rebate available up to 12 lakhs. That was, I think, really amazing. People didn't expect that much. And that could be one reason why there is not so much on expectation and noise this year from a personal tax perspective. Also, a lot of cleanup on the capital gains taxation that happened last year, very clearly putting off 24 months and 12 months categories, saying, okay, if you're in equity, this is what's going to happen. If you have a property, you have a bullion, these are the standard rules of 24, 12 months. I think life became much more simpler after that. Also, the consumption of the default tax regime or the concessional tax regime really picked up in the last year. Now it's become like a no-brainer that people would generally be in the new tax regime or the default regime vis-a-vis the old regime. Unless somebody really has a lot of deductions available, it doesn't make any more sense. So I think great budget last year, and hence the lower expectations this year.
Okay, absolutely. So I think on the income tax front, I don't think anybody can go out and expect the finance minister to do more, because it's already a stated, sense that lesser deductions move towards, a tax regime which has lower rates, which is what we've kind of seen in the past couple of years. But now I want to talk about capital gains, Rahul.
Yeah.
And that's a sore spot, right? First, the rate of tax went up from 10% long term, went to 12.5%. Then market didn't give much capital gain to begin with in the entire year. So when you've interacted with so many investors through the years, what is the feedback? This 12.5%, I mean, it's here, it's the law now, so we have to pay it. But is that kind of further souring sentiment at all?
So I would say that when someone is looking from long-term wealth creation and when they expect to make a double digit or 15% returns annually, I think that 2% does not make a big change or dent to their portfolio or thinking. And that's when you're making money. I think the soreness comes when end of the day you don't end up making money and then you start thinking about all things which are there.
Yeah.
So I think all this becomes a cost for investor in that sense. But I would also agree what you said and other gentlemen said that there's a lot of transformation which we did last year in terms of capital gain simplification. I would say that income tax cut, which no one expected, I thought was a big one. I would say this year can be a year where certain things can still get simplified. So I would bucket income tax in two parts. convenience and simplification, and the other could be parity in that sense. And there are areas which can be done. To just give you some perspective, like in a Cat 3 AIF, everything gets taxed at the fund level, and mostly funds are at the top slab. Now, if I am a Cat 3 investor and it's not a pass-through vehicle, and I have a 20% slab, for example, hypothetically, then I will get taxed at the full rate.
Okay.
But rest of the other AIFs are all taxed at the investor level. It's a pass-through mechanism. So if it brings confusion, complication, if someone has done Cat 3, Cat 2 both at the same point of time. And this can be a big simplification where it can also become a pass-through from Cat 3.
So basically you're saying that when it comes to Category 3 AIFs, alternate investment funds, tax them like the other two categories, basically at the level of the investor.
Pass-through will be better, it will be convenient. Another thing is that a lot of investors, what I meet, they always try to switch from a dividend to growth scheme.
In a mutual fund.
In mutual funds or a regular to direct. These are not actually taking out the money or redeeming the money. It's like moving from one way to another, well, either for cost efficiency, from regular direct is cost efficiency effectively. Other is that I was taking dividend, now I want to do growth from wealth planning, long-term point of view.
Correct.
That also has a tax implication. So a lot of people are not able to take that decision that why should I pay tax now?
Because you have to remove the entire sum and then pay capital gains on it and then reinvest that money into a different option, for instance, a dividend option.
Exactly. And similarly, if you look at ULIPs, the movement of one fund to other is very easily available. So I think similarly things can be done here also from convenience point of view. From parity point of view, if you see, and if you look at from wealth, asset allocation is very critical from philosophy point of view. And every client has an equity need because they want growth. Every client has an annuity need because they need stability, predictability. And some gold for hedging, like you've seen what's happening.
Some gold, people want all gold and only gold now in their portfolio.
That's a big change which is happening now. But coming to my point of equity and debt, a lot of people are now getting into more equity-led schemes because they think that the difference between taxation is widened between debt and equity.
Okay.
What happens is that while it looks tax efficient, but equity also increases your risk from a profile point of view. For example, a 60-year-old plus, a lot of investors are plus 60. And they now generally tend towards getting more into equities because they find the tax very efficient. So we keep explaining that tax is secondary. First is risk and income.
Correct.
But somehow people move towards that direction.
Because tax, ends up driving our investment decisions, even when it shouldn't. Let me bring in Amarpal exactly on this point. Amarpal, now capital gains, right? And you've just heard it from Rahul. I mean, he helps people manage their money, but that's the fact of it. In an ideal world, tax shouldn't decide our choices, but it does because we want tax-efficient returns. So how do you rate and rank the overhauled capital gains tax regime? First of all, whatever the changes that were announced last year.
Yeah. And Surabhi, that's a great point which Rahul made. I think we also need to understand the genesis was earlier in the old tax regime. You'll remember all our investments were governed by the fact that there was an ATC deduction available. People would put money into schemes to get deductions under Income Tax Act. So all that was a philosophy that was being taught through tax to people, isn't it? If you have to save money, put through tax, invest in these schemes. Luckily, with this new tax regime, which is the default regime, now this concept is going. Now people are free to take out their money and put where they would like to, whether it's an NPS or an open option or mutual fund. So it helps people to rethink, especially the younger generation would not get blocked by just the tax rates. And if you see the capital gain regime now, like what Rahul mentioned, some of these things, yes, as new products come, for example, a direct versus a mutual fund route, all of these are developments, isn't it? So tax laws need to live up to it. So some of these changes will come as industry comes with new products. So some clarification on these things definitely helpful. But I would say government is already on that path. These are more evolving discussions and products which slowly would get clarified.
So on the point, Amarpal, of debt or fixed income specifically, I mean, that's the point that Rahul just made, that there still seems to be a big gap between equity taxation and fixed income taxation. There are very few avenues in which you can be in fixed income and yet have that be tax efficient. Most of it is just taxed at a slab rate, right, in interest income. Is there a case for the government to consider this and to consider changing this?
See, a lot of these discussions have happened in the past, and one reason for increasing the tax slabs, the threshold could be this. Because see, if you start giving specific exemptions, let's say for fixed income, for other aspects, it becomes then difficult to manage the whole scheme because the government is also moving a lot towards simplification. So hence, a slab increase is a better answer, and which the government done. So now you can go up to a very high income level, isn't it? As it's coming on the screen, you are up to 24 lakhs, you will not be at 30%. So even if you have fixed income and your income, let's say for a senior citizen, there is a fixed income which is below this threshold, you are still at a lower income. But yes, no comparison to the equity game, because in equity, you are getting higher returns and lower tax. So can a fixed income product be put pari passu with that? Is it something that can be done? I think it's a great idea. If there is some fixed income product which can get taxation of a long-term equity or a short-term also, it would be great. But currently, the law doesn't have any scope for that.
Yeah. Rahul, you think, I mean, there's a need to look at this here, because there was a point in time a couple of years ago where at least debt mutual funds had the benefit of indexation, and if you were holding for 3 years plus, you could enjoy more tax efficient returns. All that is history now. So on the fixed income side, what are you, advising investors to do as of now?
So for us, like I said earlier also, that tax is secondary. First is managing your risk and your asset allocation well. That is the first and foremost advice. And now if you look at from debt point of view, one of the things government has done there in last budgets is that having the same rates across different categories, or that at least that simplification has come into the play. The point what I was trying to say, and what the gentleman also said, is that equity makes higher returns and lower tax, but equity comes with higher risk as well. For us, it's important to know is that a good balance of risk from every client portfolio is very important and critical. He takes tax as one of the ways of looking of investing, and that is where the confusion comes into play, because the gap has widened.
Right.
So some reduction on the debt side, or bringing more simplification, more uniformity, or closure to equity can be one of the ways to solve this out. Otherwise, people will keep moving more towards equity.
More towards equity, whether their asset allocation really needs it or not.
And whether the risk decision is happening on the basis of tax.
Which is not the best way, perhaps.
Perhaps
take that point. Gentlemen, stay with those thoughts, because we have more to discuss. There's also property, where there was a change in taxation, and that benefit of indexation was taken away for some cases. So we'll go back and revise what the law says on that front. And then let's not forget this big gold rush, which is on, gold and silver rush. So from a tax perspective, is there anything that we should be aware of? We'll be discussing this in just a moment.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are getting you budget ready. From a taxation perspective, is there anything left undone, so to speak, considering we've already had big cuts on income tax and a whole overhaul of the capital gains tax regime? Rahul Jain of Novama and Amarpal Chadha of EY are with us in conversation. So, gentlemen, I quickly want to move to other asset classes, property. And Amarpal, here there was a big hue and cry when the change was announced, right? That you can no longer enjoy indexation now. But then there were some changes and they put a cutoff date to it. So just recap for us what the law currently states when you're selling a house and whether you think there's any further clarification needed or any carve-outs or any change needed.
Sure. And I think you're right. There was a lot of hue and cry, and it's normally the first reaction when you see any big change. But as people sat down and did their calculations, it was not that bad. See, what in a sense now the law says, and this is a cutoff date, like what you said, of 23rd July 2024. If you have bought a property before that, you have an option to go for indexation with a tax rate of 20% or simply play and give 12.5% on the total gain. So you have an option to compute your tax under both these formulas and pay tax whichever is lower for you. My practical experience is most of the people are actually happier with the 12.5 given the calculations, unless the properties were really old and you had a big indexation benefit that was available. So it's quite clear now, and generally people are adopting this quite well. I don't foresee a major change requirement on the property side because the 12.5% long-term capital gain is a good rate to be in.
Okay. So that's on property. Amarpal, now let's talk about gold and silver, right? Because every other person I meet wants to increase their exposure in gold and silver. People are talking, someone wants to talk about ETFs, someone's wondering if those sovereign gold bonds will come back again or not. So let's clarify taxation, because even within precious metals, depending on the instrument you're holding, whether it's a fund or an ETF, the tax treatment is different, right? So if you could just explain that to us once.
Yeah, I think for the precious metal is pretty clear. If you hold for 2 years, there is a slab rate. Now the benefit of 12.5% is available. So people can just go simply hold gold and pay 12.5%. I think here Rahul would probably put a caution to how people should be careful on the investment. I think this is one place where you should not be driven by tax treatment here at all, given the price sensitivity we are sitting on, both with gold and silver. It should purely be a call based on a good rationale for investing into metals at this point of time. I'm sure everyone wants to do it because we all missed the bus. But I think Rahul should be the right person to guide people on this.
See, simple math. Rahul, you were saying, पहले capital gain होना चाहिए, फिर उसके बाद उस पे tax देखेंगे. People will say gold is already up almost 20% this year. Not even 1 month of the year is gone.
Yeah.
It's been a crazy rally. So, I mean, what are you telling clients? And again, just from a tax perspective, is there a preference of instrument? How do you tell people to invest in these metals, if at all?
So again, two things which have done very well. Gold and silver. Now people have started talking about copper also.
Yeah.
I have clients who have been calling me and saying that should we keep copper at home? They're looking at...
Let's get the wires, long wires.
They're looking at warehouses to store copper. So coming back to gold and silver, I think that is one of the two assets which have done extremely well. We have been telling clients from last 12-18 months to start allocating towards gold because the geopolitical global conversation all led to talking about gold.
Yeah.
And I think it's done well. I think silver is the surprised one. I think no one expected that it will go up so much. Yeah. From allocation point of view, I think from gold, at least you can do some part through multi-asset allocator funds effectively. So they have some gold allocation there. But if client wants to go directly on gold, I think the best convenient way is to look at gold ETFs, since SGBs have now been stopped effectively. And then silver also becomes ETF is the best route. Because
why ETFs over index funds? This always stirs up a big debate, whether you should be in simple mutual funds that invest in golds or whether you should be in these ETFs, because they hit the headlines, right? They had a lot of very high premiums and then they cooled off very sharply just a couple of days back.
Yeah. So this keeps happening, but what happens is that ETF is listed on the exchanges, correct? And you can see the value every time. You can use a SIP route also effectively there. You can do lump sum. So it's more convenient. And I think it becomes, the tracking error is also relatively better there, what we have understood. So that makes more sense of putting money in ETFs. And again, for us, at least from this category, at least silver as a category was not available also too much on the mutual fund side. So ETF.
Yeah, at least you had ETFs was an option.
Option available. So that's why we advised ETF. And again, I come back to my old point that tax is secondary. First is to make the returns and have the right asset allocation. Because if you don't have the right asset allocation, at some point of time you will do a wrong decision, and your returns can get significantly eroded.
Absolutely.
And then the question of tax will anyways go away.
Exactly, and then tax cannot save you. Even the low tax regime will not save you
100%.
if the decision to invest itself was the wrong one. Got that point. So quickly coming down to final thoughts, gentlemen. Quick recap. So Amarpal, your top, couple of 2, 3, 4, whatever wish list from a personal tax perspective from the finance minister this year.
Sure. I think I still have 3 asks which I feel are good to have for people at an individual level. One, there is no clarity still on the VDAs, the virtual digital assets, which include crypto and others. So if there is some clarification on the losses that people have to be set off against other gains, because the virtual digital assets are taxed at the full rate. So it will be helpful for it to be recognized as an asset class and some set off or a tax rate clarified for that. That's one. Second, on the whole social security, the retirals that we have, Provident Fund, NPS, you'll remember there is a cap of 7,50,000. There is still clarity required on how the taxation of the amount above that and the accretions to it needs to be done. So it'd be good if in this budget that clarity comes. And last but not the least is the ESOP taxation. I think that's a big one. You know, currently all startups, technically there are almost 2 lakh startups that are on the DPIT list. And there are some only 3,000 odd which take the benefit which is available for the delay in taxation for 48 months. So I think that's the most critical one where the government should clarify a little bit given the focus on increased startups and looking at how we can scale them up in the Indian environment. That would really be a big help because it leads to early cash outflow in case of exercise of stock options.
Sure.
So I think that's the 3 things on mind.
Okay. Rahul, famous last words. Any other advice? Any tips to investors? They've been through a rough 1-year period. Now the budget is upon us. What would be your last words to our viewers?
So tip for investor like what you asked, I think use asset allocation. Like last 18 months has been a good reminder of the fact that diversification is the best strategy.
Absolutely.
Coming to my wish list, I think from convenience and simplicity point of view, CAT 3, CAT 2 all should become similar from pass-through point of view. This switching off from regular to direct, which is a very cost-efficient method for a client, should be not treated as sale of or redemption where tax should be paid. Similarly, from movement from dividend to growth also, this is one. From parity point of view, spoke about that, how the debt and the equity, there's a widening gap.
Some sort of
more little parity so that people don't take decision on the basis of tax from risk point of view.
Absolutely. It ties in with your first point on asset allocation. That's the the bedrock of all our wealth creation decisions and our wealth journey. So hopefully we make sure that we stick to that roadmap. Thank you very much, Rahul and Amarpal, both of you for joining in. This was a great, quick-fire classroom to get us ready for the 1st of February. And viewers, of course, we're going to see you on the day of the budget, after the day of the budget, to decode all of the fine print and the announcements that come in that impact your financial well-being and your wealth creation journey. Back with that. In the meantime, keep watching CNBC TV18.
Let's talk money.
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The headlines we're tracking for you this evening. The Sensex and the Nifty gain for the second straight session. Mid-caps outperformed. The rupee weakens marginally against the dollar, even as the dollar index plunges to a 4-year low. Global markets tread with caution ahead of the US Fed decision later tonight. The central bank is likely to keep interest rates unchanged. Gold extends the record rally, soaring past $5,200 per ounce. US Trade Representative Jameson Greer says India has made progress on reducing Russian oil imports, but still has a long way to go, and Washington is watching closely. Also says India has come out on top in the trade deal with the EU. British Prime Minister Keir Starmer arrives in China for a state visit to mend bilateral ties as Western alliances come under strain due to Trump's tariff onslaught. This is the first visit by the British Prime Minister to China in 8 years and comes just days after Canada's Prime Minister Mark Carney visited Beijing. Maharashtra's Deputy Chief Minister Ajit Pawar dies after his chartered flight crashed in Baramati. 4 others, including 2 crew members, killed as well. The aircraft, Learjet 45, is operated by VSR Ventures. The Maharashtra government has announced a 3-day state warning. Maruti Suzuki reports a steady Q3. Revenue up nearly 30%. Profit rises 4% despite a 600 crore rupee hit due to the new labour code. Parliament's budget session kicks off with President Draupadi Murmu's address. The government will table its economic survey tomorrow. Finance Minister Nirmala Sitharaman will table the union budget on Sunday. The Indian government drafts norms for the second phase of its semiconductor mission, may look at design-linked incentive scheme to push for designing chips in India. Sources say the government is planning an outlay higher than the sanctioned 76,000 crore rupees for phase 1. Amazon announces 16,000 job cuts in a fresh round of layoffs. This comes after 14,000 jobs were slashed in October last year as the company restructured after overhiring during the pandemic and expanding the adoption of AI tools. Electronics maker Boat delays its IPO once again. Sources cite market conditions and the lack of internal preparedness. The company's founders Aman Gupta and Samir Mehta stepped down in November last year. Auditors had also red-flagged a mismatch in financial statements to lenders. Well, the market action to start with the Lal Street beginning February on a positive note, gaining for the second straight session. The Nifty and the Sensex ended 0.5% higher, with the Nifty closing above 25,300. The Sensex 487 points higher. The Nifty Bank continues to do well, up by about 400 points and almost a 1,000-point rally there on the Nifty mid-cap today. So metals, oil and gas stocks led from the front. Banks rose in line with the blue chips and the mid-caps outperforming today. India's industrial production growth accelerated to a 26-month high of 7.8% in December. Manufacturing output, which carries the largest weight in the index, grew 8.1%. Mining activity strengthened while electricity generation rebounded to 6.3% after contracting 1.5% last month. That's the IIP data for you. Investors expect the US Federal Reserve to maintain status quo in their policy decision later tonight. According to a CNBC Fed survey, respondents expect only 2 rate cuts this year and don't anticipate any rate cut in 2027. 31% want the Fed to trim rates at a meeting. Further, most investors in the survey expect the former Fed Governor Kevin Warsh to be the next Fed chair. Only 11% believe the National Economic Advisor Kevin Hassett will be picked as the next Fed chief. So, majority there voting for Kevin Warsh. President Trump has said the dollar is doing great despite the dollar falling to a 4-year low. Speaking to reporters in Iowa, President Trump argued that the currency's weakness is a good thing.
Mr. President, with the current value of the dollar, do you think it's declined too much?
No, I think it's great. I mean, the value of the dollar, look at the business we're doing. No, dollar's doing great. You know, it's very interesting. If you look at China and Japan, I used to fight like hell with them because they always wanted to devalue their yen. You know that? The yen and the yuan. And they'd always want to devalue it. They devalue. And I said, not fair that you devalue because it's hard to compete when they devalue. But they always fought, no, our dollar's very good.
Well, that's President Trump on the dollar. Gold price is hitting a fresh record high, breaching the $5,200 per ounce mark for the first time. The yellow metal surging as the dollar plunged amidst geopolitical concerns. Silver price is also hovering near all-time highs. The white metal has rallied nearly 60% so far this year. In India, too, gold and silver prices hitting new highs, tracking gains in the global market, so no abating there of the rally. Oil prices rising to a 15-week high. Supply concerns lingered. A winter storm across the U.S. disrupted crude output and exports, while tensions in the Middle East also lent some support. Brent hitting $68 a barrel today. India and the European Union have finalized a landmark trade agreement. 99% of Indian exports and 97% of European shipments will see tariff reduction. The deal is expected to be implemented by 2027 after the European Parliament's consent. Global broking firm Bernstein has analyzed the deal. The simple average tariff imposed by the EU on the top 10 products exported by India stands at 3.5%. On the other hand, the average tariff imposed by India on the top European exports stands at 14%. Bernstein points out that this asymmetry means India's headroom to grant concession is far greater than the room to make gains. Bernstein says this is a major problem faced by India in trade deals with Western economies because India's tariffs are much higher. Sudarshan Venu of TVS Motors says the trade deal with the EU will be an enabler for leveraging India's manufacturing market in Europe. Speaking to CNBC-TV18, he also said the deal will let Indian automakers access higher CC vehicles in the higher CC vehicle market in Europe.
This will benefit many sectors, including ours. I think Europe is a large market mainly for bigger CC vehicles, and Indian companies have been producing bigger CC vehicles, what we do with BMW, Bajaj, of course, with KTM, Hero's working with Harley, and also you see now more exports of two-wheelers into the European market. And of course, with Norton starting production in the next months, really, or weeks, this will help all of us to leverage India as a manufacturing base for the European market as well.
Well, that's TVS's Sudarshan Venu. That stock a big mover in trade today on the back of strong results. U.S. Trade Representative Jameson Greer says India must do more to wind down Russian crude imports. In an interview with Fox News, Greer said that while India has made progress on cutting dependence on Russian crude oil, it has not gone far enough. Remember, last year the Trump administration imposed additional 25% tariffs on India, taking the total tariff rate to 50%. This on account of a penalty for purchasing Russian oil. Greer also reacted to the India-EU free trade deal being finalized in what was the U.S. government's first official comment on the deal. Greer said India has come out on top and cited the framework granting mobility for Indian service professionals in the EU.
The EU is turning to India to try to find a place. The EU is so trade dependent, they need other outlets if they can't keep sending all their stuff to the United States. I've looked at some of the details of the deal so far. I think India comes out on top on this, frankly. They get more market access into Europe. It sounds like they have some additional immigration rights. I don't know for sure, but President von der Leyen of the EU has talked about mobility for Indian workers into Europe. So I think on net, India is going to have a heyday with this. They have low-cost labor, and it looks like the EU is doubling down on globalization when we're trying to fix some of the problems of globalization here in the U.S. Frequent contact with my counterpart in India. I have a great working relationship with him, but they still have a ways to go on this point. They like the discount that you get from Russian oil. It's close by, so it's hard for them. The Treasury Department has put into place, a few weeks ago now, more significant sanctions. So we expect India to continue to wind that down, but we're watching it closely.
That's Jameson Greer. British Prime Minister Keir Starmer arrived in China for a state visit to mend bilateral ties as Western alliances come under strain due to President Trump's tariff onslaught. Now, this will be the first visit by a British Prime Minister to China in 8 years and comes just days after Canada's Prime Minister Mark Carney visited Beijing. At least 5 have died after a Russian drone attack on a Ukrainian passenger train carrying 200 people. The attack took place near a village in the Kharkiv region. Ukraine's President Zelensky has called the attack an act of terrorism. This comes as President Trump said that very good things are happening in the negotiations aimed at ending the Russia-Ukraine war. Back home, logistics solutions provider Shadowfax Technologies made a weak debut on D Street today. It listed at a discount of 9% at 112 rupees 60 paise a share versus the issue price of 124 rupees. The muted listing came despite the IPO being subscribed 1.68 times during the 3-day public bidding period. Vedanta's shares surging after it announced plans to sell up to 1.59% of its overall holding in Hindustan Zinc through an offer for sale. The number of shares which will be up for sale as part of the OFS are worth nearly 4,900 crores. The OFS will open for non-retail investors today and for retail investors tomorrow. Vedanta had a 61.8% stake in Hindustan Zinc at the end of the December quarter. In earnings, Maruti Suzuki has reported a steady Q3, revenue up nearly 30%, profit up 4% despite a 600 crore rupee hit on account of the new labour code. TVS Motors also posted a strong Q3 performance, surpassing estimates. Reema standing by with more.
Thanks so much for that. So let me start with TVS Motors, where the numbers were ahead of street expectations. The company's top line went up by 37%. This was driven by a volume jump of 27% and an increase in the company's realization to the extent of 8%. Margins came in at a multi-quarter high of 13.1% on the back of a better mix and rupee depreciation, and margins were up 120 basis points on a year-on-year basis. Bottom line got impacted on account of the labour code, so expenses went up by 41 crore, but even outside of that, profits were up 52%. Now, Maruti also reported an operationally pretty strong numbers and largely in line with expectations. So top line growth went up 29%, again, mostly driven by volume growth, about 18%. The balance was a realization increase. The stock initially reacted negatively to the margin miss. So EBITDA margins for Maruti declined by 80 basis points on a year-on-year, 180 basis points on a year-on-year basis, and it came in lower than expectations. But this was an account of a one-off because of gratuity long-term compensation. So if you strip that out, adjusted margins were in line with expectations. But the reason why the stock could be under pressure is because there was this article in Bloomberg which spoke about how South Africa is looking to impose higher tariffs on imports of cars from India as well as China to protect its own domestic industry. Now, for Maruti, exports are not very large, but in the export business for Maruti, South Africa is one of the key markets. So maybe that overhang was there on the stock price all day today. But operationally, adjusted numbers look fine for Maruti, and TVS, of course, was a beat.
Reema, many thanks. Maharashtra's Deputy Chief Minister Ajit Pawar died after his chartered flight that he was flying crashed while landing at Baramati. A leader and a tough administrator, the 66-year-old Pawar held multiple portfolios in the current Fadnavis government. An 8-time MLA from Baramati, Ajit Pawar was also the state's longest-serving Deputy Chief Minister. He was travelling to Baramati from Mumbai to attend campaign rallies ahead of the district's council elections. 4 others, including 2 crew members, also lost their lives. Witnesses said the plane burst into flames moments after hitting the ground, triggering multiple explosions. Ajit Pawar was long considered Uncle Sharad Pawar's political successor till the NCP patriarch's daughter Supriya Sule burst into the scene. He split from the party in 2023 along with 41 MLAs to join the government led by the BJP and Eknath Shinde-led Shiv Sena. The Maharashtra government has announced 3 days of state mourning. His final rites will be held in Baramati tomorrow.
अजीत दादा ने महाराष्ट्र और देश के विकास में अपना बड़ा योगदान दिया है। विशेष रूप से गांवों के जीवन को बेहतर बनाने के लिए उन्होंने हमेशा आगे बढ़कर काम किया। मैं अजीत पवार जी के परिवार के प्रति संवेदना व्यक्त करता हूं।
इसकी वार्ता आने के बाद समूचे महाराष्ट्र में बहुत ही दुख का वातावरण तैयार हुआ है। हम सभी के लिए इस प्रकार के जननेता को खोना एक अपरिमित इस प्रकार की हानि है। व्यक्तिगत मेरे लिए वो एक बहुत ही दमदार और दिलदार इस प्रकार के मित्र थे।
समस्त पवार परिवार और जितने भी समर्थक हैं उनको हमारी तरफ से संवेदना और शोक। मैंने बात की सुप्रिया जी से भी और उनकी
Aviation regulator, the DGCA, said the Learjet 45 had taken off from Mumbai and was attempting a second approach to Baramati when it went down. Captain VK Singh, the founder of VSR Aviation, which operated the plane that crashed, said the aircraft had no technical issues. He also suggested that low visibility was the primary factor behind the incident.
Primarily, it appears that, the pilot could not see the runway, and that's why he would have carried out.
But he has already taken 2 loops, sir. How is it possible that he could not see?
The pilot will carry out a missed approach in case if he's not comfortable to land on the runway.
Yeah.
Very experienced pilot, more than 16,000 hours of experience. Very seasoned. The co-pilot was also 15,000 hours.
Okay.
1,500 hours.
Okay. Yeah.
And the captain was very experienced, instructor, examiner material. He was with Sahara, he was with Jetlight, he was with Jet Airways, and he was very experienced on this type of aeroplane. The aircraft was very well maintained. There was absolutely no problem in the aircraft. There was no technical failure in the aircraft. You know, the DGCA is doing their work. So please give us some time, handle the DGCA, and then we'll get back.
A probe being ordered. Parliament's budget session kicked off with President Murmu's address today. In nearly 1 hour address, President Murmu said India remains the fastest growing major economy despite various global crises. The president's address also saw a brief protest by opposition leaders who demanded the restoration of the MGNREGA scheme. The government is set to table its economic survey tomorrow, and Finance Minister Nirmala Sitharaman will table the union budget on Sunday. And ahead of the budget, the government is considering incentives to support the manufacturing of sports goods. Parikshit joins us now with the exclusive details. Parikshit.
The government is considering incentives to support sports goods manufacturing, and a task force under the government think tank Niti Aayog has been taking feedback from sports goods makers nationwide for the past few months. Sources say the government could announce a scheme to support sports goods manufacturing in the union budget, and the new scheme could be announced soon. It is likely to be put into effect from 1st April 2026 for a 5-year period. The government is currently considering a combination of capital investment support and subsidies for sports goods manufacturing, according to sources. The Sports Ministry is exploring ways to support companies in getting certification and recognition from international sports federations. As part of this, they may consider subsidizing companies for the money they spend on getting certification from international bodies. The ministry may also take steps to generate greater awareness and recognition for Indian sports goods manufacturers. The centre is currently aiming to support manufacturing of goods for 36 Olympic sports, and officials believe that FTAs with European Union, UK and the EFTA region will provide a big market for Indian sports goods makers. And the Commonwealth Games in Ahmedabad in 2030 will also be a big showcase for India-made products. According to a KPMG report, sports good equipment and apparel manufacturing in India is valued at $6.7 billion, and this is projected to touch $10 billion by 2030.
Parikshit, many thanks. Let's see if the budget announces a scheme for sports good manufacturing. Now, the government has completed drafting norms for the second phase of India's semiconductor mission 2.0. We learn from sources it's looking to secure a cabinet nod by the end of March. Ashmit joins us now with the exclusive details. Ashmit.
Well, ISM 2.0, a key piece of stimulus program that the semiconductor ecosystem has been watching very carefully for. Bear in mind that ISM, the first phase was approved in 2021. That had an outlay of 76,000 crore rupees. And that stimulus program has translated into 10 projects being approved. The companies like Micron, like Tata Electronics coming on board for making chips out of India. What's important here is that the government's position has been clear that the stimulus program needs to continue for supporting the semiconductor ecosystem, and to that end, we're given to understand that MeitY, the Ministry of Electronics and IT, has completed the drafting of the structure of ISM 2.0. Now we're given to understand begins the legwork of interministerial consultations, securing a nod from the Finance Ministry on the expenditure and the funding that has been proposed. And importantly, what MeitY officials tell us is that they are targeting a cabinet nod as early as March. And now this will be critical given as how the scope of ISM 2.0 will be much wider. We're given to understand that the outlay may be even more than 76,000 crore rupees, that there will be inherently a focus on designing and fabricating, both of them, ensuring that designing also happens here in the country. And that is going to be the focus of this ISM 2.0, the support program. The government keen on it. All eyes now on approvals that are now required from the Finance Ministry and then subsequently from the Cabinet for this new phase of the support program to continue for the semiconductor ecosystem.
Ashwat, many thanks. Up next, Amazon announces 16,000 job cuts in a fresh round of layoffs. This after the 14,000 jobs that were cut in October last year. That and more when we return. Amazon has announced another round of layoffs impacting around 16,000 roles. Most US-based employees will be given 90 days to look for a new role internally. Those unable to secure a position or who choose not to pursue one will receive transition support, including severance pay and health insurance benefits. Shilpa joins us now with the details. Shilpa, 16,000 jobs on the block at Amazon?
Well, you're absolutely right, Shireen. This time around, it will be 16,000 roles that are being eliminated, and that takes the total layoffs to about 30,000 in just the last 4 months since the last round of layoffs happened in October. Now, Beth Coletti, who heads HR at Amazon, said in a communication to employees like the last time, employees will have about 90 days to look for a new job, and if they don't find a new one or they choose not to, they will be given transition support. Now, the reasoning to this time is the same. It's to reduce layers and cut bureaucracy. Now, remember, this follows an internal email that was prematurely sent a day ago and then cancelled that gave employees an indication that job cuts are imminent at the company. Now, what we are given to understand is that the cuts are expected mainly and more heavily focused on Amazon Web Services or AWS, and within that, including teams across global sales, Bedrock, WWSO, and also apart from that in the retail, HR, and the Alexa division, among others. Now, India is also set to be impacted. Employees across Bengaluru, Hyderabad, and Chennai are likely to face job losses, with some staff already being notified since today. Now, remember, this follows Amazon's previous round of layoffs in October 2025, where 14,000 employees were cut globally and nearly 1,000 were from India. Now, all of this comes as Amazon doubles down on AI and a broader cost-cutting drive after an over-hiring spree post the pandemic. Now, the company has begun shutting down its physical Go and Fresh stores in the US, and it is choosing to focus on online delivery and instead prioritizing the expansion of its Whole Food stores. It is also set to shut down its Palm-based service called Amazon One by June, which it had launched in 2020. Now, this same cost pressure seems to be extending beyond Amazon into other ventures owned by Jeff Bezos, one of the richest men in the world. At the Washington Post, owned by Jeff Bezos, over 100 newsroom roles could be cut, with nearly 300 employees across the organization potentially losing their jobs. Now, the cuts are expected to hit the sports, metro, and foreign bureaus the hardest. In fact, foreign correspondents and foreign bureau chiefs have been publicly appealing to Bezos over social media platforms, warning that shrinking global coverage could weaken the pay-per-score journalism. About 60 journalists, in fact, from the international desk have also signed a collective letter urging Bezos to reconsider the potential job cuts. Now, from big tech to global journalism, the cost-cutting drive is intensifying, leading to several job losses, with growing questions over what gets lost in the process. But even as Bezos continues to invest aggressively in artificial intelligence, both through Amazon and through his personal investments. Back to you.
Shilpa, many thanks for joining us. And more job losses. Pinterest has announced plans to lay off approximately 15% of its global workforce as part of a significant restructuring effort. The decision will affect around 700 to 800 employees. It comes as the company accelerates its shift towards artificial intelligence. Pinterest aims to realign its cost structure, product roadmap, and hiring priorities to prepare for an AI-driven future. Homegrown audio and wearables brand Boat has deferred its initial public offering despite having all regulatory clearances in place. We learned from sources that the firm is reassessing market conditions and internal preparedness. Remember, analysts had flagged concerns over leadership exits, financial mismatch, and valuation pressure. This was the startup's second attempt at going public. Rachna joins us now with the details. Rachna, deja vu for Boat?
Well, sources have told CNBC-TV18 that Boat's IPO now has been deferred. This is even after the company secured key regulatory clearances. Imagine Marketing, which is the parent company of the brand Boat, has paused the public issue to reassess market conditions and internal preparedness. This is according to people who are familiar with the matter. So yeah, this is a bit of deja vu for Boat, because neither was this their first attempt at going public, nor is it being shelved for the first time. Now, the company had revived its listing plans in 2025 by filing a confidential draft red herring prospectus with SEBI. Following this, SEBI granted its observation letter in September 2025, effectively clearing the company to proceed with the IPO. Now, the proposed issue issue size was pegged around 1,500 to 2,000 crore rupees, with a structure that included a significant offer for sale component aimed at providing partial exits to existing shareholders and promoters. However, the IPO push came under increasing scrutiny on social media. The updated DRHP, which was the UDRHP, revealed auditor observations, with the company's statutory auditor flagging concerns related to internal controls and financial reporting processes. We had reported it when this came out. These disclosures triggered closer examination from analysts and investors alike ahead of the planned listing. At the same time, financial performance raised questions. While both reported strong top-line scale margins, it was profitable, but it also remained under pressure due to high inventory costs, marketing spends, and competitive pricing, limiting visibility on sustained profitability. Now, the deferment also comes amid leadership churn at the top. Co-founders Aman Gupta and Samir Mehta stepped down from their executive roles in late 2025, shortly after the clearance came in. Now, this is a move that added to governance and continuity concerns in the run-up to the IPO. Analysts tracking the issue had flagged leadership exits, auditor red flags, financial mismatches, and valuation pressures as key risks, especially in a market environment that has turned cautious on new-age consumer companies. Now, both did not respond to CNBC-TV18's queries that were sent on mail, but we will be keeping an eye out for more.
All right, Rachna, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. There's plenty more that we have lined up for you.
At India Energy Week, we are now joined by Mr. Sarthak Behuria. He is chairman at GOBP. Mr. Behuria, hi, thank you so much for joining in. Sir, when you look at India's mobility economics, how would you place it as? How would you define it as?
I think India's mobility economics has been very linear in the last several years. I'm one of those few who've been associated with the mobility business for over 50 years now.
Yes.
Those days, in terms of mobility, it was just the fuel stations that we talked about, the petrol and the diesel, and very traditional pump and tank kind of thing. But I think at that time, it was also controlled by the government in terms of what we called as an administered price mechanism. There were only public sectors in India whose only job was to see that the supply is maintained. But then I think came in the early 90s that the entire process of deregulation for the economy opened up with Dr. Manmohan Singh and Rajiv Gandhi. But like other sectors, the oil sector also opened up. And that gave an opportunity for the private sector to look at India as an opportunity, particularly as I'm talking about the oil industry. Then came the companies like Shell, who were the earlier in India as Burma Shell and Esso, who were all nationalized in 70s. The opportunity came back to them in 2000. Since then, the entire mobility business worldwide had gone through a very transformational change, where the customer became the core focus as far as the transition was concerned. And that kind of feeling or that kind of learning or that kind of message through these companies who came back to India. And also we had the opportunity of having people who joined us from different institutes, the IIMs or IITs, who had the global experience in all sectors. And that the real transformation of mobility came through, I think, in the early 2000s, when I was still in the oil industry, very much so at very senior levels. And of course, since then, I think we've just cruised along, and we've now transformed, and we are one of the leading retail marketing companies in the world, not just in India, with all the new features and experiences that the mobility can bring to a consumer.
Mr. Behuria, when we look at Reliance Industries and then we look at BP and the kind of partnership that we have seen, whether it is about global expertise or the local strength here, how would you look at this partnership growing from strength to strength?
This was a very unique partnership and a relationship that BP, who is one of the world leaders in terms of retail marketing, and Reliance, who has the scale, who has the technology, who has built one of the largest refinery in the world, the most complex refinery in the world. They also started a small retail venture, but because the fact that public sector is dominated and the pricing power was with them, it was not possible for them to sustain. And BP, when they got the license 5 years ago, again they started looking at starting the retail venture, but it was not possible to start from scratch. So it was a very win-win situation where Reliance had 1,400 outlets. BP had the worldwide experience of the transformation of new ways of doing mobility business, and they formed a 51-49 joint venture, transferred all the existing retail outlets, which were rebranded as GeoBP, and the BP world brought in the class, the quality, the active technology, the convenience, of course the EV charging now, and I think we've just moved on and on to be now world-class in terms of not just the look and feel, but the customer experience and all the digital initiatives that we take in terms of customer loyalty, in terms of the automation that we have, and 100% guarantee on Q&Q, which has been the bane of the oil industry for so many years now because of the situation we were in.
Active technology is something that GeoBP is absolutely hands-on pushing right now. What would you say about it? Active technology is basically, we put some additives, and the difference, and these are tested over 100 years by BP in their research laboratories, both third party and theirs. And what it does, so we buy normal fuel, both from our refinery and from other companies' refineries. We make a special effort to put additional additives to make it, a premium fuel. And that both in terms of power, in terms of cleanliness, and we've tested them in terms of mileage. A diesel customer gets 4.3 kilometers, the petrol customers gets 100 kilometers a year. Plus, it is not just the mileage, it is the look at the power behind and the feel and the smoothness and cleanliness, which is guaranteed. And I have personally met people who self-drive. Two-wheelers, of course, commit there, but even diesel customers, they all feel that this fuel is certainly much better than normal fuel. We have a Q&Q guarantee because we have totally automated dispensing units. That is 100% tested. Q&Q is guaranteed because this was one of the, as I said, main for the oil industry customer. And the more than the quality of fuel, when you drive a car, you can see the smoothness, the feel, the power behind the car. But unfortunately, our network is not so strong. We have 100,000 plus retail network in the country, whereas our number is about 2.5. So we have about 2.5% of the network, but we are having 6% of diesel market share and 4% petrol. That means our market effectiveness is 2.5 times. For every retail outlet that we have in this country, we are able to deliver 2.5 times the normal average PSU outlets. So that is because of the look, feel, the kind of convenience, the kind of offerings that we offer, and the kind of confidence that people have.
Most of our outlets are very much highway oriented, very large format. We are able to put convenience stores, we are able to put also now the EV charging, we have plazas, we have wayside amenities, and we are now looking at also moving a little urban, because we want all our colleagues, friends, people that we know that relate to also experience it. But that was the strategy because there are huge entry barriers. It's very good to say that I want to put up an outlet in Mumbai, but love of money, you can't get land. And the kind of value for land and the appreciation, it becomes uneconomic in terms of an economic proposition. So we have to do a balancing act. So wherever there are opportunities, NHI is bidding a lot of sites, but now we are moving into maybe small towns, maybe suburban areas of big cities. That's where I think we need, and we want to also increase our gasoline market share to at least the same as maybe 5-6%. So all the campaigns in terms of the kind of fuel quality, particularly on gasoline, because Metro Spirit gasoline is one product which attracts because people take 4 kiloliters or 5 liters of 1 liter. So the same volume will have at least 20 times more people, and the experience and the look and feel, the wow effect that we have, that comes in more by way of people who actually visit compared to a trucker. There's a great loyalty. We have a TransConnect program, a huge loyalty program, and the people only come to our outlets and they are hooked on to us. We also have loyalty program as far as MS gasoline and self-drivers are concerned. But the challenge that we have is how do we improve the network to make people like you and me have that experience.
So you're saying the consumer feedback is great and the loyalty is amazing as well. How are you looking at the adoption part of it?
Adoption, one of the things that can adoption is that it has to be close by. People, the choice of a retail outlet is much more. One is, of course, the kind of confidence you have, the service standards, look and feel, and it has to be at a place which is convenient to you. If you're moving left turn and your outlet on the right turn, and now with dividers all over, you have to have it both sides of what. So I think accessibility is the most important fact. The other thing that we need to, sometimes we do, apart from campaign, is that when there are opportunities, we work out schemes. Our dealers network also gives schemes, also some kind of a campaign that we do some lotteries. You have to, every consumer gets tempted to some financial incentive or some gift.
So while you have a leadership and you have a great market as well, are you worried about others coming into this market too?
In fact, others are worried about us because so far it's been a protect. And I was both in Indian Oil and EPC, who controlled 80% of the market. I've been director marketing of Bharat Petroleum.
That is something that you're not worried about.
We were worried about them. Now they are worried about us. Because we are, 5-6%. At the best times, we can't do more than 9-10%. And they have created huge infrastructure. We have a single source of refinery. So to service the whole India is a big challenge in terms of transportation, in terms of reaching. So we know where our handicap is. We know which our strength and weakness. We know the coastal of India is available. And of course, we have to put up network where there is a good return, where we have the right kind of dealer. So there, within the constraints, I think we have done very, very well. More than that, I think we are bringing in new kind of experience, and we are setting the standards for others to follow, which is international, thanks to our active technology, BP's entire concept of convenience, and the Reliance's digital experience, technology, and the scale, and the outlook itself. The two giants, we are a baby, but we are growing very well.
So one final question, how do you see yourself 5 years down the line from here?
Actually, we have to take part in the energy transition of this country, and we've done so. Fuel is where we started, and then we quickly moved on to EV charging. We moved into gaseous fuel. We have a small aviation setup. On EV charging, we are now, and we've done extremely well. We've now moved where to go. We've quickly moved on to fast charging because we realized that more than 15-20 minutes, nobody is willing to wait. So from 6-9 kilowatt, now we're moving to 320, 360. We also realized that home charging two-wheeler is something that... So we adapted ourselves very far to the transition because we have the BP Pulse experience and the Reliance's entire might. So we moved very fast, so we moved on to on-the-go, not just retail outlets because we didn't have retail outlets in the cities or many places. So we looked at sites which are in the malls or separate on the go. We we realized that the maximum space on EV is today the taxi aggregators. So we still, our B2C is the biggest, about 40-50% of our charging is done to B2C. So taxi aggregators, now we look at the buses or LCVs. Now we're moving into the fast, but heavy kind of electrons that we get. So today I'm very proud to say that we are the leading #1 EV charging company as far as the fast charging is concerned.
Mr. Behuria, as always, thank you so much for joining us today. At India Energy Week, we are now joined by Mr. Akshay Wadhwa. He's CEO, GOBP. Mr. Wadhwa, hi, thank you so much for joining in.
Thank you so much.
First of all, with all that's happening in the international markets, the uncertainties, the geopolitics, etc., would you say India is a bright spot amid all of this when it comes to energy demand?
Yeah, definitely. I would say that from the demand perspective, it's a very interesting market because our per capita consumption is almost 1/3 of what the global consumption is. From that perspective, I think it's a growth market, which is actually evident if you look at the numbers, the recent statistic in terms of the MS, the petrol is growing at about 6%, diesel is growing about 2%. From that perspective, I think India is a bright spot, and that's how I think the fact that IEW is happening every year in India, and there are people across the globe coming and joining, that is evident that it's a growth market, and that's why everybody's looking at it.
Oh, well, absolutely. The growth numbers are really nice. How would you look at GOBP within the overall economics of energy in India?
So GOBP is here basically to create a differentiation in the market. And I think today when we are sitting here in IEW, we're going to roll out our active technology campaign, which is again talking about differentiation backed by science, not just a qualitative claims as such.
Sure.
So what we are basically doing, I think if you recall, we in the last 2024, when we went into the market, 25, when we went to the market, we actually quantified our claim for the diesel, where we claimed that we're going to get 4.5% additional, 4.3% additional mileage on the diesel, and what we are doing here is for petrol. So I think the theme GOBP has is how do we differentiate in the market. Therefore, we have 100% of outlets are automated. We have deployed AI at outlets. So for example, sitting in my office, actually I can see that which the salesman is not even wearing the uniform or wearing a cap. I can actually get a flag. So, I mean, we are doing all those differentiated, be it product, be it service, or the experience at the outlets, or be it in the terms of the energy which we are delivering, be it liquid fuels, gaseous fuels, or in even the electric mobility. So we are plugging in all those gaps to make sure that we give a differentiated experience to our customer, and that's how we are redefining the complete mobility space. Therefore, we don't say that we sell petrol or diesel. We actually provide the mobility solutions to our customer, and that's how our theme is by 2035, we want to be the largest player in the low carbon energy fuel. So that's what we are doing it.
So you mentioned various energies there, and let me come to it, each one, and break it down like that. You said HSD claim of 4.8%. You also have said 100 kilometers in petrol. Do you think the numbers from here would grow? And what is the kind of growth that we have seen?
So currently, if you look at the market exit of December, market is growing, MS is about 6%. We are growing at 30%.
Okay.
Right? HSD in the market is growing at 3%. We are growing at 28%. So growth, I think consumer is adopting it. We have a limited network today, so therefore probably some of the markets consumer does not get to experience our brand. But I think as we are expanding, consumer will get more chances to experience me as a brand, and therefore they are actually realizing the value. They are seeing how the service is different. They are seeing how their mileages are different. So I think what we are doing is we are not selling the plain vanilla diesel or petrol, normal diesel or petrol. We are selling additized, and these additives are actually being taken from BP's 100 years of experience in the international market, and we're bringing in that additive. But mind you, these additives are global, but the entire testing have been done in Indian condition. The vehicle is Indian, the roads are Indian, the fuels are Indian. So therefore, entire experience creation, the curation of the product has been done in Indian market. So therefore, from that perspective, we are differentiating from the technology standpoint, from the fuel per se, the product standpoint, the services, and the diversity of energy which we offer to our consumer for mobility. So that's how it is exactly there.
So when you talk about active technology, in simpler words, how would you educate a consumer about it? On why should a consumer go for it?
So it is simple that today you fuel normal petrol. What we are doing is we are adding additives. What happens when the fuel actually burns in the engine? It creates carbon. The way we burn a piece of paper, right? It creates a carbon. हमारे घर के गैस के चूल्हों के ऊपर you see that those carbon, right? It's similar carbon comes there. So what we do is this additive actually keeps the engine clean. So if the engine is clean, what happens is the combustion is better, the efficiency is better. So consumer gets more mileage per liter. One, the maintenance cost goes down because your engine is clean. That happens. The reliability of engine improves because you know that you are maintaining your engine well. And therefore, these are some of the things which happens in the engine which makes adds a lot of value to the consumer. So that's a plain vanilla thing that if you want to take care of your engine, you love your engine, probably you should use the additized petrol or the empowered petrol which helps you to keep your engine clean.
And what is the price point to it now? Because that is something that the Indian consumer is very sensitive about.
That's where we picked up. What we are saying is we want to democratize the efficient fuels in the country. And therefore we sell these additized petrol at no extra cost. It's sold at the same price as a normal fuel. What we want is we want consumer to actually experience it. If you, I mean, in terms of efficiency, like the pickup, the efficiency, the cleanliness. So therefore, we don't want them to say deprive them of the such efficient fuel. So therefore, we are offering at the same cost.
How are you also looking at the global energy transition, and do you see a part of that happen in Indian markets as well? And as you said, you're looking at mobility. You're not looking at just one part of energy right now.
Yes. So I think transition is happening. It's a fact. Let's look at the summer statistics. April, December, if you look at the total cars which have been sold in the country, about 2.5% were the EVs, about 6.5% were gaseous, the CNG vehicles. Balance 90 were petrol or diesel. Out of those 90, about 80% was petrol and 10% balance was the diesel. So therefore, consumers are adopting the newer fuels. Therefore, what our theme is that we want to give them any energy, irrespective of the powertrain they operate on. We will give them the energy. So therefore, what we have done is, we have done 2-3 broad things. Each of our outlets, probably based on the space available, should have multi-fuels available so that consumer can just walk in and consume it. So we expect that this pace of transition will pick up, and consumer will not only adopt different fuels, but I think he or she would also look forward for differentiated experience. Because if I am driving electric vehicles, I need to go to the outlet, spend half an hour. I should have something to engage. So I have a wild bean cafe there. Consumer can just have a sip of coffee. And by the time his or her car is charged, and he can just move on. So that's how we are adopting it very clearly, and therefore very clearly we are saying, let's reimagine the mobility. Let's not look at the traditional way, because that's what the future lies for.
Sure. The other buzzwords really have been about digitization and AI. How have you seen that make inroads into what you do?
I think very interesting. I feel the fuel is a category which is a grudge purchase for the consumer. So our effort is, how do I delight the consumer whenever he or she walks into my outlet? Can I identify a consumer when he or she walks into it, and I know what is his or her behavior? I know if he's always asked for the tank full, can I give her the same tank full always? Or if he or she walks in and needs a particular blend of coffee, can I give that? So I think what we are beautifully working on is, how do we deploy AI in our fuel operations? So what we are already started working on it. For example, today my complete attendance of the boys and girls at the outlet happens through AI. I can actually detect a salesman not wearing a uniform, the flag comes to me. God forbid, if there is any flame at the outlet, immediately flag goes to comes to us, goes to the dealer. So we are deploying all those use cases. Even safety part, we are very, 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 very focused on safety. Just example, if a vehicle is coming and it's unloading the diesel into the tank and the fire extinguisher not kept, it will immediately raise a flag. And the flag will be immediately going to the control room and the call will reach to the dealer. So therefore we are deploying AI to make our operations efficient on one side, make them safe always, and give a consumer an experience which he or she has never experienced.
It's not just about filling gas, it's about an experience that you also are giving.
Exactly.
So, Mr. Vadva, from where we stand right now, how are you reimagining mobility, let's say, 5 years down the line?
So, look, today we have about 2,000 outlet. Apart from that, I am also there in the open market where I have a charging stations. So we have 1,000 charge points with 7,000 chargers. Today I am the largest fast charging player in the market, which ensures uptime of more than 95%, which nobody can offer. So that means I don't want consumer locates a charging station and comes and sees the station is down, right? So therefore, I strongly feel the liquid fuels are here to stay, at least for next 5 years. Definitely when you talked about 5 years, gaseous fuel will pick up space, EVs will pick up space. So therefore, fuel outlets have to be necessarily multi-fuels, cannot be only petrol and diesel. I think we should not be calling it as a petrol station, petrol pump. Yeah. It should be mobility station or energy station like that. So therefore, I think going forward, consumer is going to demand that, and rightly so, and that they deserve it. So therefore, we are taking a lead ahead of our peers in the market to give that experience to the consumer, so that consumers should be delighted every time they walk into our outlet, and it should be sustainable growth, and therefore we want to plug in as much as low carbon fuels into the market, so that we grow responsibly, not just growth. That's way.
So I'll wind down this conversation with one more question. You talked about a mobility station. You talked about various energies and EV, of course. It's that much of a pie. So where is the major spend or investment really going to get into when it comes to Indian markets going forward?
So just to give you a thumb rule, what we are doing currently, we do about 10% of my capex on future generation fuels.
All right.
So what we are doing is, I know that my network share is about 2.5%. So therefore, I need to grow my network. So therefore, we'll calibrate our capex spend in sync with how the energy transition happens in the market. So therefore, we are absolutely tracking how much where do I sell, what do I sell, and accordingly we are calibrating our capex spend. I feel that probably this 10% would become about 20% by next year, and then we'll ramp it up as consumer adopts new generation fuels, and probably that's the way it is. I mean, we want every rupee to be spent, there should be return on it, right? So, so that's where it is.
Mr. Vadva, thank you so much for joining.
Thank you so much, Manisha. It was nice. Thank you.
Good evening. Thanks very much for joining us on Business 360. I'm Shireen Bhan. The headlines we're tracking for you this evening. The Sensex and the Nifty gain for the second straight session. Mid-caps outperformed. The rupee weakens marginally against the dollar, even as the dollar index plunges to a 4-year low. Global markets tread with caution ahead of the US Fed decision later tonight. The central bank is likely to keep interest rates unchanged. Gold extends the record rally, soaring past $5,200 per ounce. U.S. Trade Representative Jameson Greer says India has made progress on reducing Russian oil imports, but still has a long way to go, and Washington is watching closely. Also says India has come out on top in the trade deal with the EU. British Prime Minister Keir Starmer arrives in China for a state visit to mend bilateral ties as Western alliances come under strain due to Trump's tariff onslaught. This is the first visit by the British Prime Minister to China in 8 years and comes just days after Canada's Prime Minister Mark Carney visited Beijing. Maharashtra's Deputy Chief Minister Ajit Pawar dies after his chartered flight crashed in Baramati. 4 others, including 2 crew members, killed as well. The aircraft, Learjet 45, is operated by VSR Ventures. The Maharashtra government has announced a 3-day state warning. Maruti Suzuki reports a steady Q3. Revenue up nearly 30%. Profit rises 4% despite a 600 crore rupee hit due to the new labour code. Parliament's budget session kicks off with President Draupadi Murmu's address. The government will table its economic survey tomorrow. Finance Minister Nirmala Sitharaman will table the union budget on Sunday. The Indian government drafts norms for the second phase of its semiconductor mission, may look at design-linked incentive scheme to push for designing chips in India. Sources say the government is planning an outlay higher than the sanctioned 76,000 crore rupees for phase 1. Amazon announces 16,000 job cuts in a fresh round of layoffs. This comes after 14,000 jobs were slashed in October last year as the company restructured after overhiring during the pandemic and expanding the adoption of AI tools. Electronics maker Boat delays its IPO once again. Sources cite market conditions and the lack of internal preparedness. The company's founders Aman Gupta and Sameer Mehta stepped down in November last year. Auditors had also red flagged a mismatch in financial statements to lenders. Well, the market action to start with the Lal Street beginning February on a positive note, gaining for the second straight session. The Nifty and the Sensex ended 0.5% higher, with the Nifty closing above 25,300. The Sensex 487 points higher. The Nifty Bank continues to do well, up by about 400 points and almost a 1,000-point rally there on the Nifty mid-cap today. So metals, oil and gas stocks led from the front. Banks rose in line with the blue chips and the mid-caps outperforming today. India's industrial production growth accelerated to a 26-month high of 7.8% in December. Manufacturing output, which carries the largest weight in the index, grew 8.1%. Mining activity strengthened, while electricity generation rebounded to 6.3% after contracting 1.5% last month. That's the IIP data for you. Investors expect the U.S. Federal Reserve to maintain status quo in their policy decision later tonight. According to a CNBC Fed survey, respondents expect only 2 rate cuts this year and don't anticipate any rate cut in 2027. 31% want the Fed to trim rates at a meeting. Further, most investors in the survey expect the former Fed Governor Kevin Walsh to be the next Fed chair. Only 11% believe the National Economic Advisor Kevin Hassett will be picked as the next Fed chief. So, majority there voting for Kevin Walsh. President Trump has said the dollar is doing great despite the dollar falling to a 4-year low. Speaking to reporters in Iowa, President Trump argued that the currency's weakness is a good thing.
Mr. President, with the current value of the dollar, do you think it's declined too much?
No, I think it's great. I mean, the value of the dollar, look at the business we're doing. No, dollar's doing great. You know, it's very interesting. If you look at China and Japan, I used to fight like hell with them because they always wanted to devalue their yen. You know that? The yen and the yuan. And they'd always want to devalue it. They devalue. And I said, not fair that you devalue because it's hard to compete when they devalue. But they always fought, no, our dollar's very good.
Well, that's President Trump on the dollar. Gold price is hitting a fresh record high, breaching the $5,200 per ounce mark for the first time. The yellow metal surging as the dollar plunged amidst geopolitical concerns. Silver price is also hovering near all-time highs. The white metal has rallied nearly 60% so far this year. In India, too, gold and silver prices hitting new highs, tracking gains in the global market, so no abating there of the rally. Oil prices rising to a 15-week high. Supply concerns lingered. A winter storm across the U.S. disrupted crude output and exports, while tensions in the Middle East also lent some support. Brent hitting $68 a barrel today. India and the European Union have finalized a landmark trade agreement. 99% of Indian exports and 97% of European shipments will see tariff reduction. The deal is expected to be implemented by 2027 after the European Parliament's consent. Global broking firm Bernstein has analyzed the deal. The simple average tariff imposed by the EU on the top 10 products exported by India stands at 3.5%. On the other hand, the average tariff imposed by India on the top European exports stands at 14%. Bernstein points out that this asymmetry means India's headroom to grant concession is far greater than the room to make gains. Bernstein says this is a major problem faced by India in trade deals with Western economies because India's tariffs are much higher. Sudarshan Venu of TVS Motors says the trade deal with the EU will be an enabler for leveraging India's manufacturing market in Europe. Speaking to CNBC-TV18, he also said the deal will let Indian automakers access higher CC vehicles in the higher CC vehicle market in Europe.
This will benefit many sectors, including ours. I think Europe is a large market mainly for bigger CC vehicles, and Indian companies have been producing bigger CC vehicles, what we do with BMW, Bajaj, of course, with KTM, Hero's working with Harley, and also you see now more exports of two-wheelers into the European market. And of course, with Norton starting production in the next months, really, or weeks, this will help all of us to leverage India as a manufacturing base for the European market as well.
Well, that's TVS's Sudarshan Venu. That stock a big mover in trade today on the back of strong results. U.S. Trade Representative Jameson Greer says India must do more to wind down Russian crude imports. In an interview with Fox News, Greer said that while India has made progress on cutting dependence on Russian crude oil, it has not gone far enough. Remember, last year the Trump administration imposed additional 25% tariffs on India, taking the total tariff rate to 50%. This on account of a penalty for purchasing Russian oil. Greer also reacted to the India-EU free trade deal being finalized in what was the U.S. government's first official comment on the deal. Greer said India has come out on top and cited the framework granting mobility for Indian service professionals in the EU.
The EU is turning to India to try to find a place. The EU is so trade dependent, they need other outlets if they can't keep sending all their stuff to the United States. I've looked at some of the details of the deal so far. I think India comes out on top on this, frankly. They get more market access into Europe. It sounds like they have some additional immigration rights. I don't know for sure, but President von der Leyen of the EU has talked about mobility for Indian workers into Europe. So I think on net, India is going to have a heyday with this. They have low-cost labor, and it looks like the EU is doubling down on globalization when we're trying to fix some of the problems of globalization here in the U.S. Frequent contact with my counterpart in India. I have a great working relationship with him, but they still have a ways to go on this point. They like the discount that you get from Russian oil. It's close by, so it's hard for them. The Treasury Department has put into place, a few weeks ago now, more significant sanctions, so we expect India to continue to wind that down, but we're watching it closely.
That's Jameson Greer. British Prime Minister Keir Starmer arrived in China for a state visit to mend bilateral ties as Western alliances come under strain due to President Trump's tariff onslaught. Now, this will be the first visit by a British Prime Minister to China in 8 years and comes just days after Canada's Prime Minister Mark Carney visited Beijing. At least 5 have died after a Russian drone attack on a Ukrainian passenger train carrying 200 people. The attack took place near a village in the Kharkiv region. Ukraine's President Zelensky has called the attack an act of terrorism. This comes as President Trump said that very good things are happening in the negotiations aimed at ending the Russia-Ukraine war. Back home, logistics solutions provider Shadowfax Technologies made a weak debut on D Street today. It listed at a discount of 9% at 112 rupees 60 paise a share versus the issue price of 124 rupees. The muted listing came despite the IPO being subscribed 1.68 times during the 3-day public bidding period. Vedanta's shares surging after it announced plans to sell up to 1.59% of its overall holding in Hindustan Zinc through an offer for sale. The number of shares which will be up for sale as part of the OFS are worth nearly 4,900 crores. The OFS will open for non-retail investors today and for retail investors tomorrow. Vedanta had a 61.8% stake in Hindustan Zinc at the end of the December quarter. In earnings, Maruti Suzuki has reported a steady Q3, revenue up nearly 30%, profit up 4% despite a 600 crore rupee hit on account of the new labour code. TVS Motors also posted a strong Q3 performance, surpassing estimates. Rima standing by with more.
Thanks so much for that. So let me start with TVS Motors, where the numbers were ahead of street expectations. The company's top line went up by 37%. This was driven by a volume jump of 27% and an increase in the company's realization to the extent of 8%. Margins came in at a multi-quarter high of 13.1% on the back of a better mix and rupee depreciation, and margins were up 120 basis points on a year-on-year basis. Bottom line got impacted on account of the labour code, so expenses went up by 41 crore, but even outside of that, profits were up 52%. Now, Maruti also reported an operationally pretty strong numbers and largely in line with expectations. So top line growth went up 29%, again, mostly driven by volume growth, about 18%. The balance was a realization increase. The stock initially reacted negatively to the margin miss. So EBITDA margins for Maruti declined by 80 basis points on a year-on-year, 180 basis points on a year-on-year basis, and it came in lower than expectations. But this was an account of a one-off because of long-term compensation. So if you strip that out, adjusted margins were in line with expectations. But the reason why the stock could be under pressure is because there was this article in Bloomberg which spoke about how South Africa is looking to impose higher tariffs on imports of cars from India as well as China to protect its own domestic industry. Now, for Maruti, exports are not very large, but in the export business for Maruti, South Africa is one of the key markets. So maybe that overhang was there on the stock price all day today. But operationally, adjusted numbers look fine for Maruti, and TVS, of course, was a beat.
Rima, many thanks. Maharashtra's Deputy Chief Minister Ajit Pawar died after his chartered flight that he was flying crashed while landing at Baramati. A leader and a tough administrator, the 66-year-old Pawar held multiple portfolios in the current Fadnavis government. An 8-time MLA from Baramati, Ajit Pawar was also the state's longest-serving Deputy Chief Minister. He was travelling to Baramati from Mumbai to attend campaign rallies ahead of the district's council elections. 4 others, including 2 crew members, also lost their lives. Witnesses said the plane burst into flames moments after hitting the ground, triggering multiple explosions. Ajit Pawar was long considered Uncle Sharad Pawar's political successor till the NCP patriarch's daughter Supriya Sule burst into the scene. He split from the party in 2023 along with 41 MLAs to join the government led by the BJP and Eknath Shinde-led Shiv Sena. The Maharashtra government has announced 3 days of state mourning. His final rites will be held in Baramati tomorrow.
अजीत दादा ने महाराष्ट्र और देश के विकास में अपना बड़ा योगदान दिया है। विशेष रूप से गांवों के जीवन को बेहतर बनाने के लिए उन्होंने हमेशा आगे बढ़कर काम किया। मैं अजीत पवार जी के परिवार के प्रति संवेदना व्यक्त करता हूं।
इसकी वार्ता आने के बाद समूचे महाराष्ट्र में बहुत ही दुख का वातावरण तैयार हुआ है। हम सभी के लिए इस प्रकार के जननेता को खोना एक अपरिमित इस प्रकार की हानि है। व्यक्तिगत मेरे लिए वो एक बहुत ही दमदार और दिलदार इस प्रकार के मित्र थे।
समस्त पवार परिवार और जितने भी समर्थक हैं उनको हमारी तरफ से संवेदना और शोक। मैंने बात की सुप्रिया जी से भी और उनकी
Aviation regulator the DGCA said the Learjet 45 had taken off from Mumbai and was attempting a second approach to Baramati when it went down. Captain VK Singh, the founder of VSR Aviation, which operated the plane that crashed, said the aircraft had no technical issues. He also suggested that low visibility was the primary factor behind the incident.
Primarily, it appears that, the pilot could not see the runway, and that's why he would have carried out.
But
a
he has
missed approach.
already taken 2 loops. How is it possible that he would not see it?
The pilot will carry out a missed approach in case if he's not comfortable to land on the runway.
Yeah.
Very experienced pilot, more than 16,000 hours of experience. Very seasoned. The co-pilot was also 15,000 hours.
Okay.
1,500 hours.
Okay. Yeah.
And the captain was very experienced instructor examiner material. He was with Sahara, he was with Jet Light, he was with Jet Airways, and he was very experienced on this type of aeroplane. The aircraft was very well maintained. There was absolutely no problem in the aircraft. There was no technical failure in the aircraft. The DGCA is doing their work. So please give us some time, handle the DGCA, and then we'll get back.
A probe being ordered. Parliament's budget session kicked off with President Murmu's address today. In nearly 1 hour address, President Murmu said India remains the fastest growing major economy despite various global crises. The president's address also saw a brief protest by opposition leaders who demanded the restoration of the MGNREGA scheme. The government is set to table its economic survey tomorrow, and Finance Minister Nirmala Sitharaman will table the union budget on Sunday. And ahead of the budget, the government is considering incentives to support the manufacturing of sports goods. Parikshit joins us now with the exclusive details. Parikshit.
The government is considering incentives to support sports goods manufacturing, and a task force under the government think tank Niti Aayog has been taking feedback from sports goods makers nationwide for the past few months. Sources say the government could announce a scheme to support sports goods manufacturing in the union budget, and the new scheme could be announced soon. It is likely to be put into effect from 1st April 2026 for a 5-year period. The government is currently considering a combination of capital investment support and subsidies for sports goods manufacturing, according to sources. The Sports Ministry is exploring ways to support companies in getting certification and recognition from international sports federations. As part of this, they may consider subsidizing companies for the money they spend on getting certification from international bodies. The ministry may also take steps to generate greater awareness and recognition for Indian sports goods manufacturers. The centre is currently aiming to support manufacturing of goods for 36 Olympic sports, and officials believe that FTAs with European Union, UK and the EFTA region will provide a big market for Indian sports goods makers. And the Commonwealth Games in Ahmedabad in 2030 will also be a big showcase for India-made products. According to a KPMG report, sports good equipment and apparel manufacturing in India is valued at $6.7 billion, and this is projected to touch $10 billion by 2030.
Parikshit, many thanks. Let's see if the budget announces a scheme for sports good manufacturing. Now, the government has completed drafting norms for the second phase of India's semiconductor mission 2.0. We learn from sources it's looking to secure a cabinet nod by the end of March. Ashmit joins us now with the exclusive details. Ashmit.
Well, ISM 2.0, a key piece of stimulus program that the semiconductor ecosystem has been watching very carefully for. Bear in mind that ISM, the first phase was improved in 2021. That had an outlay of 76,000 crore rupees. And that stimulus program has translated into 10 projects being approved. The companies like Micron, like Tata Electronics coming on board for making chips out of India. What's important here is that the government's position has been clear that the stimulus program needs to continue for supporting the semiconductor ecosystem, and to that end, we're given to understand that MeitY, the Ministry of Electronics and IT, has completed the drafting of the structure of ISM 2.0. Now we're given to understand begins the legwork of interministerial consultations, securing a nod from the Finance Ministry on the expenditure and the funding that has been proposed. And importantly, what MeitY officials tell us is that they are targeting a cabinet nod as early as March. And now this will be critical given as how the scope of ISM 2.0 will be much wider. We're given to understand that the outlay may be even more than 76,000 crore rupees, that there will be inherently a focus on designing and fabricating, both of them, ensuring that designing also happens here in the country. And that is going to be the focus of this ISM 2.0, the support program. The government keen on it. All eyes now on approvals that are now required from the Finance Ministry and then subsequently from the Cabinet for this new phase of the support program to continue for the semiconductor ecosystem.
Ashwat, many thanks. Up next, Amazon announces 16,000 job cuts in a fresh round of layoffs. This after the 14,000 jobs that were cut in October last year. That and more when we return. Amazon has announced another round of layoffs impacting around 16,000 roles. Most US-based employees will be given 90 days to look for a new role internally. Those unable to secure a position or who choose not to pursue one will receive transition support, including severance pay and health insurance benefits. Shilpa joins us now with the details. Shilpa, 16,000 jobs on the block at Amazon?
Well, you're absolutely right, Shireen. This time around, it will be 16,000 roles that are being eliminated, and that takes the total layoffs to about 30,000 in just the last 4 months since the last round of layoffs happened in October. Now, Beth Coletti, who heads HR at Amazon, said in a communication to employees like the last time, employees will have about 90 days to look for a new job, and if they don't find a new one or they choose not to, they will be given transition support. Now, the reasoning to this time is the same. It's to reduce layers and cut bureaucracy. Now, remember, this follows an internal email that was prematurely sent a day ago and then cancelled that gave employees an indication that job cuts are imminent at the company. Now, what we are given to understand is that the cuts are expected mainly and more heavily focused on Amazon Web Services or AWS, and within that, including teams across global sales, Bedrock, WWSO, and also apart from that in the retail, HR, and the Alexa division, among others. Now, India is also set to be impacted. Employees across Bengaluru, Hyderabad, and Chennai are likely to face job losses, with some staff already being notified since today. Now, remember, this follows Amazon's previous round of layoffs in October 2025, where 14,000 employees were cut globally and nearly 1,000 were from India. Now, all of this comes as Amazon doubles down on AI and a broader cost-cutting drive after an over-hiring spree post the pandemic. Now, the company has begun shutting down its physical Go and Fresh stores in the US, and it is choosing to focus on online delivery and instead prioritizing the expansion of its Whole Food stores. It is also set to shut down its Palm-based service called Amazon One by June, which it had launched in 2020. Now, this same cost pressure seems to be extending beyond Amazon into other ventures owned by Jeff Bezos, one of the richest men in the world. At the Washington Post, owned by Jeff Bezos, over 100 newsroom roles could be cut, with nearly 300 employees across the organization potentially losing their jobs. Now, the cuts are expected to hit the sports, metro, and foreign bureaus the hardest. In fact, foreign correspondents and foreign bureau chiefs have been publicly appealing to Bezos over social media platforms, warning that shrinking global coverage could weaken the pay-per-score journalism. About 60 journalists, in fact, from the international desk have also signed a collective letter urging Bezos to reconsider the potential job cuts. Now, from big tech to global journalism, the cost-cutting drive is intensifying, leading to several job losses, with growing questions over what gets lost in the process. But even as Bezos continues to invest aggressively in artificial intelligence, both through Amazon and through his personal investments. Back to you.
Shilpa, many thanks for joining us. And more job losses. Pinterest has announced plans to lay off approximately 15% of its global workforce as part of a significant restructuring effort. The decision will affect around 700 to 800 employees. It comes as the company accelerates its shift towards artificial intelligence. Pinterest aims to realign its cost structure, product roadmap, and hiring priorities to prepare for an AI-driven future. Homegrown audio and wearables brand Boat has deferred its initial public offering despite having all regulatory clearances in place. We learned from sources that the firm is reassessing market conditions and internal preparedness. Remember, analysts had flagged concerns over leadership exits, financial mismatch, and valuation pressure. This was the startup's second attempt at going public. Rachna joins us now with the details. Rachna, deja vu for Boat?
Well, sources have told CNBC-TV18 that Boat's IPO now has been deferred. This is even after the company secured key regulatory clearances. Imagine Marketing, which is the parent company of the brand Boat, has paused the public issue to reassess market conditions and internal preparedness. This is according to people who are familiar with the matter. So yeah, this is a bit of deja vu for Boat, because neither was this their first attempt at going public, nor is it being shelved for the first time. Now, the company had revived its listing plans in 2025 by filing a confidential draft red herring prospectus with SEBI. Following this, SEBI granted its observation letter in September 2025, effectively clearing the company to proceed with the IPO. Now, the proposed issue issue size was pegged around 1,500 to 2,000 crore rupees, with a structure that included a significant offer for sale component aimed at providing partial exits to existing shareholders and promoters. However, the IPO push came under increasing scrutiny on social media. The updated DRHP, which was the UDRHP, revealed auditor observations, with the company's statutory auditor flagging concerns related to internal controls and financial reporting processes. We had reported it when this came out. These disclosures triggered closer examination from analysts and investors alike ahead of the planned listing. At the same time, financial performance raised questions. While both reported strong top-line scale margins, it was profitable, but it also remained under pressure due to high inventory costs, marketing spends, and competitive pricing, limiting visibility on sustained profitability. Now, the deferment also comes amid leadership churn at the top. Co-founders Aman Gupta and Sameer Mehta stepped down from their executive roles in late 2025, shortly after the clearance came in. Now, this is a move that added to governance and continuity concerns in the run-up to the IPO. Analysts tracking the issue had flagged leadership exits, auditor red flags, financial mismatches, and valuation pressures as key risks, especially in a market environment that has turned cautious on new-age consumer companies. Now, both did not respond to CNBC-TV18's queries that were sent on mail, but we will be keeping an eye out for more.
All right, Rachna, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. There's plenty more that we have lined up for you.
Hello and welcome to Startup Street. I'm Arundhati Ramnan, and with me as always is Shruti Mishra. These are the top headlines from the startup world. IAN Alpha Fund has invested 25 crore rupees in deep tech startup Deep Propulse Aerospace. The seed capital will be used to expand the engineering team, strengthen simulation capabilities, and set up testing infrastructure. Deep Propulse is also integrating AI into design and validation cycles, with early engagements underway with the Indian military.
Deep tech startup Aquarix has raised 12.5 crore rupees in a seed funding round led by Rain Matter. The proceeds will be used to strengthen the company's core technology, including system autonomy, air-to-water transition reliability, sensing and communication capabilities, and to expand its engineering and research teams.
AstroTalk has posted an operating revenue of 1,176 crore rupees in FY25, a jump of around 81% from 651 crore rupees a year earlier on sustained demand for its core astrology offerings. Total income rose 85% year-on-year to 1,214 crore rupees in FY25 compared with 656 crore rupees in FY24.
The Indian government drafts norms for the second phase of its semiconductor mission may look at design-linked incentive scheme to push for designing chips in India. Sources say the government is planning an outlay higher than the sanctioned 76,000 crore rupees for phase one.
China has given the green light to 3 of its largest tech companies to buy NVIDIA's H200 artificial intelligence chips. Reuters reported ByteDance, Alibaba and Tencent have been approved to purchase more than 400,000 H200 chips in total, with other firms now joining a queue for subsequent approvals. On what's brewing today, Amazon has announced another round of layoffs, which is likely to impact around 16,000 roles. This is the second round of layoffs after the company let go of 14,000 employees in October last year. Shilpa Ranipeta joins us now with all of those details. Shilpa, another round of layoffs there for Amazon.
Well, you're right, 16,000 roles, that is what will be eliminated, and that will take the total layoffs to 30,000 in just 4 months since October 2025. Now, Beth Galetti, who basically heads HR for Amazon, said in a communication today to employees that most of the employees, especially the US-based ones, will be given 90 days to look for another role within the company, and if they're not able to find one or they choose not to look for one, then they will be given transition support like outplacement, insurance, etc. Now, the reasoning too is the same. They've been told that this is to reduce layers and cut bureaucracy. Remember, this follows an internal email that was sent prematurely a day ago and then cancelled that gave employees an indication that job cuts are imminent at Amazon. Now, what we're given to understand is that in terms of teams, it's mostly AWS that will see the most amount of cuts. And within that, the global sales, Bedrock, the WWSO team, and also the retail and HR and Alexa divisions apart from that will also be impacted. India is also set to be impacted, and employees across Bengaluru, Hyderabad and Chennai are likely to face job cuts, and we're given to understand that some staff is already being notified today. Now, this follows, remember, Amazon's previous round of layoffs in October 2025 when 14,000 employees were cut, jobs were cut globally, including nearly 1,000 from India. And all of this comes at Amazon doubles down on AI and a broader cost-cutting drive after an overhiring spree post the pandemic. The company has also begun shutting down its physical Go and Fresh stores in the United States, and it's choosing to focus on online delivery and prioritizing the expansion of its Whole Food stores instead. It is also shutting down the Palm-based payment service called Amazon One that it has launched in 2020, and that will be shut down by June. Now, remember, this same cost pressure seems to be extending beyond Amazon also into its other ventures owned by Jeff Bezos, one of the richest men in the world. At Washington Post, owned by Jeff Bezos, over 100 newsroom roles could be cut, with nearly 300 employees across the organization potentially losing their jobs. Now, the cuts are expected to hit the sports, the metro and the foreign bureaus, and they will be the hardest hit. So foreign correspondents and the foreign bureau chiefs have been publicly appealing to Bezos over the past couple of days, warning that shrinking global coverage could weaken the paper's core journalism. In fact, about 60 journalists from all the international desks have also signed a collective letter urging Bezos to reconsider these potential job cuts. So, you know, from big tech to global journalism, the cost-cutting drive is intensifying, leading to several job losses with growing questions over what gets lost in the process. And remember, this even as Bezos continues to invest aggressively in artificial intelligence, both through Amazon and through his personal investments. Back to you.
Well, thank you, Shilpa, for those details. Appreciate you joining us here today. Moving on, homegrown audio and wearables brand Boat has deferred its initial public offering despite having all regulatory clearances in place. We learned from sources that the firm is reassessing market conditions and internal preparedness. Now, remember, analysts had flagged concerns over leadership exits, financial mismatches and valuation pressures. This was the startup's second attempt at going public. Rachna Dhanrajani is here with all of the details. Rachna, is this a deja vu moment for Boat?
Well, sources have told us that Boat's IPO has now been deferred even after the company secured key regulatory clearances. Imagine Marketing, the parent company of consumer electronics brand Boat, has now paused the public issue to reassess market conditions and internal preparedness. Now, this is according to people who are familiar with the matter. So, yeah, this is a bit of a deja vu for the company because neither was this their first attempt at going public, nor is it being shelved for the first time. The company had revived its listing plans in 2025 by filing a confidential DRHP with SEBI. Following this, SEBI granted its observation letter in September 2025, effectively clearing the company to proceed with the IPO. Now, the proposed issue size was pegged around 2,000 crore rupees with a structure that included a significant offer for sale component aimed at providing partial exits to the existing shareholders as well as promoters. However, the IPO push came under increasing scrutiny on social media. The updated DRHP revealed auditor observations, with the company's statutory auditor flagging concerns related to internal controls and financial reporting processes. These disclosures triggered closer examination from analysts and investors ahead of the planned listing. At the same time, financial performance raised questions while both reported strong top-line scale margins and it even turned profitable, but it all remained under pressure due to high inventory costs, marketing spends and competitive pricing, limiting visibility on sustained profitability as well. Now, the deferment also comes amid leadership churn at the top. Co-founders Aman Gupta, who is the CMO, and Samir Mehta, who is the CEO, have stepped down from their executive roles in late 2025. This is a move that has added to the governance and continuity concerns in the run-up to the IPO. Now, analysts tracking the issue had flagged leadership exits, auditor red flags, financial mismatches and valuation pressures as key risks, especially in a market where environment is such that it's so cautious when it comes to the new age consumer companies. Both did not respond to CNBC-TV18's queries that were sent via mail, but we will be keeping an eye out for more.
All right, Rachna, but stay with us. The AI race is heating up as Anthropic and OpenAI scout for fresh funding. And that's not all. Anthropic CEO has sounded off a warning, saying unusually painful job disruption lies ahead due to AI. Take us through those details as well.
That's right. Anthropic is in the spotlight with reports indicating a massive funding round underway. Now, the company is set to be raising close to $20 billion at a valuation nearing $350 billion. Now, demand for its Claude model remains strong, especially large corporations look to deploy AI safely across operations, and Claude has proved itself to be a good enough rival in a competitive market. But even as capital flows in, caution is coming from the top. Anthropic CEO Dario Amodei is warning that AI could lead to unusually painful job disruption. He says entry-level white-collar jobs are most at risk and that artificial intelligence is moving way faster than policy and regulation are. This is a rare moment where an AI CEO is openly flagging social consequences, even as investment keeps accelerating. From caution to scale, the focus also shifts to OpenAI, because as per reports, OpenAI is in talks with SoftBank for another funding round that could go up to $30 billion. But this is a new record for the valuation, because this time the valuation is at nearly $850 billion. The last time we reported on a funding round for OpenAI, it was at $500 billion just a couple of months ago. So in just a few short months, it's gone from 500, which was already a milestone, to now $850 billion of valuation. Now, the capital is expected to fund next-gen AI models as OpenAI is prioritizing rapid compute expansion as we know it. However, growth is not without pressure, because this is the year when everybody is going to start asking what's happening to the money. So OpenAI continues to face rising chip and power costs as training and running advanced models has become increasingly expensive. Now, the contrast is clear. Anthropic is signaling caution on impact while OpenAI pushes scale at full speed. The money is, of course, unprecedented, but so are the stakes.
Absolutely. Thank you so much for taking us through all of those details, Rachna. But moving on now, assisted wealth management is emerging as the next big theme in India's investing journey, and Asset Plus is betting big on that shift. The digital assisted wealth platform has raised 175 crore rupees in a funding round that was led by Nexus Venture Partners alongside existing investors, with over 18,000 mutual fund distributors on its platform, managing over 7,250 crore rupees in assets and a monthly SIP book of 125 crore rupees. Asset Plus is now scaling its technology, products and distributor ecosystem. Joining me now is Vishrant Suresh, the co-founder and CEO of Asset Plus, to talk about what comes next. Vishrant, thank you so much for taking time out and being here with us on Startup Street. As I pointed out, you're a wealth tech startup that provides a digital platform to MF distributors and investors, right? If you could sort of, take us through what's on offer and what was the gap in the market that you were trying to address?
Sure. Good evening, and thanks for having me here. So immediately post my graduation, I'm an engineer by background, but took an unorthodox leap to become a mutual fund distributor myself, right? So broadly, as the wealth management industry has scaled, so has the mutual fund industry. And there have been two schools of thought. So the first school of thought has been that in India, most of the customers, if given the right access in terms of platforms, technology and transaction tools, can possibly manage their own investments, make all the right decisions that requires them to create wealth via mutual funds. So this is in fact, last 4-5 years, there have been a lot of fintech startups that have offered these do-it-yourself models under this. Their second school of thought is that a large part of the population in India requires the help of professional experts, guidance to be able to actually stay invested and create wealth. Because mutual funds are quite sophisticated, a lot of products, markets are very dynamic. So who is the person who's going to give the right kind of advice and handholding to help customers create wealth? So Asset Plus has identified that we have always had the conviction that human MFDs cannot be eliminated. So that's been our thought process. And I was an MFD myself and eventually pivoted to providing a platform for other MFDs to grow their business digitally.
Sure. And you've also raised 175 crore rupees, right? If you could sort of take us through how you plan to spend these funds. You know, you're looking to also spend them on new products, right? So what will you be adding to the mix as well?
Sure. So number one, a research document that AMFI had published highlights that for about 15 to 20% of the population to invest in mutual funds by 2047, which is the Viksit Bharat, almost 9 to 10 lakh mutual fund distributors are required. So right now, the industry has just about 170,000 MFDs. One of the primary focus areas for us is to see how can we bring more mutual fund distributors into the ecosystem. So there's a large initiative from our side called Asset Plus Academy that enables to take the word out. This apart, right now we offer mutual funds and we have expanded to term and health insurance to cover the risk protection aspects. But we feel this is the right time for retail investors to consider other products as well. So global investing, especially the ones via GIFT City routes, is something that's very closely in our radar. And we're also evaluating PMS as an offering because beyond a certain stage, as customers graduate to 1 or 2 crores in portfolio size, there's a requirement for them to be able to invest in products that are more niche. So technology offerings will continue to have to scale because right now we have 18,000 MFDs. The goal is to be able to provide the platform for 1 lakh MFDs the next 5 years. So expanding the distribution, strengthening tech, and expanding our product offerings. These are what we have in store.
So you've got those key priorities sorted out, but like you said, you've added health and term insurance to the platform, right? So what share of your distributors are already cross-selling multiple products, and how critical is this to sort of boost your distributor income?
Great question. So we've launched health and term insurance about 18 months back. So as on today, almost 10% of our overall active mutual fund distributors cross-sell insurance products as well. So my personal opinion is that the need for MFDs to graduate as holistic advisors, right, that not just encompass mutual funds, but also are able to advise on term and health insurance is very much required because the industry is evolving quite a bit and so are the customers' needs. So this enables the MFDs to have the entire wallet share of customers in one place and also adds more revenue streams to them, thereby de-risking from the possible revenue disruptions that can happen in mutual fund.
Sure, and you also point out that you work with over 18,000 MFDs, managing 7,250 crore rupees in AUMs, right? How concentrated is this business? What percentage of your AUM comes from your top 10% of distributors, and how do you want to sort of change this mix going forward?
So as a platform and company, we have always been SIP focused because the belief is that SIP is what is the best way for the retail investor to create wealth. And it also has great cash flow predictability for the mutual fund distributor and therefore is what is good for the customer and for the MFD is beneficial for Asset Plus. That's how we have thought about it. So AUM wise, it takes, the scale has started kicking in. So we were about 5 years back, we were at 50 crores. And I think in the last 5 years, we have scaled to 7,250 crores. Percentage of AUM wise, if you see the top 10% of our MFDs will probably contribute to about 20-25% of the overall AUM on the platform. But if you look at the same top 10% of MFDs, the contribution to SIP book, which is 125 crores, will be more like 12 to 13% or so. So we see that the eventual trajectory and as customers' portfolios compounds, the MFDs revenue also compounds and thereby the platform's AUM also compounds. That's how we see this.
Sure, and you said your monthly SIP book is the key here, right? And which is now at 125 crore rupees. So how much of this growth is organic from existing distributors versus new distributor additions over the past year?
So I would say roughly about, say, 75 to 80% of the SIP book has been added by mutual fund distributors who were on the platform prior to April 2025. So, and the MFDs who have come on board in about 9-10 months have added the remaining 25%. So the interesting trend here is a lot of the new mutual fund distributors, the moment they enter the industry, they have a lot of customer interest to manage, and SIPs are usually the best way for them to get their business kickstarted.
Sure. And what about revenues and, what's the path to profitability looking like?
So we've, over the past 4-5 years, we've been completely as frugal as possible because we understand that it's a low margin industry and costs play a very critical role here. So we are only based in Chennai. So we don't have any physical infrastructure. We hire freshers and we have massive L&D investments to train them. So no high cost resources. As much as possible, we are perfecting a low cost model, I would say, an asset light model. So we are not very high cash burn as a business because the operating leverage kicks in because tech as a platform is doing most of the work to service the mutual fund distributors. So with new products being added and expanding our distribution network, we hope to be profitable in the next 18 to 24 months. But we do have sufficient cash in the bank thanks to the shareholders' trust to take us a long way. So we can parallelly invest in growth initiatives as well.
All right, Vishrant, thank you so much for taking time out and being here with us on Startup Street. We wish you all the best on your journey going forward.
Thanks a lot. Thank you very much.
On that note, it is time for us to head into a short break. But coming up next, Secret Alchemist backs $3 million in a bid to give India's fragrance market a clean makeover. We speak to the founder on the other side. Stay tuned.
Welcome back to Startup Street. India's fragrance market is getting a clean makeover. Clean perfume brand Secret Alchemist has raised $3 million in a seed funding round led by Unilever Ventures with participation from DSG Consumer Partners. The startup is betting big on ingredient-led, transparent and wellness-inspired fragrances at a time when clean has become the global baseline in beauty and is now making its way into perfumery. So how big is this opportunity, and can an India-first brand take on global players? Joining me now is Akash Walia, the co-founder of Secret Alchemist. Akash, welcome to Startup Street. Clean beauty, like I mentioned earlier, is now mainstream globally, but fragrance is still catching up. What makes India ready for clean perfumes now? And also, Secret Alchemist started with aromatherapy-led wellness solutions. So what drove the shift to becoming a fragrance-first lifestyle brand?
Firstly, very good evening. Sorry, I'm just under the weather with the voice. But so Secret Alchemist is India's leading clean fragrance brand today. I think what we have seen internationally in the market, clean fragrance is huge in the US. Clean skincare is table stakes in India. And I think with that, clean fragrance is going to be the new normal in 1 year's time. And Secret Alchemist is right there leading this wave of change. We were always an aromatherapy brand, and we still are. In fact, clean fragrance is nothing but a subcategory of aromatherapy itself. So aromatherapy is, very simply put, the art of mixing essential oils together. And clean fragrances have almost 25% of high-grade essential oils in them, along with green alcohol, which makes them clean. And I think that's where we were able to successfully pivot towards a more aromatherapy-based lifestyle brand.
Okay, all right. You know, Akash, Secret Alchemist is backed by celebrity co-founder Samantha Ruth Prabhu. Tell us, how does her involvement help build trust faster in a category like fragrance where scent and emotion matter deeply? Also, if you could take us to the current sales and business growth numbers you're seeing right now.
Sure. So, to begin with, of course, Samantha's alignment with the brand is very, very organic. For Samantha, what is extremely important is everything wellness, clean products, and everything that believes in aromatherapy. I think this is the ethos of what Secret Alchemist today is as well. And I think it is this authenticity of the partnership that we have together is what brings credibility to the brand, and at the same time helps us amplify the trust amongst our consumers with the reach that she has. So I think that's been very crucial standpoint for us when building the brand along with her as well.
All right. Akash, you say you're building high quality, clean fragrances. If you could take us through your price points, how do you balance clean ingredients, performance, and affordability?
So our core alchemy range starts at 1299, and then we have the signature line, which has rare Indian essential oil ingredients, and that is at about a 2999 price point. While this is a middle price brand, the band allows us to use high grade essential oil ingredients. And while we don't want to be a ultra luxury, out of reach brand, we always want to be a aspirational but yet affordable brand. And it is this middle price band that allows us to use high-grade ingredients, yet you reach every part of India today.
All right, so it's a middle price brand, like you said. But Akash, what does your distribution and revenue mix look like today, online versus offline? And is demand still metro-led, or are Tier 2 and Tier 3 cities beginning to drive growth?
No, great question. We are absolutely online-led brand, and today a large portion of our sales come through our own website. And after that, marketplaces like an Amazon or a Nykaa. We are in process of going live with one of India's leading Q-commerce players as well. And along with that, of course, we want that larger presence overall. And that's where, while metro cities form one of the key sales share, Tier 2 audience is actually a close second amongst our top 10 cities as well. There's a large contribution from Tier 2 as well.
Okay, let's talk about the seed round. Where will the $3 million be deployed first? Product innovation, R&D, team building, or distribution? And how do you plan to scale brand presence across India?
So I think a large portion of the funds would be used towards product development and R&D. We are a ingredient-led, ingredient-focused brand to begin with. Secondly, we would use the funds towards team building to increase our team in terms of brand management, marketing, and of course, for product development. And lastly, towards brand building and marketing activities, including, while we continue to be an online-led brand, we want to start building offline experiences, which allows the customer to experience the brand offline, to experience the product offline, and thereby improve our discovery of products.
Okay, you want to take this Indian perfumes brand global. Which markets are you eyeing first, Akash? And what's your India to global playbook? And also, fragrance remains under-penetrated in India. Are Indian consumers buying and using perfumes differently today?
Right, very interesting. So for sure, we want to be the Indian origin brand with global ambitions. I think for us to penetrate India first is extremely crucial. The consumption pattern of perfumes in India has drastically changed. While 5 years ago, an average Indian would have one perfume throughout his lifetime, and it would actually be an occasional purchase. Now, perfumes have become almost everyday staples where people have more than 3 perfumes that they use in a day, one for work, one for going out, or one for their workout as well. And it is this layering and the excessive or additional use of perfumes that is going to drive growth in India across the perfume segment. And with that, we want to penetrate international markets that already resonate for Indian brands, specifically a UAE or some parts of Europe, that also values the ingredients that go into a fragrance and values fragrance as a category itself. So I think that will be one of the first few markets that we will go for.
All right, and we wish you the very best for that. Many thanks, Akash, for joining us on Startup Street today.
Thank you.
And with that, it's a wrap on this edition of Startup Street. For more news and updates coming up on the other side. Stay tuned to CNBC TV18.
पिछले एक दशक में 25 करोड़ देशवासी गरीबी को हराकर गरीबी से बाहर निकल गए।
Well, the budget session of Parliament is kicked off with the President's address. We are just 3 days away from Finance Minister Nirmala Sitharaman's 9th consecutive budget history in the making. From revamped income tax slabs to a brand new labor code, the government has unleashed a slew of reforms in the last year. So what can we expect from Budget 2026? Staying the course on fiscal discipline, sustained infrastructure spending and boosting domestic manufacturing are the key market expectations. Almost all brokerages expect the government to peg nominal GDP growth near double digits. Only Jefferies is expecting nominal GDP growth to be below 10%. Brokerages also expect the government to stay the course on fiscal consolidation. A majority predict a fiscal deficit projection of either 4.2 or 4.3% for FY27. They also expect the government's capital expenditure to rise from just over 11 lakh crore rupees last year to more than 12 lakh crore rupees in this budget. Well, those are some of the expectations that the market is building in. To discuss what we should look forward to from Union Budget 2026 and what the Indian industry is hoping for, we're joined by the top brass at FICCI, Anant Goenka, the president of FICCI, Puneet Dalmia, the vice president of FICCI, and Rashesh Shah, the former president of FICCI. Gentlemen, appreciate you joining us here on the program. Anant, let me start by asking you, last year, the direction of the budget was very clear. It was more focused on spurring consumption, giving tax benefits to the consumer. Do you believe that we're likely to see a continuation of that or a reversal back to more capex?
Yes, from FICCI side, we had a pre-budget survey, and the three asks that are coming out from industry is: one is continued focus on manufacturing, focus on exports, and a continued thrust towards growth with the various FTAs and opportunities that are getting signed, and thrust on infrastructure spends. So these are the three larger expectations that came out of our pre-budget survey. There is overall fair amount of optimism with growth expected to be between 7 and 8%, and the fiscal glide path also to be maintained at the targeted 4.4%.
Let me pick up on those themes that you spoke of that the FICCI survey brought up, and let me go across to Puneet Dalmia. Puneet, in specific next steps now, we've also seen a flurry of activity from the government ahead of the budget, many measures being taken, including, for instance, the notification of the Labour Code, which was actually brought in many years ago, the operationalization of that innovation fund as well, which was again a budget announcement 2 budgets ago. Puneet, from an export perspective, while we've seen these deals being inked, none of them are yet operational. They'll only be operationalized in 2027. That's the EU deal, and hopefully the UK deal will be operationalized in this year. What would you expect on the export side from the budget to provide some more sort of momentum to Indian exports?
I think, the fact that the EU deal has been announced recently is a, very massive opportunity for India. It is unlike other deals, and it's unprecedented in terms of scale. India has just 3% market share in the EU imports. And I think it's a $6.6 trillion opportunity with, where across labor-intensive sectors, also India has phenomenal, possibilities. So apart from scale and growth, it also gives India diversification. I was talking to many of my friends who are already diversifying markets. And, this is a, unprecedented opportunity. Yes, it will take some time to play out. But I think, businesses are built for the long term. And
yes.
I think people will make very serious investments in the supply chain. And finally, I think this is a sustainable deal because it's based on shared values of, democracy, rule of law, and civilizational states. So I think I'm very excited about the fact that this is an opportunity which offers scale, growth, diversification, as well as shared values. So it's sustainable in the long term.
Yes, those are, of course, those are important factors as far as the India-EU deal is concerned, Puneet. But, coming back to the near term, the specific ask that FICCI has made of the government, what would you like to see this budget deliver on?
Look, I think, budget is a statement of intent. Budget is a statement of where the government wants to focus. I don't think, we can expect anything in the immediate quarters, like what will happen in Q1 or Q2. I think government has already done a lot to spur consumption domestically. I think government has reduced GST. We have also reduced income tax for under 10 lakh slab. So I think domestic market is good, and a lot of export rupee is falling, which is making India's exports more competitive. So I personally think that the macro opportunities are, getting created. But just in terms of specifics, I think if government just continues its momentum to implement these trade deals sooner and ensures that the India remains cost competitive, I think it will hold us in good stead over the long term. There'll be some hiccups along the way, which all of us as entrepreneurs have to deal with.
Rashesh, let me bring you in. The ask, of course, of the capital markets is a change in taxation. Whether or not it will happen is a different story at all. Are you going into this budget expecting anything on that front?
No, I think overall, I think the capital markets are in a good place. Of course, FIIs have been selling. There has been pressure on the rupee and all that. But overall, I think last year was a difficult year. But every year cannot be a great year for capital markets. So I think a lot of the investors are absorbing it. I do feel that government needs to, by commentary and by action in the budget, need to bring the animal spirits back. I think the India-EU deal is a great, it has improved sentiment a lot. And along with that, I think in the budget, if the government continues to push, I for one feel allowing the fiscal deficit to slip a little bit by government spending more on infrastructure may not be a bad thing, because that will give it a fillip. And with inflation being low, we can take the risk. Yeah. Of course, the rupee may fall, but I think we can allow that because that will improve our exports. But we do need to get the animal spirits going, and the government spending is a key catalyst for that.
Yes, government spending has been a key catalyst for many budgets now. But, Anand, going back to this animal spirits business, I mean, we've been waiting for the animal spirits to be unleashed for the last several years now. And the government keeps saying that, look, we've done our part. We've cut GST, we've cut income tax. What about you guys? What are you going to do?
Seeing a big shift, I'd say that post GST 2.0 from October, November, we are seeing growth levels in many industries, double digits, strong double digits, 20% plus rates, levels of growth. And as a result of that, utilization of capacities is certainly going up. And I'm seeing a shift clearly towards much higher private capex. So I do believe that that will continue. A few areas that FICCI has suggested to the government that we can do more on. One is continue the momentum on the electronic space by setting up a mega electronics park along the lines of what's happened in China, where the entire value chain is closely knit together. Second is with various wars being led happening in the last year, can we increase spend on defense manufacturing, especially on the technology and research side? So an increased spend in defense. And the third is critical minerals tailings program. Again, critical minerals are very important. We are not naturally very rich on that. So on the tailings, is there some recovery that can be done? And can we have a specific program around that to make sure there's higher recovery?
Well, important points, each one of those. An electronic hub, an electronic park may perhaps be an idea that the government will toy with. We don't know. This has been the big success story. The Apple story has been the big success story for the Indian export sector. But Anant, you talked about defense, and I was having a conversation with the defense secretary, and he was of the opinion and of the view this is going to be, by the way, the first budget post-Operation Sindoor. So a higher defense allocation is expected. You've seen defense stocks rallying ahead of the budget on the back of that expectation. Critical minerals. But one more aspect, and I want to get both Puneet and you to comment on that if you'd like. The nuclear sector, the last budget, the last session, the government passed the Shanti bill. Both the renewable energy minister as well as Mr. Vaishnav have been talking about, micro reactors, small modular reactors. Do you expect measures to push this sector in this budget? A PLI scheme is being spoken of as well. Anant, I'll start with you.
Right. I think it's very timely, particularly with the growth in data centers coming in and suddenly India possibly being short of power just because of the amount of shift towards AI. So this is a great momentum that has been started towards opening up and looking at partnerships on the nuclear side. I think it's still very early in terms of the research technology that is there to really make it live. So whether it will come in this budget or we wait for technology to strengthen. And maybe in about a year's time, we'll see more incentives and goals towards making nuclear happen. I think that is still to be decided.
Yes, that perhaps could be a start, could be made in this budget. We will have to wait to see. But Puneet, any out-of-the-box ideas that FICCI has suggested to the government that you would like to see the government take forward? You know, we saw that jobs focus with the internship schemes and so on and so forth. We had seen the Research and Development Fund in the previous budgets. Any out-of-the-box idea that FICCI has put on the table?
Shireen, I think, there is a lot of the, breakthrough ideas that the government has announced has to find its way on the ground. So, like, I think you just spoke about this R&D budget. I think ANRF has been formed now, and even RDIF, has been formed. And I think it's been headed by a, very strong private sector person. So I think just to ensure that India plays the innovation game globally, a lot of more work needs to be done into how this capital will be allocated, who will be the secondary level fund. So I think just executing on some of the ideas to increase India's R&D spend, which can be linked to national priorities and where we can get solutions which really have tangible impact on the ground, is very important. And I personally think that just some of the things which we have already started doing more of this faster will yield a lot of results. And I think one of that is also just ease of doing business, decriminalization of various codes. It will just unleash animal spirits much more. So I think some of the things just need to be executed deeper and faster, in my view. And I think that will really get India even more momentum, than what it already has.
Rashesh, coming back to you, we've seen the government move away from setting high disinvestment targets, which were then not being achieved. Do you expect anything on that front, any change perhaps, bolder statement perhaps on disinvestment, asset monetization, anything you believe that we could perhaps hear on IDBI Bank, for instance, and even bank consolidation in general, because the finance minister has spoken about it publicly in a conversation with me where she said it's work in progress. Do you believe the budget could perhaps take things forward?
Yeah, I would expect, I think IDBI is on the cards and there has been quite a bit of conversation on that. So something on that lines along with the consolidation and driving efficiency in the PSU banks, maybe also something on LIC, some disinvestment in LIC would also be on the card. So I think headlines would be around that. But as I said earlier, I think what government, earlier you said government has been spending for last few years and the private capex has not come, which is true. But if you look at the drive for fiscal consolidation has also impacted overall growth, especially when the private sector capex has been slow. Exports may face some headwinds in the coming quarters because of US. So I think it's very important right now that government allows the fiscal consolidation to be on pause for some time, start spending money. It might drive yields up a little bit. It might drive rupee down a little bit. But I think it's a worth risk taking because inflation is low and people need some catalyst. And the catalyst will have to be the government because I don't think the private sector is not aggressively investing because the demand has been muted. If you look at capacity utilizations, they are still not inching up. So I think that is going to be very important.
Well, so far, we've seen the government being steadfast in maintaining its fiscal deficit glide path. And we're going to see any departure from that. By the way, gentlemen, there's also going to be another important event to watch out for, which will be the release of the 16th Finance Commission report, which will coincide with the presentation of the budget. What will the tax devolution to states be? That's also going to be a key factor to watch out for. What happens to centrally sponsored schemes? All of that will also have to be factored in as we look at the impact of the budget. Gentlemen, before I let you go, a quick budget poll. Anant, I'll start with you. How long do you think the speech is likely to be? Over an hour? An hour? You're on mute, Anant.
No, I think it'll be over an hour.
Over an hour. Puneet, a little bit more specific.
Over an hour.
Over an hour. Okay,
yeah,
Rashesh.
I think it should be more than an hour. The commentary is going to be very important. So I do hope that she elaborates on quite a few things.
Well, over an hour, that is the FICCI consensus on how long the finance minister's speech is likely to be. By the way, it was a very short speech the previous year, not the last budget, but the budget before that was a very short speech. But of course, over an hour is what FICCI is voting with. Remember, 11 a.m. is when Finance Minister Nirmala Sitharaman will rise to present her 9th consecutive budget, creating history in independent India. Gentlemen, we will tune back in on Budget Day, which is a Sunday, so it's going to be a working Sunday for all of us. But look forward to more conversations then as we decode the fine print of Budget 2026. Many thanks for joining us here this evening. We will head into a break, but when we return, an exclusive interview with Sudarshan Venu of TVS Motor on the India-EU free trade deal. That and more when we get back.
Joining us right now is the chairman of TVS Motor Company, Sudarshan Venu. Sudarshan, thank you so much for joining us. The India-EU FTA talks have been concluded. It will come into effect sometime in 2027. Give us a sense of how does this help global automobile majors like yours, and how does this reduce tariffs on automobiles, on two-wheelers being exported from India to Europe?
Really a pleasure to be with you, Parikshit, on this wonderful occasion of the signing of the India-EU FTA. India, as you know, is the fastest growing large economy in the world, and it's such an exciting place to be in. With the Prime Minister's vision for Viksit Bharat and the efforts taken by the government, we now have access to a lot more countries, to UK, to Middle East, to Australia, to Switzerland, and now to the whole EU trading bloc, which is one of the largest trading blocs in the world, if not the largest. And I think this will only further enhance the strength of our exports and add to more jobs and more growth in the Indian economy. This will benefit many sectors, including ours. I think Europe is a large market mainly for bigger CC vehicles, and Indian companies have been producing bigger CC vehicles, what we do with BMW, Bajaj, of course, with KTM, Hero's working with Harley, and also you see now more exports of two-wheelers into the European market. And of course, with Norton starting production in the next months, really, or weeks, this will help all of us to leverage India as a manufacturing base for the European market as well.
How does the tariffs on two-wheelers being exported from India to Europe go down and vice versa?
I think the bigger opportunities for Indian two-wheelers going into Europe and also for the broader auto component sector, as far as the reduction on the European tariff for the European two-wheelers coming into India, that clarity is a little awaited in terms of the reduction. In terms of Indian two-wheelers going into Europe, of course, like in the case of UK, it was 5%, which now goes to 0. So the bigger opportunity is for Indian two-wheelers going into Europe. I think in addition also, this is more beneficial broadly for the larger industry in terms of auto components, automobiles, and commercial vehicles. So far, the Indian two-wheeler market has been more focused on exports to Africa, Latin America, and now in addition to the larger displacement vehicles where India has already been exporting to Europe. So it is more a question of those duties coming down and also the significant 30+% duties of European vehicles into India coming down, which hopefully will expand the customer base for high-end two-wheelers.
Right. And of course, the CKD tariffs have also come down from 16% to about 8.25% on cars. This is what Maros Sefcovic had told us. Sudarshan, so the CKDs on two-wheelers are also on similar lines?
I think two-wheeler exact details are awaited, Parikshit, but really what we're looking at more is, I think, the expansion of the premium industry and the customer base, because these foreign European two-wheelers are coming into India. But you must also keep in mind that many European brands are also already producing a line of two-wheelers in India. So hopefully this will lead to more of their global production shifting to Indian base, and also for many of the companies in the supply chain becoming part of the global big motorcycle supply chain of the European companies.
Right. One question before I ask you about your results and we end this. How do you see India becoming or Europe becoming a big market for two-wheeler manufacturers in India once this FTA comes into effect?
I think this opens up a broad array of opportunities for various sectors. Two-wheelers is only one of them. So far, two-wheeler exports have been more in Asia, Latin America, Africa, and this opens up Europe further. We already partnered with BMW where the one-cylinder and in future the two-cylinders will go into Europe. The Norton two-cylinder is being produced in India, which will also go into Europe. And this gives a further fillip to that opportunity and also for the auto components and entire sector as well.
Right. My final question on TVS results. The company has reported a 48.6% jump in consolidated net profit to 841 crore for the third quarter of the financial year. And the profit stood at 566 crore. How do you see the results, the major growth drivers, and how do you see the next few months?
Firstly, I think the Indian economy has done very well, supported by government measures of reducing GST and also reducing income tax on the middle class, which was done in the last budget. This has resulted in the two-wheeler industry having its fastest growth in the last 8 or 9 years at over 20% in the last quarter. And I think this industry growth is giving a momentum to all of us. And of course, TVS products have been well received in the industry. So that helps us continue to grow. Secondly, I think some of the African markets are also doing well, and therefore we are seeing growth on the international markets. Lastly, I think India is such a great place to be in with economic growth and a young consumer base that our financial services business continues to grow as well on the lending.
All right. Thank you very much, Sudarshan Venu, for